B2B e-commerce business, that has shown some kind of improvement from around 900 crores. Now it's scaled up to around 1200 crores. And for the year, they've achieved close to around 5,000 crores, which is good. Even the paints business from around 700 crores, it's perked up to around 950 crores or thereabouts. And the losses as well are reducing gradually. So from around 350 crores a few quarters ago, that's gradually come down to around 315 crores. The management goes on to say that based on their estimates, they have become the third largest decorative paint company here in India. As per the exit rate of Q4, and also by capacity, they're more than 21% of the market. The net debt number came down a little bit because some of the rights money did come in. So expect the stock to open up in the red. The positive, though, is that the paints business is ramping up. The e-commerce business is ramping up, B2B e-commerce business, though in fact the losses do continue. But let's hop across to Mangalam. He's tracking a whole host of names, Metro Brands, as well as Honasa. Mangalam.
Well, what's common between both Metro Brands and Honasa is the last 3 quarters weren't very good for them, but now they are seeing signs of improvement. So let's start with Honasa, 13.2% revenue growth. However, that's come at no expansion in the EBITDA. In fact, the EBITDA has declined by 18%. Margins too have come off from 7% to 5.1% with a net profit decline of 18%. That's because ad spends have ramped up and other expenses are higher on account of the distribution reset as well. But what's positive is a 13% revenue growth is higher than the FMCG industry, led by 21% underlying volume growth. Some of the core products of Mamaearth, which is their core brand, growing in double digit, and some of the ancillaries like Dermaco and the other companies doing well for them too. So expect, because the stock has halved, expect some green on Honasa. Metro Brands as well. I'm going with green because after 3 quarters of single-digit revenue growth, they've reported double-digit revenue growth, 10% growth on the revenue, and that's reflected in their margins as well, which have improved from 27% all the way up to 30%. The net profit is lower, largely because of a tax credit in the base quarter. The company said the EBITDAs improved due to better cost control and reduction in losses in the Fila segment, and liquidation of old inventory of Fila has been completed in the 3rd quarter. So going forward, operational performance is likely to improve with revenues improving on account of new brands that the company has been launching.
Okay, all right, Mangalam, thanks for that. Well, Ramco, these numbers are disappointing for the past quarter. Yes, the street was bracing for a weak set of numbers, but this is even weaker than what the street was working with. And the problem is top down. So the top line itself, they degrew by close to 4%. Some on the street were estimating a volume growth of close to around 3 to around 6%. So that's clearly disappointing. And what's even more disappointing is it seems they're facing pressure with regard to pushing out their volumes. Because after a while, I've seen that Ramco in their core market has actually underperformed the industry with the degrowth on the volumes front. So that's disappointing. And that's why the revenue, EBITDA margins, all of them are a miss. Now, the PAT number, that took a harder hit because that degrew by close to around 74%, while the EBITDA number was down by close to around 23%. Because they've commissioned capacities, the finance cost as well as the depreciation, both of that went up. However, the management has stated they're on this plan to sell their non-core assets, and because of that, you've seen the debt gradually come down from close to around 5,000 crores. Now it's at sub 4,500 crores, and for the past year, they have monetized close to around 460 crores out of that promised 1,000 crores, and they're saying the remainder will be done by July 2025. So that deleveraging plan is working as per plan. The outlook, though, is good because they are saying that prices have gone up both in trade and non-trade segment, and that's what will bode well for profitability in the coming quarter as well. So the stock starts off in the red, and we'll have to see whether or not the street wants to look ahead and brace for better numbers ahead. But let's hop across to Vivek. Vivek, tell us about GMR Airports as well as Power Mech.
Well, good morning. GMR Airports, late last evening, the company declared its results. Now, it was operationally a better quarter, but one thing that the street will be wary of is the fact that debt has increased both on a year-on-year as well as on a sequential basis. Looking at the numbers, revenues higher by close to 17%, aided by almost a 9% increase as far as passenger traffic volumes were concerned. EBITDA up 23.2% on a year-on-year basis. EBITDA margins are quite steady, almost 180 basis points higher on a year-on-year basis. But higher finance costs, higher depreciation, higher tax expenses, all of this led to a loss on the bottom line, a loss of close to 237 crore versus a loss last time around of just around 120 crore. So this is something that the street won't like. However, what is it that the company has said? The company has said that going forward on account of the revised upward tariffs for the Delhi airport, the company expects better aero revenue, better overall profitability and cash flow generation across its airports. Now coming to Power Mech projects, it's a strong finish as far as Q4 FY25 is concerned. Revenues higher by 42% on a year-on-year basis, EBITDA higher by 44%, margins too very steady at 11.6% versus 11.5% on a year-on-year basis, and profitability higher by 54%. The company is yet to upload its investor presentation, but remember, at the end of Q3, the order book was quite strong, in excess of 57,900 crore. Expect a green on both of these stocks. GMR Airports, however, on account of the red figure, may see some booking.
Okay, got that. Thanks very much, Vivek. So green on both of those. Let's go back to Manglam. Manglam Concord, how did it fare?
It's a muted performance, and the street was expecting no less out here as well, because we already had the volumes disclosed and they were a far distance away from what the company had earlier promised, 18 to 20%. The overall annual volume growth was actually 8% itself. Board has approved a bonus, so that may keep the stock afloat in today's trading session, but by and large, nothing really to write home about in these numbers. A revenue decline of 1.5%, EBITDA declined by nearly 12%, which meant the margins compressed. The net profit declined by 2%. The reason why the net profit declined lower than the EBITDA was because of a change in the depreciation method in the third quarter. If you look at both the segments as well, Exim, the revenues grew just about 3.4%, with the margins contracting 250 basis points. Even the domestic business, the revenues declined by 9%, with a 50% decline in the operational performance, and as a result of which, I expect the stock to see some red.
Okay, all right, got that. Manglam, thanks very much. In fact, at 9:50, we will be in conversation with the management of Concord as well. Sanjay Swaroop joins in from the company to talk about the outlook, whether FY26 can be better than the way they've ended FY25. Well, with that, let's move on to Sudarshan. Sudarshan's watching out for GSPL. How was the quarter, Sudarshan?
It's a weak set of numbers from GSPL, mainly on the back of sharp drop in volumes. Company has reported volume decline of 11% on a sequential basis and 23% fall it has seen year on year. Coming to the headline numbers, profit was down 48%, revenue has fallen 9%, and EBITDA has slipped more than 35%, and margin has declined. It has seen a sharp decline. It has come at 52.1% against 73.8% that company reported in Q3 of FY25. Also, operating numbers were impacted by other expenses, which have seen an increase and have almost more than double. It has come at rupees 50 crore versus 20 crore in this last quarter. So I'm going with red for GSPL.
Okay, all right. Thanks, Sud, for that. Let's quickly recap our list of stocks to watch. The ones that have positive news flow or positive earnings are ITC, Metro Brands, Honasa Consumer, GMR Airports, and Powermech Projects. Stocks with negative news flow would be Sun Pharma, Grasim, Ramco, Container Corporation, and GSPL. It's an even split today between the green and the red. That's the equity list, stock list for the morning. Let's find out what's happening in commodities and cryptocurrencies, I would imagine. Manisha is joining in. Manisha, beyond crude and gold, Bitcoin was catching the headlines overnight. Good morning.
And it continues to do so. So it'll be a second straight day where we're looking at all-time highs continuing in case of Bitcoin. So 112,000 is done. Well, actually, Bitcoin is gained up by 16% in the month of May. A very strong increase in institutional ownership, corporate adoption, and JP Morgan allowing clients to buy digital currency have all been very, very supportive factors for this one. Well, actually, when you look at the Asian markets right now, perhaps cryptos is the only thing that's trading in the positive, because we've seen crude oil prices heading for a weekly decline. There are statements that OPEC and allies will increase production for a third straight month in the month of July. We anyways have been looking at higher production from US. The inventories have been on the higher side as well. So all of those factors weighing onto the markets. After that very strong run that we saw yesterday in gold and silver, well, that also has gone in for some profit taking. So off its multi-week highs, and same is the case with copper aluminum, which was trading on the higher side for the last couple of days, have also seen some decline. A lot of uncertainty still into the markets there, and the focus clearly now is in the U.S. trade deals with various countries, while the markets over the weekend will also watch out for the U.S.-Iran nuclear talks. So ahead of that, some bit of a profit taking in Asia.
All right, Manisha, thank you very much for that. So that is, of course, commodities in focus. We're going to take a quick commercial break here. The management of Deepak Fertilizers joins us here on the other side. Fourth quarter earnings in focus. We'll also have Siddharth Khemka with us for some fundamental stock conversation.
Welcome back. Lots and lots of earnings have been coming in. So let's straight away get to our first corporate conversation of the morning. The company on our radar is Deepak Fertilizers. The growth has been fairly steady, actually. Just to recap the numbers, I mean, I'm looking at Q4 revenues up 28%. The margin has declined by almost 300 basis points. So we have to, get into that. Profit is fine, up about 20%. And as far as the year is concerned, it's been a fairly good year for Deepak. Top line growth of 18%. Margins have expanded to 19%, and the profit has doubled this year for Deepak. So let's find out what the trends are like and what the outlook is. Mr. Sailesh Mehta, Chairman and Managing Director at Deepak Fertilizers, is with us. Mr. Mehta, good morning. Thank you very much for joining in. So, let me just start there to understand what's been happening, because in your, your fertilizer business has been doing very, very well, but the mining chemical segment and the pharma specialty segment, that's where, perhaps one can argue that growth has not been as optimal as you would have liked to see. Fourth quarter trends, let's first go into this margin compression. What is a more sustainable level of margin? You're at 18% EBITDA margin in Q4. What are the factors at play, and what is a sustainable margin we can expect this year?
Sure. So broadly, we have now evened out at 18-19% margins. And as we move towards more and more of specialty, we will see a margin expansion coming in. And in terms of sustenance, if one were to see what has transpired, what has brought this kind of a result, and as we see an increasing trend, fundamentally there are three things strategically at play and which are now getting more and more validated. Number one is the beautiful alignment that we have with the India growth story for all of our three businesses, whether it is in terms of coal for power sector, or limestone cement for real estate or infrastructure, which is where the mining chemicals is beautifully aligned. Then when we come to fruits, vegetables, horticulture, which is where our crop nutrition business is beautifully aligned. And similarly, as India grows into the pharma sector globally and the specialty chemicals, that's where our industrial chemical group is very beautifully aligned. So the first aspect strategically which we are seeing, which is bringing sustenance, is this beautiful alignment with the India growth story. There's a very good tailwind.
No, absolutely. Long term, no doubting that. But it's just the short term issues that we have to kind of go by. Mining and pharma, let's focus on these, because here the growth has been either low or slightly patchy. So if you could tell us, in FY25, your mining chemicals growth was just about 3%. It seems that there were some capacity constraints with respect to nitric acid. Now tell us, how much will this business deliver? What is the top line growth? What is the kind of margin profile? Because even here you have your premium or specialty products, like I think this product called LDAN, if I'm pronouncing it right.
Yes.
So let's talk about mining. What is the volume growth you're expecting in the business this year, and what is the margin at which it will operate at?
So we are almost reaching 100% capacity utilization, and which is where the new project that we have taken up at Gopalpur, where we are adding a substantial, capacity that will kick in, by H2 of next year. So that is going to be coming in a very timely fashion. Having said that, you're right that in terms of this shift from commodity to specialty, that is also something that is going to help us, shore up the margins as we go forward. Fertilizer side, as you're aware, we have virtually moved over from commodity NPK to crop-specific NPKs. And that is getting very, very positive feedback from the marketplace. In case of ammonium nitrate also, as rightly so what you have pointed out, we are the only ones who make the whole range, melt, high-dense product, low-dense product, right up to the hospital grade, which gives us, the segment-based strengths.
Sure. Mr. Mehta, just a question. Since obviously it is the move higher up on the value chain on specialty products that's going to drive your, your margins and your overall P&L profile. You're at 22%. I think out of your total revenue, 22% came in from specialty products as of the end of last year. What is the scale up you're expecting this year? And I go back to my margin question then. You ended last year at 19% EBITDA margin. As the share of specialty products goes up, can the margin go to 20, or is 19 the best case?
No, so there is now going to be a faster move towards specialty, because the proof of concept is now already settled. The market has accepted, and there is a very good positive, I would say, push in terms of acceptance of the specialty products. So now the journey will be faster. We have also done something else from a restructuring perspective, which is going to get much more focus on specialties. All the businesses now we have unwind and restructured into separate corporate entities, where the focus, right from the board member to the lowest officer, is going to be specifically on that project to deliver these specialties. So the journey that we see now on is going to be a lot faster. And in a sense, because different products will have different premiums, I'm not in a position to precisely say, but it is overall going to, give a very positive fillip to the margins.
Okay, all right. Hi, Mr. Mehta. Good morning. Nigel on this side. A couple of numbers before we let you go. As you've told us in the past, you're debottlenecking, you're getting the ammonia plant, you're getting the technical ammonia plant as well up and running, which will help your growth. What is the debt in the books currently? What is the capex plan you have for this year? And by the end of this year, what kind of your debt will you have in your books, sir?
Sure. So broadly, as you are aware, we have taken up projects now further enhancing the capacity of ammonium nitrate and further enhancing the capacity of acids. Both the businesses where we have been there since the last 40 years, and both are riding on the India growth story. And that total investment would pan out to be close to around 4,500 crores. We are, I would say, a year and a half away from commissioning. And in terms of the debt, it's around 3,500 crores out. We brought in a reduction with the last year's cash, positive outflows, where we brought in a reduction of 120 crores. And going forward, since all of this debt is tied up, and including the interest cost has been incorporated in the project kind of thing, we don't envisage any issues as far as
But the debt goes up, right? To what level?
That would go up to 4,500 crores at a peak level. Of course, it will come down as we see the older projects now contributing more and more. Recently, we have also done CCD capital infusion of 800 crores. So that is also bringing a much better balance sheet in terms of the debt equity for the projects and other needs.
Okay. All right. 4,500 crores. Got one number. Second number, what about the revenue growth for the year in percentage terms? What will it be?
So we are seeing a very even keel. And, as we see things pan out, as we are all aware that predictions are good rains. So from that viewpoint also, all our businesses will get a positive flip. So we look forward to continuing the same positive trend.
So mid-teens growth for the year.
Yes, I think it's in the right direction, as you say.
Okay. All right. Thanks a lot, Mr. Mehta, for joining in. We'll hold you to these numbers. Wishing you all the best for the coming year as you focus more on specialized versus commoditized products across your segments.
Indeed.
Good speaking to you.
Thank you.
Well, let's get in Sid Khemka, Head Research, Motilal Oswal Financial Services, who joins on the show. Hi, Sid. Good morning. Well, a lot of numbers we've got overnight. From the Nifty pack itself, you had Grasim, mixed set of numbers out there because core business is struggling, but the newer businesses, the losses have come down. So your view on that, if you could tell us?
Yeah, good morning, Nigel. Glad to be on the show. I think, yes, if you see the core business, both the core segments reported weak performance led by lower than estimated profitability in both VSF as well as the chemical segments. Standalone EBITDA has declined almost 60%, which is almost 40% below our expectation. Operating profit margins was at 2.5%. Versus estimated of 4.2%. What we see is that the chemical prices continues to remain low, the caustic soda prices, and that could impact the Q1 numbers as well. And hence, we believe that the core business would not contribute meaningfully in the coming quarters. However, if you look at paints business, that is something that the market is excited about, and that is where you see that losses have come down. The business within 6 months of launch has become the third largest decorative paint brands with the 5 of the plants started operations. The 6th one will be starting commercial operations, which is in West Bengal in the first quarter of or the first half of the current financial year FY26, which is again estimated to contribute to the overall growth. So currently we are expecting that they are about 24% of the decorative paints market capacity in India. And once that turns profitable, that could be a good contributor to the profitability. Hence, bearing the core business, which continue to remain sluggish, we believe that paints is something that could drive the stock going forward. Today, I believe stock could be under pressure and not much to cheer off from the core business. But from a long-term perspective, paints is something that the market will definitely track.
Got that. So we'll keep an eye out on this one. Sid, good morning. Good to have you here as always. Just a quick word, Sid, on what's happening with the broader market and some of the stocks which saw large moves. And I want to just get a word in on BSE. It's the best performing NSE 500 stock over a 1 year period. We put out the story, and of course others then put out as well, that the regulator is basically considering NSE's request to give them Tuesday for their expiry. So we don't know if it'll happen or not, but that was the story. Stock was down 4% yesterday. Any thoughts?
Yeah, Prashant, yeah, good to see you. So I think if you look at that is one stock which has consistently outperformed. We have been having a positive view. Q4 numbers were stellar. Revenue grew about 7%. And what we are seeing is that in the derivative segment, they have been gaining market share. And they have this key expiry day on Tuesday, where I think a lot of action is happening. And with NSE applying to the regulators to shift their expiry to Tuesday, that could be a big negative if the regulators were to accept. In the past, we have seen that with any changes that NSE does, BSE is also proactively moving its or plans to move its own Sensex expiry. Maybe if Nifty is moved to Tuesday, Sensex could be moved back to Thursday. So that, I think, market will take a look at it. But otherwise, what we see is that the core business continues to do well. We see that the last regulation where the SEBI clearly came out and said that each exchange will have only one benchmark indices on a weekly expiry. That is a very favorable regulation and augurs well for BSE's robust growth in the derivatives segment. So we continue to have a positive view. Yes, valuations are a bit expensive. Any correction and clarity on NSE's expiry plus the Sensex expiry going forward will give more clarity on the way forward.
Okay, all right. That's BSE always in focus. And let's see if we get new expiry days now across the two exchanges. We'll take a break. Sid, stay on. We'll have more questions in just a bit. Quick break. Come back. We'll also connect with our technical experts, Sudarshan Sakhani and Srikant Chauhan, joining in on the technical setup.
Welcome back. Let's just quickly look at the GIFT Nifty. I think there is still, 7-8 minutes to go for the pre-open session. So 50 points higher on the GIFT Nifty still. So is this going to be with the expiry behind a different market, a little different, more cleaner? Let's get that perspective in terms of trade. Sudarshan Sukhani and Shrikant Chauhan are joining us with what they make of things. Gentlemen, good morning. Sudarshan, yesterday morning you were saying that it's not very clear. I mean, it's confusing signals out there. Maintain that view, Sudarshan, or what's the thing to do as far as indices go first?
Yeah, good morning. See, that sense of confusion remains, and the market resolved itself at least yesterday on the downside. Now, once the Nifty breaks significant support levels, it's difficult to get bullish and say, okay, today we are going up. In a choppy market, there will be days when the index comes down, and there will be days when it goes up. But then that becomes unpredictable. So we are now in a position where it's not easy to suggest the direction in which there will be a sustained move. So if you have some intraday trades, market has a sharp dip, then buy and then take profits on any small rally. That's the only trade that is possible. The best trade, of course, as usual, is not to trade. But since that advice is very seldom followed, look for sharp dips and exit immediately.
Not doing something is also doing something, it is the hardest thing to do. Because point taken, Sudarshan, and I think good advice. Shrikant, what about you? What's your recommendation?
Good morning, Prashant. Yeah, I think the way the market has broken its important support at 24,700, 650, I'm of the view that now the market is going to take some time. It is going to consolidate. It is correcting to the larger rally that we saw from the lows of 24,000 to almost 25,000. So it's a correction to that, and the overall sentiment, if we consider, and the macros, then they are not supportive. So I'm of the view that at higher levels, we need to be careful. Around 24,800, 750 sort of levels, we need to be careful. And in case if there is any correction, then close to 24,400, 24,350, we should look for taking some contra bets in the market. And we should look for taking some mixed bets or mixed view sort of strategy in the market.
Okay. All right. Sudarshan, you go first then with regard to stocks. What's in your radar?
Well, it's primarily still buying because there are mid-caps which are giving good signals. Now, whether that sustains is something we don't know, but it's worth looking at them. Atul is a buy with a stop under 7,080. REC has gone through a deep correction. It's moving sideways and it's giving signs of an uptrend or a breakout. Let's see. It's a buy with a stop under 393. United Spirits, another stock, similarly is an outperformer. Look to buy it at a stop of 1540. I have one intraday short, and that's a disappointment. Colgate, which was part of that FMCG pack, which was suggesting an up move, suddenly dropped yesterday. And that brings it into an intraday short with a stop above 2435. But I would still focus on the mid-cap buying.
Okay, all right. Yeah, Colgate was a result disappointment. In fact, we'll discuss that with an expert in just a bit. But Shrikant, let's come to your stocks as well. What are you doing today?
Good morning, Survi. Good morning, Nigel. Yeah, I think as Sudarshan said, I am of the view that we should look for taking those bets which are really showing some strength or major weakness. So in that specifically, Divi's Laboratories looks good. It is above its important resistance level, and it has spent a lot of time, close to 6 months, below the levels of 6,300. Now it is comfortably trading above the same. So I'm expecting this stock to do much better in the near term, and we can expect the levels of 6,800 or maybe even 7,000. So with a target of 6,800, we should look for taking long bet on Divi's at current levels with a stop loss at 6,400. And the other stock on which we are bearish is Wipro. IT stocks are under pressure and they are finding difficulties to sustain at higher levels. So from current levels, Wipro is forming some negative continuation formation. Here around 245, 246, look for creating short positions with a stop loss at 248. And we can expect 230, 35 sort of levels in the near term.
Okay, all right, got it. Thank you very much, gentlemen, for giving us all the trading calls. We'll come back to you a little closer to market opening. Quick break right now. Come back on the other side. We'll have the pre-opening raise. And then as promised, that discussion on stocks like Colgate as well as ITC. What is the fourth quarter earnings print telling us? Abneesh Roy of Nuvama will join in. Okay, welcome back. We've started getting the first of the pre-open rates, and it's a downward start, about 100 and 120 points low. But let's see, it's only 1-2 minutes, so we'll figure out how it stabilizes. I just want to look at rates on things like ITC, some of the key big stocks that posted numbers after market hours. ITC, for the time being, is actually starting positive, 1.7% on the higher side. The other is Sun Pharma. Sun Pharma starting lower. With Sun, the issue is that their global specialty business as well as the US business, it's been subpar, below expectations. So the India business has done very well for Sun. That's Sun Pharma. And ITC, the problem is with the FMCG business and the market and the margin pressure there. Cigarettes is fine. But I think some of the commentary that I've been reading since morning is pointing out that this palm oil pressure on, especially on the FMCG side, maybe it'll start, waning. So that should work well. Stocks up. Speaking of ITC, let's straight away go to Abneesh Roy and discuss some of these trends. Abneesh, morning and happy Friday to you. So Colgate and ITC both on our radar. Let's start with ITC. What did you make of it? I think cigarettes, everyone is saying it's fine, the kind of volume growth and overall, 5-6% growth. But this FMCG pressure, what did you make of it?
Yeah, happy Friday and thanks for having me. So ITC, what we see is some more time correction can happen, but the worst is behind from a stock perspective. We had highlighted that the stock could come under some pressure because of two reasons. One, of course, palm oil is impacting the FMCG part of the business, which you highlighted. Our sense is worst is behind there. From the top, there is a almost 20% kind of a correction in palm oil cost. It is still inflationary, but my sense is from Q2, a lot of the food companies which were severely impacted because of palm oil, for example, BKG, Britannia, Nestle, and ITC also will see improvement starting from Q2. So we are behind the negative news on that. Second, Godfrey Phillips has been growing much faster in cigarette. Here, I would not like to be really disappointed from an ITC perspective because the ITC is almost 3/4 of the market. If you are that high market share, you can never grow faster than some of the smaller players if they are doing something different. So in Godfrey Phillips, if you see, it is not a pan-India player. They have become aggressive in the 10 rupee price point in terms of trade incentive, just like Campa Cola is doing a higher trade incentives. That is impacting other beverage companies. Similarly, Godfrey Phillips, which is, say, 1/5 the market share of ITC in cigarette, they have become aggressive in the 10 rupee price point, not at the customer level, at the dealer level, more incentive.
What's your target price very quickly on ITC? I mean, it's also market positioning, right? Stock hasn't done too much. What's your target price, Abneesh?
Yeah, we do expect almost 20% upside in the next 1 year. Maybe 2 months of time correction can be there. But yes, the worst is behind for ITC.
And that's the optimism I think the stock is reflecting today. Okay, very quickly, let's move to Colgate, which was quite a disappointment. But I think you still have a buy call on it, don't you, Abneesh?
Yes, because we remain positive on the new MD's interventions which she is doing. If you see, the market share loss is not there. Dabur saw -5% in oral care in Q4, while Colgate saw -2%. Our sense is two issues are there. A very high promotional intensity is there. Our sense is in Q2 that will start reducing. Second is urban slowdown at the lower end is impacting all FMCG companies. So that is the issue. Colgate is seeing very high growth in the premium and in the rural also it is doing well. So our sense is from Q2 the recovery will start and H2 you will see strong numbers from Colgate. So this is just a temporary blip of the urban slowdown and very high competitive intensity in the toothpaste, which will reverse.
Okay. All right, Abneesh, quick short chat today, very focused on these two stocks, but quite helpful. Thank you so much for joining in with the quick notes over there on both ITC as well as Colgate. Now we're at about 9:05, so I'm just checking the pre-open rates. It's settled. Now the Nifty is actually up 25 points, in sync with how a lot of the other Asian markets are trading. So that's what we have. Sensex changes around the corner. Come June 23rd, we'll have two stocks moving out, two stocks coming in. Let's go over to Vivek to understand what the names are and more importantly, the flows impact. Vivek?
Well, good morning. Absolutely right. Well, came as a bit of a surprise. The changes generally happen on a Friday. That's what they announced. But this time around, they were announced on Thursday evening itself. So this is the June 2025 reconstitution. As far as the Sensex is concerned, adjustments will take place on the trading session of 20th June, effective 23rd June. So, which are the two inclusions? Trent as well as Bharat Electronics enter the Sensex. As per IIFL Capital, Trent will see inflows of a little over $300 million and Bharat Electronics will see inflows of over $350 million. On the other hand, what makes way? Nestle will exit and expect to see outflows of close to $220 million. And IndusInd Bank, that also will exit the Sensex. We'll see outflows of close to $130 million. Expect some reaction on all of these stocks in today's trading session.
Vivek, thank you very much for that. Sid, any implications of these changes, in your opinion? And more on which of these names?
Yeah, because I think, so if you look at, definitely, if you look, both of these spaces are doing well, especially if you look at the defense space. For the first time, we'll have a dedicated or a focused defense company in a benchmark index. So that goes on to show that how the sectoral mix is changing in the large caps for India. So definitely a big positive move for the entire defense space, not only for BEL, getting it included in the Sensex. And I think the structural story continues to be very positive, and we remain positive on defense. Trend, I think, yes, some sluggishness in number, but overall long term we remain very positive. We see that again, aggressive growth plans across its segments, consistent growth, same store sales growth did slow down in the previous few quarters, but again we believe that there is a huge potential long growth runway, and with the store expansion, they're all set to achieve the high growth numbers set out going forward. So positive on both BEL as well as trend from here on.
I think the pre-open has ended and is mixed basically. Sid, thank you very much. Good speaking with you here on CNBC TV18 this morning. So not directionless actually, like overnight Wall Street. If you look at what the Nifty and the Sensex have ended at the end of the pre-open session. Now the RBI board is scheduled today to review their FY25 balance sheet and to decide on the dividend payout to the Government of India. A huge interest here. Sapna is joining in with details. Sapna, put this in context for us.
Hi, Prashant. So yes, street expectations are extremely aggressive on this year's dividend. So the estimate that's doing the rounds is anywhere from 2.5 lakh crore to 3.5 lakh crores. Some of our colleagues are also indicating that maybe it could be around 4 lakh odd crores as per brokerage reports. However, we also need to look at two aspects. One, how much is it that the government has kind of estimated, factored in the money already? That's one. Second, also, what happens to the economic capital framework? Are there going to be material changes to that? Because RBI has already indicated last week that they have reviewed the framework. So the first point, of course, is that 2.56 lakh odd crore. It's a combined head inclusive of PSB dividends, FIs, and of course RBI dividends. So if you do all these subtractions and estimations, around 220, at least 220 to 225, I think is what government is factoring in. Anything over and above that is going to be the real boost to the exchequer, because this amount they have already factored in. If it's lower than this, then obviously the story is very different. Then there could be questions raised on the RBI's balance sheet and, how their profitability has been over the past year. What are the headwinds that they have faced? That's one aspect. Second, and also the ECF thing. So both these things are what we have to watch out for. So in case it's anything above 2.5 lakh odd crore, that would not be a small boost. That would be pretty good. And this will have implications for the bond market as well, for the liquidity as well. There's a wide expectation that OMLs will start tapering off, and so much of liquidity will come in the banking system, which is what the RBI has been trying to ensure. And last but not the least, because of Operation Sindoor and the way the situation is on our borders, it could just be possible that maybe some request has been made to the Reserve Bank of India to make sure that some additionality is given.
Okay. All right, Sapna, thanks very much. We'll leave it on that note. Let's see what that final number indeed looks like and whether it is significantly above 2.5 lakh crore rupees. Let's go back to our technical experts with some final trading ideas and calls. Sudarshan, so 910, what's your call?
REC. I consider buying REC with a stop under 393.
Okay, so REC is a buy for Sudarshan today. Quickly revisiting some of the stocks. Let's go back to some of the consumer names. Metro Brands and Honasa. I think we've got Manglam joining in. I'm just checking how they are in the pre-open. Metro Brands is actually up about 4%. Honasa is also not bad, about 3.5% higher. Manglam.
The reason why both of them are higher in pre-open is because there are signs of improvement in these numbers. If you look at it, both stocks have corrected a bit from the highs, more for Honasa than Metro. And, the last 3 quarters, they've not shown much in terms of revenue growth. The fourth quarter, things seem to be turning around because of the strategic changes that the company has been undergoing over the last few quarters. So let's start with Metro. A 10% revenue growth that they've reported in the fourth quarter has led to margin expansion as well. The EBITDA margins have moved to 30% versus 27%. And going forward, they believe that margins are likely to improve because a lot of the Fila liquidation, the old inventory of Fila has been done, and they have newer vectors of growth in the form of Foot Locker, Fila, as well as New Era. On Honasa, the problem was revenue growth wasn't coming by, and the company had undergone an inventory liquidation with the distribution reset. Now we are seeing early signs of some recovery, 13% growth in their overall revenue, though we haven't seen an improvement in the margins. So operating leverage was something that the street was anticipating that hasn't come by, but good revenue growth is a start. More importantly, some of their core products in Mamaearth, which is about 70% of Mamaearth's portfolio, has grown in double digit in their key, channels. And the non-Mamaearth businesses, Dermaco has done about 100 crore in offline distribution, and all their newer brands have grown 30% as well, with an underlying volume growth of 21.2%, with increased presence in physical stores. So we'll watch out for how both these stocks perform in today's trading session. My sense, they should see some recovery from the lows.
All right, Mangalam, thanks a lot for that. We'll also be joined by the management later on, Metro Brands, in the next 20 minutes or so. For the time being, let's focus on Ramco Cements. It appears the street is extending the long handle and saying maybe the next quarter will be better because the numbers are very, very disappointing, but the outlook seems positive. If you take a look at what they reported in comparison to what we were expecting, the volume degrowth for me is the biggest worry. It's telling you that competition is ramping up out there because they've degrown and they've underperformed the industry, and this is after a while out there because they've been consistently outperforming the industry. That's what led to the top-down miss, revenue, EBITDA, as well as margins. The problem is the PAT as well did compress big time because of higher depreciation and higher finance cost. So that was the reason, because they've commissioned facilities as well. What's good, though, is that the net debt number from around 5,000 crores, it's come down to sub 4,500 crores. And they had promised the market that they will sell their non-core assets amounting to around 1,000 crores. Almost half of that, 460 crores, has been done. They're saying by July 2025, the remainder will be done. That will be good news, actually. But the outlook seems to be good from here on. And that's why the stock is getting away with just a 2% cut, because the prices have improved in the trade segment by 30 to 35 rupees and in the non-trade segment by around 60 to around 70 rupees. So here's the street is looking ahead, but the volume degrowth is something that is a little bit puzzling and a little bit disappointing on that front.
All right, Nigel, thanks very much for that. Market open coming up, just about 60 seconds to go, and then we will get going this morning. I don't think there's very much, at least large or directional on the Nifty, on the indices, and it's kind of flattish, slightly higher. Let's see if you're able to pick up on that. But this week the market's not done very much. As we sort of, start to report on these Friday markets, remember, the week ended last Friday was spectacular. So that's the backdrop that we've got to see what happened this week in. So 24,600 on the Nifty, 24,630 on the Nifty. It's about 0.1% higher. The Nifty Bank is up about 0.9. Nothing. It's basically just about holding on with this very, very, very small green change. 1,140 stocks are higher. It was very early to look at it, but for what it's worth. Mid-cap index is up 0.1. Small-cap index also will come up on your screen, and it'll give you a sense. Again, nothing. 2-point change. It's almost as good as unchanged this morning. Heat map on the Nifty, and then we'll get down to stocks. So it's largely in the green, so about some 7-8 names in the red, but bulk of it starting in the green this morning. Surabhi.
I would say Honasa, very well spotted by Manglam, because indeed, look at the stock, 9% higher. It seems that it's been an absolutely bombed out stock. So perhaps the market's saying that is this, a sign of things turning? That's definitely catching the eye, probably the stock of the morning. But let's talk about the Nifty now. Nifty is very, very quiet. The newsmakers here on earnings. ITC is also up, like Abneesh was telling us. Even here, the market's taking a view that the worst of this palm oil inflation is probably behind, so the FMCG business should pick up. And cigarettes is holding steady, so 1% up on ITC. Sun Pharma is a disappointment. US business lower. Specialty business revenues lower than expected. Cautious commentary talking about even the revenue guidance for FY26 is lower than what they typically put out for previous years. Sun Pharma is a result casualty. Reddy's is actually lower. Cipla is too. So all of pharma is starting lower. Other than that, Mahindra and Mahindra, ONGC, ICICI Bank, these are the other stocks on the lower side. Maruti Suzuki also on the lower end of the screen. So let's see what's working. Grasim is responding well after the fourth quarter print, 2% higher over there. ITC I've mentioned. Trent and BEL, both of these stocks, by the way, make an entry into the Sensex, remember. They're up and about today, 1.5% to about 1% up on these names. Eternal, Adani Ports, Infosys, those are the kind of names. The Bank Nifty is absolutely undecided. SBI is on the higher side. ICICI is negative. And HDFC Bank is also completely flat, not getting any directional cues. Reliance, your big names like Reliance, about 0.25% up. TCS, it's absolutely, indecision is pretty much the story today. Nigel, but Sun Pharma from the large cap space, Sun Pharma is still down 4%.
Well, that's right. And the reason that Grasim is up is because the street seems to be saying, okay, the VSF business, which is the fiber business and the chemicals business, is not doing too well. But at least the losses in the new business, which is the paints, as well as the B2B e-commerce business, out there the losses have come down from around 350 crores to around 315 crores. So they seem to be liking that. But otherwise, plenty of stocks actually from the broader markets that are moving around. Power Mech, good set of numbers. Stock is flying away. Just pull up the intraday chart out there. The stock is doing very, very well. HPL Electric, another stock that's bursting away actually. The sales have come in higher by close to around 15%, and there's strong margin expansion. So big move is what we're seeing out there. Centum Electronics, that's another one. I think that's up close to around, 12-13% or thereabouts. So big move out there. A few stocks actually are building on to gains that we saw yesterday as well. So you have Emcure Pharma, stock is now up close to 10%. You have Cosmo First, that one as well is up and about in today's trading session. And remember, these stocks, they did well even towards the end of yesterday's trading session. So solid move is what we're seeing on a couple of these names. Pull out Reliance Infra as well. I think they had organized, they had announced a tie-up with one of the leading companies globally. And that one, in fact, was moving yesterday as well with high volumes. For the time being, more or less flattish as we speak. So flattish start with a mild negative bias in the broader markets, guys.
Absolutely. 1,300 stocks are lower and about 800 stocks are higher at this point in time. Vari Energy is down 6%. It's the number one volume-led sort of loser on the NSE right now. So 28.24 on Vari. Look at the volumes. Over 500,000 shares already traded. BSE has undergone a corporate event, I think, right? So 23.53 on BSE. That's Bombay Stock Exchange. There you go. So that is Bombay Stock Exchange. Sun Pharma is down 4.5%. I'm not sure if there is any news flow here.
Yeah, Sun Pharma is on earnings.
Okay.
Earnings being very patchy, especially the US business, the global specialty business, all of it has been below expectations.
So 5% lower here on Sun Pharma. Premier Explosives, 10%. I think we highlighted that, but it basically has had a one-way kind of a move. And from 350, in about 10 days, it went up to about, almost $600. So 550 on that one. Coming off a little bit. Container Corporation, you'll hear from the management, is down about 2.5%, 2.6%. GMR Airport, again, numbers 2.5% lower. This Premier Energy, 3%, as a solar company, 3% down, 1,052. Deepak Fertilizer, you just heard from the management, is down about 2%, 1,335, and so on and so forth. So, there's more, but volumes are kind of lacking beyond that. On the upside, I think like yesterday, the number one volume-led gainer is Garden Reach Shipbuilders. Garden Reach is up another 3.5% after yesterday's near 12% move that we saw. So 28.65 on Garden Reach is what you've got going. It's an all-time high on that one. Power Mesh, I don't know if you highlighted.
Yes.
11% on that one. Honasa, I think we did highlight 12%. Trent is another one. JBM Auto is up about 6%. HPL Electric is up 14%. It's got large volume, so 553. And Cosmo First is another one. Cosmo First was up 20%, limit up by close yesterday. It's a bombed out name, but this morning after yesterday's 20, it's up another 12%. That also reported numbers recently, 2-3 days back. So, that's again coming up very, very sharply. So that's, some of what is moving as far as the market open is concerned. Mahesh Patil is now with us. He's CIO, Aditya Birla Sun Life Asset Management Company, with what he's making of things. Mahesh, thank you very much for your time. Good to have you here. Before we get to markets, let's just address the one situation, which is with regards to Indocent. As a fund manager, Mahesh, what's your sense? How do you think about this, basically? I'm not asking for a view on Indocent per se, but do you think after what it has gone through, someone credible at the top will be able to quickly, correct things and get the bank back on growth trajectory as many are hoping to, or this is now going to be more prolonged? Just your thinking on a situation like this.
Yeah, good morning, Prashant. So I think in the banks, I think the most important thing is the two important things. One is on the asset quality side, okay, which is a paramount important, and second is in terms of the solvency. So if you look at it in a bank, okay, it could have some issues on the asset quality side. It could be temporary, it could be cyclical in nature. And as long as the bank's balance sheet is decent enough, the capital adequacy ratio, in spite of taking the losses, okay, which needs to be taken, is good enough. I think there is, obviously the stock would react, okay, to this thing, but finally, I think there is no really run on the deposits. I mean, that's another important thing, okay, which needs to be looked at. Retail depositors, what is the confidence? As long as the overall capital adequacy is still fine after taking over the losses, and the deposit side, okay, they're able to hold on depositors. I think if there is a change in management and leadership, okay, that becomes again for investors to look at it at afresh and see what the new leadership has in store in terms of taking the bank, okay, to the next level. What are their plans in terms of stabilizing, first in terms of the asset quality issues, but also more in terms of the growth path, which are the areas they would try to look at, and what will drive the ROAs of the bank to a reasonable level. I think these are the factors, I think, which one would look at, especially whenever a bank or any of the financial services company goes through a kind of a crisis situation.
Absolutely, and let's see what finally comes out of it and how quickly they can get the house back in order. Mahesh, morning, great to have you on the show. So I want to talk to you about the one sector, actually the only sector that's managed to stand out in the last 2 odd weeks, and that's defense. And therefore also, I mean, even I was looking at the tally for this week. Actually, defense is the only sector, the Nifty Defense Index is the only one that's up about 1 to 2%. Otherwise, the market's not finding too many legs to run on. Is that a concern on the overall scheme of things? I mean, the fact that this up move beyond 24,000 is becoming narrower and narrower. And beyond defense itself, what would your advice be, given the way the stocks have already run up now? Is it, is it becoming a little too hot to handle, perhaps?
Yeah, so if you look at the defense sector, a year back, okay, or prior to that, we saw a huge amount of rally in the sector in anticipation of, good order inflow coming into the sector, and there was a focus on the government in terms of sourcing more from domestically, which led to the initial leg of rally, and the stocks really went very high, valuation zoom, and then we have seen a correction in the last 9 months. Since June, July, we've seen a correction in defense stocks and also PSU stocks in general. And post that, I think we've seen, again, if you look at PSU as a basket, right, because most of the defense stocks are in the PSU basket. PSUs are also started to now kind of do well. In some of the cases, the valuations were looking good. But defense in particular has seen a new lease of life again, coming back on the recent conflict, what we saw between India and Pakistan, but also kind of realizing that India needs to secure its defense resources, okay, and looking at the geopolitical risk. there is a feeling that allocation to defense, okay, which has been kind of over a period of time, you see the percent of GDP, it is still fairly low. That could potentially see an increase in the subsequent budgets. But near term, I think clearly there is emergency procurement, okay, which is likely to be there, which can mean that you could see order inflows for a few companies, which could buoy them up. So I think.
But are the valuations? I mean, we understand that there's perhaps still significant ordering potential, but the valuations, Mahesh, what do you think of that?
So I think valuations, again, have been the same, but as long as, again, it boils down to each company in terms of the order pipeline. I think sometimes we see in defense that it can be lumpy. So I think going back only from a short-term perspective in terms of the emergency procurement, I think that could be a misleading. But companies structurally which have got a long runway and have got larger projects or strategic projects, okay, which can see continuous investments. I think in those companies, I think the multiples could probably be better than what it was in the last, say, 1 year or so, because the visibility there is now better. But I would say that stock specific, I think it has to be looked into it. And while when there is a broad macro theme, everything moves up. But I think there is a credible story, I think, which is there from a at least from a ordering side and a more long-term sustainability in the sector.
Okay, all right. Hi, Mahesh. Good morning. Good to see you in. What about the entire renewable energy space? How interested are you out there? You know, because there's plenty of uncertainty. It was a fancied sector just around 18 to 24 months ago. And now suddenly some of these stocks, they seem to be out of favor. And you have some unfavorable news every now and then. Vare, for example, overnight what's happened with regard to the passing of the bill in the United States. That one's pulled back, though the numbers and the outlook that the company is giving is very, very strong. So from this pack, what do you like?
So the renewable space, one is the utilities or the power producers. I think those are the companies where their valuations had moved up earlier. I think we have seen a correction over there. I think that's the space which looks now more reasonable in that sense. The equipment guys, the suppliers, whether it is the suppliers of the panels or the cells, they have seen a large improvement in the order book, but more importantly in the margins because of the, mainly the export orders and some amount of demand supply mismatch which was there. I think our concern there has been that while the near-term outlook is good, profitability is very, very strong, there's a lot of capacity which is coming up in this sector, right? Because of whenever you see large margins and good order, you see more players coming up. So in the next couple of years, you could see more capacity coming in the space. And also some of the tariff barriers, okay, which have been put on China and the US is providing this opportunity to make supernormal profits. We think that could be at risk. So I think in these sectors, especially the equipment guys, we are a bit worried because there could be pressure on margins, okay, because these high margins and these high ROC seem to be unsustainable at this point in time.
Okay, so some caution there perhaps on some of the renewable energy stocks. Got that, Mahesh. Thank you very much. Good conversation as always. You have a good rest of the day and we look forward to connecting again soon. Thank you very much. Well, that's a view from Aditya Birla Sun Life AMC. Markets actually doing quite well, cruising along right now. 100 points higher. Nifty is up about 0.5%. Midcap index also up about 0.3%. So it's turning out to be a good Friday so far. Let's keep it with the corporate conversations then. The next company on our radar is Metro Brands. Now, the company reported a healthy revenue growth for the fourth quarter. EBITDA has also improved quite a bit. Let's talk about these trends and the outlook with Mr. Nissan Joseph, Chief Executive Officer at Metro Brands. Mr. Joseph, thank you very much for joining in. So really a good quarter. I think you've got 10% revenue growth. There's a significant margin improvement. Margin is up to over 30%, 30.7% EBITDA margin. So let's start by understanding the broad demand structure and trends, because while the fourth quarter has been looking good, if I look at the year as a whole, FY25, I mean, you had guided as much as 12 to 15% growth. Ultimately, the revenue growth was around, I think, 6-7%. How do you gauge demand sentiment, the mind of the consumer right now? And what do you see ahead in FY26? Is it, how will volumes do, or will you have to eke out revenue growth with some pricing uptick? What's the sense?
Well, Surabhi, good morning, and thank you for having me. I think we were very pleased to see the upturn continue through Q4 of this year. You're right, when you look at the whole year consolidated, it's been a challenging year. You know, we had a lot of absent wedding dates going back to Q1, Q2 that really set us back a little bit. We also had heat waves. We had the election distraction. So there was some headwinds to overcome through the first part of the year. The good news is on the second part of the year, we were able to recover quite well. As you mentioned, we were up 6% on a consolidated basis by the end of the year. But more importantly, I think what we've shown is our ability to have great financial discipline through the year. Though it was a tough year, as you know, that we posted some very good growth that exceeded our revenue growth in EBITDA that exceeded our revenue growth. And, we came in at the 30% range. We always guided that we would be at the 30% range. While the overall top line growth wasn't what we wanted, I think the recovery was good and we're headed back.
But what now, sir? The question is, what now? You've done 10% revenue growth in the fourth quarter. Do you think you'll build on that in Q1, Q2? What's the kind of top-line expansion we should expect? If you can't give us visibility for the whole year, maybe for the first half, but essentially, is it going to be more volume-led or is it going to be pricing-led?
Well, I think it's going to be both a little bit. We're not raising prices significantly. So any growth you see is actually coming from volume growth in the business. And we're pretty pleased as to how that's trending. We remain committed that we'd get back to the 15% growth rate on an annualized CAGR basis. So I think we have all the indications that we should be headed to that direction. You don't always recover and jump right up to that number. But as you can tell, the indicators the last 2 quarters have been very positive.
Okay, all right. Hi, sir. Morning. Good to see you, Ben. So at least a double-digit growth is what we can work with, right?
I think the indications are all in place, Nigel, that we should be headed in that direction.
Okay.
But more importantly, I think the other numbers that are important to us is the EBITDA and the profit, which we're starting to trend back at the 15% mark, which is we guide to the mid-teens on PAT. And then, of course, the EBITDA, we guide to about the 30% range. And all those metrics are coming in line.
Okay. PAT margins at mid-teens, EBITDA margins at 30%. Got that. Give us a few more details then. What kind of store additions will you be looking at for this year? And if you could help us out with some commentary on e-commerce. That seems to be plateauing a little bit. I think it contributes close on 10-11% of your total mix. Where is that headed?
Yeah, so just talking about store growth, I think we continue to be open and aggressive on opening the right stores at the right profitability. We're not going to open stores for the sake of hitting a number. We're going to open stores as and when they make sense for our portfolio of different brands that we have. Our e-commerce business continues to do well. However, as we all know, you can drive a lot of growth in e-commerce if you want to be discount-led, which we don't want to be discount-led on e-commerce. For the year, e-commerce outpaced our regular growth. We were up 20% in our e-commerce business. So that remains healthy for us, and we like it because it's at a healthy pace that comes where it's brand enhancing, without destroying any brand salience at the same time, is a profitable business for us. So it's one of those balances that you have to do as you want to grow the e-commerce business. You have to decide where you want to lie with that e-commerce machine. And also, we've started exploring quick commerce, and like what all the press has been reading, we find it to be very polar in terms of to the big cities and not as much in the smaller cities. So we continue to explore that as well.
Mr. Joseph, hi. Good morning. So online is about 8%. That channel is about 8% for you?
It's a little north of 10% for us.
Okay, a little north of 10%. Now, in the past, we've spoken about premiumization, right, across the board. Is that happening? Because if I look at, price-wise sales mix on a quarter-on-quarter basis, maybe quarter-on-quarter is just too, it's kind of, the data is jerky, but over 3,000 rupee products is about 54% of your sales mix. It was 56% the last year. It's broadly been between 52 and 54% or so. Could you give us some idea about this, how this is likely to trend up?
Sure. We continue to see the premiumization trend. But what you're saying, and you rightly pointed out, Prashant, is the fact that Q4 is our end of season sale quarter, right? And that's when we use that period of time to clean out any old goods that we have, end of season lines. And that typically mutes your ASPs, right? So what you're seeing, that 2% delta, is really more of a reflection of the business and the cyclical nature of the business, as opposed to anything that's showing a premiumization trend fading off.
Mr. Joseph, can you tell us a little more about the Foot Locker expansion this year? What are you expecting from some of these additions? Fila as well. When does Fila break even? How much will it add to your top line? some sense from these brands.
Right. So, Surabhi, let me take that one at a time. When you talk about Foot Locker, I must be honest and say that the BIS rules that came in has been a little bit of a deceleration of our growth. We would love to grow more Foot Locker stores, but we wanted to make sure that our brands, our suppliers had settled into the BIS supply chain, which is all new to a lot of people. Now that that's behind us, we will continue to open a few more stores this year. And as we overcome the BIS issues and the factories get certified and or up to speed, we should continue to see that Foot Locker acceleration into the next calendar year as well. On the Fila front, I'm very relieved finally that we have gotten out of cleaning up all the inventory for Fila, and we hope to start the journey of opening stores for Fila later on this year.
Okay, all right.
So in just in terms of break-even timelines, the losses have been coming down. What about break-even and overall contribution from Fila? Can you give us some sense of what you are expecting this year?
Sure. Yeah, it's not a question of contribution, because what we've always said was we're going to take the first couple of years to clean up the brand, number one. Number two, the second phase, which we're in right now, is to reposition the brand. So when you move to repositioning a brand, it is not about a percent of sales. It's about, are you pulling the right levers? Are the right assortments coming into stores? Are they selling well? And we've started launching Fila into our Metro and Mochi stores, and we're starting to see the green shoots come there as we anticipated on the year where we reset the brand, right? So that's going on track. And now we also, the next phase would be to start accelerating the opening of stores, and then also accelerating the amount of Fila that we carry in our Metro Mochi stores as well.
Okay, all right. Just a quick question with regard to Fila, Foot Locker, as well as New Era. How much should they contribute as a percentage of your revenue mix? And say in the next 3 years, how much should they contribute?
Yeah, so I think today that contribution is extremely low, right? It'll be single digits. I think you will see that accelerate simply because it's on a low base. From a growth standpoint, it'll be significant, but it's not like we're not growing our other banners as well, right? So we are growing Metro, Mochi, Crocs, and Walkway. We're growing all the banners. So it's not that it's going to jump up and become a double-digit contributor overnight, not because it would have been underperforming in our mix. It's just that the rest of the mix is not stagnant either.
Okay, all right. So a smaller contribution as of now. But, there's that buyout talk of by Dick's Sporting Goods of Foot Locker. Does it change things for you?
It really does not change anything for us in our arrangement and our commitment to growing the Foot Locker brand in India.
Got it. All right. So that's out of the way. And what about Fila? You didn't give us a definitive time by which when it turns around. Most of the inventory has got done, that we're sitting on in the third quarter itself. So when does that turn profitable?
It's not a question of timing it on turning around, Nigel. This is the year we reposition the brand, right? So it's a journey. It's not a milestone that you accomplish and say, okay, now we're done. It's a journey. It's going to be a constant journey to build that brand. It'll accelerate as we go through this year, and it'll pick up its own momentum at the pace that we anticipate it to.
Okay.
If you could tell us, because you're promising more store rollouts now, both Foot Locker, Fila, etc. I just want to understand how much money you'll need to put to work as you open more of these stores.
Yeah, so the capex is not cheap, as you know, but the good news is, fortunately for us, we have a significant war chest when it comes to cash at hand and cash to invest in growing our business. So that is not the concern. We're more concerned about getting the right locations that sets up the brand to be successful in India at the right metrics financially to ensure that it's not dilutive.
No, we just need to understand, absolutely, sir, full confidence in your capabilities and your team's capabilities. Just need to understand that from your cash, what is the total cash level right now? How much is going to be deployed towards these store openings? And then perhaps subsequent quarters, we'll talk about the break-even timelines for those new stores. But just some sense.
Yeah, so, we have a sizable war chest. The number changes every day, but it is in the hundreds of crores that we have at cash at bank. So that's not the issue. And as far as it being a significant dent to that, it's not going to be a significant dent to that, as you can do. A store would take anywhere between 2 to 3 crores to open up between the fit outs and the inventory costs. So, it's not a significant factor that we say, what's it going to do to our cash at bank? And, we continue to generate free cash flow as we go through every quarter.
But how many stores will you open this year? We didn't get that number.
Yeah, and it's because, we're not fixated on opening the number of stores. What we're really fixated on is opening the right stores at the right prices. So we'll open as many stores as we can find in the country with the real estate. As you know, the real estate rents have been rising. So now
I think last year you opened 70. This year, will it be as many, fewer, or more?
It should be more.
It should be more. Got it. At least we got some color on that. And final question, ad spends as a percentage of sales, what is it at? And since you're going to be driving growth, where does this number head to?
Yeah, so right now it runs about 3 to 4% in our company. And I think that's a very good question because I think the time has come for us to take a look at that and see how do we invest in the marketing, in the ad spends to ensure that we continue to solidify our existing brands and also build the brands that we've recently acquired.
Just last question, Mr. Joseph. These three brands which my colleagues were asking about, these shoes are made where? They're made in India? They're made outside India?
It's a mixture of where they're produced. So if they're produced outside of India, they're produced at BIS certified factories. But a majority of that is being produced locally now.
More than 50% of these are being made here locally in India.
50% of Fila and Foot Locker combined, yes.
Got it. Thank you very much for joining us. Good speaking with you, and good luck with your business as we look ahead. Thanks very much. That's Metro Brands. Stocks up about 3% or so. Now, PI Industries also reported numbers. Well-watched company, has been a long-term wealth generator. Fourth quarter, though, was a little tough. And more importantly, the guidance has been a little muted as well. We have Mr. Mayank Singhal, Vice Chairman and Managing Director at the company, now joining us on the phone line. Mayank, good morning. Great to have you with us here. Prashant, this side. Could you, I just want to start with that conservative guidance for FY26, single-digit revenue growth guidance. Could you give us the construct behind that guidance? What are you seeing out there in the market across your segments?
Yeah, good morning. Thank you for having me. I think just if you look at the industry over the last couple of years, the overall agchem industry has been on a negative growth rate. If you look at all the large big companies, including last year, the top 20 companies all were in the negative. PI was the only company in the top 20 companies which had a double-digit 19% odd growth. So if you look, PI is already starting at a high base, followed with this year where industry was to see a certain turnaround. But once again, there have been strong headwinds, both coming from the agroclimatical situations and crop pricing, and now certain other issues around tariff. Given that scenario, we do believe that the coming year, again, the industry overall is not looking to grow aggressively, but we definitely see positive shoots coming out in the H2 part of the year. So if you look at PI, we have taken that guidance based on the high base, based on the continued 2 years of challenges the industry has seen and is expected to see going forward. But if things turn better, we expect to do better.
No, absolutely, and maybe it'll come through the push, perhaps the revival, etc., comes in the second half, as you said. But if it does not, is it possible, Mr. Singhal, that we actually see flattish growth, no growth, even slightly lower growth compared to what you've done in 25?
Well, let me be honest, it's too early to comment on that because at the end of the day, industry dynamics do have an important role, specifically if you're playing at a scale and size that we are as a part of the industry value chain. Yeah.
So it's possible. It depends, right?
It's possible. It could be possible on the positive side, it could be possible on the negative side, to be very honest, right?
What about margins, Mr. Singhal, if you can give us a sense?
As you would see, we've already given a guidance of a margin, and we would continue to be able to manage the margins if we put that out, given looking at the dynamics of the industry.
Okay. All right. Hi, Mr. Singhal. Good morning. Good to see you. Nigel on this side. One bright spot last year was new products, and the contribution, I think, went to high teens. How much can it contribute to the overall agrochemical CSM exports? Last year, I think it grew on a lower base by close to around 30%. So for this year, what are you factoring in?
Well, looking at that, we continue to further and continue to grow that at the same pace rate. And obviously, as you know, the new products as they come in, they have their own time cycle of ramping up. And if the industry cycles pick up, they tend to ramp up faster, so that ratios could change for the better.
Okay, all right. So that number then could head, if it's going to be growing at a faster pace than the overall business. So, the new products could contribute close to around 20%, say, in the next 2 years?
Yes, that's what we anticipate, somewhere around there.
All right, great. Let's talk about the smaller part of your business then, the pharma revenue. That's perked up to around, I think, 85 crores or thereabouts. It's not making too much of money. For the year, I think you did close to around 220 crores of revenues from the pharma business. For this year, what kind of a number are you working with in terms of a growth?
If you look at the pharma business, as you know, we've acquired these couple of assets and capabilities. And as you would have seen, we've acquired a great leadership team, which we're building up across the world, given the biotech environment. and looking at where we stand, we are expecting that this could be the year where we start seeing some green shoots. We've been able to acquire some interesting customer bases, and I'm sure, been confident that we'll be able to give a good growth rate for this business, at least in the 30 plus 40% areas.
I think the growth for the pharma business is much more, right? For this year in the near term?
Yes. Yes.
F26, you're guiding for a 75% growth?
Yeah, that's right.
And at what revenue scales then will this start turning profitable? Because back on the envelope suggests that for this year, you'll be closer to around 400 crores, maybe 370 crores or thereabouts. At what revenue number does it turn profitable?
We believe in the next couple of years, it will start showing positivity, and that's where we are.
Ballpark 500 crores?
Yeah,
does it turn profitable?
Yeah, that's right.
Mr. Singhal, in pharma, do you expect a significant improvement in margins going forward?
Well, there are two parts of the pharma business right now. Yes, if I look at the contribution margins are pretty good and will improve there, but at the same time, we are investing heavily in building capabilities and resources to scale this up. So, it's a hockey stick issue right now. In the beginning, as P has always done, in the past, if you look at a contract manufacturing business, 8-10 years, we've constantly been investing. And when scale hits, then we're able to actually take that aggressive growth rate. So for that, the front-end investment in system, process, people, infrastructure is what's going to be putting that challenge for now in the short term. But I'm pretty confident in the next 2-3 years, you will see that effect coming up.
But the focus is going to be contract research, development, manufacturing. I mean, that's essentially the thrust of the pharma business from here on.
Well, it's a part of the CRDMO play. It's just not the contract research and manufacturing, which is in the pharma world, yeah. But where we are leveraging our strong capability in science and chemistry and scientific knowledge.
What about biologicals, Mr. Singhal? If you can give us a sense of, I think that's about 20% of your revenues in FY25. Again, here you're expecting better growth going forward.
Biological has been always a passion, is a part of our purpose, of putting a reimagining healthy planet. And as we believe today, going further in the ag space, agrochemicals and biologicals are going to go hand in hand. We've been not in biologicals as of today, but we've been doing biologicals over 25 years. We believe we'll be the leading company in biologicals in India in the very near future. As a part of this strategy, our passion for biologicals, we recently, as you know well, last year acquired Plant Healthcare. Plant Healthcare has got a unique platform technology based on which we are looking to take biologicals to the world, with having setups and distribution partnerships across the world in the US, Mexico, Brazil, and certainly in Europe, and further expanding that back and bringing these products and innovations into India. So we do believe biological is going to be one of our front runners, and we expect to see good growth coming from it. As you would have seen over the last 3 years, we've put our focuses on it in India. We've been doing more than a 25% plus CAGR growth, and continued on this pace, if not more, at a global rate, we would be able to put a differentiated capability in the biologicals at a world platform.
Any inorganic growth we should brace for this year?
Well, as you know, the balance sheet of the company is strong. We're sitting with surplus cash, anything that is complementary given the environment in the areas of our focus, and can create scientific and scalability and leveraging our existing capabilities would be, which are opportunities we're constantly evaluating.
So you're on the prowl?
Always looking. Nothing wrong with that.
Should we hear about something in this fiscal since you're looking?
Well, I don't know whether I can say that, but I'm always looking whether fiscal or whether it's what. But we will always look for what is right.
All right, Mr. Singhal, good speaking to you. Thanks a lot for joining in. Looking forward to chatting up with you more often. Well, for the time being, we'll slip into a short break. But on the other side, we have Sanjay Swarup of Concord, who's going to detail their quarter four numbers. Welcome back. Well, markets are booming away as we speak. We're at the high point of the day. Big moves is what we are seeing, in the markets, and the broader markets as well have seen a good recovery. And I'll tell you what, one positive today is, as I highlighted earlier, we would like to make a higher high. And that seems to be the case today. The last few trading sessions, we've been making lower highs. So that's one positive on the Nifty itself. But as promised, Container Corporation of India, that's the stock on our radar. They've reported actually a very muted performance. Even the past year's performance was rather muted. To discuss what went on, what's the way ahead, we're joined by Mr. Sanjay Swarup, the chairman and the MD at Concord. Hi, Mr. Swarup. Good morning and good to see you, sir. First, let's focus on volumes. Could you give us the realistic EXIM as well as domestic volume growth target that you have for FY26? I ask you this in the backdrop that last year, well, you all guided for high teens. You ended up with high single digits. So realistically, what can you guide for this year?
Yeah, good morning. Actually, we are having a very good demand in this financial year. We see very stable volumes in EXIM, imports as well as exports. And similarly in domestic also, there is a very good demand, and especially in bulk cement, and then rice is there. And tiles traffic, we are having a very good demand. And apart from that, food grains are also there in domestic. So we have worked out the forecast for this year, and I will like to give a guidance of 10% growth in EXIM and 20% growth in domestic. That will be total growth of 13% for overall for the company. And this is a very robust demand. And seeing all these demands and how to meet with these demands, we have embarked on a very good capex also for this financial year. Last year we have spent rupees 810 crores on capex. This year we will be spending rupees 860 crores actually on capex, and maybe mid-year we will have a review and we will scale up also.
Okay.
Primarily, this will be used for purchasing of new containers and new container rakes and setting up of new terminals. So we are giving a big infrastructure push for the company.
Got it. Okay. All right. Just focusing on volumes then, sir, what is your market share according to your expectations? And also, the hope was that the DCF connections at Mundra, that would jack up volumes. Why is that not happening?
See, DFC connection to Mundra is definitely giving us good volumes. And now in this financial year, we are expecting that even Nhava Sheva will also be connected on DFC by December 2025. Of course, we will feel the impact only in Q4 of this financial year. And we see a very good volume growth on Nhava Sheva stream also. Mundra, of course, is giving us very good volume growth. And we have been able to divert lot of traffic from road to rail as a result of the timetable trains that we are running from our MMLP at Dadri to Mundra.
Okay. And your market share?
Our market share actually on a pan-India basis, if you see, it will be around 58 to 60%. And one thing I want to add is we have gained the market share without sacrificing our margins. We have been consistently able to maintain EBITDA level of 24 to 25%, which is very good in logistics field, because normally in logistics it is in single digit.
All right,
so despite maintaining the EBITDA, yeah, we are able to give increase the market share.
All right, sir. So you'll be able to maintain your margins at these levels, right?
Yes, we will be able to maintain our margins also, and we will increase our market share, as well as I am very sure that we will be able to achieve the guidance of overall 13% growth in this financial year.
Okay, all right. But realizations, they came in at multi-quarter lows in the second half of the year. What is causing this kind of unusual pricing pressure?
No, actually, I will not call it a pricing pressure. It was not a pricing pressure. It was a strategic decision for the company to pick up some traffic volumes. And now we are okay. And if you see the overall EBITDA margins of the company, you will be seeing that for the financial year, we are quite close to 24-25% that we have been there for so many years. So there is no pricing pressure on us, and we are, serving the niche segments, and we have a tie up with big corporate houses. So there is no pricing pressure on us, frankly speaking. Basically, we get our customers, we get our volumes based on our service levels. We give a lot of emphasis on service levels, and that is appreciated by our customers.
Mr. Swaroop, sir, overall question on this long-awaited completion of the dedicated freight corridor. I think there's some reports indicating that maybe the western arm could be completed ahead of schedule. Maybe we see some traction in October. Just give us your estimates on how much of a boost will railway get once the DFC is fully operational, and more importantly for you, can you give us some sense of volumes, the implications for your business if the western arm, at least of the DFC, gets commissioned ahead of schedule in October this year?
See, officially we have been told that Western DFC will be commissioned up to Nhava Sheva. That will be completed by December 2025. So I have been reading some media reports that it may be completed ahead of schedule, but that will be a welcome sign for us. And we are fully geared up. We already have our 4 depots on Western DFC. 5th one is coming up near Ahmedabad. So all in all, we will have 5 depots on Western DFC, and we are fully prepared to cater to the increased running, increased traffic that we are expecting in Western DFC. If to answer the second part of your question, when the Western DFC is commissioned, we cannot expect that overnight there will be a spurt in traffic. It will take at least 1.5 years to stabilize. And I am pretty sure that the rail coefficient at JNPT, which is at present below 20%, within a span of 1.5 years of commissioning of Western DFC, it will double.
So, sir, okay, I mean, give or take, whether it's October commissioning or December, we'll see. But give us some sense of projections. I mean, how will your volumes change in calendar year 26, or let's say FY27 would be perhaps a better measure once the Western DFC stabilizes, as you're saying? What should be what's the numerical implication that your investors can look forward to?
See, this year I'm giving guidance of 10% in growth in EXIM. Maybe next year, if I give guidance for FY27, maybe this 10% may become some in the range of 17 to 18%. That is the rough estimate I can give you.
Okay. All right, Mr. Swaroop, a couple of more factors that I want to clear out. What is the LLF that is expected in FY26? And what's the status with regard to the disputes with Indian Railways?
I would like to clarify, there is absolutely no dispute with Indian Railways. It is our administrative ministry. We are working under Indian Railways. There is absolutely no dispute at all. Okay. And secondly, as far as the LLF is concerned, it is fully sorted out, and whatever LLF we have been paying every year, it will be around same level, because there is growth of LLF by 7% every year as per the formula. But at the same time, the land which we are not using, we are surrendering back to railways. So we will be maintaining around the same level. LLF number will be around the same level.
Okay, all right. Final question. We cannot let you go without asking you this. Since you're guiding for better times ahead, Mr. Swaroop, is a divestment on the corner? Because that was a big trigger from a stock market perspective.
I cannot answer the...
Have you heard about anything, sir? Any communication has come?
That is a policy of Government of India, and whatever directives we get, we have to follow that. I can only tell you this much.
Okay. All right, Mr. Swaroop, we'll leave it on that note. Thank you very much for joining us and giving us a sense on how the business is progressing. FY26 should be better than 25, and 27 maybe even better once the western arm of the dedicated freight corridor is commissioned. Well, that's Concor. Back to the markets, and markets are cruising along nice and steady, almost a 200-point rally on the Nifty. So it's turning out to be a really good Friday morning. There we go. And lots of mid-caps also bouncing around 0.5% up on the mid-cap index. Let's put the spotlight on some news. Ekta is tracking Sun Pharma. While the market's doing really well, it's not been such a great morning for Sun Pharma because of the fourth quarter performance and the commentary going forward. Ekta, tell us why is the market a little disenchanted with Sun this time?
Well, yes, definitely. It's besides the numbers, that's what the street is disenchanted with. So, for example, they are looking to invest $100 million in terms of additional costs on their specialty products. Plus, their R&D expenditure is going to go up to around 6 to 8% of sales. The FY26 guidance is around mid to high single-digit top-line consolidated growth. This is versus earlier years of around high to low double-digit growth that they've generally guided for, high single-digit to low double-digit growth. And they have mentioned that it is because of the uncertain environment that they're facing on the regulatory front, on tariffs. So as of now, they don't have clarity. Besides that, no EBITDA guidance which has come through. So there is uncertainty which is, on all fronts except for especially for the guidance. Now, if you look at the geographies as well, US sales $464 million, Street was anticipating over $500 million. Global specialty sales in Q4 were $291 million. There were some estimates of over $300 million, $310, $315 million. So that's the reason why there is some amount of disappointment which has taken place in terms of the numbers. Otherwise, in terms of the operational performance, it was an in-line quarter for Sun Pharma.
Okay, all right. Thanks very much for that, Ekta. So that explains the negative 3% move on Sun today. But back to stocks that are on winning ways, and Power Mech is definitely one of them. Stock's been up almost 12, 13%. Yeah, 12% right now, as we're seeing it. This on the back of what looks like a very solid fourth quarter. Vivek is back. Vivek, remind us about the numbers and the performance.
Well, that's right. What we have to keep in mind is as far as most of the infra companies were concerned, remember H1 was very muted in terms of execution. So despite a good order book, a lot of the companies face significant execution challenges on account of lack of labor as well as the election-related disruption. But what's actually transpired is that most of the infra companies, as far as H2 is concerned, especially in Q4, have managed to end the year on a very strong note, especially when it comes to execution. So when it comes to Power Mech projects, look at the numbers. Revenues in this particular quarter higher by 42.5% on a year-on-year basis, a little over the 1,850 crore mark. The EBITDA higher by over 44.2%. Cost of materials, despite going higher, has been more than offset by the operational efficiencies that the company has shown. EBITDA margins on a year-on-year basis up 10 basis points. That should be seen quite positively, and profitability higher by over 52%. On a year-on-year basis, again, profitability higher by 42%. Remember, the company is sitting on a very strong order book as well. One portion of the order book, remember, is from the MDO, which is the Mining Development Operating License as well that the company enjoys. So overall, it'll be interesting to see. We're still awaiting the investor presentation, but the order prospect pipeline as well as the order book at the end of Q4 is something that the street to watch out for. Overall, a good operational performance is leading to the stock up move.
Almost at a new high. After the short dip that we saw recently, Power Mesh there. Vivek, thank you very much for that. 200 points now on the Nifty. And, this is the expiry got done yesterday. There are two things. One, of course, is the expiry itself. So that Thursday expiry, we've seen big swings, market yanked up, yanked down. Yesterday was down. It's a bit of a cleaner run. The second is this is also the week before the monthly expiry, which is next week. And, the week before usually typically tends to be a little subdued. There is also some correction, etc. At least that's been history. And then the market finds a bit of a trend. The original trend, which has been on the way up. Is that essentially what is happening? I think one needs to see. But it's very, very strong gains now. So 24,800 is back on the table after yesterday, intraday, the market breaking the 20-day moving average. So this is looking very good. We have Vinay Rajani, Senior Technical and Derivative Analyst at HDFC Securities now joining us. Vinay, good to have you here. Thank you for your time. So what's the trade here, if any, on the indices and then specific stocks?
Yeah, good morning. So Nifty found support at 20 days EMA. Yesterday we saw a nice recovery from the lower level post 2 p.m. and today it is continuing today almost 200 points rise in the Nifty from the lower level. So a nice recovery, nice sector rotation is going on. I think the bias is positive. However, 25,000 is a very strong resistance. So overall we are into the range of 24,500 to 25,000 range. So till that range holds, we can say that markets are into consolidation, but the primary trend is clearly positive. Once we see Nifty crossing 25,000 on the upside, then immediately we can see 400, 500 points upside. So stock specific sectors specific, there are many opportunities that one should trade. Nifty, no doubt today it has already registered a recovery of 200 points, but one should look at the stocks rather than Nifty index. So IT is the index which looks very promising to me. So after consolidation, it has given fresh breakout. So there are opportunities in the IT stocks. One can concentrate and generate some alpha in the trading.
Any specific names here?
Yeah, so Coforge is one of the stock which we like from the IT space. It is one of the strongest stock from the IT space. So Coforge can be bought around 8445. Stop loss can be kept at 8300. On the upside, I'm expecting a target of 8650 in next couple of sessions. The second sector which we like is the real estate space. So overall reality has just surpassed the crucial resistances and looks very promising on the charts. So overall reality can be bought at 1735. I would suggest a trading stop loss at 1700. On the upside, I'm expecting a target of 1790 in next couple of sessions. So overall reality and Coforge would be my trading bets.
Okay, all right, got that. Vinay, thank you very much for being with us. So those are some of the trading calls of the hour. Let's move on and get you something from the auto space now. It's quite exciting for those who are looking to buy perhaps, a new hatchback. These days, the new hatches are few and far in between in the Indian market. Tata Motors launched the new Altroz hatchback, and this at a price point of 6.89 lakh rupees ex-showroom. This is the first major upgrade that the premium hatch has received since it was launched by the company, Tata Motors that is, in 2020. We caught up with the MD of the company, Shailesh Chandra, who believes that premium hatchbacks will drive growth for Tata Motors in FY26.
The players who had exposure to both SUVs as well as hatches pretty much mimicked the slowdown in the industry. But SUV-heavy players did see the benefit given the growth rate that we were seeing in the SUV segment. Hatches, which declined by 13% in the industry, our decline was more than 30%. Because of the aging of two products that we have in the hatch segment, which was Tiago, which was also in the 5th year requiring a major intervention, and the Altroz. And we lost nearly 50 to 60,000 numbers as compared to FY24 because of the issue of aging and also the decline of hatches which we were seeing. But we launched the model year, intervention, and a new Tiago was launched in January 2025. And in Q4, we saw a significant jump in Tiago, coming back to the volume levels where it used to be. And now we have Altroz, where we had seen the significant decline, that also coming with a very strong refresh. Our refreshes are going to come in time. So there will be one refresh. You have already seen the new Altroz. There will be one or two more, which you can expect in this financial year. Then there is expansion of EV portfolio with Harrier and Sierra also coming in this financial year. Then you would have the ICE portfolio, which will come with a new nameplate, which is again Sierra ICE. So a lot of actions that you are going to see during the year. At an industry level, or if you really see all the consumer-facing industries, there has been a bit of slowdown for last 1.5 years. And we see that trend right now, continuing, and therefore, at an industry level, we are seeing pretty much a similar kind of moderate growth as we had seen in FY25. Specifically talking about entry segment, and if you really see the hatches segment, which has been declining as far as the share of TIV is concerned, but within the hatch segment, if you really sub-segment the hatches into 4 parts: entry, mid, high, and premium, there's a gravitation towards the premium hatchback segment, and it is coming at the cost of significant decline in the entry hatch segment.
Okay, well, we'll take a quick commercial break here. Markets up 200 points on the Nifty. Lots of stock-specific action. Manisha will be with us with commodities in focus on the other side. Stay tuned.
Welcome back. Let's talk commodities now. Equities are, of course, having a good morning. We've got Manisha joining in to talk about the big headlines and the big cues. Manisha, so what's the main headline this Friday morning?
Well, I'm looking at natural gas prices, and that is because we've seen a very sharp correction onto this one. Remember, the first quarter of this year, the natural gas prices were just rising higher, and markets were looking at various kind of tariff impact on this. But overnight, we've seen natural gas prices decline by 3%. It's down 2% in a week. It's down 10% in 2025 till time. But when you look at the last 12 months, we still are trading in the positive, up by nearly 18% there. Well, also, when you look at the overall markets, it is about increase in supplies in the recent few months there. The markets have seen a strong build-up when it comes to US and sense of inventories there. So if you look at the build-up right now, it's at 120 billion cubic feet. 1-year average has been at 78 and a 5-year average at 87. So we are looking at inventories much higher than what has been a high long-year average as well. So with this kind of a build-up, the total gas storage that stands in US right now is 3.9% higher than a 5-year average, which stands at around 2.3 trillion cubic feet right now. Also, when you look at the LNG exports, well, for the month of May and April, we've seen those numbers continue to gain up on the higher side. It was 16 billion cubic feet in the month of April, and May is looking at 15.1. So that in turn also seems to be weighing onto the markets. US LNG output, well, if you look at that, has been a record in the month of April. It is also a low demand season. But going forward, the street anticipates that you could be looking at demand coming back, especially as we are getting into Atlantic hurricane season. And then most of the countries will start increasing inventories ahead of that winter period season as well. So that could be supportive. This quarter, markets anticipate you could be looking at some more pressure coming in. Going forward, it also is about a future perfect because you are looking at natural gas demand very strongly coming in from artificial intelligence. It's projected that the demand will increase for powering data centers, which is 24/7. And that is, especially when it comes to US and Canada, European Union, natural gas is what is used for AI data centers. Global natural gas demand could surge by 50% by the end of decade is the view coming in from Australia Woodside Energy. They are the biggest when it comes to natural gas in Australia. Strong statements also coming in from IEA, which says that the AI-driven data centers will increase electricity consumption by 90 trillion watt hours, and much of this would come in from natural gas. So near term, well, cyclical bearishness, but structural bullishness could continue for natural gas prices.
All right, Manisha, thank you very much for that. So that's the commodity view. We'll take a quick commercial break here. We're going to put our focus on energy, renewable energy, and we'll talk about the challenges that the sector is facing, if any. The broad global kind of push, of course, has been that thermal is back, coal is back, or at least it wants to be. In that context, what are renewable efforts here in India looking like? Lots of listed options here as well. So we'll have Mr. Mohit Bhargava, former CEO of NTPC Green, Sumit Kishore of Axis Capital, talk to us about this. Stay tuned.
Welcome back. We're putting the spotlight on the power space, specifically India's drive to move towards non-fossil fuel sources of power, the whole renewable push. Mohit Bhargava, who is a senior advisor at the University of California, Berkeley, and of course, he's also been the former CEO of NTPC Green. He's with us, and we have Sumit Kishore, executive director at Axis Capital, to talk more about this. Gentlemen, thank you very much for joining in. If I could actually start with you, Mr. Bhargava. Now, our ambitious, dream of reaching 500 gigawatts of capacity on the renewable side, I think last count, some notes that I read, by the end of 2024, we were roughly at about 209, 210 gigawatts. Some argue that the pace of movement is slow. What are the major challenges? I mean, I was reading somewhere that apparently 40 gigawatts of capacity is stalled because PPAs are not getting signed quickly enough. What is your assessment of how quickly we are moving towards this 500 gigawatts target, and what are the major issues, if any?
So good morning, and thank you for having me. Yes, we can always say that the speed is probably not at that level at which we are expecting to achieve our overall objective of 500 gigawatts by 2030. And yes, there are multiple challenges, and probably this is being discussed. This has been discussed at multiple levels. I could probably list down a few. Among them, of course, are land acquisition challenges. There are challenges with transmission evacuation. There are challenges with execution in terms of getting the PPAs off the ground, as you mentioned. So these are all challenges which are there. And in fact, there have been a lot of focus also, if I may say so, in terms of what's the support being provided. Because I think there's also one report which says that the government is actually again pushing the coal-based power. So it's also whether the question whether the government has kind of taken the foot off the pedal for renewables. I don't think so, but yes, those are all challenges which are there.
Is there a threat that we'll miss this target, 500 gigawatts by 2030? I mean, I don't get the sense, hearing you, that there's too much of an urgency that something needs to be done. I mean, if you just put it in perspective for us, are we moving along at a fine pace?
I would say we are moving along at a fine pace, but there's always room for improvement. And 500 gigawatts, I must say, you see, that's a very good ambition to have. I am quite hopeful that we'll be ending up very close to that. But obviously, there are challenges. I mean, look, for example, transmission probably today is one of the biggest challenges because the pace at which the evacuation system is working is probably not in line with what the renewable energy producers want it to happen. And one of the reasons why, if you check with the CTU website, you'll find that there's a long queue for connection. And the earliest now apparently available is around 2029. So a lot of activity which is happening is also incumbent upon the fact that transmission needs to be pushed further quickly. Of course, there's also on the other side, even the capacity which is already operational. I understand there are challenges in actually pumping the entire power because there are probably some segments of the transmission system which are not up and running. So for example, if there's a 1,000 megawatt renewable project, it probably does not get fully scheduled for 1,000 megawatts also at various times during the day. So these are all challenges, and we need to move quickly on transmission.
Got that. There are questions whether the government has taken its foot off the pedal, but you don't think that is correct. We have Sumit Kishore also with us. Sumit, good to speak with you after a while.
Yes.
You want to reflect on some of what Mr. Bhargav said and your thoughts on this?
Yeah. Good morning, Prashant. I think to add to Mr. Bhargav, despite the on-ground challenges, India has added almost 33 gigawatt of capacity in FY25, an increase of almost 28% on a year-on-year basis. So if you think about it, 33 gigawatt is the highest capacity addition in a fiscal ever. The next highest was 30 gigawatt in FY16, which was at the peak of the thermal capacity additions in the last cycle. So out of 33 gigawatt, almost 24 gigawatt was solar, 4.3 gigawatt was wind. So it has been a decent outcome. What actually happened last fiscal was that the peak demand grew just 2.7%, which was quite weak. And post-COVID, you had the weakest power demand growth in the country of just about 4.2%. So weak power demand and declining battery and solar module prices have allowed DISCOMs more time to finalize their power procurement plans, as a result of which you see a large pile-up of renewable letter of awards of over 40 gigawatt where PPAs have not been signed. I think this fiscal, again, so far, April power demand was just 2.2%. May power demand is down 2% year on year so far, and peak demand is at 231 gigawatt so far in May. And end of May last year, it was 250 gigawatt. So you're in a summer season where peak demand is actually down on a year-on-year basis. So I think more than the execution challenges have been evergreen. They will remain, but I think over the next 2-3 years, what is very important is that power demand growth, if it revives itself, you would basically find everything else falling in place. In FY26, the worst risk is that there is almost 8 gigawatt plus of coal capacity addition that could come on stream, even if there are 6-month delays versus CEA target. So, if that is accompanied with weak power demand and strong RE capacity addition, DISCOMs will be able to wait even more to sign PPAs.
I get that. Sumit, for the listed universe here, for your Varis and Premier and, what does this environment mean? Because then this will keep piling up. And there is a fair bit of demand, which is additional demand for solar modules, etc., which is coming up. And for these two companies specifically, this is basically there is strong demand, very strong demand for maybe 2 years. But then after that, what? Because there is a lot of capacity which is coming up. So, just your thoughts here.
India's power demand is a secular growth story. In the last 15 years, India's power demand grew at a CAGR of 5%. Possibly it can grow faster in the next 5 years because you have new levers of power demand growth like data centers, EV charging, green hydrogen. So I think there is a long runway of capacity addition that India can sustain. Think about it. Simple math is India had a 250 gigawatt peak demand last fiscal. If you have 6% power demand growth, that's 15 gigawatt. If you have to meet that using wind, solar, where the PLF profiles are lower, and even with a bit of thermal, you still have 40% say average PLF. So 15 divided by 0.4 is 37.5 gigawatt of capacity addition just to keep pace with the demand growth in the country. And that will keep growing every year. So there is a long runway. Let us not be very skeptic.
No, not at all. In fact, I was just looking at the trends, I think, out of April, that while overall demand was soft, this evening deficit issue always leads to spikes, right? And I believe on the exchange on IEX, prices were touching almost 10 rupees per unit, just to meet that short-term evening, demand deficit. Sumit, from the listed stocks point of view, and I'm not asking short-term, 1 or 2 months or 3 quarters, but if someone is to play the renewable theme from a portfolio perspective, then how would you advise them to do it? Would an integrated player like Tata, which is giving you both traditional as well as renewable, would that be the way to go? Power exchanges, stocks like Power Grid, etc. What do you play in the power supply chain?
Almost across the board in power sector, we have seen over the last few years that the pace of capital expenditure has gone up meaningfully, led by green growth. And even aspirations for companies 5-6 years out have a meaningful compounding in EBITDA led by green growth aspirations. So companies which are able to sign PPAs and have decent visibility on earnings compounding, EBITDA compounding over next 2 to 3 years stand out. So in that bracket, you have companies like JSW Energy, which have seen a healthy dose of both organic and inorganic growth, and even Tata Power, which has a more integrated approach to not just IPP capacity addition, but solar equipment manufacturing and solar EPC, which is seeing decent growth. There is possibly the privatization of DISCOMs in UP, which is standing out as a big catalyst for companies in the sector, in the distribution space, including Tata Power, Torrent Power, CESC, and so on. So I think all in all, even exchanges are having a party right now because in the advent of weak power demand growth, there is a lot of coal availability. International coal prices are flattish, and you see that exchange prices, even though they are spiking in the evening, on a year-on-year basis, exchange prices are down 15-20% year-on-year, which is welcoming the discoms to come to exchanges, welcoming C&I customers to go to exchanges to optimize their power cost. So which basically means that exchanges saw earnings growth of 20% plus in the last financial year, and even so far this quarter, volume growth has been quite strong despite power demand growth being weak in India. So I think this is a secular story where India will follow Europe and other developed markets, where over a period of time, penetration of short-term power supply in India will keep going up. 10 years back, we were at 3-4%. We are at 9% plus of total power supply in the country, which is being transacted on exchanges today. I think this will go up to 15-20% in the next few years.
Sumit, you said don't be too skeptical. In stock markets, always be skeptical.
Yes.
Even for the best laid stories. I think that's got to be the motto.
It was more from, operational and,
Yeah, no, I get that. My question, though, was only about Vari and Premier and, solar modules. It was not about the overall, how much will power demand grow, and you said those numbers, etc., all make sense. But my question was about these two. I mean, will there be overcapacity, which you yourself provided the context for?
No, so that's a separate question on the solar equipment manufacturers. I think India already has excess capacity for solar module assembly. We have crossed 70 gigawatt in terms of annual manufacturing capacity for solar modules. India is likely to achieve self-reliance for solar cells within a couple of years, and even backward integration of wafer ingot is likely to pick up sharply here on. But players who evolve their offerings in clean energy transition will be better off on margins and profitability, even as industry-wide ROCE normalizes with potential oversupply of the module manufacturing value chain. So I think India will have to find new export destinations like Middle East, because you can't, the geopolitical uncertainties and the flip-flop on decision-making, or the uncertainty in US is likely to sustain. But if you have local manufacturing in US, for example, that could help you overcome some of this. And US is being quite skeptic of importing stuff from China or countries which are seen as fronts for China in Southeast Asian region. I think India will benefit out of these interventions.
Okay, all right, gentlemen, I think we're completely out of time. Just 10 seconds answer, just checking with Mr. Bhargava. So final word, we discussed a couple of issues that you highlighted, labor, PPAs, etc. Is labor availability at all an issue for the sector right now?
Yeah, it's always a challenge because renewable sector is labor intensive, especially during the execution phase. And just, if you allow a couple of more seconds, I just wanted to add to what Sumit said. I think you missed out on NTPC Green, Mike's company, so that's also in a good space, if I may say so. So having said that, yes, you see, the story of renewables is good. And I just wanted to have a quick word also on the peak power, which you mentioned. And that's actually a good story for renewable space also, because a lot of storage, like RE plus storage tenders are there. And these are actually the most important plugs or the way out for meeting the peak demand, because whatever coal capacity is coming up, that will take its own time. What you start today will take at least 5 to 6 years. But this battery storage can actually come up within the next 12 months. So while India has moved on that, I think we need to step on the gas much faster, because that is where the peak power challenge will be taken care of. So that's one important thing which government, of course, is doing, but we need to get people, states and PPAs happening so that these things get off the ground. But yes, to answer your question on labor, that's always a challenge, because ultimately today a lot of work happening across the country in various sectors.
Sure.
At any given point of time during construction, you need a lot of people to get the project off the ground.
Absolutely. Well, we have some challenges, but then there's a big push. And perhaps these are not insurmountable issues. That's the sense we get after talking to both of you. Thank you very much for joining in. With that, we're completely out of time on this edition of Bazaar. So we're leaving the markets in a pretty good shape. Nifty's been chugging along this morning. Do stay tuned. Chartbusters will take the action forward.
Sun Pharma is among the few Nifty losers today, slips over 2.5% in today's trading session after a mixed fourth quarter. Growth concerns weigh as management expects mid to high single-digit top-line growth going ahead versus high to low double-digit growth in the past.
And ITC, that one's higher in trade on the back of its Q4 numbers. The cigarette volume growth comes in line with expectations of around 4 to around 5%. The revenue beats estimates.
Container Corp slips more than 3% on the back of a muted performance in the fourth quarter. Profit declines year-on-year due to changes in calculating depreciation while margin 2 contracts. However, the management tells CNBC TV18 that they are targeting 13% volume growth in FY26.
Well, Honasa rebounds in trade. The stock is up close to 14%. This as the company shows early signs of recovery in Q4. The company reports a 13% rise in the revenue on a year-on-year basis, while volumes grow 21%.
A couple of other stocks on our radar as well. HPL Electric and Power Mech projects are buzzing in trade with gains of 15 and 12% respectively after posting strong fourth quarter numbers.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And in just a bit, we have that at the top of your screen. The Nifty and the Sensex, they're bursting away. The Midcap index as well is doing well. And the number of stocks advancing more than the number of stocks declining. Mangalam, it's looking pretty good.
All in all, it's a good Friday for bulls so far. The question is, how do we end today? Because from levels...
For the markets.
For the markets, obviously. At lower levels yesterday, we saw some purchase. We managed to grow above the 20-day moving average. So the Nifty Bank in particular closed just at that, and now it's doing well. Let's see where we go from here. 24,850, 24,900. That's the expected congestion zone. Do we go ahead and cross that or not? The broader markets telling you that at an index level, even though it's underperforming, there are nearly 50% stocks, more stocks in the green than the number of stocks in the red. And as we speak, a bunch of stocks actually spiking. We have the Midcap IT pack, which should come up for you. First Source is up at the high point. We're seeing some recovery in Coforge and Oracle as well, and Persistent Systems, all these stocks at the high point of trade. And it's ahead of summer. There were unseasonal rains, all of that happening. Varun Beverages, no problems out there. You know, a lot of Pepsi being sold, I guess. That stock up around 3% as well. But good time to get in Manas Jaiswal for a quick technical check on the market. Manas, what do you make of the indices so far? I mean, it's been all over the place. It's been choppy. It's been trending lower. Thereafter, it surprises on the upside at some point. And it's meandering around a range. How do you trade this?
Good morning, Mangalam. Good morning, Nigel. So yes, Nifty has taken support near 20-day moving average. And now today it has regained its 10-day moving average. But again, I think one should remember that Nifty has strong resistance in the range of 24,850 to 24,950. So for turning bullish, I think Nifty will have to cross 24,950. If it breaks that, then definitely you can expect almost 500 to 600 points rally on Nifty. But at current levels, I think you should wait for some more time. And if you're long, then definitely you can hold it. Keep your stop loss below 24,600. But fresh long should be taken only on a breakout above 24,950. Even Bank Nifty has taken support at a 20-day moving average and it regained a 10-day moving average. But here also, Bank Nifty has strong resistance in the range of 55,400 to 55,500. So here also you can create fresh long only on a breakout above 55,400. And if you're long, you can hold the Bank Nifty also and keep your stop loss below 54,600.
Okay, all right. Manas, hi, good morning. Good to see you. Well, a couple of stocks are spiking up actually as we speak. Force Motors, that's one name that's now almost at around that 11,000 odd mark. So I think we should pull up the intraday chart. Good move is what you're seeing on Force Motors. But Manas, what else is on your radar in terms of stocks?
So first one is a buy call on MFSL, Max Financial, where the stock has been making higher tops and higher bottoms from the level of around 1225. Today, stock has given a fresh breakout on the chart, so take a long position here. I think here one can keep the stop loss below 1424 and target would be around 1500. And second is Tata Chemical, where stock has taken support near its 50-day moving average. And looking at the pattern, because on the hourly chart, stock has already started making higher tops and higher bottoms.
So one can create long position here. Stop loss should be around 859 and target would be around 890.
All right. Do you have any call on names like Honasa and Metro Brands? Both of them are now spiking. In fact, Metro Brands is up around 6.5%, was up 3% earlier. Management sounded reasonably confident on the channel. The stock's up around 7% now. Honasa has taken a sharp knock. It's halved from the top. It's early signs of recovery, and there is a purchase that we're seeing in the stock today of 14% right now. Do you track these?
Yeah, I think in Metro Brand, definitely you can take a long position for a little bit long term for next 3 to 4 months time. Then I think even at current levels, you can create long position. A stop loss should be around 1160. And I think here you can expect the target of around 1475. In Honasa, I think you should wait for some more time because yes, stock has broken its 200 moving average with great volumes. But I think you should buy the stock on corrections, not at current levels. On correction near 300 to 290, you can create long position. Stop loss should be around 279.
All right. Anything in mid-cap IT that you like?
In mid-cap IT, I think I just a few minutes back I saw persistent where stock has taken support at 20-day moving average and it regained 10-day moving average. So I think if you're a trader and you can keep the stick stop loss below 5,600, then here you can take a chance. Keep your stop loss below 5,600. Target would be around 5,900. All
right, take that point, Manas. Thank you so much for joining in. Just as we were having this conversation, the Nifty's crossed past that 24,800 mark as well. And this one's led by IT and ITC. So look at ITC. Now that one's zoomed to the high point of trade. Decent volume growth on the cigarette business, notwithstanding the margin compression that we've seen or the slow growth in FMCG. The street likes these numbers. Also, given the fact that the stock has been an underperformer, trading at 23 times. So valuation supportive as well. With that, let's get you some ideas for profit. We have our colleagues from Money Control Pro joining in. Nitin Agarwal has a stock.
The company that I've chosen for today is Hero MotoCorp, a leading manufacturers of two-wheeler in India. Let me briefly touch upon its Q4 number. The company recorded a 4.4% growth of its growth in its revenue on a YOY basis. This was driven by 5.2% improvement in its realization. Hero is seeing a significant surge in the demand, particularly in the rural area. Global business and the EV business continue to stay strong. The overall EBITDA remained above 14%. Now, there are a couple of factors that make us upbeat about the company. First, the demand for the two-wheeler segment and the motorcycle segment remain positive, with the wedding season in full swing. Rural demand particularly continues to show a strong momentum, as is evident from the monthly number reported by the company, and the government's focus on the rural infrastructure. Rural economy continues to augur well for the company. Further, the Hero MotoCorp continues to accelerate its premium portfolio and has been launching aggressively to capture the premium segment, which has been doing pretty well for the company. In addition to that, the company has been launching new scooters for the capturing the growth that is being witnessed by the scooter segment. Currently, company holds around 4.7% market share in the electric vehicle and is expanding its market share aggressively there as well. In terms of valuation, the company currently trades at around 14.5 times FY27 projected earnings, which we believe is very reasonable for the company like Hero MotoCorp.
All right, thanks a lot for that. With that, we take a short break, get you more on the markets and individual stocks. A lot of stocks making news this morning. All of that on the other side.
Welcome back. You're tuned into Chartbusters. You're on CNBC TV18. Well, Sun Pharma, that's one of the top losers today. It's down close to 2.5% after a mixed showing in the fourth quarter. This especially as the growth concerns weigh. In fact, let's listen to what the management had to say when they detailed their quarter 4 earnings. Let's hear out their call on the growth expectations.
In FY25, our global specialty sales were up 17.1% to reach 1.216 million or 1,216 million. In Q4 financial year 25, our global specialty sales were up 8.6% to reach 295 million. On the guidance of FY26, we expect mid to high single-digit consolidated top-line growth for FY26. We now expect our FY26 R&D spend to be 6 to 8% of sales for the next year. No, I think we've always consistently maintained that we continue to look at acquisitions which will help us create value. Because any business that we acquire, we should be able to run it significantly better than the current owners. Or we should have significant potential synergies. Otherwise, it will not justify the acquisition premium.
Well, from the top Nifty loser, let's look at the top Nifty gainer right now. Among the top Nifty gainers is Eternal, which has moved to the high point of trade. But the second one is ITC. And ITC reported its numbers yesterday post-market. It was a mixed quarter. There were some hits and some misses as well. So if you look at the overall reported numbers, on the revenue front, there was a beat. The company reported revenues upwards of 17,000 crores. The street was working with a number of 16,820 crores. Importantly, the cigarette volume growth, which is the mainstay of the company, came in at around 5%, which was, again, at the higher end of expected 4 to 5% mark itself. Though all of this did not, glow down to the EBITDA, because the EBITDA came in at a little shy of 6,000 crores. The street was working with a number of 6,100 crores. Margins came off as well. The company alluded this to a lot of weakness that we've seen in, or rather a lot of inflation that we've seen in a lot of the inputs in the FMCG business. And that explains the weakness that we saw in the FMCG growth as well. 3.7% growth out there versus street expectations of 6 to 8%. Out here as well, the margins compressed 270 basis points, higher end of the expected range of 200 to 300 basis points compression. What is it that the management said? Very high input costs is what we saw. And also at the same time, the FMCG margins, which saw a decline of over 270 basis points, did see a smidge of a recovery quarter on quarter. X of notebooks, the FMCG revenue growth has actually been 5.4%. So that tells you that maybe going forward, FMCG business also comes back. From the highs, we've seen a decline in the raw material prices. And more importantly, the company has also announced a dividend of nearly 8 rupees per share that supports the stock. The stock hadn't done much. In fact, from its peak, it has seen a correction of almost 17-18%, trading at 23 times. No reason to sell on those numbers, no reason to buy. But then the dividend sweetener comes in. The stock up 11 rupees today.
Okay, all right, Mangalam, thanks for that. Well, let's focus on defense stock. Centum Electronics, the stock is up close to 7%. It released its quarter 4 numbers, so the stock is still holding with gains. But I think from the highs of the day, it's seen some kind of profit taking. Ria joins us to detail those numbers. Ria?
Well, good morning. Centum Electronics has been trading higher today after reporting a very strong set of numbers in quarter 4 of FY25. The revenue has gone up by around 24% over the previous year, while profitability has also seen a very sharp turnaround. EBITDA has more than doubled, up around 128% over the previous year. Margins have also expanded by a solid 514 basis points on a year-on-year basis, now coming in at 11.3% in this quarter. Net profit this time around has stood at 22 crores versus a loss of 7 crores that we saw in the same quarter of last year. Now, this momentum is also backed by a very strong order book of around rupees 1,861 crores as of the end of quarter 3 of FY25. And out of this total order book, the defense and space segments contribute over 51%. Going forward, we will be watching out for the management commentary for order book growth, further profitability improvement, and a ramp up of opportunities in the defense space as well.
Thanks a lot for that, Ria. For the time being, we slipped into a short break. On the other side, we'll get you more on markets and stock-specific action. Stay tuned.
update. Let's keep an eye on a couple of these names. We have Zomato Eternal, that is, has spiked to the high point of trade, and we are seeing Swiggy. Let's see whether Swiggy is following suit or not as well. Swiggy is up around 1% or so. But speaking about Swiggy and Zomato, there will be a moment of profit from Swiggy. That's the word coming in from Process CEO Fabrizio Bloisi. He spoke with Ritu and he commented on how Process is keen on growing in India.
So if you look to the food delivery business of Swiggy, it's doing quite well. We are growing well. We are growing more than the expectations that people had. So like we are doing well. And the company is profitable and is increasing profitability. Sorry, the food delivery part.
Yeah.
The quick commerce is a younger business.
High cash burn too.
Yes, I know about that. I think India specifically, it's interesting, it's different from the rest of the world. The rest of the world is investing, is more controlled in the quick commerce investment. India is investing not only Swiggy, but everyone much more.
Yeah.
My point is this is a cycle. There will be a moment after this moment of high excitement that the cash burn are going to reduce. And I think we are prepared to, I think we are executing well. We are prepared to invest when it's time to invest, but there will be time to profit from this new business too.
So for the time being, do you intend to continue holding on to that 20+% stake that you have in Swiggy even after the IPO?
Yes, we are not in a mood of selling. We are in a mood of keep investing in India.
Okay.
So our intention is to keep investing and invest more generally in India.
Right, with that, what we'll do is we'll wrap up on this edition of Chartbuster. Stay tuned. Trading Hour comes up next as all the indices on the screen are fairly in the green.
Good morning and welcome to Friday's edition of Trading Hour. We're coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Hormus Fatakia, and markets have literally taken off today. 300 points gain now on the Nifty as it inches towards that 28,900 mark. We've recovered more than what we lost yesterday. Yesterday, benchmark indices, at least the Nifty was down 200 points. Today, we're up 300 points. And it's a large cap driven screen in action and buying. So Nifty IT, Nifty FMCG index are leading the gains in the frontline pack. The top four gainers are ITC, Infosys, Trent and HCL Tech. So dominated by tech and consumer. Midcaps in the green, but trailing the frontliners. Midcap index of a gain of about 0.5%. The advanced decline ratio, though, is positive. Good day.
Oh, good day indeed. And you'd want a kind of day like this, considering the week that we have had, a week of consolidation, a week of some correction as well. And yesterday, of course, the expiry related factor, there was the bit of an inkling came in yesterday itself, right, when the bulls defended 24,500 very firmly. We ended off the highs of the day. We managed to close above that 24,600 mark. Today we have crossed 24,750. So multiple positives coming in. And once we cross that 24,750, it's been a one-way move for the indices as well. So 24,900 is now where the index is. And so that is one good factor. Of course, you cannot take away from the earnings reactions from the broader markets. And they are at the extremes in today's session as well. Look at Honasa Consumer now 17% higher on the stock, and it is back towards its IPO price, which is at 324. So good going for Honasa Consumers. Of course, there are results that have shown signs of improvement, and the slightest bit of positive has been taken well by the street. So 17% higher for Honasa, top gainer on the Nifty 500. The other one is Emcure Pharma, and that came out during market hours yesterday. The stock is now up 10% in an upper circuit there as well. It's at 1284 now is Emcure, and it's around about 30% higher from its IPO price, which was around 1,000 rupees as well. So results were good for Emcure Pharma. The stock was up 9% in yesterday's session as well. And today, Kotak has come out with a note where it has increased its price target to 1625, which means that is another 40% upside from yesterday's closing levels. So that's another positive for Emcure Pharma as well. We'll look at some of the other movers then. On the flip side, that is the Vari Energies, of course, both Vari and Premier, they were smashed in early trade. Vari down almost 10%, but it has recovered slightly from the lows of the day. Now 6% lower. All their peers in the US were bombed in yesterday's trading session, with Sunrun and all of these stocks falling almost 20 to 40% in just one trading session, and it has shown a bit of a cascading effect on Vari and Premier as well. KPR Mill is the other one. KNR Constructions is down 3.5%. KPR Mills down 2.5%. Sun Pharma, of course, the result reaction down 2.5% among the top losers on the index. One of the very few names that are down in today's trading session. But beginning the show with corporate conversations, then Subros is the management that we first speak to. The company managed to achieve the guidance of double-digit revenue growth in FY25. Mr. PK Duggal, who is the executive director and CEO at Subros, is joining in now to discuss the quarter gone by and the road ahead for the company as well. Mr. Duggal, thank you so much and good morning, and thank you for joining in. You managed to achieve your FY25 guidance, which was of double-digit growth in revenue. Do you expect that to continue in FY26 as well? What are the kind of demand trends that you are currently witnessing on the ground?
Thank you. Good morning. Thank you for having me on your show. We have done well in FY25, and we are hopeful to continue this trend for going forward also. But FY26 industry need to be watchful, but because of many geopolitical tariff issues and other disruptions which are emerging. So still, we are sure that we will be doing better than the industry performance.
If you could quantify that for us, Mr. Duggal, in numbers, 10 to 15%, 20%?
No, it would be not double digit, but it would be very high in the single digit also.
And this is assuming some sort of disruption on account of geopolitical issues, or is it that auto demand on an organic basis, domestic demand, is also muted in FY26 vis-a-vis FY25?
No, despite all this disruption and the mute of industry, because commercial vehicle is going to be muted and passenger vehicle will have a very moderate demand, but export opportunities for the OEMs are very high. So we are banking on that, and we will overcome this situation maybe in FY27, but FY26 would be a watchful year.
Okay, and a single-digit kind of a growth. What about margins? FY25 margins were 9.6%. Can you inch them up, given what we spoke about? And on exports as well, since that's the opportunity you're trying to target. What is the export contribution and the expected growth?
So in FY25, our EBITDA margin has improved to 10.22%. So we have already clocked that milestone of 10% plus. So we are going to improve it further because in last quarter we have seen 10.86% margin. So first milestone is to cross 11%. And with the current effort, what we are doing for indigenization or localization or improving the internal efficiencies, we are towards that milestone.
You know, Mr. Duggal, what is the current revenue mix that you're seeing currently? And if this shifting focus towards green mobility, do you see that becoming a bigger part of your business over the next 1 to 2 years?
Yes, of course, because EV transition is happening and it is rapidly increasing year by year. So our products now for strong hybrid and EV vehicles are now in the product range. We have already secured business of 20% of our total revenues going to the green mobility. In the current scenario and in future, where the last mile connectivity will have much more EV penetration faster than any other segment. So there also we have introduced our product with the OEM, and that's the confidence we have that our growth would be better than the industry.
You said 20% of your revenues today are from green mobility?
Yes, from strong hybrid EV or CNG vehicles.
And that number, sir, could go up to, say, in the next
that would be, I think we have a long-term target to make it around 40%, but in the short term, maybe next year 25 and then going to 30%.
Got that. And exports, you spoke about exports and how that is an emerging opportunity.
So
what percent? Yeah.
Export of vehicle is a big opportunity for the OEM. From India, export vehicles are increasing year by year. Maruti, of course, is dominating that segment. So our product introduced in all such vehicle will have a growth opportunities for us. If OEMs export grow, we will also grow in that line.
You know, Mr. Duggal, I wanted to emphasize on this green mobility bit, right? You spoke about taking it to 40% in the long term and you want to go up to 25 this year. Would the launch from Maruti with regards to the e-Vitara by September is what they are planning to launch? What is the kind of incremental opportunity that you're anticipating from this? And would that be instrumental in taking that to the 25% mark this year?
Of course, that would be the key driver for us because our in Grand Vitara, we have a substantial business in HVAC, hose and pipe, and for engine cooling modules. So that would be the key driver. And if these variants, including Mahindra and Mahindra and Maruti, EV penetration increase growing in future, maybe next 2 to 3 years time, that would be a key business opportunity for us also.
How are the margins in green mobility as you increase your contribution from green mobility? What impact will it have on your EBITDA?
It will improve because these are niche products. They are new technology products. So initially there will be margins available. But as we grow, more and more competitiveness has to come into this business. And that will be offset by more localization in new technologies.
You know, Mr. Duggal, there is also a mandate now of having AC cabins in trucks. And after the third quarter, you had talked about blocking all of that and moving into the developmental phase as well. Part one of my question is, what is the incremental market size do you expect from this regulation? And part two of my question is, how do you expect the overall trucking segment itself to do this fiscal?
So, as I mentioned before, that truck market per se is muted in overall growth in last year, FY25, and we see the similar trend coming in FY26 also. But since AC penetration in N2 and N3 category from almost 15 to 16% will grow directly to 100%, that's a big opportunity for us to grow business within the truck segment. On the second part of your question, we have tied up businesses with the OEM, most of them now. And we are now starting for the ramp-up stage because October sales of truck with AC will start. And before that, I think OEM will start production to bring the pipeline in line with the customer demand. So it's a huge opportunity for us. We are expecting almost 100 crore delta business coming in from these incremental opportunities in truck segment.
And just quickly on railway, how is the railway side of the business doing? What are the orders that you serviced in Q4? What's the opportunity over the next few quarters? The content per coach in railways, and generally for you in terms of revenue contribution from railways, how does it trend up?
So railway is the second, I think the third largest attraction point for us. We got into railway driver cabin. We got expanded now our business into coach aircon. Last year, we got a large business of 40 crores, one tender. We service almost 40% of that. Balance will come into this. There are few large tenders are in pipeline now. Our product range for all coach aircon has already been completed. The revenue per coach is substantially different from a ICE PV vehicle. It is almost more than 40 times or 50 times. So it is not comparable business. From margin side, of course, railway is much more margin segment for us.
All right, Mr. Duggal, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management of Subros on the road ahead for the company, intending to take their green mobility contribution to 40% over the long term. The stock up 19% in the last 1 month and doing fairly well for itself in today's session as well. Take a short break. Up next, we discuss all things commodities with Manisha Gupta. Stay tuned.
all over.
टेलीकम्युनिकेशंस, इंफ्रास्ट्रक्चर, फाइनेंशियल सर्विसेज और एंटरटेनमेंट जैसे अनेक क्षेत्रों Shri Narendra Modi ji, esteemed dignitaries, good morning. Let me begin by saluting our beloved Prime Minister Shri Narendra Modi ji for the resounding success of Operation Sindoor. This success is a shining testament to his steely resolve and to the unmatched bravery of our armed forces. Friends, I also warmly congratulate Shri Jyotirajy Scindia ji for crafting this transformational platform. The 8 states of Northeast are rightly called Ashta Lakshmi. With the blessings of Lakshmi, the goddess of prosperity, the Northeast is not just rising, but to my mind, it is roaring. In the near future, I can clearly see this region replicating the miracle achieved by neighboring countries like Singapore, Malaysia, and Vietnam. Respected dignitaries, for Reliance, it is a matter of privilege to fulfill the dreams of a region that has the fastest rate of economic growth with the youngest population in India. Today, I make 6 commitments to the Chief Ministers of Arunachal Pradesh, Assam, Manipur, Meghalaya, Mizoram, Nagaland, Sikkim, and Tripura. First, Reliance has invested around rupees 30,000 crores in the region in the past 40 years. In the next 5 years, we will more than double our investments with our target at 75,000 crores. In addition to creating over 2.5 million direct and indirect employment opportunities, we aspire to touch the lives of most of our 45 million sisters and brothers in Northeast. Second, Jio has already covered 90% of the population with over 5 million 5G subscribers. We will double this number this year. Jio's priority will be to bring the revolutionary power of artificial intelligence to all schools, hospitals, enterprise, and homes. When talent meets technology and competence meets connectivity, our Northeast will surge ahead. Third, Reliance Retail will vastly increase its procurement of staples, fruits, and vegetables to boost the income of farmers. We will also invest in factories for high-quality FMCG product in the regions and promote the region's fabulous artisan economy. Fourth, we will greatly enhance generation of solar power in the region. Our Prime Minister often speaks of converting waste to wealth. In line with this, we will convert the region's vast wasteland and wealth land by setting up 350 integrated compressed biogas plants. Fifth, Reliance Foundation will bring the best of cancer care to the Northeast. To begin with, we have established a 150-bed comprehensive cancer hospital in Manipur. We are collaborating with Mizoram University on care of breast cancer using genomic data. In Guwahati, we have built an advanced molecular diagnostic and research lab. It will be among the largest genome sequencing capacities in India. We will help transform the Northeast into a healthcare hub and a research powerhouse. Sixth, the Northeast is a treasure house of world-class talent in multiple sports. Reliance Foundation will work with all the 8 states to set up Olympic training centers which will prepare our youth to be tomorrow's medal winners in Olympics. Most respected Prime Minister Shri Modi ji, you have achieved something unbelievable and unimaginable. You have brought the Northeast from the periphery to the center of India's developmental map, from the margins to the mainstream of the India story. Under your guidance, we in industry will work with all the chief ministers to make the Northeast an inspiring model to demonstrate to the rest of the world how we can make progress, how development can take care of Dharti Ma, how Lakshmi Mata can reach every home, and how Bharat Mata indeed embraces all her children with her boundless love. Thank you. Jai Hind.
Mukesh Ambani there at the Rising Northeast Summit, the Reliance Industries chairman affirming his commitment to the region and also announcing that they'll be doubling their investment in the region over the next 5 years. Take a short break. Back with more on the other side. Stay tuned. Welcome back, and shifting focus back to the commodity space now, and Manisha is joining in to talk about directionless crude oil. Manisha.
Well, after 3 weeks of gains and hitting an almost 1 month highs, we have seen some profit taking coming in for the crude oil prices. It is down by nearly 2.5% for this week, headed for a weekly decline, as I said. And the profit taking comes in on the back of 2 or 3 factors. The major one clearly has been the statements from OPEC and allies. Remember, they have increased output for the month of May and June. And the expectation is that July could be a third straight month where OPEC would be increasing production by 411,000 barrels per day. Well, the estimates are, and the conversations within OPEC is that they want to increase production by 2.2 million barrels by the month of November. So we will see this happen. But the point is that this increase in production is coming in at a time when the global markets are looking at weaker demand here. And it's not just about OPEC and allies, because the non-OPEC countries, especially US, also seems to be increasing production. Their inventories have been on a surge and their production near all-time highs, and that's weighing onto the markets. Interestingly, what the street will watch out for is the US and Iran nuclear conversation. That is yet again happening on 23rd of May, and then potential threat from Israel on Iran's nuclear facilities. So markets are looking at that premium coming in for prices. So it's a mixed kind of a fundamental, and as you rightly pointed out, it's slightly directionless and we seem to be getting stuck in a range. But having said that, after 3 weeks of constant gains, we are now trading below $65 and hoping or looking forward to a weekly decline.
Indeed, Manisha, thanks a lot for that. A weekly decline in store for crude oil prices, just as when prices had started to hit a 1 month high. But Saumil Mehta from Mirae Asset Share Khan is joining in for a quick chart check. Saumil, good morning. Thank you for joining in very quickly. If you could tell us, the Nifty now poised for 25,000. What next if it crosses that mark, and your stock recommendations as well for the morning?
Markets have taken support at the lower end of the range. Nifty was trading in a range between 24,500 and 25,000. Now the markets have taken support at the lower end. I'll be expecting this range to break out on the upside. The short-term targets would be 25,200, 25,300. That will be my short-term targets, which is the upper end of the Bollinger Band on the daily charts. Above that, I think in the medium-term outlook, I'll be looking for all-time highs above 26,200, 300 levels. Definitely high top, high bottom formation, taking support every time, taking support at 20 daily moving average and continuing the uptrend is a very good sign, very strong sign. We have been a little cautious in this range, but looks great now. The momentum has picked up. IT, reality, metals all look good. So I have 2 picks from one of them is from IT and one of them is from metals. First one is Coforge. Coforge has a small consolidation taking support at 20 daily moving average, continuing the uptrend. Stop loss would be 8280 and target would be 8750. Same thing with Hind Copper. Hind Copper has just broken out of a small basing out pattern on the upside, taking support on the averages. Stop loss would be 222 and targets would be 245.
Thank you very much for that. On Coforge today, Bernstein has come out with a report on IT. They're saying turning the corner for IT. And their top picks are Infosys and Coforge. Coforge has been doing well in terms of very growth rates, stronger than the industry, and they expect high teens revenue growth to continue for Coforge going forward. And plus, it has a 50% exposure to BFSI. And amongst all the sectors, the demand from the financial services client is the most resilient. So that's driving the optimism on Coforge and Infosys. Bernstein's top picks in IT. Get into a break. On the other side, the management of Astra Microwave Products will join in. Welcome back. Let's turn our attention to another corporate conversation, Astra Microwave Products. In Q4, the company's top line went up by 15%, profits up nearly 15%, margins expanded. Mr. Kabra, who is the Director of Business Development and Strategy at the company, is now with us on the show. Thank you very much, sir, for joining in. I was looking at your FY26 guidance, and I believe you're guiding for a top line of 1,300 to 1,500 crore rupees. Is that correct?
No, I think our guidance is between 1,200 to 1,300 crores.
Okay.
With the order intake expected between, again, 1,300 to 1,400 crores. That's the order intake, which we expect in the current year.
Okay. So if your top line guidance is 1,200 to 1,300 crore, you're anticipating a 15 to 25% revenue growth next year.
Yes, please.
Okay. And that is a big jump because last year you ended with only a 15% revenue growth. So what gives you the confidence that you will be able to accelerate growth in FY26?
I think we all need to congratulate our defense forces, our defense labs, DPSUs, and the business prospects are looking pretty good. We are sitting on our consolidated order book is right now 2,303 odd crores and a standalone order book of 1,951 crores. We are expecting that our ARC business alone will have an order backlog of about 100 odd million plus by the end of next year. So all these things translate into quite a significant revenue potential. And the new products which we spoke about, we have always been speaking to you about our focus on productization and solutions. I think combined, everything is coming together and the prospects look good. And I think the year after that and after that would be even significantly better.
Mr. Kabra, good morning. Thank you for joining in. With the kind of order book that you have, what is the kind of revenue visibility that you are seeing? Because your current order book is supposed to be executed within the next 12 to 36 months, if I'm correct. So is that the kind of visibility that you're seeing, or you go beyond that? And part two of my question is, will defense continue to remain the primary contributor into your business mix at 73% currently? That number goes higher this year?
Absolutely. I think the order book visibility, if you ask us, these are orders which we are almost certain to get because our order translation into sales is about 24 months to 30 months. And we have had a very significant carry forward order book over a period of time. So, the incremental growth which comes in from us selling our counter drone systems, et cetera, that could be a surprise element if it kicks into orders and they translate into revenues in the current year itself. Sorry, what did you ask me? The second part?
The second part, sir, was that will defense continue to remain a majority contributor to the business mix? It's 73% currently. So does that go higher this year?
Absolutely. We are a predominantly defense company, right? But I must emphasize that we are a fairly diversified, very well diversified defense company with, let's say, about 45% of the business coming in from our core of radars. We have, if I give you a breakup of about, if I look at the broad breakup, we have a significant revenue stream which comes in from electronic warfare, which is the future, as you're aware. We are big time into missile electronics and telemetry. In fact, critical subsystems in Akash missile were made by Astra in this current conflict. AVAX, the Netra, the eyes in the sky, we have been a significant contributor to Netra and multiple radars which played a part. We have space, which has been more than a decade-old business in our company, and space continues to play a big part. I think the only diversification from non-defense which you would see, a little bit of exports, but again, they are predominantly used for defense industry, and the hydrologic and meteorological segment which we have. But again, if I sell it to the defense forces, wars are, climate plays a very critical role in determining the outcome of wars. So there is a very diversified revenue stream which makes us for predictability and sustainability of business which we require.
Atim, the numbers that we have are for March. Operation Sindoor took place after.
Yeah.
Has there been any ramp up of order inflows? Have you heard from the government about advanced procurement? Just asking whether, there has been a seminal change, a turning point in the kind of defense ordering that we should expect because of the geopolitical tension seen in the last few weeks.
Simple answer, yes. Okay.
Can you quantify that
There's a
then?
very significant interest, and more importantly, I think this operation proved the resilience and the strength of the domestic armaments which have been supplied to the defense companies, right? So I think there is a very strong sense of requirement of indigenous systems, Atmanirbhar systems.
No, indeed. Mr. Kabra, sorry to interrupt because we're, running short of time, but you said that we have seen a significant shift. Will you be able to quantify that? Like, are there more orders now, say in the month of April and May? Some analysts we were talking to said that some companies are now working 3 shifts. What is the change that you've seen that you can quantify?
I don't think they are overnight orders, if I may say, but there are very significant number of inquiries. There's a massive uptick in the inquiries which have come in. I think there is a process which has to be followed in the release of the orders, and these orders, when released, will translate into revenues. So we are quite certain about that.
Lots of questions, but paucity of time. Mr. Kabra, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of Astra Microwave on the road ahead, looking at around 1,300 crore of revenue in the current financial year. The stock, though, is down around 1.5% in today's session. Take a short break. On the other side, joined by Rohit Seksaria from Sundaram Mutual Fund for a market conversation. Welcome back, and onto a quick market conversation then. Rohit Seksaria from Sundaram Mutual is now joining in. Rohit, good morning. Thank you for joining in. What do you make of this earnings season so far? You know, there has been a lot of numbers that have either surpassed or they have disappointed on the street. I would single out FMCG in particular. Where in the FMCG space do you still find value, whether it is the discretionary or is it the staples? Where are you veering towards?
See, FMCG, we have always veered towards discretionary over staples. Valuations in the entire consumption space have always been rich. The key argument for discretionary have been the growth runway for discretionary is much longer and they have a higher growth path. And that's where we have veered towards discretionary. Even now, when we talk of the tax cuts and because of that fueling consumption, I believe most of that will go in discretionary consumption rather than staples. And that's where we prefer select discretionary pockets, whether be it your restaurant or luggage, durables, stuff like that.
Rohit, does Honasa come in consumer discretionary? Because that's clearly the stock of the day. Good earnings, and I remember the time when in the September quarter when the company reported a loss, investors were spooked that Mamaearth's growth is slowing down, so core earnings are under pressure, and the stock took a slam down. From a 52-week high of 540, it went down to 200 rupees. It's clawing its way back, but it's still about 40% away from the recent peaks. Have you looked at Honasa Consumer, and what are your thoughts now? Is it attractive?
Without getting into stock specific, in general, any space within the staple side has been marred by low volume growth. So that has been the key challenge there. And there we don't see a sharp uptick. You may see a small uptick in growth, but we believe valuations are more than pricing in that kind of an uptick.
What about autos, Rohit? Numbers have been, well, okay-ish, if you could call them that. We're still yet to hear from Bajaj Auto. But within the auto space, where do you go to? Whether it is two-wheelers, four-wheelers, tractor names, auto ancillaries, it's a very wide gamut to choose from.
Sure. So autos, we have been positive, but mostly towards ancillary side, we have been positive. However, going forward, I see green shoots on even the four-wheeler side, thanks to both what our view on consumption has been in terms of tax cuts or let's say the pay commission coming next year. Those should drive the growth on the four-wheeler side. Even in terms of when we talk of four-wheeler, one thing to keep in mind is the model cycle of individual companies. There are a few companies which have good launches lined up, and in our view, they will do better in the medium term when the launch happens.
What about IT? IT is doing well. Bernstein says it's turned the corner. US economy is still resilient. Financial services demand is actually quite strong. And we know that IT companies have about a 30-35% exposure to the BFSI sector. What's the broader call on IT, and do you own any in your portfolio, any stocks?
IT, we are more on a neutral side. On the positive side, you have rightly mentioned all the factors, but the key negative, which we don't know how it plays out over medium term, is the role of AI and how it changes the entire IT space and the way IT services are provided. So that's a key medium-term negative to be kept at the back of the mind. In the short term, AI will give a lot of opportunity to even our Indian IT companies. But moving beyond the short term, how it plays out in terms of the roles, in terms of the entire coding space, that we are not sure right now. So that's why we are keeping a more neutral stance on IT.
All right, Rohit, thank you so much for sparing time and joining us today. Looking forward to having you more often on this platform. Neutral on IT, the view from Rohit Seksaria, veering towards discretionary more compared to staples. But Vari Energies is now down 6.5%, still a recovery from the lows of the day. Deepak Fertilizers is one that has sprung to the lows of the day, now 4.75% lower there on that stock. And one that has been lower since the start of the trading session has been Gravita India. That too is down around 3.5% in today's trading session. By the way, you can see some lines on your screen from the Concor earnings call. Is the Exim volume growth guidance at 10%, domestic at 20%, exactly what the management told us before the call earlier in the day. And they're seeing a 13% volume growth is also what the management told us earlier in the day when they spoke to us before the call. And that is the earnings highlights from Concor, still 2.75% lower there. Reliance Power has now moved to the highest point of the day, 10.5% higher on that stock. The other one that has moved higher though is TBO Tech. It's going to be reporting results and the stock is up 8% in today's trading session. So good going there for TBO Tech. And as Rima was mentioning, IT is doing well for itself. So Midcap IT can't be the one left behind. First Source Solutions is up 4.5%. Zensar is up 4%. And some of the other names too are doing well for themselves in today's trading session. So good going for IT in today's session. And just before we take the break, IFCI is also now sprung to the highs of the day, now 7.5% higher on that stock as well.
BSE's rebounded. After yesterday's cut, BSE's actually come back. And I think there were some statements that Avas picked up that unless the expiries on, actually I don't remember exactly, but I think if it's only on Monday, then it would be a problem, Monday and Friday. Other days, it should be okay. So, but BSE is actually rebounded pretty well. And Viatech Vaba continues with its gains from yesterday. It was up nearly 5%. It's followed it up with another 2.5% up move. Get into a break then. On the other side, the management of Electronics Mart India will join in to discuss the Q4 numbers. Welcome back. As promised, let's focus on Electronics Mart India. The company saw its margins contract on account of increased sales of mobiles and rising share of revenue from Delhi NCR. Revenue growth was pretty okay. The company's top line went up by nearly 12.5–13%. To talk more, we have the management of now joining in, the CFO of the company, Mr. Deverakonda. Thank you very much, sir, for joining in. First, if you could just tell us what's the outlook on demand? What's the, say what would be your FY26 revenue guidance, the same store sales growth that you're anticipating in this year?
Good morning, and thank you very much for having me on your show. For FY26, we have revised our business plans in such a way that our top line growth would be around 12%, with same store sales growth of it will be between 6 and 7.
Sorry, I missed the revenue growth. 6 to 7% is the same store sales growth. And the top line would be?
Top line would be around 12%.
12% top line. Okay, so similar to last year broadly. And what about sustainable margins? Is there scope for you to improve margins? Because last year margins contracted. And what was the reason for that?
See, last year what happened, we could see the demand slow down from Q2 onwards. Q2, Q3, Q4, there was demand slowdown. It was mainly due to the what you call fog of inflation descending. So that has been ultimately translated to the demand slowdown, which resulted in the truncated margins. And for the current year also, we did witness demand slowdown for the air conditioners due to adverse weather conditions in the last 3-4 weeks. So as a result, I think this year also our EBITDA margins will be around 6.5%.
Mr. Deverakonda, good morning. Thank you for joining in. What's your store addition strategy going forward? Since you mentioned you've reworked your business plans for this year, where does your store addition strategy stand at? You added around 40 outlets now in FY25, and you currently operate around 200 stores, most of them being in Andhra and Telangana. So how many more do you plan on adding this year? And is there a plan to expand geographically as well?
See, this year we will be adding around 25 stores, of which around 6 to 7 stores will be around in NCR. And remaining stores will be in AP Telangana regions. And we had a plans to expand to other geographies, but currently we are soft pedaling. Probably for the next 2-4 quarters, we would see the market responses. Based on that, again, we'll speed up our expansion plans to other regions.
Okay. What would the breakup look like between North and South? Because currently, you're predominantly a player more in South of India. So going forward, what would the breakup with the store additions?
For the current year, like we will end up adding another 7 stores, as I mentioned, in the North cluster. And South cluster will be, we'll be adding stores organically in the South cluster. And it will continue for next couple of years.
So you're doubling down on the NCR region, Mr. Deverakonda, considering the fact that that's the only geography other than AP and Telangana where you're looking to add stores. What is the margin differential between the two, if you could tell us that? Because in FY25, your sales in the South came with a 7% margin, 7.2%, but the sales in the North were on a fairly lower margin.
Yeah, we are new in that North cluster. And year on year, in fact, if you look at the figures also, we have grown by almost 50 to 60% in the North cluster. And the same growth rate is expected in the current year as well. So once we reach those targets, definitely the margins in the North cluster will also improve.
How is the competition, sir, from large offline players, conglomerates, online giants? What's the competitive intensity looking like?
See, in mobile category, the penetration of online players is decent, whereas in other categories, in mobile as well as in the small appliances, their penetration is decent, whereas in large appliances as well as the televisions, so their penetration is relatively less. So I think we have to coexist. So we both will have our share.
You both will have your share, of course, Mr. Devarakonda. But, just to take that conversation away onto your working capital days, sir, your working capital days have increased to 80 now from 66, what they were at the end of March of 2022. What could be the reason behind that? And do you see that number trending down in this year?
What happened? Last year, there was heavy demand for air conditioners. In anticipation of similar trend, so everyone invested heavily in the air conditioner inventory, and that has resulted in because the season starts sometime in the last week of March and ends in the month of June. So that is the scenario. So this time we also, and in fact, on top of it, we added 40 more stores in the current year. So we have to maintain minimum inventory in display as well as backup stock. So for all these reasons, that was the scenario. But it will be evened out by end of the first quarter or latest by second.
But sorry, just one final question, sir. Was the decision to reduce the number of store additions a conscious decision? Because usually for expansion, you would look to add more number of stores compared to what you did last year, but you're adding lesser compared to what you did in FY25.
Last year was in a different scenario because we want to have our presence across all the district headquarters in AP Telangana. So that was our plan, and right now we have expanded to all the territories within these two states, and the scenario will not be same this year because our penetration is much decent compared to earlier years. So that's why it will be a steady growth year on.
Thank you, sir, for joining in. Pleasure chatting with you. For the markets holding up, the Nifty is above 24,800, but it's come off about 50 points from the top. It's still going strong, up nearly 1% on the benchmark indices. It's a wrap on Trading Hour from the entire team. Thank you for watching.
Stocks rebound after Thursday's weak trade with heavyweights in the lead. FMCG and IT, the big gainers, even as healthcare drags.
Sun Pharma reports an in-line number but guides for only mid to high single-digit top-line growth given global uncertainties and a plan to spend more on R&D and product development also dents sentiment.
ITC gains as analysts expect input cost pressures to ease going forward after the tobacco to FMCG major reported healthy revenues but a dip in margins in the fourth quarter. Pickup in exports is an added kicker.
SEBI Chairman Tuhin Kanta Pandey tells CNBC a probe into insider trading at Innocent Bank is on and the regulator is looking into the issue of disclosures. He also confirms the investigation into investments by Mauritius entities in Adani Group companies is continuing.
Reliance Industries Chairman Mukesh Ambani commits to targeting 75,000 crore of investment in the Northeast at the Investors Summit and bats for transforming the region into a healthcare and research hub.
Very good afternoon. You're watching Halftime Report on CNBC TV18. I'm Ekta Batra and with me is Mangalam Malu. Well, it's definitely turning out to be a better session than what we've seen in terms of, the subdued nature of the markets in the past couple of days. So we have the Bank Nifty, which is up around 0.5% at this point in time. We have the Nifty, which is up around 230 odd points. A lot of stocks which are buzzing around on the back of news. We have an advanced decline ratio, which is in positive terrain, giving you an indication that there's a lot of upside in the broader markets in terms of specific stocks, which we will be covering in the next couple of minutes. But just want to point out a couple of them. Say, for example, an Emcure Pharma, which is up around 10 odd percent. We have Thyrocare, which is up another 4.5 odd percent. Subex, JBM Auto, Tata Chemicals, all of these stocks which are showing some amount of good traction on the upside, both on the volume as well as on the pricing front. Hi, Mangalam.
Hi, Ekta. Yesterday we were down 200 points. Today we're up 240 points. So going good for the market. The question is whether it sustains above the 24,850 to 24,900 mark or not, where it has been finding a lot of congestion and supply. Your portfolios would feel a lot better today because you have nearly 2 stocks advancing for everyone, which is declining, and a bunch of these cash stocks, they're surging. And why just cash stocks? Look at something like a Eternal, which is basically, among the top gainers on the Nifty today. After underperforming for a while, it's turned positive for the month. So that's the frontline index stock that we're talking about. But barring that as well, we have, First Source, which has moved higher. Max Financial is higher. Varun Beverages is another one which is higher. And Angel One definitely has taken the toast this month with a gain of almost 30% for the month of May so far. So a big mover is what we've seen in the form of Angel One. And in the cash names, we have TBO Tech on the back of good numbers, TVS Supply Chain, Affle India and Honasa. Honasa, remember, has halved from the top and now is seeing some bit of recovery. Why is that? Because maybe the tide is turning when it comes to the numbers. In the fourth quarter, the company reported a near 13.3% growth in their revenue. Notwithstanding the margin compression, the street was worried about revenues not coming back. That has come back. Now let's see whether margins return or not. What's good is a couple of the internals. Mamaearth, which is of course mainstay of Honasa, has seen 70% of its portfolio, which is the core portfolio, grow in double digits in important channels. They've increased their presence in retail as well. While they've increased their ad spends and other expenses on account of the distribution reset, we'll have to monitor how operating leverage plays out for them. The underlying volume growth in the fourth quarter has been 21.2%, which has far outpaced all the others in the FMCG space. Apart from Mamaearth, the Dermaco has crossed 100 crores in offline revenue, and we've also seen 30% growth for some of their other brands, which include the likes of BBlunt and Aqualogica. All said and done, after a big gash in the stock from the top, there are some signs of recovery, and the street is latching onto that with a 17% gain.
Okay, all right. So that's Honasa Consumer. Thanks, Mangalam, for that. But let's move to pharmaceuticals now. Sun Pharma is the top Nifty loser. It's under pressure after reporting an operationally in-line quarter. Net profit was subdued while margins came in healthy. I did catch up with Sun Pharma's Group CFO, CS Muralidharan, and began by asking him how the company is planning to use that additional $100 million that they are planning to spend in FY26.
So the $100 million spend is related to the two new specialty product Lexelvia and Loxid launch in the United States. And this spend will be covering all the launch-related expenses in the current fiscal.
Okay. You're also increasing R&D spend to 6 to 8% of sales. Where will this incremental spend go?
So we have shared our product pipeline in our press release yesterday. So the clinical trials in respect of those pipeline products are undergoing, and the expenses are intended towards that, apart from the normal R&D spend on the generic portfolio.
Okay. What would this do to your margins in FY26, considering the additional $100 million in terms of spend, as well as the R&D expenditure increasing to 6 to 8% of sales?
See, we are not giving any specific guidance on margins. However, it's important to note that our key growth drivers like global specialty business, India, emerging markets, and other business are well positioned to grow. We continue to focus on cost and operational efficiencies, remain competitive, and thereby aim to improve profitability. Having said that, the $100 million expenses related to the launch of 2 new specialty products needs to be factored in overall modeling.
All right. Well, let's talk about the top line revenue guidance then, where you have indicated it's high single-digit top line growth, mid to high single-digit top line growth. The company has mentioned global uncertainty as a reason for that. If you could elaborate.
So in our earnings call, we did share our revenue guidance for FY26, which is mid to high single digit. This revenue guidance is after considering various regulatory uncertainties prevailing in the United States and other places, and that's the reason why we are given a wide range of guidance.
Okay, so it's trying to factor in what could happen with the tariffs?
See, we are not able at this point of time to understand the real notification. As soon as it comes, we'll be able to read the fine print and interpret it. As of now, there is no clarity in terms of the regulations, neither for tariff nor for other aspects in US. As a result, we are not able to measure the same.
High single digit to low double digit revenue growth.
I think we need to wait for getting more clarity on some of these specific matters for us to understand better.
Okay. Your specialty sales, they grew around 8.6% year on year in Q4 versus estimates of maybe a double-digit growth. Were there any slower sales this quarter when it came to your specialty portfolio? Was it in line with what the company was expecting?
So the global specialty sales for the Q4 was about $295 million, up by about 8.6%. However, if you see the FY25, the global specialty revenues were $1.2 billion, up 17.1% year on year. And more important factor to reckon is that the share of specialty sales to consolidated revenues on the full year basis has moved to 19.7% current fiscal as against 18% the previous year. And I think it's important also to note that we have been consistently increasing the share of specialty revenues to the consolidated revenues every year.
Okay, but are we expecting this kind of growth going forward in FY26, single-digit growth in specialty sales per quarter?
I did mention that all our key products in specialty are well positioned to grow, and we expect to maintain the growth trajectory for the specialty portfolio.
$1.2 billion is your exit rate for FY25. What can we expect for FY26?
See, this has been factored in overall revenue guidance, what we are given.
Okay, all right. What is your sense on Illumia's run rate, given that there could be incremental competition coming into the space?
We stated in the earnings call that in respect of any biosimilars on the Illumia, at this point of time, we do not expect any headwinds.
All right. MM2 is basically one of the drugs under development. You're looking for a partner for it. Could you give us more details?
See, we did a strategic reassessment of our pipeline, and based on that, we have come to the conclusion that we will look for a partner with whom we can develop and launch.
All right. By when?
So there's no timelines as such. First, we need to look for the right strategic partner who will be able to do work along with this and bring this product to the market.
All right. GL0034, which is basically what you're looking at in the diabetes space, is that an equivalent or a competitor to, say, the Mounjaros and the Wegovy's of the world?
So, in terms of, we we feel that the product is attractive and competitive profile compared to the type 2 diabetes products that are in the market.
Okay, so that would be a GLP-1 inhibitor.
Yes.
All right. And it would be on the innovation side.
Yes, please.
All right. How are you playing the semaglutide opportunity where it goes off patent in multiple countries next year?
So we have stated that we are well positioned to launch the product both in India and emerging markets.
All right. And what kind of competition do you expect in this space?
See, the product is quite attractive. There are other companies who also given their commentary in terms of their position to launch. So at this point of time, we are focusing our preparation for the launch and to be successful on this product.
Talking about acquisitions, you have around $3 billion of cash on your books. So any utilization plans, any M&A on the horizon?
We continue to look at strengthening our specialty portfolio through the in-licensing opportunities. What we have seen in the last 3 years, you have seen we have acquired Concert Pharmaceutical through whom the Lextel came in. Recently, we are undertaking the transaction of Checkpoint through an Unlocks that has come in. As a result of which, we'll continue to look at portfolio in the area of onco, derm and optal to further add to our portfolio.
The size?
We have got war chest in the balance sheet subject to the product being attractive and we will be able to do well in the market. I don't think size is a constraint at this point of time.
What is the risk of launching Lexelvi in Q2? You do have a litigation. It will be an at-risk launch.
Yeah, it will be at-risk launch, which I've shared yesterday.
Okay. Any contingency plan for it?
Not required at this point of time. Since we have a favorable judgment, we are preparing for launch.
What is your expectation when it comes to tariffs?
Too early to comment. I said at the beginning of the call, we yet to see the fine print. As and when it is finalized by the US government, then we need to interpret the regulations and then decide.
Are you considering onshore manufacturing?
Not at this point of time.
Okay. All right. So it's not on the cards. Just a quick update before we let you go. Update on Halol and the Dadra and Mohali site.
We have mentioned that we have requested the agency for an audit in Halol. As regards Mohali and Dadra is concerned, we are still working on the remediation processes. And as soon as we complete, we will inform the agency.
All right, those are some comments coming in from the management of Sun Pharma, the stock among the top Nifty losers in today's trading session. With that, we'll slip into a short break, but on the other side, a lot more pharma talk lined up for you. The management of Mankind Pharma joins in to discuss the quarter gone by and the year coming ahead.
Welcome back. You're still tuned into Halftime Report on CNBC TV18. Well, let's get talking to one particular company. Mankind Pharma is the next management on the show. Revenue growth came in line, led by domestic and export markets. To discuss this and more, we have Rajeev Juneja, who's the Vice Chairman and Managing Director of the company, joining in. Mr. Juneja, hi. Welcome to the show. Good to see you in. Let's start with the margin guidance. That was a little bit of a disappointment to the street because you've guided for around 25 to 26%. The street was probably working with around 27%. It's a small difference, but nonetheless, what is your guidance on margins based on? And is there a chance of probably surpassing it or increasing it?
Hi, Ekta. Good morning. And whenever we go for any kind of a guidance, we make sure that we basically come up to that. Rather, we should surprise the market. And historically, we have always been very, very conservative company. And in the last couple of quarters, we have done plenty of, improvements, changes. You can call it commercial excellence. A lot of changes have happened in the last couple of years in Mankind, couple of quarters in Mankind. Based on that, we can say that whatever we commit to the market, we should come with flying color. And that's one reason we have given 25 to 26%. Even last year, you see what was our guidance. It was 25 to 26%. We came to 26% around.
Okay, all right. So you are probably looking to maybe increase it as you go along. Just wanted to, before we talk about the BSV acquisition, actually, let's talk about the BSV acquisition because that's linked to, your margins as well. You had indicated that, there would be synergies between 12 to 24 months. Where does that stand in terms of synergies with BSV? And what is the launch pipeline looking like? I know you've increased your market share in gynecology, but overall, what would the launch pipeline in women's health and gynecology look like now?
Look at this synergy, look at this BSV. In the month of October, we just took this company in our fold. And whatever initial steps are very, very important once you take over a company is just go inside, try to integrate, understand the company. It takes some time. And one of the most important thing we have done is that we have brought top leadership changes a bit as far as the domestic is concerned. We brought some leader from the topmost companies in gynecology and brought over there. BSV also had one more portfolio that they took from TTK that we have taken in the fold of Mankind prescription side. Because if you just look at BSV has two sides. One is high entry barrier, IVF, anti-venom, vaccine side. And the second side, they are just Me Too generic products, branded generic products like we promote that basically has come to Mankind side. But these products are iconic brands, Usopan and Lactea. These are very, very good brands. So we have two jobs in our hand. One, making sure that these products, which have come in Delhi division of Mankind, reach to maximum number of customers, and we can exploit the full potential of that. The second basically is what? Making sure that BSV's great products, amazing products, have good penetration. We can reach to the masses. That we are doing. And as far as the new launches are concerned, it's very early to speak anything about that.
What about the diabetes product? You did say that you are looking to expand out there and you've made notable strides in R&D for a molecule for obesity plus diabetes. So I wanted your thoughts on how far are we away from the launch? What's the progress on out-licensing, etc.? That's point number one. And are you also looking at semaglutide? You said sometime next year. What's the plan here?
The first question's answer basically is what? It is in phase 2, and I cannot tell you in how many months, but we'll try to just fasten up the process of phase 2, and that's one reason it is not happening in India. We are basically very hungry, very aggressive. We just want somehow that this product should come in the market because initial results are quite encouraging, and that's one reason we are putting our bucks on that particular product. As far as the semaglutide is concerned, this product will get off patent next year, And we are quite hopeful that we'll get in license, we'll get this product to be launched next year.
How big is the opportunity here? I mean, what we're trying to understand is from a Mankind Pharma standpoint, what's the revenue target, market share target that you would have? What is the size of the market here in India, and how much would you get?
Cannot give any kind of projection on that, but we are very, very happy and excited that we will be launching. And as far as the opportunity is concerned, there's a tremendous opportunity because this is not a kind of a product. This will not remain a kind of a product which will remain in the hands of only topmost doctors or specialist doctors. This will go down the line as well. Gynecologists, physicians, surgeons, diabetologists, everybody would be needing. Every place this product would be having some kind of a scope. And since our reach is very, very deep, so we see that we're a very appropriate company to launch this product.
Okay. Well, just wanted to touch upon the OTC segment. You grew around 15% in FY25, and it seems as though the changes that you had made in this particular segment are now probably showing up in terms of numbers. Give us a sense in terms of what the new launches are, and are you going to probably better this 15% growth?
We basically say, we'll always be in high teens as far as the growth is concerned. And we took one product from Panacea, Nimulid, that is in launching stage. Initial response is very good. Plus, in consumer side, it's never the new launches. It is always whatever brands you have built. How can you just increase the sales of those products by launching different SKUs? And that we are continuously doing it. Whether it's Praga News or Manforce. Gas-So-Fast is one brand we are very, very bullish. It is growing at a very, very good growth, 26% plus. One more product where we are just having a lot of expectations, that is OVA News. On these products we're working right now.
Okay. Now, just coming to the debt part of it, you have debt of around 5,784 crores. You have reduced your debt, say, on a Q-on-Q basis, because you did have that hotel that you sold, the Mahananda Spa to Chalet Hotels for 530 odd crores. Any more such transactions, and what would your debt reduction plan be?
We said in the starting of our quarter that the debt to EBITDA ratio would be less than two times. So it stands right now 1.8 times. Don't have any extra kind of a side business or any subsidiary which can be hived off. Hopefully, by the end of 27, early 28, this will be totally repaid back.
Right. And final question, domestic business, which crossed about 10,000 crores in FY25. You have a target of growing it by 26% in the next year in FY26. How much of that will come from chronic? How much of that will come from consumer? How much of that will come from BSV? If you could break that 26% growth up in terms of what the contributors of these growth will be.
See, as far as the chronic is concerned, we basically are making all the efforts to make sure that chronic really grows. Last year, our chronic has come to 37% of our total sales. BSV will do its own bit. But hopefully, we'll be growing more than the IPM, 1.2 times to 1.3 times next year. These are the expectations. OTC is doing fantastic.
Okay. Just on the acute, how much are you expecting it to grow vis-a-vis chronic?
As a whole, we can say that to IPM and this as a whole, this will be 1.2 to 1.3 times total revenue. In chronic side, we can expect 1.3 to 1.4 times, and the rest will fall on acute side.
Okay, all right, Mr. Janeja, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Mankind Pharma, that's stock a bit subdued, down around 1%. Well, we take a short break. Up next, we'll focus on the F-note trades at this time.
Welcome back. A couple of stocks are picking pace. TBO Tech, like we pointed out at the start of the show, TVS Supply Chain, Juniper Hotels, and we have Reliance Infra as well. Reliance Infra is the one that should actually come up for you. A lot of the gains happened in just the last 10-15 minutes or so. The stock is spiked. It was flattish for most part of the day. Then between 11 and 12, it saw one wave of an up move, and now as we speak, it's moved to the high point of trade with a big gain as well. Cosmo First is the other one, which is up 6%. But good time to get in the F&O perspective on the market. The frontline indices are bouncing back after a decline that we saw yesterday. The Nifty Bank, and the Midcap index. The Nifty Bank up around 0.75% after having closed at the 20-day moving average in yesterday's session. It recovered in the last hour to close past that, and the Nifty is building onto those gains, led further by IT and FMCG stocks. The Midcap index in step with the frontline indices. Good advanced decline ratios as well. The green and red lines are far and wide apart, with nearly 2 stocks advancing for every stock that is declining. Let's see where we go from here, largely because, you know, the 24,600 call writers are now being taken to cleaners. The premium has spiked out there, and it's very early days in the next week's expiry. It's day 1 itself. But as the markets moved higher, put writers have gotten some strength back. So 24,800 put seeing a lot of writing, 24,700 put seeing writing as well, telling you that there would be support around 24,550 to 24,600. But on the way up, 24,900 call writers are equally active, telling you there would be sustained supply around 25,000 to 25,100. And if the market sustains above 24,900 today, then there could be case for further short covering as well. Also, watch out for the put-call ratio, which has moved slightly higher to 1.15, typically indicates a topping out at around 1.25, 1.3. So that's something we'll watch for. And a lot of stocks in focus, short covering, fairly active in Varun Beverages and Eternal, the erstwhile Zomato. And a lot of shorts added on Container Corp, though the stock has recovered from the lows. Good commentary coming in from the management in the conference call and to our channel this morning as well. It'll be very interesting to see whether it sees a bit of a bounce back from here on or not. The stock has been an underperformer. Lower today, some shorts. Let's see whether they unwind or not. But with that, we'll take a short break. On the other side, we have another management, another pharmaceutical company. We have Strides Pharma joining in for their fourth quarter earnings.
Welcome back. Well, let's get talking to another pharmaceutical company now. We have Strides Pharma Science, which is the next management on the show. Revenue has grown by around 14%. Growth was led by strong performance in the US, new launches and efficient execution as per the management. We have Arun Kumar, who's the founder and the non-executive chairperson of Strides, joining in now. Mr. Kumar, good to see you in. Welcome to the show. Well, if you could just start by talking about the FY26 guidance, because you have met FY25 guidance. What are you now projecting for FY26, say, when it comes to revenue, when it comes to your EBITDA, as well as your debt to EBITDA and US markets?
Hi, Anita. Thanks for having me on your show. We actually as a company don't give guidance, but we had quite some turbulent times the last 3 years. So we guided to an extent where we wanted to be sure that we were executing right. And in the last call, we decided that we would not provide a guidance. But we have had a strong FY25. We are very confident that we'll grow from there, both on revenue and EBITDA. And our focus is obviously the balance sheet, where we believe that our strong cash flow generation that we had this year can be replicated, further deleveraging. At this time, we are very comfortable on the strength of our balance sheet, the fact that we have reduced our debt from a high of 5 times to under 1.9. And I think we've got lots of headroom to even grow the business from here based on the strong operating cash. So yeah, I think our exit run rates would be a good base to set targets for the going forward years. And a larger outlook that we have to achieve a 400 million sale in FY27-28 in the US is on track. So yeah, it's overall been a great year, a great comeback year, a fantastic teamwork, and we've delivered on everything we said we would. And I think we'll continue growing from there.
Okay, so I just want to narrow down on this $400 million by FY27, FY28 in the US. What is that predicated on? How many products are you looking to launch? You have, plans of reintroducing 60 products, which are dormant at this point in time. But would it primarily be led by generic drugs, or do you see some opportunity in terms of exclusivity, etc.?
So we have two parts of our US business. The first part, obviously, is our niche products in the generic space. More than 40 of our 70 products that are launched in the US, we are market leaders for many years. There's very little competition in these programs because they are either hard to make or hard to get APIs. That will lead us to get to the 400 million target that we have set for ourselves. This obviously, as you rightly pointed out, would be from our library of products. We now have about 260 plus ANDAs. We have only commercialized 70 of them. And while we lose some market share in products, as is the case in the US business, we'll continue to add new programs and new products to get to the 400 million. So we're kind of fully ready for the 400 million in terms of portfolio. We have launched 5 to 6 products in the last year from the old portfolio, and we are very measured in terms of timing and pricing. So we wait for the right opportunity to get our products launched. But we've now, since the last 2 or 3 quarters, been talking about what after the 400 million generics play in the US. We've called something called Beyond Generics. And Beyond Generics is really addressing your question, is more to 505(b)(2)s in specialty pharma. Our first product was filed in that program, and they are mainly controlled substance drugs in different domains and formats, which only our New York facility can produce. And that, again, is a very specialized area which we are very focusing on. So it's nasal sprays and 505(b)(2)s.
So let's take that further itself. Your exit run rate in the fourth quarter was close to around $330 million in the US. Do you think that that is a level that one can expect in FY26 before you move to FY27, FY28 and get to that $100 million per quarter sort of run rate in the US? And beyond generics, beyond $400 million, do you have an aspirational target here, say by FY30, FY32? Are we looking at $1 billion?
Our 400 million story is based on niche average revenues of $5 to $7 million per product. we work on the low end of the value chain, which is very attractive for us. And we think we have everything that's required to get us there in place. On the beyond 400, typically our average product filing size is between $25 and $50 million of revenue goals. So it's a very significant shift in our strategic play in the US. And they're obviously more exclusive developments. And like I said, they're mostly 505B2s. And there we haven't put a revenue number as yet. But what we're doing will almost be a 5A index equivalent to one product that we have in the beyond 500, 400 play. So yeah, it's completely differentiated between.
How many products are you eyeing then, if you can back calculate that?
Well, I think we would have a portfolio of over 25 products. Not everything will be very successful, but they're very expensive developments. Each of these developments are significantly higher than a regular NDA. So yeah, so I think you'll see that playing through in the next 12, 14 months when we expect to receive our first product approval in that space.
All right. Arun, you're mentioning the US markets. You've been looking at the US markets for years now, from different administrations. And now you're working with the possibility of tariffs coming through, onshore manufacturing being encouraged. I think I heard you mention a New York facility as well. So take us through where you stand when it comes to the entire situation in the US on tariffs as well as onshore manufacturing.
Yeah, so at the manufacturing high volume generic prescription products is not feasible in the US. That's not going to happen. It has to be significantly high-end products. Cost of manufacturing is between 3.5 to 4 times more than Asian manufacturing. So to assume that generics can be onshored overnight unless supported by very significant subsidies or a capital allocation from the government, the US government, I don't think you'll see a lot of generic products moving into the US. It's just not practical unless the market is willing to accept a much higher price. At the same time, there are very nice niche businesses that require US manufacturing, and therefore our US plant in New York kind of fits that segue very well. And we are excited about that operation because we've now crossed over $100 million of revenues from that plant, which also means that producing in the US makes sense. But then the limitation is the portfolio, the type of products, and typically they have to be products which are not necessarily generics, but has to have something generic plus. So I think there's a lot to wait to play out. My personal belief is that generics will not get severely impacted by tariffs, but it's a very hard call to take in with the ambiguity in the geopolitical situation, especially with tariffs. I think the next 90 days will be crucial when everything settles down. For us personally, as a company, we have been a contrarian play forever. We solidly believe in the US opportunity, and we've been growing nicely and roundly in that market. I'm sure that if tariffs hit our business, there are opportunities for us to absorb some costs, but not impacting our financial goals. And the rest will have to, unfortunately, be passed on to consumers. But that's what I think most companies will have to do, end up doing rather.
You want to give a quick one on your margins and your net debt as well? Because I remember, at some point the margins did touch that 20% mark as well, were a multi-quarter high. Thereafter, you said they were sustainable. They're meandering just a little below that 20% mark. And with the kind of launches...
So don't forget that these numbers are adjusted for a very high margin soft gelatin business, which was carved out into one source. And that's what obviously delivered the $800-900 million of value creation to the Strides shareholders. We are very confident of getting to the 20% even in our base business. But it's a process of time. We still have some more work to do on our operational costs, our under recoveries, which is standard. Network optimization stuff all of us in the generic industry do and live by day in and day out. I'm very confident that we'll be closer to the 20% in FY26.
All right, Arun, we're going to leave it on that note. Thanks very much for joining in and giving us your perspective on strides. So that's the stock. 723 odd rupees, down around 1% We'll take a short break. But here is some good news for our viewers. India's business news leader is now a click away, introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back. Let's get you some earnings expectations. Then JSW Steel reports its fourth quarter numbers today. Nigel joins in with the key expectations. Nigel.
Well, that's right. Let's look at the consolidated numbers then. For JSW Steel on the top line, we're expecting a more or less flattish to a mildly negative number of around close to around 3%. That's because steel prices have been under pressure. On the EBITDA front, though, there could be some improvement. It should jump up by close to around 7%. The profit number all over the place would be going with a number of close to around 1,470. Most brokerages are in the vicinity of around 1,300 crores to around 1,700 crores. Well, moving to the factors at play. The problem is on realizations. Year-on-year basis, it'll be very, very low. It'll be a big degrowth out there. So that's why on the top line, we're expecting a bit of a negative number. On a sequential basis, though, realizations have jumped up by close to around 1%. The crucial number to track for JSW Steel will be the standalone EBITDA per ton. And this time around, we are moving with an improvement of close to around 900 rupees on a sequential as well as on a year-on-year basis. So it should come in the vicinity of around 8,800 crores. How is that possible? Because of the cost efficiencies that they've been focusing on. Coking coal cost as well should cool off, like we have seen with Tata Steel as well. They got some benefit of that. And some realization improvement will help them on a sequential basis. The overseas business could continue to report a loss, but those losses should come down from the loss that we saw in the previous quarter. That's quarter 3, FY25. The things to track from here on, the most crucial aspect will be what is their commentary on the liquidation of the Bhushan Power and Steel asset, because that's going to be top of mind. How much money can they get back? Will they rebid if it comes up for auctioning, or can they, make it through with a penalty or so? We'll have to hear out the management's commentary on that. Besides that, demand, pricing trends, as well as overseas operations, that's something that we'll be tracking. We'll expect the numbers post-market hours today. Back to you.
Okay, all right, Nigel. Thanks very much for that. That's on GSW Steel. We take a short break. Manisha Gupta will be with us next to take us through what she's tracking in the commodities space.
Welcome back. Joining us on the show now is Sandeep Bajoria. He's CEO at Sunwin Group. Mr. Bajoria, hi. Thank you so much for joining in. I want to first talk about the edible oil imports into India. We do understand, and we've reacted to this so many times, that Feb imports of edible oil into India were the lowest in 4 years. But then March and April have seen some strength. How are you looking at May? And what's your sense now going forward?
Manishadi, you're right. January, February, March and April, all the 4 months together, average import was only 9 lakh tons, which was one of the lowest in the recent history. But coming to the May import, I believe it's going to be something around 11 lakh tons, 11.5 lakh tons. June will go up to 12.5. And July, August, September, October, we should reaching about 13.5 to 14 lakh import. Because that's going to be really off-season for us. Domestic crop availability will be lower. So we require imports for meeting our needs. So I believe India has been a very sensible buyer recently. They never overloaded themselves. And that was a good thing Indian importers did, Most of the time you over-import and then everybody makes a big loss. Doesn't make any sense. So that's what the situation is now.
Mr. Bajoria, I also want to talk about the kind of consumption pattern that India has. I mean, we know it was not very too far away when Indian PM had spoken about, lowering consumption of edible oil in the country. And there has been a lot of data floating around since then as well. 1960, and I quote a report here where it says that edible oil consumption was 3 kgs per capita, which stands at 23 kgs per capita right now. How do you look at this consumption pattern and where do you see it going from here?
Manisha ji, over the years, we have evolved as a country, as a population, and our standard of living has improved. But the way of eating has changed, So now, as per our estimate, the consumption is around 18.5 kg per person per year of the vegetable oil. Then we consume some ghee and other fats also. So, which 23, which you are referring, maybe totaling up the oils and fats and everything together. So, but however, in this consumption pattern, we have seen when the prices went up because of the duty hike last year in September, every year we used to have 3% growth in consumption. But instead of that, we saw about 3-4% decline in consumption because the oil, which was selling at 90-95 rupees per kg, went up to 130 per kg. So that's the reason. Definitely, India is a very price elastic market as far as veg oil is concerned. So we saw that kind of a degrowth in consumption. Anyway, but I think now prices have come back again to lower level from 135 kgs. The prices are something around 120 rupee a kg now. So this is a pretty equilibrium price, and at this price, I believe consumption is going to increase, and that's why we're going to step up imports in coming months. And Prime Minister said in his own way is right that whatever way we can reduce the consumption, that's okay. But some reduction was possible, but beyond that, it is not workable because after all, you cannot change your eating habits overnight. And when a lot of in population also we have the rich, and then we have middle class, and then we have people below that. So the rich consume something around 40 kgs per person per year. The middle class consumes around 23, 24 kgs per year, and the poor consume only about 10, 12 kgs per year. So that's a very skewed thing. So in fact, the poor class needs to increase the consumption, and the middle and the higher class needs to reduce the consumption.
And would you say it's very geographically done as well? Because Western India consumes more edible oil rather than what Northeast or North does?
Yes. You see, the Gujarat is very famous for fafdas, doklas, and all kinds of fried food. The highest consumption is in Gujarat of veg oil in India. So that's when I said 40 kgs. The Gujarat is much, much above national average. And Prime Minister's message is more targeted towards Gujarat than anywhere else. States like Uttar Pradesh and Bihar need to step up their consumption. So anyway, I think in a lighter vein, we all need to be healthy. But at the same time, we all need to take the daily supplement, whatever is needed for our body.
Right. It's a lighter vein, but the message is definitely, heavy-headed. It's an important message. Thank you so much. But as you said, fafdas, and it might be, very oil-rich, but it's tasty, Manisha.
I think that is where it comes in from. 40.
Absolutely.
You're saying what? Gujarat is more per capita. How much is it?
The Gujarat per se, if you say as a state, the per capita consumption is 27 kgs per person.
And what would Maharashtra be?
Maharashtra would be about 21, and national average is about 18.5.
All right, there you have
I thought Maharashtra would also have, its own share of vada pavs and batata vadas, etc.
No, but still Maharashtra is not that much as Gujarat is there. So as far as edible oil people, Gujarat is a paradise,
Would you have a seasonal breakup? Because during monsoons, a lot more fried food is consumed.
Yes, you're right. You're absolutely right. In summer, the edible oil consumption reduces. In the month of May, we have the lowest consumption of edible oil because it's so hot and people don't want to eat fried food. And even in a lot of states in India, there's a lot of mangoes coming in. So people eat roti and mango, veg oil and vegetables. So, but in monsoon season, you're right that you want to eat pakoras, you want to eat vada pav and everything.
It's becoming about food every day.
This is one of the most fulfilling conversations I've had, Manisha. I have to say this.
June, July, the consumption goes up again. And
I can bet on that.
Festival season starts. Thereafter, festival season starts from August onwards till Diwali.
For edible oil industry, this clearly is a start of a good time. Mr. Bajoria, thank you so much for joining in. And yesterday it was pizzas. Today it's pakoras?
Today it's pakoras. So yesterday pizzas were sent to our office. Let's hope pakoras come to our office today or not as well. But as we talk about that, we just talk about it. I'm telling you, we won't eat any of these because he said you have to take care of your health as well. Take a short break, come back, business lunch. You watch business lunch while we go and look for some pakoras in our office.
Stocks rebound after Thursday's weak session with heavyweights in the lead. FMCG and IT are the big gainers, even as healthcare drags. It was an inline quarter for Sun Pharma, but guidance is only for a mid to high single-digit top-line growth, even as global uncertainties persist. A plan to spend more on R&D and product development also dents sentiment. ITC gains as analysts expect input cost pressures to ease going forward after the tobacco to FMCG major reported healthy revenues, but a dip in margins in the fourth quarter. A pickup in exports is an added kicker. SEBI Chair Tuhin Kantapande says that all issues with NSE will be resolved as the exchange is amenable to solutions. He adds that SEBI may release its F&O rules as early as this month, following over 800 responses to its consultation paper. And Reliance Industries Chairman Mukesh Ambani commits to targeting 75,000 crore rupees worth of investment in the Northeast at the Investors Summit and bats for transforming the region into a healthcare and research hub. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I am Hormuz Fatakia. The markets are in absolute cruise control. As of now, the index continues to remain at that 24,900 mark, almost 300 points higher on the Nifty. The Sensex doing very well for itself as well, almost 900 points higher. The Midcap index and the Smallcap index are trailing the benchmark indices, but of course they too are trading with healthy gains for themselves. The Midcap index is at the highest point of the day, 0.7% higher. The small cap index is also catching up with the Nifty now, almost 1% higher on that as well. So it's an all-around green screen that we are seeing for the markets in today's trading session. Of course, the gains are being led by the index heavyweights, and that is evident from the contributors that you would see in today's trading session. Of course, it is them that are leading the charge as well. But the big event for today is the fact that the Reserve Bank of India's board meeting is scheduled to review their FY25 balance sheet and decide on a dividend payout to the government. Now, last week, the board had reviewed the economic capital framework ahead of the dividend payout. Now, the big debate in the money market is how much dividend the RBI is likely to give the government. Now, a CNBC TV18 poll sees that figure at 3 trillion rupees. Latha Venkatesh explains why the dividend may be even more than what the poll indicates.
Markets, especially bond markets, are keenly awaiting the Reserve Bank's dividend. As per the budget estimates, it should be around 2.5 trillion rupees. In fact, a little less, versus 2.1 trillion that the RBI declared last year. However, there is a widespread feeling in the market it will be more than 2.5 trillion. So we did a poll, and a poll of economists, which indicated that the dividend may be 3 trillion rupees. Here's why the market is expecting a bigger dividend. The Reserve Bank of India data shows that RBI has sold a whopping $415 billion in FY25, that is from April 2024 to March 2025. This compares with sales of only $153 billion in FY24. Now, you know, every time the Reserve Bank sells a dollar, it will be at the current price at right now 84 or 85 rupees, but its purchase price is calculated as the average of all the reserves that it has accumulated. Right now it works to around 78 rupees, according to experts. So the Reserve Bank had made about 6.5 rupees profit every time it sold dollars in FY25. That means the Reserve Bank made 6.5 rupees multiplied by 415 billion, that is 2.7 trillion rupees. In FY24, if you saw the math, the Reserve Bank sold only $153 billion, and therefore it made only 1.2 trillion rupees. So only on this count, on dollar sales, the surplus of the Reserve Bank in FY25 would have been 1.5 trillion rupees more than in FY24. Last year's dividend was 2.1 trillion, so this year's can be 3.6 trillion rupees, according to this math. However, there are two other important components of the RBI's income, and they are interest income on foreign securities that they hold and Government of India bonds that they hold. Now, RBI's foreign securities holding as of March 31 was a whopping 48.6 trillion, but that's only marginally higher than what it was last year as of March 31, 24. It was about 48 trillion. While Reserve Bank of India's India securities, Government of India securities, was 15.6 trillion in FY25 end, slightly higher than 13.6 trillion last year, that is FY24. But because of rate cuts in the year gone by, total interest income from Government of India bonds this in FY25 would have been slightly lower than last year's. In short, RBI's income is expected to be 1.5 trillion more than last year, largely because of profit on dollar sales. Now let's come to expenditure. As for RBI's expenditure, the big change, a changing element, if you can call it, is how much Reserve Bank transfers to the contingency reserve fund. Salary and all that remain the same. Now, the Jalan panel requires that RBI has to keep 5.5 to 6.5% of its balance sheet as reserves. In FY25, an RBI panel reviewed the rule. But we don't know if they changed this 5.5 to 6.5 requirement. As of March 2024, Reserve Bank's reserves were at 6.5% of the balance sheet. Now, RBI may exercise its option and bring down the reserves to 5.5%. That is still within Jalan Committee rules, given that there are higher defense expenses for the government this year. Also, there is no fear that higher money printing will increase inflation because this year, CPI inflation is expected to remain below 4% for the entire year. Hence, the expectation that the Reserve Bank may declare a 3.5 trillion rupee dividend this year.
All eyes on the RBI board meeting and the outcome of that later this evening. But meanwhile, there has also been a rejig on the Sensex, and that will be effective from the 23rd of June. Now, Vivek is here to tell us what will the changes be, Vivek?
Well, last night, slightly surprising because generally, the Sensex rejig comes in at the end of the week or on a Friday. But on a Thursday, the Sensex Index Committee decided to go ahead and announce changes across the various BSE indices. Key amongst them being the fact that the Sensex will now have a new look, like you mentioned, from 23rd of June 2025. So now in this particular reconstitution, there are two inclusions. So Trent as well as Bharat Electronics will come into the Sensex. On the other hand, Nestle and IndusInd Bank will make the way as far as these two constituents are concerned. Now, on 20th of June, IIFL Capital estimates that there could be inflows of close to a little over $300 million as far as Trent is concerned. Bharat Electronics could see inflows of over $350 million. Nestle, on the other hand, could see outflows of $220 million, while IndusInd Bank could see outflows of a little over $130 million. So all in all, a new look Sensex is what you're looking at come mid-June.
Indeed, the two new Nifty entrants now part of the Sensex as well, Trent and BEL. Vivek, thanks a lot for that. Take a short break here on Business Lunch. On the other side, SEBI Chairman Tuhin Kanta Pandey speaks to CNBC on the listing of the National Stock Exchange. Key takeaways after the short break. Welcome back. Now, SEBI is not opposed to NSE's listing, is what SEBI Chairman Tuin Kanta Pandey has to say. Now, in a conversation with CNBC, he commented about NSE's listing, and the possible issues are yet to be resolved ahead of the exchange's listing on the primary markets.
Is SEBI fundamentally opposed to an NSE listing?
Not at all.
What needs to change within the NSE for SEBI to approve a listing?
I think there are certain issues which are being discussed and flagged, and in my belief is that they're going to be resolved soon.
In your discussions with the NSE, are you getting any clarity then on whether leadership there is making the necessary changes that you have suggested? And just walk us through what needs to change, whether it's on the litigation side. I know that there are issues with the clearinghouse that you have flagged, which we will get on to later. But can you be a bit more specific, sir, on what needs to change at NSE to facilitate a listing ultimately?
I think all of the issues will be resolved. I think that much I can say, both on the governance, litigation, technology, all of it. It's possible to resolve. I think they're quite amenable to solutions.
Above all, is there any progress on the NSE clearing operating independently, which has been among SEBI's requests? And what progress or otherwise is being made on that front?
There has it's not been a definitive direction from SEBI. It was put out as a measure of public consultations in November 2024. Is a possible way whether we could do that, but there are different models in the world, and there is no one model which we can say is the only way we can work. So there are very much possible to resolve things and still move ahead.
The SEBI chairman there on the all-important NSE IPO. Now, the Rising Northeast Investor Summit 2025 was flagged off by Prime Minister Narendra Modi earlier today. The summit aims to attract global and domestic investment to the northeastern states of the country. Now, Reliance Industries chairman Mukesh Ambani also addressed the gathering and committed to targeting 75,000 crore rupees of investments in the northeast. And Prime Minister Narendra Modi also commented on how the Northeast will be crucial to boost trade with its Asian trading partners. Listen in.
आज भारत और आसियान के बीच का ट्रेड वॉल्यूम लगभग $125 बिलियन है। आने वाले वर्षों में ये $200 बिलियन को पार कर जाएगा। नॉर्थ ईस्ट इस ट्रेड का एक मजबूत ब्रिज बनेगा, आसियान के लिए ट्रेड का गेटवे बनेगा, और इसके लिए भी हम जरूरी इंफ्रास्ट्रक्चर पर तेजी से काम कर रहे हैं। भारत, म्यांमार, थाईलैंड ट्राइलेटरल हाईवे से म्यांमार होते हुए थाईलैंड तक सीधा संपर्क होगा।
While speaking at the Northeast Investor Summit, Reliance Industries Chairman and Managing Director Mukesh Ambani spoke about transforming the Northeast into a healthcare hub. Listen in.
Reliance Foundation will bring the best of cancer care to the Northeast. To begin with, we have established a 150-bed comprehensive cancer hospital in Manipur. We are collaborating with Mizoram University on care of breast cancer using genomic data. In Guwahati, we have built an advanced molecular diagnostic and research lab. It will be among the largest genome sequencing capacities in India. We will help transform the Northeast into a healthcare hub and a research powerhouse.
Transforming the Northeast into a healthcare hub and a research powerhouse. Take a short break on Business Lunch. More news and updates on the other side. Stay tuned. Welcome back. Now, sources are telling CNBC TV18 that India and Oman are in the last legs of a free trade agreement talks. Abhimanyu is joining in with more on this. Abhimanyu.
The India-Oman FTA talks are in their final stages, and the issue which remains to be resolved is about protection of rights of Indian workers. India wants specific guarantees from Oman to protect the rights of Indian workers working in the West Asian country under the Omanization policy. The Omanization policy of Oman aims to replace foreign workers with local citizens, and India wants protection of rights of its workers. It remains to be seen how early both the sides are going to reach some degree of agreement since talks have been taking place between both the sides since the past few years, and India has not sought any duty concessions in around 125 to 130 tariff lines, which include products like liquor and cigarettes. Also, India is expected to gain greater market access for its services sector as well as for 98% of its goods in Oman. Also, the Indian industry had opposed duty concessions earlier for Oman's petrochemical products to avoid a glut of low-cost imports, which may potentially impact India's domestic industry. It remains to be seen how early both the sides are going to reach some degree of agreement, even as India is also engaged in simultaneous talks with the Gulf Cooperation Council for an FTA, of which Oman is also a member.
Abhimanyu, stay on because India and UK have concluded the free trade agreement talks. Now tell us, how does this impact Indian companies entering the public procurement market in the UK?
It's going to be a big win for Indian companies seeking to enter the public procurement market in the United Kingdom. Government sources have told CNBC TV18 that for the first time, the United Kingdom has agreed to take a binding commitment to provide non-discriminatory treatment to Indian companies in government procurement as per the UK's social value regime. Also, on opening up of procurement for British companies in India, sources had earlier indicated that British firms will be allowed participation only in procurement of goods and services in non-sensitive central level entities in India. The FTA also provides a carve out for the Make in India policy as well as for medium and small enterprises. UK is the second country for which government procurement has been opened up in India after it was opened up for the UAE under the FTA with India. Also, access to state and local government entities will continue to exclude British companies, while suppliers allowed to bid for domestic tenders will be deemed as class 2 local suppliers. Now, by definition, as per Indian law, the class 1 local suppliers have a domestic value addition of over 50%, whereas class 2 suppliers have a DVA of 20% to 50%. So clearly, it is going to be a win-win situation for both Indian as well as British companies as far as government procurement in the respective countries is concerned.
Abhimanyu, thanks a lot for that. Now shifting focus to the latest on Indigo's Srinagar flight incident that happened earlier this week. The flight was caught in a hailstorm and the pilots were denied deviation to escape bad weather by both the Indian Air Force as well as Lahore's Air Traffic Control, according to a statement by the Directorate General of Civil Aviation. Now Madhya is joining in with more on this. Madhya, tell us more.
Well, it was a harrowing experience for the passengers on board Indigo's Delhi-Srinagar flight on the 21st of May. This story was first reported by a journalist, Swati Chaturvedi, and the Directorate General of Civil Aviation has now confirmed that the flight was cruising at 36,000 feet when it entered hailstorm and severe turbulence near Pathankot. Now, as per the crew statement, they requested Northern Control, which is Indian Air Force, for deviation towards left, which is the international border, due to weather on the route. However, the permission was not approved. Later, the crew contacted Lahore to enter into their airspace to avoid the weather, but the same was refused to, according to the DGCA statement. The crew initially attempted to return back as they were close to the thunderstorm cloud. They decided to penetrate the weather subsequently. They encountered hailstorm and severe turbulence, and the crew chose to continue at the same heading to exit the weather by the shortest route towards Srinagar. Now, several warnings were triggered by the aircraft system, like angle of attack fault, alternate yaw protection lost, and backup speed scale unreliable. The aviation regulator also revealed that the aircraft's autopilot system disengaged due to updrafts and downdrafts, and the aircraft registered a rate of descent of up to 8,500 feet per minute. Now, despite these challenges, the pilots managed to manually control the aircraft through the storm, and after completing all safety checklists declared pan emergency to Srinagar ATC, the aircraft was safely guided to land in Srinagar with auto thrust functioning normally. There were no injuries to the passengers on board, and through a post-flight inspection revealed that there was so much damage to the aircraft's nose radome, indicating the force of the hailstorm. The DGCA has launched a detailed investigation into this incident.
Harrowing incident indeed. Madhya, thanks a lot for that. Now, the Trump administration has blocked Harvard's ability to enroll international students amid a continuing standoff with the university. The Homeland Security Secretary Kristi Noem called it a warning to other academic institutions as well. Now, the move, which Harvard has called unlawful, means that around 6,800 international students currently attending the university would have to either transfer or lose their legal status. NBC's Garrett Heck has more on this.
Tonight, the Trump administration escalating its battle with Harvard University, barring the school from enrolling foreign students and ordering the more than 6,700 currently enrolled to transfer or lose their legal status.
27% of their students are foreign students, and they will have to find some other university to go to, and hopefully they find one that cares about them and provides a safe environment.
The White House saying Harvard has become a, quote, hotbed of anti-American, anti-Semitic, pro-terrorist agitators, adding the university now must face the consequences of their actions.
This should be a warning to every other university to get your act together.
Harvard calling the government's action unlawful, adding, we are fully committed to maintaining Harvard's ability to host our international students and scholars.
It's saddening and it's stressful.
Carl Molden is a Harvard student from Austria studying government.
Do you think you'll be back at Harvard in the fall?
It's hard to make a call, I hope. I'm uncertain. I think with this administration, anything can happen.
In April, the administration froze more than $2 billion in federal grants to Harvard over what the White House said were concerns about unchecked anti-Semitism on campus and demands to change hiring and admissions processes. The university's president pressed by Lester last month.
Is this really about anti-Semitism?
I would say that at Harvard, we have a real problem with anti-Semitism. We take it very seriously, and we're trying to address it. We don't really see the relationship to research funding at Harvard and other universities. They are two different issues.
The standoff there with the Trump administration and Harvard University. By the way, the Nifty still continues to remain at that 24,900 mark. Now at the highest point of the day, 280 points higher on the index. So good going for the benchmark index. No complaints there whatsoever. Two stocks that have extended their gains from the morning. IFCI is one of them. 10.5% higher on that stock, and TBO Tech numbers will be out later today, and that stock too is up 10% in today's trading session. So extending their gains, both IFCI and TBO Tech. What has also sprung up on the list of gainers is Clean Science and Technologies. That stock reported results yesterday and is now reacting to their results, 7.5% higher on that stock as well. So good going for them. BSE, the capital market link names are doing well for themselves. Remember, BSE is trading X bonus in today's trading session. So 6% higher on BSE. Angel One too trading with gains of around 4.5 to 5% in today's trading session as well. But we call time on this edition of Business Lunch. But just before we do that, here's some good news for our viewers. India's business news leader, which is now just a click away, which is CNBC TV18's all-new app. We can get you breaking news, financial world updates, and in-depth articles, all of them at your fingertips. You can download the app from the Apple Store or the Google Play Store, or you can even scan the QR code that comes up on your screen. From me and the team that put this show together, thank you so much for watching. Midcap Radar on the other side.
Good afternoon and welcome to Midcap Radar live from the CNBC TV18 Motilal Oswal studio. I'm Vamakshi Doria and with me is Vivek Iyer. Well, Vivek, it's a vibrant shade of green across the screen. Thank God it's Friday. We're almost about to end the session, in the next 2 hours, and it looks like it's going to be a very good session so far.
Good afternoon, Vamakshi. Another 120 minutes to go before we call time for this particular week, but a very, very strong end to the week is what we're anticipating. A complete recovery from the kind of selling pressure that we saw in the last 2 trading sessions. But remember, Vamakshi, today we have quite a lot of management on the show, a lot of insights to gather. Let's start off with the top headlines. Well, first up, stocks rebound after Thursday's weak trade with heavyweights in the lead. FMCG and IT are the big gainers, even as healthcare and pharma drag. Midcaps relatively lag.
Power Mech projects up near 7% after reporting Q4 numbers. Revenue and EBITDA surge over 42% on a year-on-year basis. Margins remain flat.
Honasa gains more than 16% as the company shows signs of recovery in Q4. Reports a 13% rise in revenue on a year-on-year basis, while volume grows 21%.
Waaree Energy is under pressure after US Republicans push for bill that includes faster phase-out of solar tax credits. Remember, 57% of the company's order book comes from overseas.
Premier Explosive hits the 10% lower circuit after a weak Q4 FY25 results. Revenue and profitability decline sharply. The company misses the guidance while order book declines 22% on a year-on-year basis.
Well, 24,890 or thereabouts is where the Nifty is at, just 10 points shy of the 24,900 mark. The frontline indices are doing extremely well in trade today, and the Nifty has managed to recover all of its losses that it posted yesterday. The index is up almost 1%, and so is the Sensex. The mid-cap end of the market, though, is underperforming the frontline indices, but we do have the advanced decline ratio that will come up for you on the screen, and that is largely in favor of the advances. Let's also look at some of the sectoral indices then. Most of them are trading in the green. The sectoral indices are being led by the Nifty FMCG index, which has surged higher by almost 1.7%. Varun Beverages as well as ITC are some of the counters that are leading the charge amongst the FMCG names. But lots of IT names as well in focus today. We have Persistent Systems, Coforge, OFSS, LTI, Mindtree, Emphasis. All of these counters are also flying away in trade today, but lots of mid-cap stocks moving in trade, and we now have Hormas to take us through the mid-caps that are in focus today. Good afternoon, Hormas.
Good afternoon, Vamakshi. And as you said, it's a vibrant shade of green, but the business end of the session is just about to begin with all the numbers starting to come in. As you can see, with the numbers of BEML flashing on your screen, the profits up 12%. Of course, the stock is looking to recover from the lows of the day, but we'll start off with some of the gainers within the broader markets then in today's trading session, and there are plenty full of them, and some of them include the likes of Reliance Power, like 18% higher on that stock. IFCI is up 10%. TBO Tech is extending its gains from the morning, and Clean Science, which reported its results yesterday, is now up 7.5% in today's trading session. And the earnings reactions that came in after market yesterday, reacting to them today, include the likes of Honasa Consumers, now trading close to its IPO price of 324. Emcure Pharma, after bullish commentary from Kotak, projecting a 40% upside from current levels, a 10% circuit here. Concor, with the guidance that the management has given at the lowest point of the day, and Deepak Fertilizers reporting results yesterday, is down 5% in today's trading session. Some of the other newsmakers, of course, led by Waaree Energies. The stock was down 10% at one point, has recovered some ground from the lows of the day, but the bounce is getting sold into slightly, 7.5% lower here. The capital market names like BSE doing well, trading ex-bonus today, and Ola Electric approving fundraise yesterday. The stock is up 4% in today's session. Some of the stocks that are doing well on the back of volumes in today's trade, JBM Auto is one of them at the lowest point of the day, but still holding on to gains of 4.5%. Affle India and Max Financial too seeing healthy gains on strong volumes. And lastly, stocks that are bucking the trend in today's trading session include the likes of Gravita India, Kaplan Point, Aegis Logistics. Not many losers and not significant in terms of quantum as well. 3 to 4% down for these stocks. Back to you guys.
Thank you so much, Hormas, for joining in, giving us a sense of what exactly is transpiring as far as the broader end of the markets are concerned. Well, we'll now slip into a short break. The management of Green Panel Industries joins us on the other side to discuss Q4 earnings and the way forward.
Welcome back. You're watching Midcap Radar on CNBC TV18. Pull up the chart for BEML. The stock reported its numbers just a short while ago. When you look at the revenue, that has seen an uptick of almost 9%. The margins have improved from 24.5% to 25.5%, and the net profit has surged by almost 12%. The stock is seeing a very sharp spike in trade today, as of now trading with gains of around 3%. But moving on then, Green Panel Industries is the first management on the show. The company's domestic MDF volume hurt the overall performance of the company in Q4. To discuss this and more, we are now being joined by V. Venkataramani, who is the CFO at Green Panel Industries. Well, good afternoon to you, sir. First up, I'd like to, get some numbers out of the way. You did miss your earlier guidance of nearly 1,600 crores in revenue, 220 crores in EBITDA in FY25. But what is the outlook when you look at FY26 in terms of volume, revenue, as well as margins?
Okay, I'll split that into two parts when we come to the MDF business. So there's the domestic business and the export business. So in terms of domestic, we did about 367,000 cubic meters last year. And we should be targeting about 480,000 cubic meters, including approximately 70,000 cubic meters from the new plant. And in terms of exports, we did 71,000 cubic meters last year, and we should be targeting about 84,000 cubic meters, including about 12,000 from the new plant. So I would say probably, we would, and in terms of plywood, we should be looking at a 15% volume growth, which should give us revenues of about 150 crores with an 8% operating margin. So I think probably overall we are targeting a top line of around 1,700 crores for FY26.
So FY26, 1,700 crore top line. If you could also give the corresponding EBITDA figure, that'll also be useful. And secondly, what we understand is that as far as the domestic export volumes are concerned, you're consolidated, you're expecting to grow at 28% for the domestic market, 12% for the export market, margins at 12%. Now, as far as the domestic market is concerned, especially in FY25, we understand that the market was quite subdued. So the strong volume guidance that you're giving, what is the rationale behind that? Is it mainly due to the implementation of BIS?
Okay, we primarily lost volumes in Q4 post implementation of BIS. So we had a product which was a commercial grade MDF, which was primarily manufactured for competing with imports, and post implementation of BIS we had to stop production of that product. So we did about 41,000 cubic meters from that product in Q4 FY24. And it was nil in Q4 FY25. So that's what hurt us on the volume front.
Okay.
So now with the imports also coming to a standstill, if you look at March and April, they were about 1,100 cubic meters per month compared to an average of about 20,000 cubic meters per month for last year. So the entire demand for the commercial grade MDF is now expected to get converted to industrial grade MDF, which is a BIS compliant product. So we should be recovering market share, in terms of those customers which we lost in Q4. And also with the new plant, we are entering a different product segment in the sense that till date, our plants were engineered primarily for manufacturing thick grade MDF, which is thickness above 5.5 millimeter. But with the new plant, we would be manufacturing MDF in the range of 1.5 millimeter to 5.5 millimeter, where the earlier most of the supplies came from imports. So I think that will help us to scale up volumes at the new plant quickly. And overall, that should help us to scale up the volumes in the current year.
Sure. And, with the BIS implementation that you just alluded to, what would your capacity utilization look like? Because for the MDF, it is at 60%. For plywood, it is at 42%. So how will this move? And how quickly would you be able to ramp up your new facility?
So for the older plants, we would be targeting a capacity utilization of 70%. And for the new plant, around 35% in FY26.
Okay, now let's talk about the new plant. What is the current capacity utilization as far as the new AP plant is concerned? What is the realization trend over there? Is it higher, compared to what you're currently selling at? And at peak capacity utilization, what is the kind of top line addition it can contribute?
Okay, like I mentioned, we started commercial production towards the end of March, and that plant is still in the stabilization phase. So probably, the plant will be fully operational towards the second half of June onwards. And that would help us to scale up the volumes. Not much, I think probably we are doing in about 3,000 cubic meters per month currently. And overall, our target is about 7,000 cubic meters per month for this year.
And are realizations higher from that particular facility?
Yeah, if you compare it apple to apple, realizations are higher, primarily because, with the lower thicknesses, the product has to be of a higher density, which also leads to higher consumption of wood. So realizations are slightly higher as compared to the thick MDF. But since costs are also higher, so margins are expected to be in a similar range.
Understood.
Sure, and just two questions clubbed into one actually. What would be your outlook on your working capital days? We understand that the net working capital right now is somewhere around 36 days. And the second question would be that are you looking to further take some debt, because your net debt has increased on account of the capacity expansion plans that you just undertook? So two questions, sir. Working capital as well as the net debt.
So as far as the new line is concerned, we would be adding a very small amount, which is part of the debt already considered. So I think probably adding another 15 to 20 crores this year. And that would be the end of it. As far as the working capital is concerned, we won't be requiring any additional debt. We'll do those from the balances available with us. And we would be targeting working capital days of around 30 for FY26.
Thank you so much, Mr. Venkatramani, for joining us, giving us a sense of how Q4 panned out, the way ahead as far as FY26 is concerned.
Thank you.
Well, moving on, it's now time for a short break. The management of MTAR Technologies joins us next to discuss their Q4 numbers as well as the way forward. Welcome back to Midcap Radar. Well, as promised, Srinivas Reddy, who's the Managing Director at MTAR Technology, joins us now to discuss the Q4 results as well as the way forward. Thank you so much, Mr. Reddy, for joining us. We had you at the end of Q3 as well, and that time you had intimated to us that there could be a bit of a shortfall when it comes to meeting the FY25 guidance. FY25 revenues as well as margins were below what is it that you had guided the street for earlier. What is the key reason for that particular development? And going into FY26, the street was looking at a 30% revenue growth. We understand you've given a 25% revenue growth. And also EBITDA margins are expected to be lower near the 21% mark. The street was anticipating a number closer to 24%. So what is the reason? Are there any issues that you're facing, especially at a key client like Bloom?
We don't have any issues with any of our key clients. Basically, we have factored based on the current situation what we have today, as of today, and we felt that we should give a guidance which is very reasonable and conservative at this point. And a lot of developments which will happen over the next 2 quarters, so we would relook at it at that time. But we would like to ensure that the guidance what we give, we stick to it, irrespective of what the external factors are, which we have considered that as well. So based on that, we have given a guidance which we feel that we are pretty confident of achieving it. There cannot be any downside to this, other than there can be an upside, but there can never be a downside to this.
Sure, got that. So we're working with 25% revenue growth and 21% margins for your company. But when you look at the order book as well, it came in at 980 crores. This is much below what you had guided for earlier, 1,500 crores odd. So were there any sort of delays from the customer? Is this now expected to come in Q1? And what will be your overall order book outlook for FY26? How many more orders do you see in the pipeline?
The outlook for FY26 is very strong because we had a shortfall of orders because of the nuclear reactors orders not coming in on time. Now, we already received the tenders right now, and even the Kaiga 5 and 6 purchase order has been given to the private entity, and we are expecting a lot more orders coming in. So the gap, what you see for 1,500 crores is the nuclear orders for Kaiga 5 and 6, which will kick in over the next 2 to 3 months. And then the refurbishment of reactors, we're expecting a huge amount of orders from there as well. So if you look at FY26, we're expecting huge orders not only from nuclear division, but also from aerospace and defense and space sectors. So we'll have a strong order book position moving forward by the end of FY26. And we'll be able to tell you more or less a number which is a much higher number than last year, what we said. But we would like to reconfirm all those over the next 2 months and come out with a closing order book for next year.
Understood that. It's a little tough for you to quantify it at the current juncture, but if you could give us a ballpark figure, you are now at close to 1,000 crore, 980 crore to be precise. So order inflows, including the orders that are spilling over from FY25, what is it that you're anticipating, a ballpark figure for FY26? And with this 1,000 crore order book, what is the kind of revenue visibility that you have?
We would be able to get orders during the year. Like last year, we received orders for 750 crores. And this year, we might cross even 1,500 crores of new orders coming in over the year. So we are in a very comfortable space as far as the order book is concerned. And it's just a matter of time that these additional orders will kick in into the order book.
Sure. And, when I look at your geographical revenue split, 64% of the revenue comes in from exports. So, is there any sort of impact coming in from, the tariff situation that is currently unfolding? And what would be your exposure to the US market?
We export geographically to different countries, not necessarily US, but we also export to Israel, we export to Europe as well. So we have considered all the external factors which might or might not affect, but we have taken everything into consideration while giving this guidance of 25% and 21% margins. So we have taken so any favorable external factors moving forward in case of tariffs or whatever will not affect this particular guidance what we have given. So,
understood.
Yeah.
And so far, have you seen any impact from the tariffs, especially in terms of the kind of RFQs that you're getting for clients? And the second part of the question is, going forward, FY26 onwards, will the domestic to export order book remain the same?
We have not seen any specific impact in terms of our dispatches or orders flowing in because of the US tariffs as of today. We are in the technology area, and so I don't think we'll have a major impact, but we have to wait and watch, depending on the final tariffs, what they're going to announce on July 8th. But more or less, since it's a technology-driven company, I don't think we'll have a major effect as far as the tariffs are concerned. And domestic, as I said, we are expecting huge kind of orders from nuclear and space divisions. And aerospace, we have done extremely well in terms of our efforts put in for developing various products. And we are growing at a very rapid pace in the aerospace and defense sector for exports as well. So that's something which we are very excited about.
Sure, and client concentration has been one of the factors that the street always looks at. But in the clean energy space, there was one addition, Fluence Energy. Currently, what is the contribution that is coming? Last time, I think when we, when you interacted, the contribution was nil. But you expect going forward that maybe it could be as big as Bloom Energy. So, what is the contribution now, and where can it go from here on?
Yeah, so we are trying to add a lot more new customers in the clean energy segment. Fluence is one of them. It's just not the Fluence. We started working on the prototypes. We're going to deliver the final prototype by end of this quarter or beginning of next quarter. And then most probably we should be able to sign off an agreement with Fluence if everything goes well by next quarter. And then we'll get into batch production, and subsequently we'll move into very big volume production with a separate facility. So that should happen. That's on track right now after a long time. And we're hoping, I won't be able to quantify the numbers, but it will be a substantial numbers moving forward, especially from FY26, FY27 onwards.
Mr. Reddy, when it comes to Bloom Energy, what is the kind of spends that they have penciled in for the year? Out of the spends, how much are you expecting to garner, especially in terms of orders? We understand that there is one spillover contract that's still pending. And secondly, what we want to understand is in terms of a customer mix, what will be the contribution coming in from that particular customer? And like you said, you've been trying to diversify.
Look, Bloom Energy is one of our customers right now. Our plan is to diversify more and more, which we are doing. Whatever we are doing with Bloom, they're also increasing the wallet share within the existing system. I will not be able to go into the details, but it's going in the right direction. But at the same time, we are looking at other customers in clean energy. And if you look at our aerospace and defense, we added a lot more customers, and we're also increasing our revenue base in this particular segment with the new facility which was commissioned recently. So we are moving in a path where there'll be a diversified customer kind of a distribution over the next couple of years.
Sure. Thank you so much, Mr. Reddy, for joining in with us. It was a pleasure talking to you, and hope we get you more on the show going forward as well. Wish you luck for the year ahead. But with that, that's all we have on this edition of Midcap Radar. Don't go anywhere, because your stocks when we return.
Hello, good afternoon. You have tuned into Your Stocks, coming live from the CNBC TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. The markets, a bit of a good day coming in for the markets. Friday for the markets. 1% uptick that we're seeing coming in for the benchmark indices. Nifty holding on to 24,800 levels, above that mark, almost nearing 24,900. So that'll be interesting to watch out for over there. We have the broader end of the market. That's too performing in well in today's trading session. So broader end, so mid-cap as well as small cap holding on to gains of 0.8%, almost mid-cap, day's highest point there. Small cap too is holding on to gains of 0.9%, day's highest point. Do not forget they opened up, there was a bit of a red that came in for the Nifty mid and small cap also, and that then we saw that recovery coming in. Let's look at the Nifty Bank also. That's managing to hold on to green in today's trading session. So versus what we saw yesterday, today is a better day coming in, and Nifty Bank holding on to gains of 0.8%. Now the sector that is not doing well today is pharma. I would like to pull that chart up as well. Nifty Pharma is down almost 0.6%, so keep an eye out on that. That's the only sector that is actually trading in the red. Apart from that, we have all the other sectors that are trading in the green. But this is a show where we solve all your stock related queries, and that's what we'll be doing with our experts for today. Shaina Mukaddam, independent market expert, as well as Vaishali Parekh, Vice President, Technical Research at Prabhudas Leeladhar. Afternoon, Shaina, as well as Vaishali. I think we are set, right? Fridays, we all three have to be here. And Shaina, when are you treating us is going to be the question. Markets are today in the green as well. Let's take a check from you today. What are you expecting in terms of markets?
I think the markets are pretty steady. And I think it will be more, earnings driven. So it will be stock specific. And there is a sector churn. But at the same time, I think, a long-term investor needs to remain invested in the market because we are seeing continuing buying. So yeah, remain invested, be stock specific, do not over leverage.
Okay, be stock specific, do not over leverage. That's the word coming in there. On that note, let's get started with all those stock related queries that you all have sent us. The first query for today is coming in from Prashant Kumar, who's writing to us from Bangalore. He's wants to know if it's the right time to invest in ICICI Bank. If yes, what levels can he invest this at, and what is the time period that he should be keeping for ICICI Bank as well? Vaishali, afternoon, and ICICI Bank, your view coming in, what are the right levels to enter this one?
Very good afternoon, all of you. Yes, so ICICI is one of the banks in the private sector which has been outperforming, and it's done very well. So according to me, well, since it's run up, I won't say this is the right level, but stocks like these, one should have a SIP view of accumulating this stock, that buy at every decline, because the long-term projections are much more, and I think can accumulate right from, I don't think this stock should go below 1300 levels, and right now it's at 1450. So accumulate at every low that you get an opportunity.
Okay. And Shaina, your view coming in for ICICI Bank, we have all the numbers for private banks come in. Is this the best bet in the private sector banking space, or should the viewer look at something else? And if ICICI Bank is the right bet, what are the levels that they can look to enter at?
Yeah, so this is one of the stocks that when I mentioned that you need to be stock specific, so, in this volatile market, it's better to play into and buy into something like ICICI Bank. I would be comfortable, I hold also, and I would be comfortable adding on ICICI Bank even at current levels. Of course, you need to keep a stop loss, maybe close to 1,300 and odds. But at the same time, if you see the quarter numbers, they were pretty steady. So you saw 18% growth in terms of your profits, and while the loan growth at 13% may have been lower than what we have shown over the last couple of quarters, I believe it is better than what the overall market did. So to that extent, it was a good number. And in terms of price to book, also at about 2.5, 2.6 times 1 year forward, it's not expensive. It's got all its subsidiaries in place, which are growing well. So I would say ICICI Bank is a good bet for the long-term portfolio hold.
Okay, let's move on to the next query now for today. This is coming in from Anil Bhandari, who's writing to us from Bangalore. He's holding 25 shares of Interglobe Aviation. This is purchased at a price of 5,300 rupees per share, so making some bit of a profit on this one. Now he wants to know the future outlook of his investments going forward from here on. Vaishali, on the charts and technicals, what are we watching out for in terms of the move that is expected from Interglobe Aviation?
I would say it has maintained a very strong long-term trend also. So I would say for now, if one has to make an entry or if one is holding, I think continue holding. We are looking at a near-term target of 5,800 and all going well above that, it can go towards 6,300 levels also. So, well, continue holding with the trailing stop loss.
Continue holding, trailing stop loss. First level to watch out for is 5,800, then can go up to 6,300 as well. That's the target coming in from Vaishali. Shaina, your view. We just had the results that came in on Wednesday post-market hours. So yesterday we saw that reaction coming in because of the earnings. And there were a lot of brokerage notes also, right? Citi, MS, Jefferies, all of them were positive on the stock. But one that was not is Investec. They have maintained a sell. So which side are you on? Are you on maintaining and holding on to your guidance and holding on to the buy, or would you say it's time to get out of Indigo?
So I'm in the middle actually, because on a top-down approach for airlines, for the long term, it's a risky sector to hold. So this sector needs constant review. Having said that, on the positive side, there's very little competition out between Air India and Interglobe. And if you see valuation also, it is not that expensive. If you see EV by EBITDA is just about 6 times. So I would say that with crude oil prices, airline, the fuel price remaining manageable, I would say you could continue to hold Interglobe. They're doing better on all parameters. So it's a hold, but keep reviewing the stock.
It's a hold, but keep reviewing the stock. That's the view coming in from Shaina. Let's move on to the next query for today. And this is coming in from Jayesh Menon, who's writing to us from Kerala. He's holding 1,055 shares of HAL. This is at a price of 3,500 rupees per share. Obviously, he's making a profit on this one right now. Stock is almost near 5,000, right? So he wants to know whether to continue to hold this or time to get out, book in your profits as well, and look at something else. Vaishali, on the technicals, your view coming in for HAL. Obviously, there's no doubt we have seen the run-up coming in the recent times for all these defense names. But HAL is one of those names also. Previously, also, we had seen a very sharp run-up coming in the last couple of years. And then now it had become a bit subdued. But again, in the last few weeks, that run-up is there. Charts, what are they indicating? Should we expect a further run-up?
You rightly said, Vinith. So for all this while, we were seeing a good euphoric move coming in the defense stocks. So HAL is one of them too. We have seen a one-way rally coming from 3,200 to now at 5,000. So technically, on technical parameters, 5,000 acts as a little bit of a resistance. But if time is not a problem, I would suggest the stock needs to be held on, because I think long-term projections, we still see upside coming towards 5,600, 5,800 in times to come. So I would say hold.
Okay. Hold coming in from Vaishali on Hindustan Aeronautics or HAL. Shaina, your view coming in for HAL, right? Because some of these defense names do have a very high valuation, which becomes a concern at some point of time. Should the viewer continue to hold HAL or maybe book out some bit of the profits right now?
Yeah, actually, valuations look expensive. I would agree. But that is like, if you look at last quarter numbers, take for example, there was some accounting provision write-offs, etc., which actually resulted in a weak sort of, optically weak type of numbers in terms of growth on both the top line as well as on the profitability front. Having said that, if you look at the order book position, it is very strong. If you look at the margins are pretty high, over 50% margins. So if you ignore the valuations for now, while it's expensive, and take the next 3 to 5 years, I believe you are going to see a very good growth. They are targeting almost 12 of their aircrafts to be delivered in the current year. So I see the turnaround starting to happen even in starting FY26. So it's a stock I would say continue to hold for the long term. It could be part again of your long-term portfolio.
Okay, it could be a part of your long-term portfolio. Continue to hold. That's the word coming in from Shaina. Let's move on to the next query for today. This is from Sandeep, who's writing to us from Hyderabad. He's holding 15,000 shares of JSW Infra. Price is 290 rupees per share. Currently, also the stock is trading around the buy price, so not much of a difference in terms of the buy price and the current price. Now he wants to know the outlook for the next 1 year of the stock. What should he do? Should he continue to hold, sell, maybe look to buy some more? Vaishali, your view on the charts?
So, well, if 1 year is the horizon, I think the stock has been quite a laggard. It's just been, in a very narrow range. But, well, I would say on technical parameters, 270 should act as a support. And once the stock moves above 300 levels, I think this should be poised to take a further run up towards 360. So, for now, we're keeping 1 year time frame in mind, hold with a stop loss of 270.
Okay, hold with a stop loss of 270 is the view from Vaishali. On the fundamentals, JSW Infra, what is your view coming in here, Shaina? Should the viewer continue to hold or maybe just get out of it, given that they're not making much of a loss on this front? Or would you say average also as an option?
No, I would not say to average as of now. I would agree with Vaishali that you hold with a stop loss of 270. Basically, if you see the last quarter numbers, they've done about 5% growth in volumes. And but if you look at the longer term, next 5 years, the management has indicated that they're planning to double their capacity from current levels. So they're close to a full capacity utilization, doubling capacity over the next 5 years across all the 4 ports that they are currently operating at as of now. I think will be a good volume growth for them, as well as I would believe that profitability also should improve. So at current levels, I would say it's a hold.
Okay, current level is a hold that is coming in from China as well. But on that note, we're going to sip into a very short break, viewers. And here's some good news coming in for you all, our viewers. India's business news leader is now a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on the screen. Welcome back to Your Stocks on CNBC TV18. We still have with us Shaina as well as Vaishali to solve all those stock-related queries that you all have sent us. And keeping it going with the queries, the next query for today is coming from Sai Charan, who's writing to us from Andhra Pradesh. He is asking if it is the right time to invest in Punjab and Sind Bank. Shaina, your view, Punjab and Sind Bank, is that something you would be betting on in the banking space?
Well, I would say as of now, it is better to avoid it. It's a small cap. The thing is, the government was 98% of the equity. And they have already indicated it is one of the banks which they are planning. Either the bank will do a QIP, there'll be some sort of equity dilution. I mean, offer of sale for equity shares. So this is an overhang on the stock, which is why I believe, and combined with this is that the valuations are not cheap. It's about 2 times price to book. But at the same time, the operational performance, if you see in FY25, was extremely strong. They showed strong profit growth, good growth across all parameters. So I would believe that they will, the stock will consolidate at current levels. So if you want to add, you add it post the QIP or some sort of when this overhang of equity is removed. So I would say don't add now, avoid.
Okay, don't add now, avoid is the view coming in from China. On the technicals, Vaishali, do you have a similar view?
Well, I would think otherwise, because technically speaking, well, the stock is corrected right from 70 odd levels. And now, after coming back out of its oversold zone, the stock is showing some signs of revival. So I would say, well, disciplined trading can be considered. 28 should be taken as a stop loss. And further conviction comes only about 32 levels, which would trigger a further upside move coming towards 38 to 45 levels. So a calculated risk at this juncture should be taken.
Okay, calculated risk is what on the technicals is something that you can take, but there is a stop loss price also that is, and a strict price also that is mentioned by Vaishali. So keep an eye out of that one. Let's move on to the next query. Balaji is writing to us from Bangalore. He's holding 700 shares of Lakshmi Organics. This is at a price of 290 rupees per share. So currently making a loss on this one. Wants to know if he should stay invested or exit at the current levels. What is your view coming in on this one, Shaina? What should one do with Lakshmi Organics? Does it merit that one actually stay invested in this stock?
Well, it's not one of my topics, wouldn't be in the sector, chemical sector. At the same time, the stock has corrected substantially if you see the last couple of quarters, 2 quarters, 3 quarters. And this is on back of poor performance, both in terms of turnover, profits, margins, everything was impacted. Now, going forward, I would say it's a hold. One, given the fact that valuations are not that expensive. If you look at it from turnover to market cap to turnover, it's about 1.5 times, which for a chemical stock, it is not expensive. 2 is that they have got new capacity that is coming up of fluorochemicals. So that will come on stream over the next couple of quarters, and it should sort of improve their performance overall in terms of growth. So I would say you add, you hold it for now, but keep a stop loss and review it after 6 months, depending on the performance. Either you exit or then you can continue to hold and then exit at a bounce.
Okay, that's the view coming in there for Lakshmi Organics on the fundamentals. Technicals, what is a view for you, Vaishali? Given that, the stock has seen a correction, does it merit? Maybe they can average it so that at least the loss that they're making is reduced.
I totally agree. So, because actually we see some revival coming in the chemical sector. And this too, if I were to talk, it shows signs of bottoming out of 170 levels. So I would say at this level, you can average it out and wait for a bounce. For now, I would see a target of 240 from here on. I would have a relook once the stock goes above 240, because that would confirm a good trend setting in. So yes, at least for bounce back purpose, it merits for a good buy.
Okay, for bounce back purpose, it merits a buy also. So thanks for that view on Lakshmi Organics. But again, we have a query coming in, and this is again a defense stock that we have. Parag is writing to us from Navi Mumbai. He's holding 100 shares of BEL. Price is 275 rupees, making a profit. Stock price currently at 384. He's asking whether to book profits, buy more, stay invested. BEL, your view, Shaina, similar to HAL?
Yeah, actually, valuations are, as you had mentioned earlier, have become a bit expensive. The stock has gone up, if you see last 3 months, 50%. So now if you look at it on PE basis at current levels, it's, more than 53 times PE, 1 year forward. So to that extent, it is expensive. Having said that, if you see the order book position, it's over 71,000 crores, which is about 3 times their estimated revenues. So there, and with margins are very high. And of course, as you know, the performance that they showed in the last, skirmish and the war that we had with Pakistan They have shown that the products are very effective, and we've had a lot of new, countries that are coming in to buy from India, and BL is on the forefront to execute those orders. So I would say that you can continue to hold more for the long term. Here again, it can be part of your long-term portfolio.
Okay, can be a part of the long-term portfolio. BL, your view also, Vaishali, similar to HAL, or is there an option actually maybe to look at some of these smaller defense names also instead of just an HAL, BL? Would that be an option for you as well?
Yes, I do think so, because according to me, on technical parameters, this has been a perpendicular rise and a deep overbought. So I would say either keep a stop loss, trailing stop loss, or book partial profit and shift to some other stocks which are fairly priced. So if I'm looking at Zen Technology or DCX, these are the stocks which still have not run up to that extent. So either do that or at least book partial profit in BEL. So when you get a chance in decline, you may add more further on.
Okay, that's how we come again for BEL. Let's move on to the next query. Sanjay Dikshit is writing to us from New Delhi. He's holding 100 shares of Poonawalla FinCorp. Price is for 51 rupees per share. He wants to know whether he should continue to hold or look to sell. Not mentioned long-term, short-term. So, both the views, Shaina. If it's a short-term view that you want, then does it make sense holding Poonawalla FinCorp, or only long-term is something that makes sense for you?
Actually, there's not too much of fundamental information that we have on the company to really sort of give a long-term view, but it is looking like there is some sort of a bounce based on the management having deep pockets. One, two is the aggressive guidance that they have given. AUM currently is just about 35,000 crores, so it is pretty small if you look at it in the comparative NBFC space. Having said that, they are talking of taking it up to more than around 1.5 lakh crores over the next 5 years. So if they are able to do that and maintain their cost efficiency, I think it would be a good investment if you're holding it for the long term. But at current levels, valuations are expensive, so you need to keep a stop loss, keep a watch, how the performance evolves over the next couple of quarters.
Okay, and Vaishali, your view coming in for Poonawalla FinCorp, because after we saw a bit of a correction coming in since last year, and then since March again on the chart seems like we're seeing a bit of a spike up for the stock. Is this a time that the viewers should continue to hold this? What are the targets for short term and long term for this one?
Well, for short term perspective, the stock is in a trend, but I would say keep a stop loss of 380 and look for a target of 420. That would be the range for short term perspective. But if you're still wanting to have a long-term view, I think 360 acts as a support. And on a weekly chart also, if I'm looking at it, it's at a very tough resistance. So unless and until the stock moves above 405, 410, and it sustains above, I think this would go towards the levels of 460, 470. So 410 is the level to watch. Are we proceeding ahead, or are we seeing some resistance?
Okay, surely we'll be keeping an eye out on that. But let's move on to the next query. Venkatesh is writing to us from Hyderabad. He's holding 50 shares of Mankind Pharma. Price is 2,901 rupees per share. Wants to know whether he should hold or sell. Shaina, what's your view coming in for Mankind Pharma? We had the numbers also that came in from the company. Seems like slight bit of a moderation was there in some part, but commentary seems to be good, because we spoke to the management today. They spoke about growth and guiding a growth of around 25-26%. They've spoken about expecting some chronic segments to do well as for the company. Your view?
Yeah, actually, right. So they have also continued with the guidance of 26%, 25-26% over FY26. Valuation-wise, it is more expensive than some of the other pharma stocks. But at current levels, I would still say that we can continue to hold, because they have got a couple of positives going forward. They have the women health, new products that they plan to really aggressively push. This is from their acquisition that they did of Bharat Serum. So there is a positive. They have got other products in pipeline for diabetes, which they could launch over the next 1-2 years. Their OTC products are doing pretty well, growing 15%. So to that extent, I would say you can continue to hold, but do not add now. If you want to add, I think you could look at maybe 10-15% lower levels to average.
Okay. can add if there's 10-15% lower. But right now, just continue to hold. That's a view coming in from China. But that was the last query for today. So thank you so much, China, as well as Vaishali, for joining in with us. Hope you all have a great weekend. And viewers, thank you so much for sending us your queries. Remember, you can always send us your queries and email us your queries on the email address that is flashing on your screens as well. So do send us your queries. But with that, we'll wind down this edition of Your Stocks. Thank you so much for tuning in. Up next, your closing bell.
Market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV18 Motilal Oswal studio.
In terms of the handover or the opening that's coming in for the Asian market is a positive opening so far. Whether you look at the Nikkei, whether you look at the ASX 200, Hang Seng, Shanghai, all of them are managing to hold on to gains.
The S&P was flat, the Nasdaq was up about 0.25% or so, nothing very much at all.
Street expectations are extremely aggressive on this year's dividend. So the estimate that's doing the rounds is anywhere from 2.5 lakh crore to 3.5 lakh crores.
So 24,600 on the Nifty, 24,630 on the Nifty. It's about 0.1% higher. The Nifty Bank is up about 0.9. Nothing. It's basically just about holding on.
Finally, I think there is no really run on the deposits. I mean, that's another important thing, okay, which needs to be looked at.
Midcaps in the green, but trailing the frontliners. Midcap index with a gain of about 0.5%. The advanced decline ratio, though, is positive.
Not giving any specific guidance on margins. However, it's important to note that our key growth drivers like global specialty business, India, emerging markets, and other business are well positioned to grow.
I think all of the issues will be resolved. I think that much I can say.
The index is up almost 1%, and so is the Sensex.
Well, that is the day so far, and it is actually turning out to be a fantastic session. The early week blues are all but gone, and we are back at about 24,800, 24,900 kind of level. So The expiry is done. The pre-expiry week is almost done. 1 hour to go. And will we get a bit of a clean slate over the next few sessions? That's the question. We're coming to you as always from the CNBC TV18 Motilal Oswal studios. I'm Prashant Surbi and Rima here with me in the studios. And Nigel is joining in from the newsroom floor. Guys, good afternoon.
Hi, afternoon. Doing really well and actually doing better than some of the other global markets as well. So it's been a week of consolidation. Up until yesterday, the indices were down between 1.5% to 1%. But I think today is changing a lot of that, guys.
And considering the last week, we added about, 4.5% on the Nifty and the Sensex, 6-7% on the mid and the small cap. We haven't given up too much. So week to date, the Nifty is just down close to about 0.5%. So we've retreated, but hardly in context to the kind of up move that we had in the prior week. All in all, seems like a good close to the week, Nigel.
Well, that's right. Good close to the week, it seems. But I think we're still in that band. However, I think Monday's trading session will be crucial because the US markets will be shut. So we'll be purely on our terms. So let's see whether or not the domestic money can come in and in fact get us past the 25,125, which has been a bit of a resistance zone. So no worries going into the weekend. Let's see whether or not we can build on to Monday. Hopefully the next 60 minutes don't have any kind of negative surprises. But I think we have Ashish Kayal who joins us on the show for some closing strategies. Hi Ashish, good afternoon. Good to see you in. Ashish, what's your take on today's trading action and how would you trade the Nifty?
Hi Nigel, afternoon to you and all the viewers as well. If you look at Nifty, interestingly, over the past few days, we have seen 5 days of correction. And that 5 days of correction is ideally not even retraced one candle which was formed on 15th of May. So 15th of May, Nifty rallied from around 24,500 towards that 25,000 mark, and it has taken 5 days to retrace that. That clearly indicates that the overall undertone is bullish. Price found the support near the 20 DMA. And sharply bounced back today. It's managing to close above the prior day high as well. So it's turning the trend on the upside. I'm optimistic that we will see 25,100 followed by 25,300 levels on Nifty on the upside. On the downside, the support for the index is going to be near today's low, which is 24,630. So positionally, it's a buy. Any dip should be used as a buying opportunity, aiming for 25,300 levels on the upside.
Ashish, hi, afternoon. What about stocks? What's on the table today?
From the stock-specific perspective, the first pick is going to be ICICI Prudential Life Insurance. We can see a very strong breakout on the upside in the stock after some time. The volumes have picked up pretty well. The stock managed to bounce back from its 20 and 10-day average, aiming for the target of 672. And on the downside, the stop loss can be 487 levels. And the next stock on the buy side is going to be NMDC. We can clearly see that NMDC has been consolidating for quite some time. It has been an underperformer, but showing a strong breakout. It formed a double bottom pattern, breaking out that neckline. So NMDC can be a good bet now, aiming for the target of around 77 on the upside. And on the downside, support for the stock is around 70.50.
Okay, all right. Thanks a lot for that, Ashish. Well, let's focus on a couple of sectors then. In insurance stocks, they're in focus. We have a positive note coming in from UBS. Nimesh joins us early on the show today to run us through what is their rationale. Nimesh?
Well, Nigel, all the stocks are buzzing in trade, and there is an interesting report from UBS today. They've done actually constructive on the sector, and some interesting observations that they've made in that report. The first one is they believe that the insurance sector had gone through multiple rounds of regulatory overhang. That seems to be changing now at the margin, and all the industry players have actually turned out to be more, constructive or more stronger post the changes in the product mix as well as in terms of structure. So that's one big positive that UBS is watching out for. Second big important thing is UBS believes like what we've seen in other financial subsidiaries like RBI and SEBI, they expect similar softer stance from the regulator IRDA going forward. So any benign outlook from the regulator would be a huge positive for the sector. That's the strong belief of UBS, and that's the reason why they've turned a bit constructive as well. Also, from here on, they expect the earnings to improve on the back of change in the product mix. Also, there's going to be a change, potential trigger in terms of they could benefit from the interest cuts as well. So again, that's something which UBS believes could be a re-rating trigger for a lot of the insurance sector stocks. In terms of preferences, they prefer Max Financial and SBI Life as their top bets. In fact, they've raised the target price in both Max Life and SBI Life. On Max Life, the new target price is 1665, and on SBI Life, they've raised the target price to 2100. They are neutral on other two names, HDFC Life purely on valuations,
And on ICICI Pru Life, they're neutral largely on back of weak internal. So the preference clearly seems to be with SBI Life and Max Life.
Well, that's right, and they expect better profitability as the ULIP as a percentage of their total mix goes down as well. So interesting times. Prakash Diwan joins us on the show. Hi Prakash, good afternoon. Good to see you in. What's the view on insurance companies?
Sorry. Quite positive, Nigel. There is absolutely no, indication that there's any kind of a slowdown. Each of them is getting their mojo in terms of what's the right product mix, what's the right channel to sell their products through. But if you look at some of the moves that we've seen in insurance, they usually come in when a company's strategy gets full blown. I mean, it's full blown in terms of implementation, and it starts kind of accruing some sort of results. So from that perspective, HDFC Life probably seems to be better placed because they've had a head start as compared to some of the other names. But best is to take a basket approach. No worry about which one should do well and actually beat others to the races. But take a basket approach, buy all four of them, and you'll be probably sorted with that. So that's the approach that I've always recommended, and it has worked given how each of them kind of reconfigure themselves. But HDFC Life does have some salience at this point in time.
Prakash, Honasa, 18% up now on Honasa. It went through a period of derating. Stock crashed to levels of 200. If you remember, in the September quarter, they had reported a loss. Their core Mama Earth brand business had started slowing down. Investors were concerned. It's rebounded, but it's still about 40% away from its recent highs. Is it a buy? Has it turned the corner?
I don't think so, Rima. It's turned the corner for sure in terms of some of the metrics. Things have started looking up. The repair is kind of taking shape. But whether you want to bet on a business which is still beleaguered in terms of, a lot of the inventory losses and all that have been part of the, journey till now. The answer is you have far more proven this thing. See, this result season, Rima, very clearly thrown up surprises on the favorable side, where a lot of companies which were not anticipated to reflect revenue growth and margin growth have actually done so. So if you see the smattering of choice that you have, it's fairly large. In fact, companies like Honasa will have to continue doing like this for maybe another 2 quarters to really start validating it, the valuation that it deserves. But I would wait for it. I would be patient, give them time for the turnaround to be much more cemented than what it is. So 1 quarter shouldn't kind of, change things so dramatically.
One is, of course, product acceptability and things like that. If you remember, there was one issue, which is, and these were purely allegations, that they'd pushed a lot of stock to distributors. And then they
And then they revamped the entire distribution.
Yeah, and they were not able to clear that. This was, I think, the quarter after, the first quarter, the second quarter after listing. At that point, there was a lot of hue and cry around it. And they clarified that, they've revamped and it's going to look a lot different. So let's bring in Mangalam now, who's joining us with exactly that question. Of course, there is the quarterly numbers, but more importantly, Mangalam, if you managed to speak with analysts, etc., on this one, what's the overall sense on Honasa from here?
Well, so everyone believes that maybe the tide is turning, but you have to look at the numbers over the next few quarters to know whether this is sustainable or not. But from what you see so far, it seems like they've pushed through growth via giving a lot of sales promotions, and a lot of the distribution stuff is getting sorted as well. Why do I say that? Because a 13.3% revenue growth is underscored by a 21% volume growth. Typically, a 21% volume growth with 13% growth tells you that there has been a realization drop of almost 10 to 11 percentage points. That may be them, taking their products out of the shelves as well, which is why it's not reflecting in the margins. The 13% revenue growth, the margins have come off from 7% to 5.1%. We've actually had to spend more on advertising. So as a percentage of sales, advertising is 34.4%. The street, typically what happens is if your revenue is growing a lot faster in teens, etc., then you see, the percentage of advertising spends come down, and that's how leverage plays out. Other expenses obviously have increased because of their distribution reset project that they've gone down for. But the important part is there are a couple of highlights that suggest that maybe the tide is turning. One, 70% of Mama Earth's business, which is their core business, is actually growing in double digits, and it's growing in important channels. they're adding presence in physical channels as well. And at the same time, a large part of their revenue jump has happened on account of their own sales force. And also, we're seeing diversification away from Mamaearth. So Dermaco, for instance, has hit that 100 crore mark when it comes to offline retail sales. We've also seen all the other brands, which include the likes of Dr. Sheth's, Acologica, as well as B Blunt. They've all increased, sales by about 30%. So the wheels are set. Let's see whether they pick up pace or not. But just a cursory glance at their presentation, and that tells you, how fast the night changes. Because about a year and a half or 2 years ago, everyone was talking about the naturals wave, which is what benefited Mamaearth the most, because their products were all, the positioning was all nature-based. But now, as the beauty trends move to ingredient-based beauty, they've also evolved their portfolio. Look at their presentation, and you'll see things like, peptide. You'll see hyaluronic acid. You'll see salicylic acid. You'll see keratin, you'll see, microneedle serums, etc., which sounds like they're out of a chemistry lab, but that's the nature of beauty, and that's how they've tried to evolve. Let's see whether customers accept the new Honasa with that positioning.
Absolutely spot on, Mangalam. I think we've all found ourselves caught in searching what are these new acids and what this peptide means and what this particular, serum, alpha hydroxy, etc., does to you. So, yeah, I think...
I have tried a lot of them, and I will take that for the team.
They work? In that case. No, jokes aside. But, yeah, that's become the new wave of beauty from Besan, Haldi and Chandan. Now we've moved to full-blown chemistry. Got that point. Thanks very much for that, Mangalam. Okay, Honasa, definitely a winner of the day, and what a winner, 18%, big move coming in. By the way, the other side of the market that's really, pulsating and throbbing and rising higher is once again the capital market space. I was looking at BSE, but then BSE is not alone. BSE, you can argue, there's a lot of back and forth about what happens if this weekly expiry is shifted, and there are some notes that are saying that BSE stands to lose about 15% market share in the options premium segment. That's one, but look at Angel now. Look at a couple of other names as well, which have also started rising. So in general, it seems DAM Capital, I saw DAM Capital is up in double digits as well. So once again, this capital market space is alive and kicking. Prakash, good afternoon and happy Friday to you. Market goes up, the stocks come back in favor. But what's your sense? What to play here and what to avoid?
I think good afternoon, Samita. I don't think there's any reason to avoid this space. The brokerage names have a strong direct correlation to volumes and, how the market behaves. In fact, they are probably the only names which lose out on some ground of sorts when markets come down or cool off, because the activity levels come down. But technically, buying or selling both will continue irrespective of where the market's headed. It's just that the participation levels aren't at the peak that we saw earlier. But as we draw closer to higher highs on the indices, there is a lot of activity. And remember, there's this big change that's happened over the last 10 days, and that is a lot of IPO activity has come back to the market. We didn't see any IPOs in the Feb to April kind of a phase, but certainly you have a lot of them lined up. Some of them are already kind of making waves in terms of anticipated listing gains and all of that. So my sense is this is an all-weather kind of a portfolio. Now depends on what side of this thing you want to choose, value chain. But as I keep saying, the fintech, the KFINs and the CAMs of the world, the CDSLs of the world will definitely be always in great shape. So it's better to bet on those because they're more secular in terms of the growth trends and the kind of margin profile they sit on. So I really won't worry about dips out there. In fact, it's a good time to buy when there's some sort of a softness, not maybe a day like this because there's too much of exuberance. And there's a very clear sector rotation that's happening. You have defense, then you have FMCG, then you have capital markets, someday you'll have capital goods, railways, so the market's waiting to latch on to newer themes every day, every week. So don't buy things when, that's the day where that particular theme is actually in the limelight.
Okay, all right. By the way, just pull up the intraday chart of AIA Engineering. I think that just came out with the set of numbers. And it seems the street actually liked the set because the stock as we speak is spiking up. It was in the red. Now it's seen a bit of an uptick. Let's pull up the intraday chart out there. I think that will tell you a better picture. Prakash, I wanted to ask you about Cosmo Films. There was a fire at the Jindal Poly unit. And I don't know how much of the capacity goes out of the way. But it appears, going by the move that we're seeing on Cosmo first, the street believes that they could be potential beneficiaries. Have you done any math? You should track this space, so I ask you.
Right. So, but the unfortunate part is that Cosmo First is gone beyond films in a lot of other areas, which means that they might not be a very first order impact. There could be some benefits, of course, coming to them in terms of market share, but that also will be short-lived because these capacities kind of tend to get worked upon by a lot of other players. So you have so many of them who are always capable of doing that, maybe with a lag, but Cosmo has underutilized capacity, and that's where the street probably feels that they will be direct beneficiaries. But you will have to evaluate the business from an SOTP basis, and from that perspective, there's still some way to go before it starts kind of getting traction. The earnings growth that you would expect a business like that to have. Good business, very strong pedigree, good history, everything's fine, but it's just that the business has to start showing some sort of traction before you put your money behind that.
Prakash, the other two names, I don't know if you have any thoughts on what's going on. Lots of talk, though, around these. R Power, 15%, and Reliance Infra, 7%. They're, amongst the top 5 volume-led moves today. Huge volumes. Any thoughts?
The only thought that I have is when these names start making waves, you know what is happening in terms of market interest. So there's slightly more broadening of interest. These you can add Suzlon to that list as well. So a lot of money, is again coming back. FOMO will always drive people to buy into things which are more newsy, but the much more stronger, boring names will probably get sidelined. So that's what typically happens. So, and I'm sure there's some news flow around it, but whether the news flow is commensurate with the kind of 14-15% move that our power is showing, that I really don't know, because the math is fairly complex here. There's so many moving parts. So I have never been able to get that right, to be honest. So that's why I don't track much of that. But generally, symptomatically, I've seen that this is what happens when there is strong FOMO and you want to buy into something which is erstwhile penny stocks, which seem rewarding at this point in time.
FOMO there is no doubt about it, and I think that's absolutely the case. Prakash, thank you very much for joining us. It's always a pleasure. Have a good weekend. We'll talk to you again soon. Now, the RBI's board meet to review their FY25 balance sheet and decide on the dividend payout to the government has just concluded. Last week, the board had reviewed economic capital framework ahead of the dividend payout. Now, the big debate in money markets is what is that check size going to be? The CNBC TV18 polled the dividend at 3 trillion rupees. So as we slip into a break, just a quick primer on the significance of what the RBI transfers as dividend to the government of India. Lata is here with that explainer.
Markets, especially bond markets, are keenly awaiting the Reserve Bank's dividend. As per the budget estimates, it should be around 2.5 trillion rupees. In fact, a little less, versus 2.1 trillion that the RBI declared last year. However, there is a widespread feeling in the market it will be more than 2.5 trillion. So we did a poll, and a poll of economists, which indicated that the dividend may be 3 trillion rupees. Here's why the market is expecting a bigger dividend. The Reserve Bank of India data shows that RBI has sold a whopping $415 billion in FY25, that is from April 2024 to March 2025. This compares with sales of only $153 billion in FY24. Now, every time the Reserve Bank sells a dollar, it will be at the current price at right now 84 or 85 rupees, but its purchase price is calculated as the average of all the reserves that it has accumulated. Right now, it works to around 78 rupees, according to experts. So, the Reserve Bank had made about 6.5 rupees profit every time it sold dollars in FY25. That means the Reserve Bank made 6.5 rupees multiplied by 415 billion, that is 2.7 trillion rupees. In FY24, if you saw the math, the Reserve Bank sold only $153 billion and therefore it made only 1.2 trillion rupees. So only on this count, on dollar sales, the surplus of the Reserve Bank in FY25 would have been 1.5 trillion rupees more than in FY24. Last year's dividend was 2.1 trillion, so this year's can be 3.6 trillion rupees, according to this math. However, there are two other important components of the RBI's income, and they are interest income on foreign securities that they hold and Government of India bonds that they hold. Now, RBI's foreign securities holding as of March 31 was a whopping 48.6 trillion, but that's only marginally higher than what it was last year as of March 31, 24. It was about 48 trillion. While Reserve Bank of India's India securities, Government of India securities, was 15.6 trillion in FY25 end, slightly higher than 13.6 trillion last year, that is FY24. But because of rate cuts in the year gone by, total interest income from Government of India bonds this in FY25 would have been slightly lower than last year's. In short, RBI's income is expected to be 1.5 trillion more than last year, largely because of profit on dollar sales. Now let's come to expenditure. As for RBI's expenditure, the big change, a changing element, if you can call it, is how much Reserve Bank transfers to the contingency reserve fund. Salary and all that remain the same. Now, the Jalan panel requires that RBI has to keep 5.5 to 6.5% of its balance sheet as reserves. In FY25, an RBI panel reviewed the rule. But we don't know if they changed this 5.5 to 6.5 requirement. As of March 2024, Reserve Bank's reserves were at 6.5% of the balance sheet. Now, RBI may exercise its option and bring down the reserves to 5.5%. That is still within Jalan Committee rules, given that there are higher defense expenses for the government this year. Also, there is no fear that higher money printing will increase inflation because this year, CPI inflation is expected to remain below 4% for the entire year. Hence, the expectation that the Reserve Bank may declare a 3.5 trillion rupee dividend this year.
Okay, welcome back. Ronak Konkar is now with us, co-fund manager of equity and head of research at PPFAS Mutual Fund. Ronak, great to have you with us here on the program. Thank you, as always, for being with us. So let's just start with the two capital market names in your FlexiCap fund that are very visible. One is, of course, Motilal Oswal. The other is MCX. And I ask you this in the context of this entire NSE, BSE debate. It was our story yesterday, which we said that both exchanges want Tuesday as the expiry day, and then of course we'll see what happens. Just your, BSE is the only listed stock exchange. You own MCX. Is it just about sort of owning the dominant kind of player in the space? What are your thoughts? I mean, why not have BSE in your portfolio as well? Not now, it's already done phenomenally well, but just trying to understand the thought process.
Prashant, thank you for inviting me. Good to see you. It's a nice question. So the whole idea is, if you look at any of these capital market intermediaries, they are essentially network effect plays. So you need more buyers, more sellers transacting on these platforms, and that generates the economic value for this business. And from the capital requirement point of view, all these companies are very capital light, except for the regulatory capital that they need to hold. And any of the new services that they sell, like data feeds or anything, are essentially incremental profits for them, because the data anyway is their own proprietary data. So because of this model becomes very attractive, and going with a dominant player usually helps, because the network effects can be quite strong and very difficult to penetrate. Although we have seen in the past that when NSE was not there, BSE was very dominant. But once NSE came, BSE's dominance a little bit waned in the core activity of stock trading. So it's not guaranteed that any platform will retain its dominance. But once you are at a critical mass, these platforms tend to be very sticky, and transactions and volumes tend to converge to the more dominant player. So that's why dominant players with higher market share are preferred.
All right, got that point. Ronak, hi, great to have you this afternoon. Before we talk more, themes and sectors and what you like and how the portfolio's moved, I have to talk to you about the cash levels. Now, between money market instruments, cash, arbitrage, you're holding 26% cash in the portfolio. I think it's the highest we've seen, across the industry in a very long time. Definitely, I think, in my reporting career. And what's the sense here? And we've had a correction, but yet your cash has been high. Is valuation still a problem? And at some point, isn't that going to become a bit of an issue with investors if the market keeps rallying?
So maybe in the history of PPFS, this is not the highest cash position we have had. So we have had about close to 30% cash holding of the AUM when we were in the 2018-2017 bull market, when the same situation occurred, that wherever we wanted to look or take a position, the valuations were not too attractive. And even today, even after the Q4 results are out, many of the sectors where growth has been very, very promising and growth has been beyond expectations, the valuations of those sectors are actually significantly above the median valuations they were quoting. Now, one can assume that these valuations can continue to go up and up, but that's not how equity market or cycles work, right? So if cycle turns against these companies, then the valuations can derate very, very quickly. So it's better to be cautious when you're looking at a market which is generally a little overvalued. And in India, if you're seeing most of the sectors where the businesses are very stable and the growth rates are quite moderate and in their long-term averages, the valuations have not corrected as much. Where the valuations have corrected significantly is where the cyclical tailwinds of that particular company or a sector have disappeared for a short period of time. And that's what cyclicality does. So the valuations might look on a normalized basis very, very expensive, but on a short-term basis or a trailing 12-month basis, they might look reasonable. So we are not seeing valuations at an attractive position right now. Hence, the cash has been there. So it's a bottom-up call. It's not a call based on the market has to fall or correct and we'll deploy. And we have been deploying. So if you see the last month's fact sheet and this month's fact sheet, a lot of the existing names is where we have added our positions. And more or less the weightages across sectors also remain the same.
Ronak, hi, you've exited ITC hotels. Is that correct? That's the recent change?
That's the only recent exit we have done. We got it in the demerger from ITC Limited. We still continue to own ITC. But ITC hotels is something where we see the valuations and the growth rates are not very, very reasonable at the moment. So we will reevaluate. So we are tracking this sector very closely. We are aware of this business model. But at the moment, the valuations are not attractive.
Hi Ronak, good afternoon, good to see you again. Ronak, I'm looking at the same set of stocks that you have, Coal India, Power Grid, Petronet, LNG. Coal India, what's the view over there? Because, it had valuation support, but now the fear is that they could start seeing degrowth in volumes. What's your view on the stock? Valuation comfort, yes, but if they start seeing degrowth, then that's a worry, right? Captive coal mines are ramping up.
So that is again a thing we have to wait and watch, because any of the mining capacity coming up does take time, and by the sheer volume of which Coal India operates, to suddenly dislodge the supply chain is also very, very difficult. So at the moment, the ramping up of volumes itself for Coal India is happening. Production mechanization has been happening for a while. Their productivity improvement also has to be seen how it goes over a period of time. So I think over a period of time, the thermal piece of power that we use as a base field for the domestic power consumption in India, that I don't think is at a threat. In the longer term, yes, renewable sources will definitely try and edge into it. But as the power needs keep going up, as more manufacturing capacity India wants to put up, more households are also being built. At the same time, we want EV penetration. We want all the modern facilities that all developed countries also enjoy. So all of these needs power. So power demand itself is on a growth trend. So it remains to be seen where the volumes actually will grow. But short term, anything can happen. But longer term, I think it's not there yet where we can completely phase out coal power and say now we can depend fully on renewables.
No, absolutely got that. Just a quick word on your US tech exposure, Ronak. That's remained static, right?
That's remained static. We own 4 of them. So if you remember, RBI has not allowed mutual funds to invest globally after 2022. Since then, the overall allocation of the US stocks in the portfolio has also come down for us. Most of the incremental flows have been into Indian stocks only. And we have the 4 stocks. We own Microsoft, we own Alphabet, which is the parent company of Google. We own Amazon, and we own Meta, which owns Facebook, Instagram, WhatsApp. So all of these companies are on a very, very different growth trajectories of their core business as well as the cloud business and the social media and digital advertising business. These are actually long-term tailwinds, and it's actually most of the time it's surprising to see at the scale at which they operate, they continue to grow at these growth rates and with the return on capital that they generate despite spending so much money on the GPUs and computing capex.
And did did the team at PPFAS have a discussion about, the only thing you can do is reduce exposure here to these 4 names. You can't add. They went through a bit of a drawdown phase earlier this year. Was there any discussion at all to trim position before that or during that period? At all, no.
In the drawdown, it's actually better to add on to these stocks, but unfortunately, we can't add at the moment. But whenever we earn dividends from these companies, we do reinvest in them. And anyway, we are free to reshuffle this portfolio. So if we feel like selling one of them and buying something else in the international markets, we are free to do that. But at the moment, the tailwinds I spoke about, all these companies are running on, they are very, very strong for them. And the nearest competitors are not there yet in terms of scaling and also building the distribution advantage that these companies have. So it remains to be seen whether the dominance of these companies is waning. But yeah, cyclical or valuation fluctuations are fine. We can tolerate them.
This news on Google or Alphabet, which you own, that the number of searches is down for the first time, I think, in 15-20 years or something, right? That was the last data point because of things like Perplexity, things like all these large language models, etc. Does that worry you at all at the margin?
So in fact, it's a good thing and a bad thing. Bad thing because the company is reducing its search volumes. But again, it's a platform change as well, how people are consuming search as a product now. And it's actually a good thing because if you see, Google has been in the crosshairs of antitrust for a very long period of time. And because of that, if a new competitor can take some volume of search from a major player, actually a good sign that competition is still thriving. And it remains to be seen what happens to the case that they are fighting in the department with the DOJ in the US. But it's interesting to see that competition is still thriving and Google has to pull up its socks and improve its product if it wants its search results to go up.
Out of time, Ronak, thank you very much for joining in. Enjoy your weekend. So that's the word coming in from PPFAS. We will slip into a break. On the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We also get you a few BTST calls.
investing.
Welcome back. Nifty up close to around 250 points. So good going out there. Well, the couple of stocks that are doing well, Reliance Infra and Reliance Power, they are one of the top volume movers in today's trading session. So big up move is what we're seeing out there. HFCL, they reported its numbers very weak, but from the lows, that as well has moved into the green. That said, it's time for our favorite segment, D Street Chatter. Nimesh is back with us. Nimesh, what are you picking up?
Well, you know, Nigel, it's been a kind of a day when, you know, we opened gap up and we've sustained that. But I guess today's rally is largely a short covering rally, and to some extent supported with the IT stocks. So the IT index is what helping the bulls to fight today's rally. And you know, as you rightly pointed out, HFCL, there are so many such stocks, despite weak numbers, are trading up largely on back of short covering. And that is essentially for two reasons. First reason is the RBI dividend, right, which is going to get announced today. It could be a big number which will surprise the street, and maybe I think market is playing for that. And the other big buzz in the market is maybe you'll hear a big rating upgrade from a large foreign agency for India. That is something which the street has been anticipating for the last couple of days. If that turns out, you'll see further rally. And maybe because of that, you're seeing a bit of short covering as well in today's market. From a flow perspective, yesterday there was a clarity of a large sell trade. Today seems to be quite mixed and quite muted as well. I guess the only space which continues to be see buying interest is PSUs, and for a change today within the PSUs is the OMCs which are well bid. So again, you know, it's kind of a sector rotation within the PSUs as well. You'll see some of the other PSUs doing good on a daily basis. Even the broader market, the index may look just 0.5% or a 0.7% higher, but there are a lot of individual names which are buzzing in the broader market stocks. So the momentum is clearly there in the broader markets from a flow perspective. I guess from a Nifty and the Bank Nifty perspective, it's more of a short covering rally today.
Well, that's right. It gives you a pulse of the mood, right, Nimesh, when the broader markets do well. But what about individual stocks? What are you picking up?
Well, again, you know, I'll start with the stock where there was a large block today. The stock is under pressure, which is Gravita. There's a large block in the morning trade. I understand the promoter entity was a seller, and within the buyers, one of the large domestic AIF was an anchor investor. So again, disclosures could be quite interesting in Gravita India. So that's the first stock. The second stock is Supreme Industries. The entire space, seems to be buzzing in trade. Supreme stands out. One, there was a clean out trade by leading FIR today, so they've sold out. Some domestic mutual funds have bought, is what I understand. And in general, there is a bit of interest back in the entire space, and so is Supreme, which is a leader in that space. So that's the second stock. The third stock is HDFC Life. I spoke about the UBS note. The entire life insurance space is buzzing in trade, but HDFC Bank stands out in terms of good buying interest. And also remember, HDFC Life is now virtually at an all-time high. So there could be a big breakout as well on HDFC Life from a technical perspective. So that's the third name. And the last stock is Federal Bank. For second day running, the feedback is there is supply from larger institutions in Federal Bank. So there is the delivery is on the higher side, but that's on the sell side by larger institutions.
All right, interesting names, Nimesh, with what you're picking up. So we'll keep an eye on some of this stuff. By the way, Ashok Leyland numbers are coming out, and numbers look pretty decent. Almost 39-40% growth in terms of net profit, 1,246 crores. Margins seem to be better by almost 100 basis points. Revenues are up about 6% on a year-on-year basis. More as we go along. Stocks did a bit of a spike and then it's now started to come off. Ashish Kayal is with us to run us through what to buy or sell today for a reverse trade on Monday. Ashish, good afternoon. What do you have?
Afternoon, and if you look at the overall broader market, I think it's bullish. We can clearly see the markets are buy on dips, and having said that, there is a lot of activity buzzing around. So for the BTST or for Monday, you can possibly look forward to pick up the stocks which are outperforming. Something like Hindustan Copper, for some time it has been consolidating and underperformer, but reversing back on the upside. Formed a breakout from the inverted head and shoulder pattern. The target on the upside comes to around 270, and on the downside one can maintain a stop loss of around 225 levels. The next stock on the buy side is going to be Tata Chemical. Again, we can see it is about to give a breakout, not yet done that, but there is possibility we can see a breakout. Volumes have picked up, so Tata Chemical can do outperformance from here on. 920 is the target. On the downside, one can maintain stop loss of 855 levels.
Okay, all right. Thanks a lot for that, Ashish. Well, let's run through a couple of numbers that we'll be getting a little post-market as JSW Steel. We're looking at the consolidated numbers. Revenues are expected to see a flattish or mildly negative number. The EBITDA number, though, will improve, which tells you that margins are likely to improve. The profit number should come in at around 1,500 crores. What are the factors at play? JSW Steel will get some kind of benefit because they are a facility at Vijayanagar. That's come on stream, so that will contribute some additional volumes. On the standalone business, volumes will improve. However, realizations on a year-on-year basis will be under pressure. But you'll be looking for a bit of an uptick on a sequential basis with regard to their realizations. The crucial number to track, as always, will be standalone EBITDA per ton. That's expected to come at around 8,800 rupees, which compares with around 7,800 rupees, both on a year-on-year as well as on a sequential basis. How does this happen? They've been working on their operating efficiencies. Input costs will come in lower. That's primarily coking coal, going by what Tata Steel as well said. And realizations, HRC prices have moved up. Remember, 75 to 80% of their mix is on HRC, so that's what will help them. On the overseas operations, they could continue to struggle. However, on a sequential basis, we should see the losses that should come down. All eyes will be on the commentary, particularly on Supreme Court's verdict with regard to liquidation of Bhushan Power and Steel. What is the clarity? Will they bid again? How are they going about things? That's going to be top of mind. I'll be speaking to the management as well. We'll get you a slice on Monday morning. But JSW Steel, top stock to track for Monday morning trade. Gurmeet Chadda is with us, Managing Partner and CIO at Complete Circle. Hi, Gurmeet. Good afternoon. Good to see you in. Gurmeet, I wanted to ask you, what's the view, not on JSW Steel, but what are you all doing with solar now? The time to add is over, or are you adding even now?
It's always tough, Nigel. Thank you. Good afternoon to you. When the stock goes up so much in terms of build further conviction and add. We are not adding anymore in portfolios where the stock has become more than double digit. We are trying to rebalance a little bit. But we continue to be very constructive on the defense expenditure. I think the government emergency purchase of 40,000 crores of defense products will get announced pretty soon. Also could be a function of the RBI dividend. Second, the global military expenditure, Nigel, last year was $2.7 trillion. And this grew 9% from 23. This year, the growth could be 13 to 15%. Now, if you take 2 years growth of 13 to 15%, you're talking of an additional opportunity of $700-800 billion other than the spend which happens. And, so I think there's a huge opportunity for exports as well, which includes drones, includes BrahMos, includes the air surveillance and defense system, like the new one we are developing, which is Project Pusha, which has been assigned 40,000 crores. So I think the runway is big, but probably I agree with you. Maybe a lot of the good news is in the price. So you have to be selective here. And, it may see some price correction at some point of time. That might be a better opportunity to add.
Okay, that's solar industries and power stocks. Gurmeet, hi, good afternoon. Want to draw your attention to Sun Pharma and what you made of the commentary, the numbers and all of that, because it seems that the specialty business and the US business was a little below expectations in the fourth quarter. But, and then there is this constant unease. We don't know what's the policy shift in the US now on pharma imports. What's your thought on the stock?
So two things, in the near term, there will be pressure because of the tariff overhang, what Trump says, tweets the next day. So there will be pricing pressure. But, if you see the pricing pressure on generics now, it's been there for a while. And no new incremental capacity has been added because of that, which means there are very limited players now in that space who can compete at that pricing. And obviously, it will vary from therapy to therapy, in different generics, from chronic to other segments. So I think one market is disappointed that, they thought that the specialty business actually will do the heavy lifting, especially in terms of margins. That did not come through. So that's the reason you can see a touch disappointing, but that's okay. I mean, you don't have to really look at quarter on quarter. So two triggers to me is one, more clarity on tariffs. Second, with Sun Pharma in particular, the specialty component picking up, and the contribution coming from some of the new drugs coming, including the cancer drug. My sense is the bigger opportunity is CDMO, Surbi. And I think if you see the Biosecure Act, which right now has not been tabled up, it actually specifically, names about 5 Chinese companies. And they're very, very concerned on gene mapping and genetic data. And China has more than 20% market share. A lot of their companies like Lonza, etc., they do $5, $6, $7 billion top line. A lot of our companies are not even 1/3, 1/5 of it. And a lot of the companies we have, which is, let's say, DVs, we saw fantastic numbers, Laurus, Newland, Hikal, a lot of them have been around, They have a track record with US FDA and they have good chemistry skills, especially in the late life cycle strategies. So I think CDMO is a huge opportunity. In fact, it is as big an opportunity as IT outsourcing was in 90s.
Okay, got that. Gurmeet, we were just chatting with Ronak Omkar from PPFAS. And when you look at their FlexiCap fund, the second largest holding is Bajaj Holding and Investment, the holding company of Bajaj Auto, Bajaj Finance. And I was just checking that Bajaj Holding has outperformed its listed subsidiaries. So the last 5-year stock price CAGR for Bajaj Holding is 46%, outpacing Bajaj Finance at 37% and a Bajaj Auto at 28%. Have you had a look at any of these holding companies like a Bajaj Holding? Does it make sense to buy the parent sort of instead of the subsidiaries?
So, Rima, we took exposure in 2 of them. One was TVS Holdings, one was Bajaj Holding. And this was when the SEBI circular came on, getting the right intrinsic value through the derivative position, because holding companies were at 50, 60, 70% discount. Bajaj Holding, we almost entered at 8,000 odd levels, but we booked our profit much earlier than what the price you're seeing now, because for us it was a tactical move. Bajaj Holdings in particular, also, I think, they've done well. But obviously, it's a holding company. Second, I think the alliance, they are right now also trying to get the alliance share. A lot of the money is getting rerouted and internally getting restructured there. So there was a similar opportunity which came with, there was the news of Tata Sons getting listed, and Tata Chemical, despite its holding, went up briefly, and then the stock is still languishing as such. So I think you can use them as a special situation, more as tactical play. So amongst all of them, we still hold some position in TVS Holdings. Bajaj Holding, we've already exited, almost like 3 months back.
Okay, got that. Gurmeet, stay on. Just a quick word on IT today. Bernstein has come out with a note, titled it, Turning the Corner. They see potential for earnings upgrades and guidance improvement through FY26 for the IT companies. Their top picks are Infosys and Coforge. And the big reason is that if they look at the demand environment, it's strongest for financial sectors. And both these 2 companies, Infy in the large cap space and Coforge, is highly indexed to BFSI. For Infosys, 30% of the revenue comes in from BFSI, and for Coforge, it's more than 50%. So they expect Infosys to outperform peers, and for Coforge as well, they expect high teens growth to continue. Also, the other data point is that deal activity has been very strong despite all the volatility, geopolitical tensions. The deal wins, the TCV, the total contract value for large cap IT companies, went up 20% on a quarter-on-quarter basis in Q4. And also AI adoption, that's the third reason, AI adoption is starting to deliver tangible efficiency gains. So turning the corner, they believe earnings upgrades are in store for IT companies as we parse through the year. Get into a break, we'll come back with more. Welcome back. SEBI says they're not opposed to NSE's listing, says Chairman Tuhin Kanta Pandey. In conversation with CNBC, he commented on NSE's listing and the possible issues that are yet to be resolved.
Is SEBI fundamentally opposed to an NSE listing?
Not at all.
What needs to change within the NSE for SEBI to approve a listing?
I think there are certain issues which are being discussed and flagged, and in my belief is that they're going to be resolved soon.
In your discussions with the NSE, are you getting any clarity then on whether leadership there is making the necessary changes that you have suggested? And just walk us through what needs to change, whether it's on the litigation side. I know that there are issues with the clearinghouse that you have flagged, which we will get on to later. But can you be a bit more specific, sir, on what needs to change at NSE to facilitate a listing ultimately?
I think all of the issues will be resolved. I think that much I can say, both on the governance, litigation, technology, all of it. It's possible to resolve. I think they're quite amenable to solutions.
Above all, is there any progress on the NSE clearing operating independently, which has been among SEBI's requests? And what progress or otherwise is being made on that front?
There has it's not been a definitive direction from SEBI. It was put out as a measure of public consultations in November 2024. Is a possible way whether we could do that, but there are different models in the world, and there is no one model which we can say is the only way we can work. So there are very much possible to resolve things and still move ahead.
Gurmeet is still with us. Gurmeet, any thoughts on NSE? I think you own a lot of NSE. I don't know about BSE, if you've owned it or you still own it. Any thoughts?
Prashant, huge demand in the market, last 3 days in particular. In fact, I think the market is net short, I think, by a few lakh shares. Some of the deals could not go through. So the unlisted price right now, which is going is I mean, obviously there's no definitive prices, but it's gone up from almost 1550 to 1700 plus now. It's almost like a 10% move in 3 days. And I think the reason is that you have BSE, which is trading at whatever it is trading at, gravity-defying valuations, and NSE is still around 30 times. If you take, let's say, 1700 as the price, it's about 4.7, 4.8 lakh crore market cap. And if you put the EPS, that roughly is about 30 times. So there is demand, and NSE is also a lot of now, since the ISN got unfreezed, there's a lot of retail ownership, which has gone up, almost 1 lakh investors now. But I think this entire capital market space, Prashant, looks very, very good. Even asset management companies, you look at the authorized capital for HDFC, AMC or Nippon, and like at 50 crore, you make like 1,500 crores or 2,000 crores a year as profit. I mean, it's almost like infinite ROE. So once you achieve scale, the returns are disproportional. Same for some of the, I think CDSL is also due. I think it made a peak. And so I think a lot of capital market plays, in my view, you should have a significant weightage to the portfolio.
And you're not mentioning wealth management. I'm not joking, Gurmeet. When I was talking to a friend on the sell side broking, he said, "Man, I should join wealth." This is sell side is too much work and not, I guess. But anyway, jokes aside,
you are already managing it to whatever value additions you do. I think we are formally doing it. You are informally doing it.
Yeah, but he's not getting paid for it. That's his problem. Gurmeet, on NSE, the serious question: if somebody has a chunk of money, right, and he wants to kind of sort of deploy it in listed or unlisted or whatever, does NSE make sense? Because there's chatter of listing, etc. I mean, the regulator is much more receptive, so it'll happen at some point. Now, again, people have been saying for a long time, but maybe with change at the top, etc., we are at least hearing about it now once in a while. Is there an unlocking kind of an event once it lists, a significant kind of an upside, a one-time kind of reset?
There could be some now, Prashant. So if you see, I mean, last 2-3 years, the stock is now 6-7x. I remember pre-bonus, it used to be like 2,000, 3,000 bucks. Now post bonus, which is 5 times, it's still about 17, 18. So it's been a great wealth creator in unlisted space. But people have also lost a lot of money in unlisted space in, let's say, a Baiju or Farm Easy, and so there are always winners and losers. So unlisted space is not for retail, in my view. You should not go beyond 5-10% of your portfolio. And IPOs can get it. IPO is only one of the event, right? NSE, that was anyways liquid. So I don't think so. Just unlocking is an event. You should not buy only from a IPO coming perspective. But I think it could be a steady compounder, something that can compound 15-20% earnings for very long periods of time. And we just have like 11 crore investors right now, which are unique. So all capital market play, whether it is NSE or CDSL or CAMS, etc., you can have about 8-10% weightage and then hold it for a longer period of time, because this is a very secular. Look at AMC growth. The AUM has grown now almost 22% CAGR for last 6-7 years. I've been tracking it. Now that's the fastest growing industry. I mean, whichever way you want to look at it.
I don't know. This valuation reset, NSE shareholders are looking in BSE valuations. And
could happen there. Actually, my view, I think, should happen there instead of NSE.
Yeah. Oh, you're saying that goes down?
Should
that value?
Exchange world over, Prashant, trades at about 20-30 times. You can't have exchange trading at 90-100 multiple on assumption that the market share will keep improving. I think it's too many good things getting priced in. That's my personal view. I've got it wrong. We exited it much earlier as a disclaimer, but I think it looks extremely overvalued, right?
Okay, got it. Now, fair enough. Gurmeet, we leave it there. Thank you very much for joining us. Good conversation as always. Have a good weekend, restful one, and we'll talk to you again. What do we have? 24,850 on the Nifty, 240 points higher. So about 1% in the green. The Nifty Bank is up about 0.83%. The small cap index is up and the mid cap index is also up. So actually, after a spectacular last week, this week has turned out to be pretty decent. If anything, the mid and small cap indices are flat to slightly higher after 7 and 9% gains the previous week. So nothing, absolutely nothing to really complain about. Some individual one-off single stock specific accidents, but beyond that, a pretty decent week all told. Rima.
Okay, let's get to the week-to-date action then. On the way up, BEL was the big winner. Good numbers, commentary positive. Stock ends the week with a gain of about 5%, though on Friday it didn't do too much. Stock was flat. HDFC Life, Tata Steel ended the week with gains of about 3.5%. IndusInd Bank, despite reporting a worse than expected loss, much worse than street expectation, it managed to close up on Thursday and Friday and ended the week with gains. On the way down, from a week-to-date point of view, it was Grasim and auto stocks on the back foot, Maruti and M&M, and Sun Pharma too, courtesy the 2% fall on Friday post numbers, but the street was disappointed by the US performance, the generics there. The stock ended down nearly about 2%. All in all, for the week, the Nifty was down close to about 0.6%. Mid-cap index also staring at a knock of about 0.5%. Well, that brings us to a close on Closing Bell. Don't go anywhere, because on the other side is our very special Editors Roundtable.
Dalal Street gives negative returns this week with the Sensex and the Nifty falling under 1%. 35 Nifty stocks post losses this week. On today's edition of Editors Roundtable, we put the spotlight on the week gone by, and we also talk about the top EPS downgrades as well as upgrades this earnings season. I'm Surabhi Upadhyay, and with me on the show are Prashant as well as Nimesh. And today we have with us Nilesh Shah of Envision Capital joining us right here in not the studios, but in our newsrooms. We always love talking here because it's more informal. But thank God it's Friday. Week is over. A week without too many mega headlines or mega outliers, right? But
While we were going through the week, it was seeming
it's huge. IndusInd Bank and whatnot. That's true.
idea. And actually, as we look back, it seems like, as you said, a quieter kind of...
The numbers are like, kuch nahi hua. But the headlines were heavy.
And you will sort of go through the numbers. But actually, it's been a pretty decent week because last week was very, very strong.
Yeah.
Midcap index last week was up 7. The small cap index was up 9. And this week, if anything, we are flat to slightly higher.
Correct.
So all told, Friday to Friday, not bad.
And actually because markets have not reacted, Surabhi, we're missing out on the global headlines. Actually, global gave us a lot of headlines, right? Especially on the bond market side.
Never missing. Prashant is there on the global
Exactly.
headlines.
So,
Never.
So, I think that's something which the markets have ignored this week. The bond yields globally, US as well as Japan and everybody else. So I guess that's something which one needs to take an account of. But otherwise, in terms of corporates or in terms of for the domestic cues point of view, I think apart from earnings, the other big headline to me was the kind of blocks and the way promoters are aggressively selling out. So that was a big headline for me.
So, whatever global bond deal, and I think Nilesh would also agree, people say bond deals and, recession and tariff. And towards the end, everybody there's too much foreign interest in India.
Yeah.
And that is true. Actually, people I know a senior banker who was marketing in the US recently came back 2 days back. He said just a lot of interest. And the general view seems to be that a lot of foreign money will leave US assets over the next 3-4 years. How much we will get, we don't know. But basically, it will move out of, out of the US because US gets 75% of all money. Yeah. So even if a small amount of it gets out and a smaller percentage of that small amount comes to India, that's the broad kind of narrative out there that, earnings growth, etc., is not spectacular to talk of, and we'll talk more about that. But it's just that there's just a lot of liquidity, a lot of money.
That's true, and the color of money is usually quite green. I'll come to the week's movers and shakers and numbers in just a bit, but Nilesh, opening thoughts, feeling what, positive, neutral, negative? I don't think anyone is, but your sense?
Yeah, absolutely, no reason to be negative. Every reason to be positive or maybe even neutral. Earnings have been relatively fine. Yes, take out a few of the large caps, which obviously the earnings were not up to the mark, but otherwise broad-based earnings has been, I think, good. Liquidity continues to be very good. The macro tailwinds continue to be strong. Inflation trending lower. So I think right now there's really no reason to kind of be negative. If at all, I think there's every reason to be positive.
Lovely. Sounds good. It's a good sort of note to begin on. So let me quickly recap then, the numbers for the week and what we saw in terms of the final performance. So it's been a week of consolidation, and actually thanks to Friday, the week is looking much better because up until Thursday, the market was down between 1.5% to 1.6%, depending on which index you were looking at. But after Friday's up move, where we were actually outperforming a lot of global markets as well, the final numbers are looking good. So the cut on the Nifty is just 0.6%. The cut on the midcap index is exactly similar, just about 0.6% as well. Small caps have actually done better. Small caps have seen, gains. So the micro cap and the small cap market, stock specific level, that's really alive and kicking. 0.5% up on the small cap index. Now, top sectors of the week. Real estate, 2.7%. DLF did a lot of the heavy lifting here, by the way. Within the realty index, it was the best performer. Defense, of course, even this week at an index level, maybe it was far more narrow. For instance, a stock like Garden Reach Shipyard did very well. The sector was up about 2%. The capital market plays were thriving on Friday, in particular names like Angel and BSE. So 1.6% up on that index. PSU banks up about 0.5%. On the flip side, consumer durables lower this week. Auto lost about 2%. IT was down about 1.5%. Oil and gas losing 1%. And FMCG, we had accidents like Colgate, remember? So there was some, shake off on the FMCG side of the market. It's been a week that's been defined by earnings. A lot of the mega moves in the defense stocks were also behind us, barring one or two specific names. But it's been more about earnings. And we had, both accidents as well as outside surprises. Accidents, like I mentioned, Colgate. And a complete, outside surprise would be Honasa, for instance. After a totally bombed out stock, on Friday it was finally up almost 20%. So good going over there. The bank Nifty has been absolutely flat for the week, and that's the problem for the market, that the clear sense of leadership seems to be missing. We don't have either IT or FMCG or banks, any of the big sectors providing defining leadership, and we'll talk about that. Finally, I'll come to flows, because going forward, obviously, a lot of the global US bond headlines will drive the action, so will flows. To go back to Prashant's point, now the tally is very patchy for the week. You have one good day and one bad day. So if we can maybe pull up the numbers for the week so far, till Thursday. Monday was negative 500 crores. Tuesday was a negative 10,000 crores. Wednesday was a positive 2,200 crores. Thursday again was negative. Now Friday we'll see if today's move is backed by big cash market buying or not. Overall, May still good. May FPIs have been net buyers to the tune of 19,000 crores. But a lot of that perhaps would be because of the block trades and the other action that Nimesh talks about. We still have to see if the secular return of the FPI in terms of cash market buying has come back or not. So that's the week.
Nilesh, what have you been doing? What's on your radar? What's keeping you busy?
I think earning calls.
Yeah, absolutely. I mean, the earnings calls, the earnings season, especially the mid and the small cap side, I think it's been a wonderful quarter. I think most companies have probably given or delivered returns in earnings in line with expectations, or probably even beaten. While we say, for example, defense, we talk about this whole thing about what happened at our borders, but in general, most defense companies came out with good numbers, good quarter, despite the fact that the order inflow has not been phenomenally high for them, but they still managed to kind of do it. A lot of the engineering companies, I mean, they came out with good numbers. I mean, despite the fact that the financial year gone by has not been a great year from a GDP point of view. A lot of the smaller consumer companies actually bounced back really well and delivered a great quarter. And the other thing that we are seeing for many companies is significant improvement in terms of their cash flows and significantly better capital efficiency. And to me, that actually becomes pretty much a prerequisite for a re-rating in them. So while we think that mid-cap, small caps are expensive, and that's part of the larger narrative, but on the whole, there's strong earnings push coming in from there. I think most of them have guided for a strong year ahead as well. And clearly, most of the manufacturing defense side, they continue to kind of be extremely optimistic in terms of the outlook for the next maybe few quarters.
This is the universe of stocks you own, Nilesh, which have
both own and the ones which are on the radar. I mean, even if I were to kind of look at some of the digital platform companies, I mean, they still continue to be very, very strong. So it's not just about, earlier we were very dependent on export-oriented companies or anything like that. But right now, I think the domestic side, I think, is looking very, very strong. A combination of both digitization and indigenization. These two essentially are powering a lot of the mid and the small cap companies.
So, Nilesh, when you hear a lot of the con calls, especially in the broader market names, the mid-cap and small caps, what is the key takeaway? Why are they turning so bullish, or why the commentary is so strong? Where they see, the management see the growth coming in? Is this going to be purely domestic plays, or there's going to be a bit of export push as well?
Largely domestic.
Okay.
And I think what's really happening with the mid and the small cap companies is they are able to kind of get an increasing larger pie in the overall scheme of things. So they're basically gaining market share from the big players. So if you were to look at FMCG, that's precisely what's happening. Yeah. The big guys are struggling, they're getting challenged by the smaller guys. If you look at banks, financial services, you see that across the board. You look at even all the guys who are digital platforms, guys who are adopting technology, across the board you're really seeing, while the headline GDP is growing at 6-7%, the larger guys are struggling to keep pace with that growth. But the mid and the small guys, the emerging guys, the challengers are growing in double digits. And that's something which I think is quite phenomenal and seems to be very, very sustainable.
So Fino and Paytm, right? The two.
That's on the payment side.
On the payment side.
Yeah, I mean, on the payment side. Again, look at it on the payment side. I mean, these are businesses which are still growing at 20 to 30%.
Yeah.
And on the digital others, which are the names?
Even if you look at, say, for example, I can't take specific name, but say, for example, the insurance distribution platform. I mean, the business is still growing at 30%.
PB, of course.
Yeah, I mean, that's growing at 30%. We own another name called Car Trade. That again had a phenomenal quarter. I mean, revenues growing in high teens and earnings growing in double digits. I just think overall, I mean, these are proxies for domestic plays or domestic economy.
I think it just absolutely ties in with what we've been hearing, that going forward, this is going to be a stock picker's market. I mean, if you have the right stocks where you're talking about some of your companies, portfolio companies or stocks on the radar, earnings are coming in. But if you're looking for that easy, one big headline narrative, just buy the sector and make money, probably not that kind of a market anymore, right?
Yeah.
Cartrade, Nilesh, is they recently acquired
OLX. They acquired OLX. Okay. So that's not yet fully kicking in terms of the overall business. That is something which still, essentially, while they've managed to turn it around, but in terms of its contribution yet, I think it has a long way to go. So clearly, I think each one of these businesses, I think they're doing fantastically well.
You know, let me ask you, I'm not sure if this is a portfolio stock or not, but if you can just generally talk about this, Protean, which was a casualty of the week. And I think it came out of nowhere. A lot of people have been very bullish on the stock. But this whole situation with PAN 2.0, I mean, I don't know if you have a view on the business, on the company, but any thoughts here?
No, in fact, we've been tracking it. We owned it earlier and we exited quite a while back as well. And I think the challenge out there is that the existing businesses are kind of probably at best growing in single digit. That's the challenge. They have yet to find a business. So while they have many optionalities, which they have worked upon, but none of these are yet firing. So, for example, they have a massive kind of involvement in the whole ONDC.
ONDC, yeah. The management spoke about it.
Yes.
It's very small, though. I mean, right now it's only contributing 7-8 crores.
Correct. So that business has yet to kind of scale up. So that's the challenge. And on top of that, the valuations are not kind of compelling or cheap. It still trades at probably 50 times trailing earnings. Yeah. It's fine. I don't think there's an issue with the valuation as long as the business is growing in double digit. The challenge for them is that overall revenues are not growing in double digit.
I think you know, Nilesh, in this earnings season, what stood out for me as well, you know, even if it's an expensive stock, but if it's delivered the results, if it delivered growth, the markets are latching into it. You know, there are so many stocks which have hit 10%, 20% circuits for 2-3 days on the back of very strong growth. So if there is a growth, I think, I guess there is a lack of ideas as well. People are struggling for good ideas, so they're willing to buy and pay premium for a good earning.
Absolutely.
Have you seen that? Have you observed that?
Yeah, absolutely. That's been the theme. I mean, you know, we kind of keep debating in terms of valuations. But I think when managements deliver, markets, I think out there are willing to pay back. In the sense, in terms of re-rate, disproportionately reward.
Right.
You know, what I'm going to do is just also look at a few other names, specific stocks, and maybe we can ask Nilesh to weigh in. So these are, so the earnings season is largely behind, and these are the top upgrades and downgrades, EPS upgrades and downgrades for FY26, which have happened over the last 1 month, essentially. So, you know, typically would cover the entire earnings season. Now, I think, just to caveat, not all of this would be earnings related, but I think bulk of it would be earnings related. So, NSE 200 is the universe, top downgrades and upgrades for FY26, and this has happened over the last 1 month. So, let's get started. Look at the downgrades first. Cochin Shipyard, and this was surprising to me, it's one of the strongest run-ups that we've seen. Earnings, and these are all Bloomberg numbers, consensus earnings for FY26 have been brought down 36% for FY26. I don't know if there is a one-off or something, but minus 36% for Cochin Shipyard. Stock's gone the other way. I think it's up 30% in the last 1 month. Adani Enterprises is number 2. It's down. Earnings have been brought down about 30%. Siemens, there is a 24%, downgrade of earnings cut for FY26. Swiggy, again, I've sort of tried to lump these businesses together. Swiggy is 33% lower earnings for FY26. All Bloomberg numbers. Zomato, 23%. IndusInd Bank, of course, I think we've seen widespread earnings cuts, 27% cut to FY26 numbers. Then a few banks, Union Bank, 15%, IDFC First, 14%. Bandhan, over the last 1 month, has seen a 13% downgrade to numbers. Bandhan, of course, has been guiding that things will look much better starting the third quarter this year. Motilal Oswal has seen a 20% downgrade to earnings. So, again, this is surprising. Jubilant Food, 13% cut. Phoenix is 13% cut. Biocon, 19% cut. BHEL, 12% cut. Vedanta even has seen a 12% downgrade to FY26 earnings. Now some upgrades here to FY26 numbers. Bank of India comes up as a top one, 32% upgrade to its earnings. PFC, a 17% upgrade. Indian Bank, 8%. OMCs have done well, and I think we've seen some upgrades. BPCL, a 14.5% upgrade. Adani Energy Solutions, 13% upgrade. JSW Energy, a 10% upgrade. There is Mahindra, MRF, TVS, Exide. Between 5 and 12.5% upgrades here, the entire auto pack. BSC seen a 10% upgrade to F526 numbers. Godrej Properties, there is Solar Industries. I mean, that, we've, of course, talked quite a bit about this one over the last fortnight or so. Kalyan Jewellers has seen a 7.5% upgrade. Lupin and ABB about 5-6% upgrades each. So, that's the bulk of it, both downgrades and upgrades. Nilesh, anything stands out to you out of these?
So I mean, the upgrades, at least what it looks like, I mean, one was the PSU banking pack, and obviously they'll probably make, with interest rates coming down, and they have a large bond portfolio. I think probably they stand to benefit from that. The other
PSUs, there is auto.
Auto, again, I think is that auto's coming off, I think, a low base. Last year was not particularly great for the auto companies. And if rate cuts do happen, then I think that's a positive. Also, I think directionally, when we've seen crude oil prices kind of soften, basically auto tends to do relatively well. So probably there are some of these things which are going. I mean, a lot to do with macro. The macro is getting better. That's kind of having a spillover effect on some of these sectors.
It's Swiggy and Eternal, 30 and 20% downgrades to...
Because of and that's the debate actually.
Because of not the full delivery, but the quick commerce.
Yeah, I mean,
that's
really sad. So because I think what had happened was that earlier both the platforms had guided that we're going to open more dark stores. Yeah. So they had pretty much preponed their entire dark store rollout. And that's beginning to be seen, number one. Number two, I think it's also by choice that they decide to basically discount more. It's part of customer acquisition. You want to kind of be there before the other three come in, which is the Amazon, Flipkart, and Big Basket. So I think it's a very, very conscious strategy. I mean, it's a playbook that they're very familiar with, that this is the way they want to do to weed out potential competitors. And I think as a strategy, it surely makes a lot of sense. So you could probably have a downgrade for a year, but after a couple of quarters, it's quite possible that you'll again see upgrades there.
Cochin, any thoughts? Do you track it?
No, I don't track it, but what it could be is that I think shipbuilding is a very long drawn business. You have these are like execution cycles which run into multiple years. And if probably just because there's been a delay by a quarter, it just spills over from one year to the next financial year. I presume it could be more to do with that rather than anything else. And the fact that the stock, despite the downgrade, has kind of moved up, somebody's probably taking a view beyond a year or so.
I remember Sanjeev Prasad, I think it was Monday or Tuesday, he was with us and he singled this out as an example, not gave it as a call, but he said, I mean, everything and more is already baked into the stock price. That day the stock fell, but then there are enough takers, enough buyers as well, I guess, in the market. Okay, we have to take a very quick break on that note. Come back on the other side, we continue the discussion.
Okay, welcome back. You're with us here on Editors Roundtable. We're in conversation with Nilesh of Envision. Nilesh, we're talking themes, and I think digital is a big one for you, right? And I think recently you've also bought into a consumer/retail play, but in the US, right? I mean, that's been a newer kind of an addition over the last
absolutely. I mean, that's a company whose stock price probably is down 75% from the peak now. And therefore, I think it just represents some good, nice value because they essentially successful. It's not just US, but it's US, it's UK, now Germany. And it's a classic case where you manufacture in India or you make in India and also have a supply chain spanning many other countries. And you pretty much manufacture or make in low-cost countries and you basically sell in high-income countries. And that's a very, very good arbitrage to have. So I think clearly both the stock price decline and the fact that the business model is getting more and more resilient with every passing day, with every passing quarter, I think it represents some good, incredible kind of opportunity. I also think it's probably one platform which is India-centric, but has an opportunity to make a global mark. So we kind of keep looking out for these kind of Indian brands which can make it big.
Since you can't, for our viewers, Nilesh is talking about Vaibhav Global. That's the name of the company. And full disclosure, it's all publicly disclosed that Nilesh's fund owns that. It's one of a kind of a business, right? I mean, it's not. I've not seen very many. It's a unique business.
Yeah, absolutely. It's unique. And again, I think it's a great combination of both manufacturing at home and selling abroad to the consumer. It's not like kind of B2B where you make something and export. It's not a B2C, it's a B2C business. So I think it's incredible from that point of view.
I just want to come to financials as well, Nilesh, because a lot of people have been waiting for that leadership, from banks. But the earnings season seems to be telling us that growth is not coming by as quickly as what one would have wanted. Your thoughts here, and in the midst of all this, we had this Indus saga. I was frankly, personally quite relieved to see at least it didn't impact sentiment of the markets too much. But the management uttered, the F word, the fraud word, and we don't know. The last has still not been said on it. So financials within which, and maybe Indus, if you want to share any advice on it at all.
So within financials, clearly, I mean, I still believe the large banks, I think any kind of uptrend or upmove will really be dependent on big bouts of foreign liquidity coming in, because that's a space which foreign institutional investors love. I mean, that's something that they're comfortable with.
Yeah.
But in terms of earnings growth...
Intrinsic earnings, when the money comes, they'll rally. We know that.
I think intrinsic earnings are not... These are businesses which are not going to grow beyond, like, say, 10, 12%. And they face the specter of declining ROEs. So if you look at all these banks, I think over a period of time, the ROEs have kind of begun to inch down. And that's, I think, a trend which will continue. So I think from having 15, 18% ROE, they could potentially land up at maybe 12, 14%. Institutional investors don't like that situation. Number one. Number two, there are other opportunities outside the big banks which have done really well. I mean, we talked about, say, for example, the insurance platform. I think all the housing finance companies, the mortgage companies, they did very, very well. They had some challenge in terms of tighter liquidity and high interest rate last year. But this year, that situation has turned. You have better liquidity, benign liquidity, and interest rates falling. That's a really sweet spot for them. So there are these kind of pockets. And then there's essentially the big NBFCs like Bajaj, etc., who essentially have made a comeback. So I probably think that space will outperform yet the large banks. The large banks will do well, but there's more liquidity kind of coming in.
Non-banks
the NBFCs, HFCs, I think that's a better place to be.
Nilesh, that's the call with the IT as well. The large cap IT will report very muted numbers, but the few mid-cap ITs like Persistent, Coforge will show very strong growth.
Yeah, I mean, the difference is just, it's very stark in terms of the growth numbers, because of course, all of these companies are very capital efficient. The ROEs are in the 20s, so there's no issue with that. There's no issue with capital allocation. There's no issue with governance. The issue is in terms of growth, because the big guys are so big that they struggle to grow beyond the single digit. I mean, I think most large companies grew probably at about 6% for the last 1 year, versus that the tier 2 companies grew in double digits.
True.
And that, I think, scenario continues. And I think when you have things like AI and all coming in, the tier 2 companies will use that as an opportunity, while the same AI will be an adversity for the large.
Have you looked at any company within the mid-cap IT which you think will really benefit from the AI explosion which is going to happen in the next few years?
So a company that we own with full disclosure, like say Newgen, which is a product company, but they have been able to create AI tools and AI agentic solutions for their customers. I think the company itself is already doing well. They have strong tailwinds, but for them, this can actually kind of add to the growth rate, and it could kind of mean a lot. that if you're growing at, say, 15%, can you therefore grow in, say, high teens? It's quite possible. For the big guys, just purely the maths doesn't add up. And I think that's the biggest challenge for the large IT services.
It's a hardware, basically. It's a hard...
No. These are all software. These are all software solutions.
For new gen as well.
That's right.
Unlike players like E2E, I don't know if you...
Yeah, so that's total hardware. That's total hardware. That's the whole world of chips and those kind of things. So yeah, that's a very different kind of a thing.
Okay.
And Prashant, just on that note, I mean, while there's a lot of hype around, all this, the whole... the chips and all of that.
Is Nugent trading at AI valuations or normal valuations?
No, I don't think that. But I think if you really look at the history of markets last 10, 20, 30, 40 years, the hardware guys have a limited shelf life in terms of the market. It's the software guys which essentially rules.
Yeah.
So look at what Cisco was 20 years ago and versus that Microsoft then, Microsoft now.
Yeah.
And always the leader of the next decade comes in from the software side. And then those guys rule for 10, 20, 30 years.
Also much more consistent. I mean...
much more consistent. And the challenge is that on the software side, you still have pricing power. On the hardware side, your prices keep coming down. I mean, that's the whole nature of innovation. Innovation helps you to improvise, lower costs, and create a better deal for consumers. I think that's the challenge for hardware, that hardware always faces the specter of falling prices. And that, I believe, is true for all hardware companies.
Absolutely. I think NVIDIA is the exception because they make the chips and they are physical chips. But I mean, and those are chips that go into the AI story of the world, so to speak.
But even there, I mean, there's Chinese chips, right? Yeah. Which apparently are equally good, and the US is now trying to block it.
Exactly.
Because, there is, which ties into the point that, lower, and Chinese chips will be definitely cheaper than, US.
Well, not
chips.
coming in the US. Not allowed. Okay. All right. Great conversation as always, Nilesh. Thank you very much. Very, very interesting. And you're leaving us feeling a lot more optimistic, I think. Like you're saying, there are more positives than negatives as we analyze markets at this point in time. So thank you very much for being with us today. All right, with that, it's time. It's a wrap on this edition of the show. So from Nimesh, Prashant, myself, and the whole team, thank you very much for being with us. Do stay tuned. News and updates continue right here on CNBC TV18.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty end the week down nearly 1% despite a rally on Friday. 35 out of the 50 Nifty stocks post losses this week. Real estate and defense stocks buck the trend, gain over 2%. The Central Board of the Reserve Bank of India is expected to decide on the surplus transfer to the government today. A CNBC TV18 poll shows economists expect at least a 3 lakh crore rupee bonanza for the government. The higher surplus is on account of large profits from the sale of dollars by the central bank. The CEO of Processor Naspers is betting big on food, fintech and e-commerce in India. Fabrizio Bloisi promises to invest billions and eyes at least 5 IPOs in the next 18 months despite setbacks in Byju's and Farm Easy. Also rules out any stake sale in Swiggy. That's a CNBC TV18 exclusive. Pakistan denied permission to Indigo's Srinagar-bound flight from using its airspace to escape bad weather, says India's aviation regulator. The flight from Delhi suffered damage to the nose cone, leading to its grounding for further inspection. Passengers and crew escaped without injuries. The Trump administration revokes Harvard's authorization to enroll foreign students who currently account for 27% of the student population, says the university failed to create a safe campus environment, alleged that many anti-American pro-terrorist agitators on the campus are foreign students. The U.S. House of Representatives approves Trump's tax cut bill. This includes a 3.5% tax on remittances sent by non-U.S. citizens to other countries of origin. Nearly 3 million Indians work in the U.S. under various visa programs. The U.S. contributed nearly 28% of remittances for India in FY24. Israel's Prime Minister Netanyahu accuses leaders of UK, France and Canada of emboldening Hamas after they called for an end to the military offensive in Gaza. At least 29 people, including children, have died due to starvation in the last few days, according to health officials in Gaza. Well, straight to the market action of the day. We witnessed a major buying in trade today with the benchmark indices rising nearly 1%. 48 out of the 50 Nifty stocks closing in the green. FMCG and IT were amongst the top gainers. But for the week, the market closed in the red. But this is the story for today, up 1%. The markets this week down by about 0.5% for the Nifty, and similar story playing out for the Sensex. The Nifty Bank closing absolutely flat. Prashant is standing by now to wrap up the day's market action for us. Prashant, well, it's a flat close for the week. Of course, we saw a big move on Friday, but sum up the week that was, and more importantly, the triggers that we should watch out for in the week ahead.
Well, it looked like the week will turn out to be a down one, and maybe even pronounced, because if you looked at in the middle of the week, it looked that way. But the market recovered, and by Friday, it was actually a pretty decent week. So the Nifty was down only 0.7% after being up 4% the prior week. The Nifty Bank was actually unchanged, even slightly higher. And remember, the Nifty Bank also had a 5% week last one. Midcap index was down again 0.7% after being up 7% last week. And the small cap index was actually up another 0.5% after last week's 9% gains. So I don't think there is any other way to sort of describe what happened, but to say that a bit of a dip early on, but was largely bought into, especially on Friday, and it turned out to be a pretty decent week. Nothing spectacular in terms of this or that sector. I'll just start with Nifty and what did well. So BEL, the defense pack, continued to shine, 5% for the week on BEL. HDFC Life was up 4%. Tata Steel was up about 3.5% or so. On the downside, Grasim lost 5, Maruti was down 4, and Mahindra & Mahindra was down about 4% as well. I looked at the universe of NSE 500, the top gainers and top losers through the course of this week, and Honasa came up with a 26% gain for this week. Emcure was up 21, Pfizer was up 17, Jubilant Pharma was up 14, and a name like BASF was up about 13% or so. So much more dispersed and not really from one sector. For example, if you go back and look at what last week was like, it was largely all defense. Now, on the downside, if you look at broader markets, DOMS, the stationery company, 11% cut. Dixon was down 10. Questcorp was down about 9%. SW Solar, Idea was down 8%. Of course, news flow there. Colgate, Credit Access, and some of these are numbers related as well. So, I mean, an unremarkable kind of a week, but not bad, given that you've actually, especially in the broader market, managed to eke out a little more gains after what was a pretty spectacular week, the last one. Monday, of course, is a US market holiday. That market will start trading on Tuesday. Focus very much in the US on bond markets. And on 3 days next week, I think Tuesday, Wednesday and Thursday, there are bond auctions cumulatively about $200 billion. And response to those bond auctions will be watched closely because, there have been fears that maybe buyers are hesitating to put in bids, put in money. Will the government need to cut the size of these auctions? Will the Fed have to do something? Are we at that point? I think those are questions which matter a lot more for equities, but it's all coming from the bond side. Back to you.
Prashant, many thanks for joining us. Now, the Central Board of the Reserve Bank is expected to decide on the surplus transfer to the government today. Now, let's take you through a CNBC TV18 poll of economists. They expect a 3 lakh crore rupee bonanza for the government. The higher surplus is on account of large profits from the sale of dollars by the central bank. Ritu's here with more details. Ritu, we've been getting used to this bonanza from the RBI. The government's been getting used to this bonanza from the RBI for the last few years. What's the street working with? What's the best case scenario?
Well, Shireen, the broad range of this bumper dividend that the street is working with is about 2.5 to 3 trillion rupees as per most, but there are exceptions like Citi, for instance, which expects the surplus transfer to be anywhere between 3.5 all the way to 4 trillion rupees, although that seems a bit unlikely. Our poll had suggested a number of 3 trillion for FY25. Now, even at this, it will be a sharp jump from last year's dividend transfer, which was then at a record high at 2.1 trillion rupees, and it is also going to be much larger than the government's FY26 budgeted amount of 2.6 trillion, which is collectively from the RBI, public banks and financial institutions put together. The key reason that we're going to get such a huge number, of course, is going to be the dollar sales. Now, the gross dollar sales, in fact, rose very sharply to about $400 billion in FY25 compared to just $153 billion in FY24. And that's probably the highest since the global financial crisis as well. Now, keep in mind, when RBI sells dollars, it sells at current prices, which averaged about 84 to 85 rupees on average for the previous fiscal. And the purchase price is the average of all of its reserves, which economists expect at around 78 per dollar, which means for every dollar that RBI sold, it earned a profit of about 6.5 rupees. So considering the $4 billion dollars that have been sold, that is a straightaway gain of 2.5 trillion, and that is where the bulk of the dividend is likely to come for. Then there are other factors like interest income on rupee and foreign securities that will also support this. But what is the big unknown is how much RBI transfers to the contingency buffer, which is the ECF, Economic Capital Framework. The Bimal Jalan Committee had recommended that RBI keep 5.5 to 6.5% of its balance sheet as contingency risk buffer. Last time around, they had kept it at the upper end at 6.5%, but this time we'll have to see what the number really comes out to be.
Yes, we will, and we are waiting for that. Ritu, many thanks for joining us. Now, net foreign direct investment into India crashed by more than 96% to just $353 million in FY25 compared to the previous year. This is due to large-scale repatriation of capital by overseas investors and increased foreign investments by Indian companies overseas. The central bank also said that the decline reflects positively on the economy, as it's a sign of a more mature market where foreign investors can enter and exit smoothly. The gross FDI remained elevated in FY25 with 14% growth year on year. The big earnings of the day are Ashok Leyland posting a healthy performance in Q4 along expected lines. Net profit up 38%, primarily driven by a tax credit of 170 crores. Revenues saw a spike of close to 6% as recent price hikes have boosted realization. The board approved a bonus issue of 1 share for every share held. It also approved a dividend of over 4 rupees a share. Metal giant JSW Steel posting a strong Q4. Net profit rose by over 13% on a yearly basis, meets street expectations. Revenues declined by 3%, but in line with what the street was forecasting. So that's JSW Steel for you. And it's also sent demand notices to banks requesting a refund of 19,300 crore rupees paid under its resolution plan for Bhushan Power and Steel. The company's also sought a 60-day delay in the liquidation proceedings. Banks have said that they will decide on the refund during this period and don't have to immediately refund the money to the company. This was part of the terms and agreement between the company and the lenders when the deal was signed. But the big news maker this evening, the global CEO of Process and Naspers, is betting big on food, fintech and e-commerce in India. Fabrizio, Bloisi, the head of one of the largest tech investors in the world, is planning to invest billions and has promised at least 5 IPOs by companies backed by Process in India. The portfolio of Process spans across sectors, including companies like Swiggy, Rapido, Meesho, Urban Company, among others. Process is not keen on selling any stake in Swiggy, though, at the moment. Take a look.
Yeah. We have in total $19 billion in cash in Prosus.
Yeah.
Our intention is to invest to grow, and I think India is one of the 3 big priorities. So we will invest for sure a few billions here.
A few billions here, but your style of investment, when Prosus first started investing here, it was growth stage. Then in the last few years, we've seen early stage investments come up as well. Are you looking at, perhaps more larger deals, buyouts? Is that something you see an opportunity in the India market?
I think something that Prosus has is flexibility, and our strategy is to empower the local demands and the local entrepreneurs. We have 35 companies in India. Yeah. Having 5 IPO, it's not like this is the potential, this is the short-term potential. I think we will have more public companies from Prosus portfolio just after the next 10, 12 months, the next 12, 18 months. Well, so my point is we are really confident that we have so many nice companies. We have many IPOs ahead. But I don't see IPOs as the end, like, we are IPOing so we can sell. No, we are trying to build a $50 billion business here in India. There is so much more to do. We have to invest much more. We have to enable consolidation in terms of ecosystem consolidation, how some of our companies can help the others. That's what I think we bring to the table.
So for the time being, do you intend to continue holding on to that 20+% stake that you have in Swiggy even after the IPO?
Yes, we are not in a mood of selling. We are in a mood of keeping investing in India.
Okay.
So our intention is to keep investing and invest more generally in India.
But no plans to sell some of your stake from Swiggy yet?
No. PayU has a lot of growth ahead. We are doing well in credit also inside PayU. And just a quick story to inspire you. We invested in China 25 years ago.
Tencent?
Yes.
Yeah.
And for many years, people said, why don't you sell Tencent? They are valuing like 10, 20, $50 billion. People said, I was not there, but people made this question, like Tencent now is public, $10 billion, sell. And we haven't sold, and now Tencent is a $600 billion company. We are in India. India can be as exciting or better than China. We have so much ahead. We are just getting started. We have space to build $10 billion companies here. That's the obvious, but $50 billion, $100 billion here.
And you can catch that full interview with the Process CEO at 6:30 p.m. tonight on a special edition of our show, Dalal Street. US President Trump's tax cut bill has proposed a 3.5% tax on remittances sent by individuals who aren't citizens to their countries of origin. Now, the bill was passed by the US House of Representatives and it refers to the tax as an excise tax. The final version of the legislation has reduced the controversial tax from the proposed 5% to 3.5%. Now, nearly 3 million Indians work in the US under various visa programs like the H-1B, etc. The US contributed nearly 28% of the remittances for India in FY24, which is money sent to India by Indian origin non-residents living in the US. Now, the Trump administration has revoked Harvard University's certificate to enroll international students. The university has just 72 hours to comply with 6 federal demands to regain its eligibility. The demands include giving the Trump administration access to all records of illegal activity by non-immigrant students in the past 5 years. If the university fails to comply, it means that thousands of current students must transfer to other schools or leave the country. This action comes after the government terminated the $2.7 million in grants for Harvard last month. Take a look.
U.S. President Donald Trump's administration on Thursday revoked Harvard University's ability to enroll international students and is forcing existing students from overseas to transfer to other schools or lose their legal status. Homeland Security Secretary Kristi Noem has ordered the university's Student and Exchange Visitor Program certification be terminated and accused Harvard of, quote, fostering violence, anti-Semitism, and coordinating with the Chinese Communist Party. Harvard rejected the allegations, calling the move unlawful. The clampdown on foreign students marks a significant escalation of the Trump administration's campaign against the elite Ivy League university in Cambridge, Massachusetts, which has emerged as one of Trump's most prominent institutional targets. The move comes after Harvard refused to provide information that Noem had previously demanded about some foreign student visa holders who attend the university, the department said. In the 2024-2025 school year, Harvard enrolled nearly 6,800 international students, amounting to 27% of its total enrollment, according to university statistics. Trump, a Republican, has undertaken an extraordinary effort to revamp private colleges and schools across the U.S. that he says foster anti-American, Marxist, and radical left ideologies. He has criticized Harvard in particular for hiring prominent Democrats to teaching or leadership positions. Trump has frozen some $3 billion in federal grants to Harvard in recent weeks, leading the university to sue to restore the funding.
And staying with international news, over 50 Palestinians have been killed or are missing after an Israeli airstrike on a residential building in Gaza. Rescue operations have been stopped due to a lack of heavy machinery. Health officials at Gaza have said that at least 29 people, including children, have died due to starvation in the last few days. Officials have warned that thousands more are at a risk of dying as limited aid begins trickling into the enclave. Israel's Prime Minister Benjamin Netanyahu has accused the leaders of Britain, Canada and France of emboldening Hamas. This comes after the leaders threatened coordinated action if Israel did not stop its military offensive in Gaza. The Israeli Prime Minister also said that President Macron, Prime Minister Khani and Prime Minister Starmer were on the wrong side of justice. The suspect in the fatal shooting of 2 Israeli embassy employees in Washington has been charged in federal court with 2 counts of first-degree murder. The suspect, Elias Rodriguez, has been charged with murder of foreign officials and causing death with a firearm. Officials have said that more charges, including terrorism, could be added. From one war-torn region to another, U.S. President Trump has announced that there was a major prisoner swap between Russia and Ukraine. Trump congratulated both sides on the negotiations. Meanwhile, G7 nations have vowed to impose more sanctions on Russia if it fails to make progress towards peace with Ukraine. We will head into a break, but up next, Pakistan denied permission to Indigo's Srinagar-bound flight from using its airspace. This after Indigo asked for a flight path deviation to escape from bad weather. That and more when we return. Well, the Supreme Court has issued a notice to the centre over a petition filed seeking to regulate betting apps. The top court has refused to pass an interim order and said it will issue notices to states if needed. Abhimanyu joins us now with more. Abhimanyu, take us through the Apex Court's observations in this matter.
Well, the court had observed that there is not much which the judiciary, which the courts can do in such a case. If people voluntarily are engaging in betting, be it online or offline, the PIL before the Apex Court had sought regulation on online as well as offline betting. The petitioner had claimed that several people, thousands of people across India had committed suicide, and he was intervening. He was filing a petition before the top court on behalf of the parents of the people who have committed suicide. He had also rued the fact that several celebrities were also endorsing many such activities, and he wanted the court to come down with clear-cut orders as far as clamping down or regulating the practice of online and offline betting is concerned. However, the court refused to pass any interim order. A notice has been issued, though, to the centre. The court has also made it clear that if need arises, it would issue notices to the states, but no interim order can be passed for now. Justice Suryakant also observed that principally he is with the petitioner, but there's nothing much which can be done by the court. So it remains to be seen whether there would be any judicial intervention even at a later date. And more importantly, the eyes would be, of course, on the affidavit which would be filed in due course by the central government, clarifying what is their position on the issue. And even if there is a malpractice or people are falling prey to betting or betting apps, what kind of action can be taken by the union government?
All right, Abhimanyu, many thanks for joining us. That's the latest as far as the betting app matter in courts. Prime Minister Modi inaugurated the first Rising Northeast Investor Summit in New Delhi. In his address, the Prime Minister called the region India's new growth engine. The event saw major investment pledges from large conglomerates like Reliance, the Adani Group and Vedanta. Speaking at the summit, Reliance Chairman Mukesh Ambani pledged to double the group's investment in the region to 75,000 crore rupees in the next 5 years, added that the company will also help transform the region into a healthcare hub.
Reliance Foundation will bring the best of cancer care to the Northeast. To begin with, we have established a 150-bed comprehensive cancer hospital in Manipur. We are collaborating with Mizoram University on care of breast cancer using genomic data. In Guwahati, we have built an advanced molecular diagnostic and research lab. It will be among the largest genome sequencing capacities in India. We will help transform the Northeast into a healthcare hub and a research powerhouse.
Well, that's Mukesh Ambani. Now, SEBI Chief Twin Kanta Pandey said that the market regulator is not opposed to NSE's public listing. Speaking exclusively to CNBC Sri Jayagaraja, Pandey reiterated that all issues related to the NSE IPO will be ironed out soon. Take a look.
Is SEBI fundamentally opposed to an NSE listing?
Not at all.
What needs to change within the NSE for SEBI to approve a listing?
I think there are certain issues which are being discussed and flagged, and in my belief is that they're going to be resolved soon.
In your discussions with the NSE, are you getting any clarity then on whether leadership there is making the necessary changes that you have suggested? And just walk us through what needs to change, whether it's on the litigation side. I know that there are issues with the clearinghouse that you have flagged, which we will get on to later. But can you be a bit more specific, sir, on what needs to change at NSE to facilitate a listing ultimately?
I think all of the issues will be resolved. I think that much I can say, both on the governance, litigation, technology, all of it. It's possible to resolve. I think they're quite amenable to solutions.
Above all, is there any progress on the NSE clearing operating independently, which has been among SEBI's requests? And what progress or otherwise is being made on that front?
There has it's not been a definitive direction from SEBI. It was put out as a measure of public consultations in November 2024. Is a possible way whether we could do that, but there are different models in the world. And there is no one model which we can say is the only way we can work. So there are very much possible to resolve things and still move ahead.
Well, that's SEBI Chief Tuhin Kantapande. Now, 2 days after a Srinagar-bound Indigo flight suffered damages to its nose cone due to a hailstorm, India's aviation regulator said Pakistan denied permission to the pilots to use its airspace. The pilots were attempting to escape bad weather, but their request was rejected by Pakistani authorities. Remember, the Pakistan airspace is closed to Indian airlines after Operation Sindoor. The passengers and the pilots managed to escape without injuries. Madiha is standing by to give us a timeline of what transpired that evening on that flight. Madiha.
Well, it was an extremely harrowing experience for these passengers on board Indigo's Delhi-Srinagar flight 6E2142. And why not? If the aircraft is being hit by ice balls from all over and is being descending at 8,500 feet per minute, we can only imagine the state of the crew as well as the passengers during those moments. The incident occurred on Wednesday, 21st May. It was all normal when the flight took off from Delhi at around 5 p.m. Problem started after a few minutes into the journey when the aircraft, cruising at 36,000 feet, entered hailstorm and severe turbulence near Pathankot. Now, according to what the pilots of the plane have told the Directorate General of Civil Aviation, that they requested the Indian Air Force for permission to deviate towards left, which is the international border. But IAF did not allow the flight to do that. Remember, Pakistan has closed its airspace for Indian carriers, and IAF's denial could be based on airspace restrictions to avoid any potential adverse action by Pakistan. The pilots then directly contacted Lahore ATC to enter into their airspace to avoid the weather, but they were not allowed to enter by ATC authorities in Lahore as well. The statement further states that the crew initially attempted to return to Delhi, but as they were close to the thunderstorm cloud, they decided to penetrate the weather, and subsequently the aircraft was in the middle of hailstorm and severe turbulence. With limited options to navigate in the mountain region, the crew chose to continue to fly through the weather by the shortest route towards Srinagar. The weather was extreme and the aircraft triggered several warnings: angle of attack fault, alternate law protection lost, backup speed scale unreliable. These were the warnings triggered. Due to the upward and downward movement of the wind, the aircraft lost the autopilot control as the wind speed had steep variations. During this period, the aircraft descended at 8,500 feet per minute, much higher than the typical descending rate of 1,500 to 2,000 feet per minute. The crew flew the aircraft manually till they exited the hailstorm and landed safely at Srinagar Airport. The flight landed at 6:30 p.m., making it the most terrifying 90 minutes for the crew as well as the passengers on board. The aviation regulator is conducting further investigation into the incident.
Madiha, many thanks for joining us. Yes, a terrifying 90 minutes indeed. That is what took place. That is what transpired there on that Indigo flight to Srinagar. Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV18. Stay tuned. We're back in a moment with more.
Talk Money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, you've often heard us talk about investments. When to invest, where to invest, how to invest, and of course, what to invest in. But perhaps not enough time and thought is given to the question around exiting our investments. When and how should we exit the investments which have done their job for us in our portfolios? Well, that is exactly what we will focus on this week, setting up a framework for scientific and planned exit strategies. And this can also, of course, help us plan our retirement more effectively, among other things. Joining me to do that this week is Mrin Agrawal of FinSafe India. Mrin, thank you so much for joining in. Welcome to the show. And this is, I admit, this is a question that even I don't ask enough. So I thought it's an important conversation to have. Do you agree?
Absolutely, Surabhi.
So, I want to tell you about the genesis of this thought. I think when the market was, going through a correction, that is when a lot of people were wondering that, yes, of course, you keep buying in when the market is falling. But people also wonder that, okay, I've made a lot of profits since COVID. Should I be now booking some gains? So you tell us, what is the overarching principle when it comes to exiting investments and, taking that profit home?
All right. So, yes, we often talk only about investing, and very often I do see that people do not have an exit strategy in mind. So 3 things that you have to keep in mind when do you exit a fund, right? First is, of course, if it is near to a goal. So if you have done goal-based investing and you're nearing your goal, then, of course, you do need to look at exiting the fund. Second is if the fund is underperforming, right? Or if there is rebalancing required. So in a situation where, for example, one asset class has become, has had a higher allocation, let's say if equities has gone up a lot and you're having more equity than what you really need to have, that's when, these are the 3 reasons why you would need to basically exit your investments, right? So when we talk about each one of these 3 cases, right? When do you check for underperformance or when do you check for rebalancing? It has to be only once a year. And also, once when you check this performance, it's not like you see that the fund is underperforming for 1 year. So then you just look at exiting it. You will still need to track the performance of the fund for a period of time. And you have to do the right tracking, right? It's not like just saying this X fund gave this much, my fund gave this much, so I'm exiting. No, you need to look at what is the performance of your fund versus the category average versus the benchmark, and then track it for a period of time. And the same thing goes for the rebalancing as well, right? I mean, it's not something that you would do on a 3-month basis. You would need to look at it on a yearly basis. And the last thing is on the basic framework, especially when you are near a financial goal. And we saw this in COVID. We saw this earlier this year, a couple of months back when the markets were down, that when people wanted to withdraw their money for their goal, if the markets are down, obviously your investment value is also going to be down. So to protect yourself against some of these situations, especially if you're exiting before a goal, one of the things that you do need to do is that at least a year before the goal, look at what is the value of the investment. If it is somewhere near to the goal value, look at protecting whatever part of that investment by moving it out into a safer instrument, right? So this is basic framework.
Okay, that's a great starting point. Helpful thoughts there. But Mrin, I want to go back to the basics, really, financial planning 101. And I sometimes wonder, because obviously planners tell us to, plan for specific goals. Take a holiday in 3 years, buy a car in the next, 4 years, or look at retirement in the next, say, 20 years. But at the same time, when we look at our portfolios, usually people have a bouquet of mutual funds, mid-cap, large cap, small cap, thematic, etc. In your experience, how do we marry the two? Have a certain set of funds which are for specific goals, but then you have an overall bouquet, which could be mid, large, small, thematic, defense, etc., passive, active. So how do you set for goals within an MF portfolio?
So there are various ways of doing it. You know, some people would just like to do it on an overall basis to say, I have this portfolio and then I'll decide at the time of exit. I think the better way to always do it is to say, this is my goal. To this, I will tag these 3 or 4 investments or these 3 or 4 funds for this particular goal, because then it becomes easier for you to basically do the exit, right? Because then you know, okay, if this is my goal and I need this money, these are the 3 funds I've tagged, and you just exit those particular funds. So I think it's basically what works for each individual, but I would seriously suggest tagging in specific funds for specific goals.
Yeah, absolutely, because that's what I was wondering. I mean, you might have a huge chunk of your money, let's say in large cap funds. Now, your goal might be a holiday, but you really want to exit, you know, your entire position in that large cap fund for a holiday that could cost you, say, 2 lakh rupees. So, okay, so you're saying that, you know, bucket it in individual goals and then list the specific funds to arrive at that goal. Got that point. Mrin, on the point of when you're nearing your goal, and you said you then need to start, you know, exiting before you hit the date of the goal. So give us some examples of how this may work. Maybe medium-term goals, short-term goals, even long-term goals. So say you know, the plan is to buy a car over the next 2 to 3 years. How would you plan for it, and when will you start the exit process?
See, as far as short-term goals are concerned, like 2 to 3 year goals, in any case, you would only look at debt funds in such cases. So there it becomes fairly simple. You know, you can pretty much withdraw at the time of the goal itself, where the short-term goals are concerned. But when you actually have longer-term goals that you've planned for, let's say child's education and you need to pay college fees, right? So what I did this for myself as well, wherein a year before the college fees had to be paid, and whatever that amount was for the 4 years, right? So that was in any case what the goal value was. So what I did is that, you know, whatever, like it was pretty close to the goal value. So I actually removed that entire money and I went and put it in a debt fund. Now that may not be the situation for everybody. You may be still far away from your goal value, right? So in which case, I think one of the things to do is that maybe start withdrawing money over tranches. But certainly, if you have invested in equities for a goal, you know, I would not look at withdrawing at the time of the goal, because you don't know what the market is going to be like, right?
Yeah.
So I would just play cautious in this case, rather than saying, no, I want to maximize my returns, or I want to wait and increase my corpus, right?
Okay. Yeah, fair enough, because you don't know. I mean, when you're about to hit the goal, suddenly there might be a 10-15% drawdown as well. May not be in your favor. Got that point. So, you know, this whole conversation on rebalancing, let's take COVID as an example, Mrin, because a lot of people who entered the market at that time managed to buy the dips. They've seen sizable appreciation in their wealth, right? And now they're looking at a market which is range bound, and sometimes you've had volatility on the downside. So now let's apply the exit framework here. Should they exit? Should they not exit? What would be the route? What should someone be doing if they're sitting on 5 years of gains since COVID in their mutual funds?
See, I would always say that, you know, it's like where mutual funds are concerned, it's not handled like stocks, right? And the point is that, let's say you've had some great gains, but you'll still have a reinvestment risk, which is like, where do you go and invest the money, and at what rate is it going to grow, right? And, you know, this is what I always tell investors, like when people say that I invested in this fund, but it's not doing well, and there's some other fund doing well, or this whole conversation that was happening around gold as well, right? To say that gold is better than equities, so should I move my money to gold? And my question is, how do you know that this performance is going to sustain, and how do you know that gold is going to do better than equity, right? So when you look at data, and I found this really nice data actually available, wherein they have looked at various tenure periods, and, you know, they looked at buy versus hold versus doing profit booking at 20%, 30%. Yeah, and reinvesting. And actually, if you pick up any data, it's going to show you that buy and hold always works in the long term. So I am a great believer of goal-based investing. And I would say if your fund has done very good, well, that's great. Continue to hold it. I mean, why are you penalizing the fund by exiting it, right? So I would just say stick on to your investment. If it's done really well, continue to stick on with it till the period of your goal.
That's really reassuring to know that, this propensity to book profit and then to reinvest, find that dip again in the market, that is not necessarily the path to long-term wealth and prosperity. Buy and hold. And that's the easier thing to do as well, right, Prince? So I think that would work well for retail investors. Brings me now to the next question of rebalancing. So if you could just elaborate over here, what all entails in rebalancing? When you sit with your planners or your advisors, what are the questions that I should ask? And when do I need to rebalance my portfolio?
So once a year is enough. You don't need to do it more than that. And you can decide if you want to do it on a calendar year basis or if you want to do it on a financial year basis, whatever works for you. Now, the first thing that you need to consider is what is the asset allocation and, what is the deviation from the asset allocation, right? So you need to set an internal benchmark as to at what number or at what deviation percentage are you going to do that rebalancing on an annual basis. Now, I think that number of 15%, 20% is a good number. So what it means is that let's say that you have 60% in equities and you have 40% in debt, and that 60% becomes 75%. So there's a 15% deviation basically. So you might decide that at a 15% deviation on an annual basis is when I'll start doing the rebalancing, which means I will get my equity back down to 60%. So that number of that deviation has to be decided by the investor. As I said, it could be 15, 20%, right? Now, what funds do you exit then? What funds do you rebalance? So let's say you have a set of equity funds and you have to bring down your equity allocation. So the easiest one would be to look at the funds that are underperforming or where you have very, very small holdings. And this is very common, because people just tend to buy these NFOs or I would say, unfavorable funds. Like, for example, if you have thematic funds or sector funds that you might have just got into, or if there are small holdings, or if you're having a lot of duplicate funds. So, now in this era of ETF investing, very often you see people having 4 Nifty 50 ETFs, right? Which is actually duplication. So, these are the factors that you look at first, either underperforming funds, small holdings, duplicate funds, or funds which shouldn't be in your portfolio, let's say like thematic or sector funds. Now, if you don't see any underperforming funds, for example, you've had a good year and you've bought all the right funds and nothing is underperforming, then you basically have to go and see that which category do I want to reduce? Do I want to reduce large, mid, or small cap? So basically, essentially based on your risk profile, what risk profile you want to maintain or what risk profile you want to be in, you keep those funds, and the ones that you reduce those. So this is about reducing. But when we come to increasing, because there's also increasing exposure in a fund, right? It could be the other way around, where equities have had a bad year and you want to increase exposure. So of course, over there, you want to ensure that you're well diversified and that you're not over allocated in one fund.
Absolutely, absolutely. Well said. But Marind, the tough part is to reduce allocation to a fund or to an asset class that's working very well. It could be mid-caps one year. It could be gold this year. And we're getting questions on this as well. If you could just take up the gold issue, a lot of portfolios, because we historically have gold holdings, there people might have gold coins and bars, and there's obviously the jewelry exposure. Then a lot of people have invested in sovereign gold bonds or gold funds and ETFs. But it's hard to reduce exposure when that asset class is still doing well. So specifically, when it comes to rebalancing, what would you advise on gold now, looking at the market?
See, if you're very, very overexposed and you're finding it difficult to reduce, let's face it, as a financial advisor, it's easy for me to come and say that reduce your exposure, right? But if you're finding it difficult to do it, I would just say, okay, stick on to it, but don't add more, certainly, because the bigger issue that people have is that when mid caps are doing well or when gold is doing well, they will go and add on more. So at least if you're not reducing it, don't add on more, certainly. And end of the day, somewhere you'll have to keep in mind the allocation, because see, when the markets are going up or when everything is looking very good, it's all good, right? But then when you have that fall is when you're going to have a big fall. So somewhere I would say that we'll have to think about these factors for sure.
Absolutely, absolutely. Got that point. We need to take a very quick break. But when we come back, we apply this whole exit framework to a long-term goal like retirement planning. How do you ensure that you start coming out of funds? Which are the funds to start exiting as you're approaching a landmark moment like retirement? Back with that in just a bit.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week we're discussing exit strategies, how to exit your funds smartly so that you maximize the output. Now, Mrin, specifically, I want to talk to you about systematic withdrawal plans. How important are they when we are talking about exiting funds where we may not need the entire lump sum money upfront?
Yeah, so very interesting. You know, I've seen that SWP or systematic withdrawal plan is something that's gained a lot of traction in the last 1 year. And I'm often asked about it as a route to creating wealth, right? So I would like to clarify a couple of things. You know, SWP is a product where you basically want to take out money on a regular basis. So it is the opposite of the SIP where you're investing. Here, what you're doing is that you're trying to set up a regular cash flow. So it's a product for regular cash flows. Now, couple of things that you have to keep in mind in the SWP, right, is that, see, whenever you want regular cash flows, it has to be from a product which is growing at a stable rate and you know, which has surety of returns, right? Now, I'm seeing a lot of people talking about setting up SWP from equity funds, which is a little concerning for the reason that equity funds can be extremely volatile. So, you know, for example, let us say that you have some amount, let's say 1 crore, and you think of setting up an SWP, but then the markets fall by 10-15%, as we saw earlier this year. So everything is going to go out of whack, right? I mean, all your calculations and everything are not going to hold good, whatever you've done, right? Like if you started with 1 crore and you're removing some amount every month and the markets fall, your 1 crore is going to come down, let's say, to 85-90 lakhs. Obviously, all the calculations that you've done are going to change, right? So very, very important that, you know, you need to get the reason for doing your SWP correct. That first, the SWP is meant to generate regular cash flows. It has to be done from an instrument which gives stable returns like debt funds and certainly not equity funds. And point number 3, the SWP also needs to be planned well. And I'll you know, explain this through 2 examples, right? So
yeah, so Mrin, so if, okay, I get your point. What you're saying is that don't do SWPs directly from equity funds because equity funds can be volatile. Let's take an example. Let's say that, you know, someone is looking at regular income after retirement. Let's say they've got a corpus. They've got either a 1 crore or 2 crore corpus. How should they plan the exit via the SWP route then?
Yeah, so 2-3 things. See, now if you if you make an investment, let's say into a debt fund, and you start the SWP right away, it's like you just getting your money back over a period of time, right? So I think first thing is that you should actually invest in a debt fund for, let's say, at least a 3-year period, and then start the SWP, because then you've built some amount of gains over the last 3 years, basically. So that's the first thing to be kept in mind. Second is you have, I think, some SWP calculators that are available online, but actually I would actually suggest that please plan this with a financial advisor, because it's not that easy. I'll give you an example. Let's say that you start with a 2 crores corpus and you want to withdraw 1.5 lakhs per month. And I'm assuming return on investment at 5%. I'm looking at a post-tax return on like a short duration debt fund. Okay. So you've got a 2 crores corpus. You've put that money in a short duration debt fund and you want to withdraw 1.5 lakh rupees every month. If you do the cash flow calculation, this money is going to get over in 16 years, right? Let us say you wanted to plan for the next 20 to 25 years. You're actually going to fall short because the money is only going to last 16 years. So there is another plan that you can do with the SWP, which is that you invest part of the money. So in the same example, you invest 1 crore and in the short duration debt fund, and you start the SWP. Same way, 1.5 lakhs every month. It's going to last you for 7.5 years, right? Now, the balance 1 crore, you can invest into a balance fund for about 5 years, move that money into a short duration debt fund, and then start the SWP. So what happens with that is that then you are able to have the SWP running for about 19 to 20 years. And that way you're able to meet your requirement of getting that amount on a monthly basis, because what you've done is that the first part of it you've invested, you've ensured that you're getting your cash flow for 7 years. The balance amount you invested into another instrument to grow the corpus and then start the SWP on that, right?
So this is interesting. Basically, you're breaking this up. You're letting one part of that corpus continue to compound in an equity instrument, and you're remaining, the other half of that corpus is being put in a debt instrument, which is more stable, and then you do a systematic withdrawal plan from the debt portion of it. Got that? That makes a lot of sense. Mrin, we are trying to just squeeze in some viewer queries here as well. If you can quickly answer these, because viewers have been writing in saying they have some doubts on mutual funds. So I want to take this query that's coming up on coming from Sam on Instagram. He's saying, what is the difference between value, growth and momentum funds? And how should I look at their composition in my portfolio? Do I need to rebalance? Do I need to add them? What should I do? Mrin, new fund categories, many of them on the passive side.
Yeah. So the value funds are funds which invest in stocks which are basically trading, below their true value, basically, and they're expected to essentially grow in the long term, but they're undervalued at this point in time. Growth stocks are, of course, from sectors that are expected to grow well over a period of time and give you sustainable growth. And momentum investing is all about investing in what is basically trending, right? So in a very, very simple way. Now, what should be the allocation of each of these categories in your portfolio is totally dependent upon the risk that you want to take. Certainly momentum, followed by growth, followed by value. That is your high risk to lower risk. So if you want to take a very high risk, if you're able to take high risk, then you could have a higher amount in momentum. If you don't want to take high risk, if you want to be more conservative, you could do value funds. It's all dependent upon what is the sort of risk that you want to have in the portfolio, basically.
Okay, absolutely. So that, I guess, is the golden rule for rebalancing. First, assess your own risk profile, your own requirements and your goals, and then look at your portfolio. So final thoughts, Mrin? I mean, this is a very helpful conversation. So just recap this for us in a nutshell. Exit strategies and the question of exit via an SWP versus lump sum exits. Just what should be a holistic framework to follow?
Okay, so first and foremost, look at exiting only if you're close to a goal or if you're looking at doing rebalancing. That's point number one. Secondly, lump sum versus SWP. So lump sum, of course, you can withdraw, and then you can design like whatever sort of strategy you want for your withdrawals. But there does exist a systematic withdrawal plan, which is actually a very good feature that's there in mutual funds to get regular cash flows. But point number one, always, I would say, of course, do it in a debt fund because equities are really, really volatile. And secondly, plan it well. Use the SWP calculators online to figure out as to how long the money would last based upon what is the sort of withdrawals that you're doing. And as I said, if it's really not tying in with your time frame, then see how you can work with a financial planner or get someone to basically design it out for you.
Okay, all right, Rin. Thank you very much for joining in. Sometimes, something that sounds so logical and commonsensical escapes our minds. So it's important to discuss it and put it out there for everyone's reference. Thanks very much for joining in and sharing your thoughts with us. Well, folks, that's a wrap on this edition of Let's Talk Money. Hope you found this conversation useful, simple and systematic, not just when it comes to your investments, but when it comes to your exits as well. Keep sending us your feedback, comments and queries. We'll see you with another conversation next week.
Let's Talk Money.
Hello and welcome to Global Eye. I'm Parikshit Luthra. The top story we're tracking this evening. 2 staff members of the Israeli embassy were shot and killed by a gunman outside a Jewish museum in Washington, D.C. The victims, Yaron Lishinsky and Sarah Lynn Milgram, were leaving a networking event at the museum organized by the American Jewish Committee when a man opened fire with a handgun at a group of 4 people. The suspect was identified as Elias Rodriguez, a 30-year-old from Chicago. Rodriguez was arrested by the authorities right after the incident and was heard saying, "Free Palestine," as he was being led away by the police. He has been charged with first-degree murder, as well as murder of foreign officials and related firearm charges. According to the Israeli ambassador to the United States, the 2 victims were a couple about to be engaged. US President Donald Trump called the incident a horrible attack and demanded swift action to combat hate in America. Echoing the same sentiment, Israeli Prime Minister Netanyahu said and also linked the shooting to the 7th October 2023 attack and said he was shocked by the horrific incident. Netanyahu also said that the security will be increased at all Israeli embassies worldwide. This attack comes as Israeli forces continue to deepen their presence in Gaza. Over 50 Palestinians have been killed or are missing after an Israeli airstrike on a residential building in Gaza. Rescue operations have been stopped due to lack of heavy machinery. To take this forward, we are now joined by Kobi Shoshani, Consul General of Israel to Midwest, India. Mr. Shoshani, thank you very much for joining us on the program. Let me begin by asking you, as per the preliminary information available, what do you think were the motivations of this attack on and shooting on 2 Israeli officials, embassy officials in Washington, D.C.?
Definitely, it's a very right and very precise.
the poisoning language that this pro-Palestinian organization use. They are fueling terror attacks by agenda. I have to say they are trying to use words against the state of Israel, which I don't even want to repeat. But they are poisoning the atmosphere. But I want to tell you in a very frank way, Sarah and Yaron was a couple that is supposed to be married, as you mentioned before, very young gentlemen. What they did to go to a museum, Jewish museum in Washington, this is something that, this is the real face of this terrorist. And I'm very, very sorry and send my condolences to the families.
What's been the reaction now in terms of increasing security for Israeli officials and the advice for them all across the world?
Definitely, as the Prime Minister said very, very clearly, of course, going to tie the security around our missions all over the world. I have to say that in India, we are have a very good collaboration with the Indian authorities, and we are fully trust and fully support what they did to us, to protect us. But definitely this hatred that comes from these Palestinian groups, it's actually grow in the poisoning language that coming up from the Palestinians. I would like to add one more thing with your permission. The pro-Palestinians, I can understand them. They hate us, they like terrorism. That's part of their daily life. But the people who support them, some of them, naive, especially from the left, I have to say, in America, their agenda is a peace and everything. That's the time to say no. No to violence, no to terrorism, not to killing. And I hope that one day they will understand that they're supporting by this poisoning language killing of innocent people.
I would also like to ask you, sir, about the present offensive in Gaza. Prime Minister Netanyahu has said that Israel will eventually take over all territories in Gaza. Could you give us a status of the operations and what is the strategy ahead?
I think Prime Minister make it very, very clear 2 days ago, or I think even last night, make it very, very clear, and I fully support. I think this is something very crucial. Bring back the hostages, disarm the capability, the military capability of Hamas, and the war going to be ended. He make it very, very clear, and that's right now in the end of the Palestinians.
Right. Now, when it comes to the current situation in the region, US and Iran are talking about a nuclear deal. If this deal is not reached, what could be the action? Because there has been a lot of reporting about how Israel could launch an attack on Iran if this nuclear deal is not arrived at. In fact, Iran has already been sending out warnings.
I think that we are fully support President Trump initiatives to settle down and to get into a deal. What I see from the Iranian side that they don't accept it, which means that the ball again, it's in the hands of the Iranians. But I think that they have to be smart and to accept the deals that the Americans make for them. I think that it's going to be good for the region, good for the Middle East. I think Iran with the nuclear capability is a risk not to Israel. It's a risk to the world. It's a risk to Europe. It's a risk to Asia. It's a risk to United States. And I think everybody understands it.
Right. But I would like to ask you, what would be the threshold for Israel to carry out an operation on Iran? Because this could lead to a wider war in the region as well. So what is the threshold? What will be the benchmark or the point at which you will say that, yes, we're now going to carry out an operation?
I think, again, our Prime Minister make it very, very clear. The interest, the security interest, the security issue of the state of Israel is about any government and every opposition and coalition in Israel. And I think that the Iran capability, nuclear capability, is a risk to the state of Israel. This is our focus right now. And I think that everybody understands this position.
Right. In terms of the operation against Hamas, what can we expect next from the Israeli government, from the Israeli ground forces?
I think that right now in Gaza, the Israeli military forces, the IDF, is controlling most of part of Gaza. Right now, we are controlling a very part ready to continue and deepen the operation until they were going to release the hostages. We still have 59 hostages in Israel. Some of them dead, some of them are alive. We want them back, and I think that that's the only solution to end this war. Bring them back and disarm, bring authority to Gaza, but which is not Hamas, without any military capability. Israel will not accept any military capability and risk of its security when such capability there are in Gaza like that.
Right. My final question to you would be about India. Give us a sense about the conversation that you have been having with India. One, about the situation in Gaza and Israel's operation. And number two, India-Israel cooperation over Operation Sindoor and the conflict with Pakistan.
Let me not go into diplomatic collaboration between Israel and India. Everybody knows that Israel stands by India. I think the operation was successful in my point of view. And I think that right now everything calmed down. I think this is the right way to India as well. India needs stability. India is a superpower that's coming up in the economic field, and they need stability. As you probably know, I'm a big fan of India, big friend of India. And I think that India is doing the right thing in my perspective.
Right. All right. Kobi Shoshani, thank you very much for joining us on the program on the death of Israeli embassy officials in Washington, D.C., and also Israel's operations in Gaza, and what next in terms of the country's attack on the Hamas to bring the Hamas terrorists to book and make them accountable. We're taking a short break here on Global Eye, but coming up on the other side, President Donald Trump's crackdown on immigration has gathered steam. The president's tax and spending bill has allocated billions of dollars for mass deportations. A special interview with Christopher Elms, spokesperson at the U.S. Embassy in India, after this break.
पता है।
Well, this is what we've been waiting for. The Reserve Bank of India has announced its dividend to the government, and it is not as high as what the street was expecting. Remember, the forecast went all the way from 2.5 to 3.5 lakh crore rupees. What it's coming at is a little over 2.68 lakh crore rupees. Let me go across to Ritu. This is just one of the announcements that's coming from the Reserve Bank. There is also a revised economic capital framework that has been approved by the Central Board of the Reserve Bank. But Ritu, let's start with that. The surplus number, the dividend number, as we were saying, the street was forecasting anywhere between 2.5 to 3.5 lakh crore rupees, and it's come in at over 2.68 lakh crores.
That's right. The street was factoring anywhere between 2.5 to 3 lakh crores of surplus transfer. It has come in at 2.68 lakh crores. You know, I believe the street, at least the economists, may be slightly surprised because the wider consensus was for the number to be upwards of 3 lakh crores, especially given the large gains that the Reserve Bank of India would have made in FY25 on dollar sales. But that said, this is still far higher than last year's dividend transfer. That was at 2.1 lakh crores, and this is a new record high. It is also higher than the 2.6 lakh crores that the government had budgeted for the collective dividend from public banks, financial institutions and RBI put together. Of course, our own poll had suggested 3 lakh crores. Now, while we get to know the fine print of what really contributed through this large surplus, when RBI publishes its annual report in the coming weeks, safe to say the big contributor will be the gains from the sale of dollars that I'll get to in just a bit. But the very important change that RBI has also brought about is the board approving a revised economic capital framework. Now, this essentially mandates that RBI keep anywhere between 6% plus minus 1.5% of its balance sheet as surplus, as contingency buffer, to protect its balance sheet, given the macroeconomic uncertainty in the environment. For FY25, importantly, the RBI has factored in ECF or the contingency risk buffer of 7.5%, which is at the higher end of the new revised ECF range. So even at 7.5%, it is able to get to this 2.68 lakh crore kind of a number. Perhaps, if the contingency buffer was lower, we would have seen a number higher than 3 lakh crores. Keep in mind, the gross dollar sales for FY25 were about close to $400 billion. Given the difference in the prices of purchase and the average price of a sale, RBI would have profited by upwards of 6 rupees for every dollar that it sold. And that itself would have got RBI gains of about 2.5 trillion rupees. And then there would have been the other factors like the interest income it earned on the foreign securities and on rupee securities. So that's where we stand as far as the number is concerned. Not as large as what the street was expecting, still a record high, with the contingency buffer being raised all the way to 7.5% for FY25.
Well, it is 25% higher than the previous year, but not as high as what the street was anticipating. Well, let's bring in reactions now. Madan Sabnavis with us, also Madhvi Arora, Chief Economist at MK Global Financial Services, and Radhika Rao, Executive Director and Senior Economist at DBS Bank. Madan, let me come to you first. 2.68 lakh crore rupees, almost 2.69 lakh crore rupees. That's the dividend that's been announced by the Reserve Bank. What was your number that you were working with? As I said, the street had factored in anywhere between 2.5 all the way to 3.5 lakh crores.
In fact, we were at the lower end. We were looking at 2.5 lakh crores. This was based mainly on the budget number and our own estimates about what kind of adjustments could have been done in terms of the buffers. So I think given the uncertain times, it's not really surprising that the board has decided to increase these buffers to 7.5%. And I think that's the major reason why we're seeing this difference between 2.5 and what the market expected, around 3 lakh crores. But I think from the budgetary point of view, I think from 2.1 moving to 2.68, 2.69, 50,000 crores more is definitely something which would be beneficial in these uncertain times. I say uncertain times, not just on account of what's happening in the world, but also from the fact that any kind of renegotiation we have on tariffs could mean custom collections could be getting affected. So here we have a buffer out here. And I think and if there's any additional expenditure which has to be incurred by the government, I think that's something also which could be absorbed very well by these things. So I think it's very good from the fiscal point of view. It's not really extravagant to the level of being 3.5 lakh crores, but it's something which adequately takes care of any kind of contingency which the government could be facing during the course of this year.
Well, that certainly is the case. But, you're talking about uncertainty and talking about possible events that could create more uncertainty. And President Trump is at it already, now threatening the EU with more tariffs come the 1st of June. So it is an uncertain environment. And certainly this does provide that much needed fiscal respite and fiscal cushion. Radhika, your first comments, what was the number that you were working with? It's now coming at close to 2.69 lakh crore rupees, a 27% increase over the previous year.
Yeah, hi, Shane. Certainly, I think we started off with 2.5 to about 3 trillion, 3 lakh crores. That's the kind of sum we were working with. Certainly, a lot of moving factors. And I think one of the biggest ones, while all of us were spending a lot of time thinking about which income, lines would actually add to the dividend buffer, I think the one unknown was what happens to the ECF, what kind of contingency buffer that they would prefer to keep. And I think that's been the biggest source of surprise. Like the other, speakers, commentators mentioned as well, I think for the times we are in, I think it's a very ideal move. Still, there is an increase vis-a-vis last year. Still, we're at a record high. Still, there is about a 25%, 30% increase. And I think in terms of how much it adds to the fiscal, revenue, there's still about 30 basis points as compared to what it was budgeted for. So I think it's overall still a positive, but market expectations were quite high. And because of that, I would think for a start, it looks like, it's a bit underwhelming. But when you see the fine print, I think it still adds positively to the revenue flow as well as potential liquidity boost.
Lakh crores of surplus transfer came from. But on that aspect that you highlighted, and Abhishek, if I could come to you, the street was factoring in upwards of 3 lakh crore, even some as high as 3.5 lakh crores. What will this number mean in terms of, what's been priced into bond yields? Where do you expect the 10-year to settle on the back of this kind of a number?
This number would have been closer to 3.5 trillion if RBI had not increased the contingency reserve buffer by 1% to 7.5%. I think market estimates consensus was a number around 3 trillion. To that extent, it is a modest undershoot. I don't think it should have significant implications from market standpoint. Therefore, in that context, fiscal deficit, any case compared to budgeted 4.4% of GDP, because the historical GDP numbers were revised, was already 4.3% of GDP. Now, this additional cushion of maybe around 0.15% of GDP allows that much more wiggle room to government to spend some extra amount on heads, including defense capex, etc., which is being rumored. So gives more confidence on the fiscal outlook, and should not have significant implications from market standpoint, given the expectations already baked in.
Yes, already baked in by the market. Abhishek, we'll just come back to you, but let me bring my colleague Sapna into the conversation as well. She's tracking the reactions coming in from the government. Sapna, this does provide that fiscal cushion to the government, as all of our guests were pointing out. Any reactions from Northlock so far?
Well, senior government officials, they have been of the view that it's a well thought out, calibrated economic capital framework that has been brought out by the Reserve Bank. And, the dividend number also basically should be read from that standpoint. It's a well-calibrated, balanced policy and dividend to the government. So I think absolutely both GOI and RBI, the RBI management and GOI are very much in sync and on board, on this 2.68 lakh crore. Let me just give some added perspective. I suppose the government estimates were around 215 to 220, somewhere around. It's still around 48 to 50,000 crores higher than that. So it's an excellent number. It also, as the guests have pointed out, leaves some little room for future, fiscal requirements, if any. And this would be what? The additionality would be around, more than 0.1% of the GDP. And I'm talking of the FY26 nominal GDP base that the government has calculated at over 257 lakh crores. It will be higher if you calculate on the FY25 revised estimates of GDP. So, more than a 0.1% buffer that's coming in, ideally it should have helped the government to bring down the fiscal deficit. But we have just heard from, top sources in the morning that the FY25 fiscal deficit is remaining unchanged. 4.8% is what they penciled in as RE, and that's where they stand. So all in all, the reactions here are, sanguine, optimistic, positive, and government appears pretty cool and happy with the number.
Well, yes, Sapna, it certainly is larger than what the government had budgeted for. But Madhvi, let me come to you quickly then. To what extent, as Sapna was saying, do you think the government will adjust its fiscal math based on this kind of a windfall? And how much additional fiscal room can this kind of a surplus create for the government?
Hi, Ritu. So as Sapna was mentioning, the government had taken somewhere close to 2.1 trillion for this year budget from RBI as a surplus. And we were expecting almost 3.2 lakh crore from the Reserve Bank to the government. The delta exactly has come in the form of a higher fiscal contingency buffer of 7.5 as against our expectation of 6.5% of the balance sheet, which is basically led to this lower dividend. But despite that, there is going to be roughly around 500 billion plus of additional buffer that the government will get from this higher dividend, which is close to around 0.1% of GDP. Now, as of now, we are not looking at government trying to even think of saving this number. Our sense is that the government fiscal math would not change dramatically owing to this. The incremental gain that they're getting from the higher RBI dividend would be largely or actually partly offset by a possibly slower tax revenue growth because they have taken a much higher tax buoyancy this year. And we're likely to be seeing a much slower tax buoyancy given the late cycle growth trajectory that we are in. At the same time, we will also be seeing a lower than expected nominal GDP this year. So any additional saving whatsoever, if any, is there because of this would be largely spent than saved. So as of now, we think the gross fiscal deficit GDP ratio would be still at 4.4% for FY26. And any kind of gains that they make out of dividend would be either offset by the slower tax revenues, or if at all they're still left with any, they would be still spending that than saving it.
Yeah, well, that is the fiscal side. But Radhika, let me come to you on the monetary aspect of this. What are the liquidity management implications of this kind of a transfer? We've already seen RBI pumping in upwards of 8.5 lakh crores into the system since December. Now, with this, how much could core liquidity increase and therefore the need for durable injections, liquidity injections in future? To what extent could that slow down?
Certainly, I think even if you had assumed about a 2.3, 2.5 lakh crore kind of addition in terms of the dividend, I think you would have seen the liquidity, surplus liquidity be closer to about 5.5 lakh crores. So I don't think that really changes much. Now with the smaller dividend infusion, we do think that the central bank will remain on course in terms of wanting to keep the surplus in place. Indicatively, they have spoken about 1% of NDTL. At this point, we are about, I would say, roughly 20-25% lower than where they would like it to be. So you could see more action coming the way. And of course, then you have the seasonal cycle always picking up, right? You have the currency leakage or the advanced tax outflows. And all of that plays out in the rest of the year. But in terms of the liquidity as well as the monetary policy, there are some expectations that if they do a lot on liquidity, they will not cut more. We do see this as two different approaches. In fact, the governor did mention that just because the stance has become dovish does not mean that that's going to be the stance on liquidity as well. To me, monetary policy and liquidity will be seen as two different, levers. And I think that kind of view is going to hold. So while they do keep liquidity in surplus, I think the reaction function in terms of cutting rates is likely to continue. In fact, the next inflation number could be even below 3%. So that's going to give ample headroom for the central bank to to remain on course to cut rates. So again, going back to your liquidity question, I think that this still adds to the core liquidity surplus. This still adds to the surplus that they would prefer to have to make sure that whatever cuts are being taken, it really passes through to the real economy.
Abhishek, to continue where Radhika left off, both as far as liquidity is concerned, as Ritu was pointing out, as well as on the rate cut cycle from here on, given also the fact that we are in a very, very uncertain global mix. I mean, we've seen what's happening as far as the US bond markets, for instance, is concerned. But, you know, back home, what do you expect, what do you anticipate on both liquidity as well as rate cuts?
In liquidity, near term, while technically the durable liquidity goes up, this liquidity will only impact the banking system when it is spent by the government. So the pace of spending matters here in terms of when this liquidity really starts bringing down the money market rates more. It is likely that government could make changes to its T-bill borrowing calendar, like has been their preference. In the past, they have preferred, in the recent past, they have preferred to use any fiscal largesse to cut short-term borrowings and to carry lesser cash rather than cut dated borrowing calendar. It is again likely that Q2 borrowing calendar will be adjusted, and that could help bring down government surplus a little more quickly than would have been the case otherwise. For monetary policy, we are thinking there is scope for 2 more rate cuts. For a terminal policy rate of 5.5%. Inflation this year is going to be very low, perhaps around 3.5% only. In that context, 5.5% may look high, but going down further would increase the risk that next year when food inflation picks up, RBI will need to change course and hike again at some point. It is best if growth concerns are manageable, which is the case if a forecast of 6.5% still holds true for RBI, and that is quite reasonable, even if we are slightly lower. A 5.5% terminal policy rate should be suitable, and next rate cut is likely in the upcoming meeting in August itself.
Mr. Madan Sabdavis, just to pick up from that, in terms of action in the next policy, if this pushes the short-term rates towards SDF 5.75%, and if there is some sort of effective easing, how do you expect that to impact RBI's decision? And also, this surplus, if you see it as a form of monetization of deficit, would it really move the needle on inflation, the 2.69 lakh crores?
This particular transfer of surplus from the RBI to the government, if we are assuming it's going to take care of all the contingencies which are there in the budget itself, to my mind, it's not going to have any impact on liquidity. It's only a case of saying that if this additional 60,000 crores is going to be spent and the budget size is going to increase by this amount, only then will the liquidity impact come in. Otherwise, it will be a status quo if we're going to assume that there's going to be a shortfall on account of customs, maybe on income tax because of slower nominal GDP growth rate. I don't think liquidity is going to get affected, which means that the RBI will have to continue to look at liquidity as a different instrument. You keep looking at OMOs and VRR based on the need base, which is what they have been doing since April and May. Now, in terms of policy, I think the RBI has a very strange situation. One thing is to say that inflation has come down. There is a market expectation that interest rates are going to be lowered. But we should keep in mind the fact that we normally see the vegetable prices going up in October, November. This is because of the changing climate pattern, where the crop tends to get affected and food inflation spikes. So we need to see how the monsoon progresses. We need to see pulses, oil seeds. I think these are the 2 pain points which are normally there. We need to see as to what happens on the tariff front. And more importantly, from a banking perspective, I think we've seen that we have already seen a 50 basis points cut in the repo rate, but the transmission to deposits has been slower because I think there's always this fear for banks that funds will move to the mutual funds. The capital market is still doing well. So the absorptive capacity of the bank is also what they have to keep in mind. So therefore, we feel that the rate cut, while definitely is on, and what Abhishek said, we also believe that 50 basis points cut during the course of the year. June could be a status quo. Observe what happens in June and July before you take a decision in August, and probably accelerate in case everything looks good in the subsequent months.
All right. Radhika, quickly, just to sort of also get back to the contingency buffer being raised all the way to 7.5%. Now, given the current macroeconomic conditions, the RBI, of course, said it was prudent to keep a larger buffer with itself. But would it be safe to say this size of a surplus will not become the new normal? The 2.1 trillion we saw last time and 2.6 trillion that we're seeing now. This is more of a one-off and not really going to be sustainable going ahead.
Yeah, certainly. I think, attention really comes back to the basic math in terms of where the income is getting generated from. I think between years, we will see that kind of, up and down, which is this time around, I think the biggest contributor would have been FX sales, foreign exchange sales, and the change or the different gap in what the dollar was sold at and what the dollar was bought at. So that would have been, I think, when the breakdown comes and the balance sheet is released, annual report is released, we will see that. So I think that would have been the biggest contributor, apart from some of the other non-interest income headings as well. But yes, I don't think one should take this as a given. The year ahead, as we are seeing on a daily basis, is a very different place. The central banks, policy makers have had to be, I'm sure, keeping their eyes on the target. A lot of things have been changing. So I don't think the government in its own math or the central bank is going to consider this as a given. But that said, again, it's a wide range. It's 4.5 to 7.5. So, there could also be years when the risks kind of settle down, and then we have the contingency. The buffer, the ratio is at 4.5%. So that could also be the case. So it just brings a whole set of possibilities. But I don't think in the math as well, end of the day, this is also kind of not, I would say, an organic revenue source, right? Revenue source, typically, we should go back to the direct, indirect taxes. That's where the tax buoyancy, that's where the growth matters to revenues. So I would think attention should really be on that. So this is, if anything, a supportive or another additional source of revenue. So I don't think complete dependency will be on this source all the while. So it's going to certainly fluctuate between years. Good years, the buffer could come down. Bad years, the buffer could go up, like we are in. I wouldn't say bad, but a rather challenging backdrop as we are in currently.
Well, it's been a significant buffer over the last few years, Radhika, and of course, it's not something that you can depend on, but it's certainly been a significant cushion that the government has enjoyed over the last few years, and it's only been going up significantly. But let me end by asking each one of you, and Abhishek, I'll start by asking you, since we are talking about risk assessment at this point in time, given both global factors as well as domestic risk factors, what are you going to be watching out for? What will be the triggers that are on your radar as possible risks that the RBI will need to factor in?
Shireen, RBI is in a reasonably good place from the perspective of managing the volatile external sector situation. Current account deficit was below 1% of GDP last fiscal. That is what we estimate, and is likely to remain so this year with commodity prices, including crude, having come down. Yes, capital flows is an issue. BOP was in deficit last year, but RBI has done reasonably well in managing the FX market, its FX market interventions. So RBI should be able to frame policy based on domestic growth and inflation considerations. And on that basis, the task is not really that tough right now. Of course, global conditions can worsen more and downside risk to growth could increase. We have to monitor that. But right now, RBI is in a reasonably good place to respond with a clear, stable policy from monetary policy perspective.
Madan?
So in fact, I think given the way in which there is this uncertainty, especially on the global front, I think the major concern for RBI is that if at all we're going to see growth slowing down in the economy, there's definitely going to be some kind of an impact which is going to happen on exports. Exports being largely in the SME sector, I think the possibility of stress building up in the loans given to this particular sector is something which they would be keen to monitor, because I think that seems to be the major risk for the banking system when it comes to this uncertainty which we're seeing across the world.
Radhika?
I think for the central bank, I think in addition to what the other panelists mentioned as well, I would say the currency has become a lot more, it's allowed to take in the kind of cushion, pressure. So if the dollar, for example, weakens, the rupee strengthens, and which was very different from the past 5-6 years when the currency was kind of moving in the same direction or volatility was very low. So that kind of allows the currency to take in some amount of pressure and adjust. So I think that is something that the central bank would keep a very close eye on. And the other one is certainly the growth impulse. I think there has been a large realignment with what the street expected in terms of growth. I think the central bank has also come closer to that. Official forecasts have come closer to that. I think they would watch that very closely because end of the day, not only the external sector, which is trade, but also private sector capex cycles do draw attention from what local demand is doing and what global demand is doing. So there is a fair amount of linkage with how the external environment is. So I think this is where the central bank's attention would be. And having a low inflationary backdrop certainly a big plus at this point because it gives them a lot more flexibility in terms of what they want to do to support growth.
Oh, that it certainly does. And we have seen that inflation print providing comfort to both the Reserve Bank as well as the government. Madhvi, I'll give you the last word on this.
While I think for me, as of now, the only risk RBI is sort of watching is the fluidity of the global markets, because the way global markets have sort of been very patchy over the past 1.5-2 years. I think wherever we've seen RBI really tilting its monetary reaction function has only been because of the global dynamics and less because of the domestic dynamics. So my sense is that currently we are very comfortable in the global dynamics, domestic dynamics. We are seeing pretty comfortable inflation scenario. We are comfortable with regard to current account deficits and the fiscal deficit as well. The only risk as of now is that of growth, for which RBI has already is in an easing mode. Plus, they are also ensuring that liquidity is adequate. So I think to that extent, they're pretty sorted as far as domestic dynamics are concerned. It's the global bit which is going to worry them. And I think they'll be very, very watchful of that, because global dynamics can get really nasty if uncertainty really drags.
Well, since you are talking about global uncertainty, a quick word from each one of you on the latest edition on the tariff wars. President Trump tweeting away. 2 specific tweets coming in this morning, bright and early from President Trump. 1, threatening to impose 50% tariffs on the EU, and 2, saying that he's told Tim Cook in no uncertain terms that if you want to sell iPhones in the US, then they better be made in the US, not in India or anywhere else, or there will be a 25% tariff. Abhishek, let me start by asking you, I mean, this tariff war, one was hoping that there were signs of it abating, but doesn't seem to be the case any longer.
Well, financial markets have been treating, some calm, which had come after reversal of the earlier, very high tariffs very positively. But this was always going to be tested because still it is not clear what the exact approach is going to be and what the final target is in terms of administration's requirements. So what we are seeing is volatility is going to stay quite high. These higher tariffs on EU could again mean dollar actually had been bouncing back a little bit after earlier weakening. It is possible it can start to weaken again. In such environments, typically emerging market currencies also tend to be weaker. But given simultaneous speculation that currency levels are also part of negotiations, there is confusion. Broadly, global financial conditions are going to stay quite volatile till there is clarity on U.S. trade policy, and we have to live with that. Our RBI India is in a still better place compared to many other countries, and that is a relief.
Yes, we do find ourselves relatively better positioned, but who knows? But Mother Sabnavis, what is all of this likely to mean now, both in terms of FDI as well as FPI flows, given this very volatile mix?
No, I think definitely FDI across flows to across the emerging markets is something which is going to get affected. And I think India, we were relying a lot on FDI in terms of financing our capital formation. So it was an important source of finance. So what we're seeing here is that FDI definitely is going to slow down across the world, and even India will get affected since America is one of the major suppliers of funds. And the second, I think, is that overall global growth is something which is going to get retarded. So I think these kind of announcements actually sort of makes us lose a bit of confidence in the global growth story. So it's one thing to say that India is isolated because we're a domestic-oriented economy, maybe not directly affected. But I think through the currency, through the investment route, there are going to be implications also for India. But on the whole, global growth slows down, FDI flows slow down.
Madhavi?
Yeah, I think I agree with both of them that one, that global risk sentiments are going to be pretty patchy and could be even sour, which also implies that to some extent the emerging markets will have to continue offering a much higher risk premium. As of now, there's been massive resilience that emerging market assets, including that of India, have shown, which is also visible by the fact that our emerging market currencies have not only risen since January, but also the emerging market bonds are actually easing, despite the fact that developed market are actually seeing a much higher bond yields over the last 4-5 months, which is led by Germany, and for that matter, US also is now seeing a very sticky term premium and very high yield premium as well. But emerging markets to that extent have sort of been much better placed, and have been able to also enjoy some degree of freedom as far as their own policy making is concerned. But if it continues to become a very patchy story in the globe because of US war on trade and US trying to actually disturb the global trade dynamics, there would be definitely some disturbance in terms of supply chain management across the world, and there will be a cost to the world that will be borne by emerging market disproportionately. I hope that is not the case this time around, but we'll have to be pretty watchful for that, and that is exactly what RBI probably would have also thought while they built up a much higher risk buffer this time around when they had extra profit in hand. So whenever they're making profits, they're actually ensuring that the profit is actually kept as a buffer instead of being fully spent. So I think that's pretty wise on their part. But I think while we've seen relative global calm in the recent months or so, we are still in for a pretty volatile world, and the global cycles are going to be very difficult to really predict if that continues.
Yes, we continue to be in choppy waters globally, and that is perhaps what the RBI has factored in as it has enhanced its risk buffers and also delivered a dividend higher by about 27% year on year to the government, providing that much needed fiscal respite and fiscal cushion. Radhika Rao, Madhavi Arora, Madan Sabnavis and Abhishek Upadhyay, always a pleasure. Appreciate you joining us on CNBC TV18 to decode the RBI's math as well as the implications of the enhancement of risk buffers. We will take a break here, but there's a lot more coming up. Don't go anywhere. We're back in a moment with more.
week back.
Well, this is what we've been waiting for. The Reserve Bank of India has announced its dividend to the government, and it is not as high as what the street was expecting. Remember, the forecast went all the way from 2.5 to 3.5 lakh crore rupees. What it's coming at is a little over 2.68 lakh crore rupees. Let me go across to Ritu. This is just one of the announcements that's come in from the Reserve Bank. There is also a revised economic capital framework that has been approved by the Central Board of the Reserve Bank. But Ritu, let's start with that. The surplus number, the dividend number, as we were saying, the street was forecasting anywhere between 2.5 to 3.5 lakh crore rupees, and it's come in at over 2.68 lakh crores.
That's right. The street was factoring anywhere between 2.5 to 3 lakh crores of surplus transfer. It has come in at 2.68 lakh crores. You know, I believe the street, at least the economists, may be slightly surprised because the wider consensus was for the number to be upwards of 3 lakh crores, especially given the large gains that the Reserve Bank of India would have made in FY25 on dollar sales. But that said, this is still far higher than last year's dividend transfer. That was at 2.1 lakh crores, and this is a new record high. It is also higher than the 2.6 lakh crores that the government had budgeted for the collective dividend from public banks, financial institutions and RBI put together Of course, our own poll had suggested 3 lakh crores. Now, while we get to know the fine print of what really contributed through this large surplus when RBI publishes its annual report in the coming weeks, safe to say the big contributor will be the gains from the sale of dollars that I'll get to in just a bit. But the very important change that RBI has also brought about is the board approving a revised economic capital framework. Now, this essentially mandates that RBI keep anywhere between 6% plus minus 1.5% of its balance sheet as surplus, as contingency buffer, to protect its balance sheet, given the macroeconomic uncertainty in the environment. For FY25, importantly, the RBI has factored in ECF or the contingency risk buffer of 7.5%, which is at the higher end of the new revised ECF range. So even at 7.5%, it is able to get to this 2.68 lakh crore kind of a number. Perhaps, if the contingency buffer was lower, we would have seen a number higher than 3 lakh crores. Keep in mind the gross dollar sales for FY25 were about close to $400 billion. Given the difference in the prices of purchase and the average price of a sale, RBI would have profited by upwards of 6 rupees for every dollar that it sold. And that itself would have got RBI gains of about 2.5 trillion rupees. And then there would have been the other factors like the interest income it earned on the foreign securities and on rupee securities. So that's where we stand as far as the number is concerned. Not as large as what the street was expecting, still a record high, with the contingency buffer being raised all the way to 7.5% for FY25.
Well, it is 25% higher than the previous year, but not as high as what the street was anticipating. Well, let's bring in reactions now. Madan Sabnavis with us, also Madhvi Arora, Chief Economist at MK Global Financial Services, and Radhika Rao, Executive Director and Senior Economist at DBS Bank. Madan, let me come to you first. 2.68 lakh crore rupees, almost 2.69 lakh crore rupees. That's the dividend that's been announced by the Reserve Bank. What was your number that you were working with? As I said, the street had factored in anywhere between 2.5 all the way to 3.5 lakh crores.
In fact, we were at the lower end. We were looking at 2.5 lakh crores. This was based mainly on the budget number and our own estimates about what kind of adjustments could have been done in terms of the buffers. So I think given the uncertain times, it's not really surprising that the board has decided to increase these buffers to 7.5%. And I think that's the major reason why we're seeing this difference between 2.5 and what the market expected, around 3 lakh crores. But I think from a budgetary point of view, I think from 2.1 moving to 2.68, 2.69 is 50,000 crores more, is definitely something which would be beneficial in these uncertain times. I say uncertain times, not just on account of what's happening in the world, but also from the fact that any kind of renegotiation we have on tariffs could mean custom collections could be getting affected. So here we have a buffer out here. And I think and if there's any additional expenditure which has to be incurred by the government, I think that's something also which could be absorbed very well by these things. So I think it's very good from the fiscal point of view. It's not really extravagant to the level of being 3.5 lakh crores, but it's something which adequately takes care of any kind of contingency which the government could be facing during the course of this year.
Well, that certainly is the case. But, you're talking about uncertainty and talking about possible events that could create more uncertainty. And President Trump is at it already, now threatening the EU with more tariffs come the 1st of June. So it is an uncertain environment. And certainly this does provide that much needed fiscal respite and fiscal cushion. Radhika, your first comments, what was the number that you were working with? It's now come in at close to 2.69 lakh crore rupees, a 27% increase over the previous year.
Yeah, hi, Shane. Certainly, I think we started off with 2.5 to about 3 trillion, 3 lakh crores. That's the kind of sum we were working with. Certainly a lot of moving factors. And I think one of the biggest ones, while all of us were spending a lot of time thinking about which income, lines would actually add to the dividend buffer, I think the one unknown was what happens to the ECF, what kind of contingency buffer that they would prefer to keep. And I think that's been the biggest source of surprise. Like the other, speakers, commentators mentioned as well, I think for the times we are in, I think it's a very ideal move. Still, there is an increase vis-a-vis last year. Still, we're at a record high. Still, there is about a 25%, 30% increase. And I think in terms of how much it adds to the fiscal, revenue, there's still about 30 basis points as compared to what it was budgeted for. So I think it's overall still a positive, but market expectations were quite high. And because of that, I would think for a start, it looks like, it's a bit underwhelming. But when you see in the fine print, I think it still adds to positively to the revenue flow as well as potential liquidity boost.
On that aspect that you highlighted, and Abhishek, if I could come to you, the street was factoring in upwards of 3 lakh crore, even some as high as 3.5 lakh crores. What will this number mean in terms of, what's been priced into bond yields? Where do you expect the 10-year to settle on the back of this kind of a number?
This number would have been closer to 3.5 trillion if RBI had not increased the contingency reserve buffer by 1% to 7.5%. I think market estimates consensus was a number around 3 trillion. To that extent, it is a modest undershoot. I don't think it should have significant implications from market standpoint, therefore, in that context. Fiscal deficit, any case, compared to budgeted 4.4% of GDP, because the historical GDP numbers were revised, was already 4.3% of GDP. Now this additional cushion of maybe around 0.15% of GDP allows that much more wiggle room to government to spend some extra amount on heads, including defense capex, etc., which is being rumored. So gives more confidence on the fiscal outlook and should not have significant implications from market standpoint, given the expectations already baked in.
Yes, already baked in by the market. Abhishek, we'll just come back to you, but let me bring my colleague Sapna into the conversation as well. She's tracking the reactions coming in from the government. Sapna, this does provide that fiscal cushion to the government, as all of our guests were pointing out. Any reactions from North Block so far?
Well, senior government officials, they have been of the view that it's a well thought out, calibrated economic capital framework that has been brought out by the Reserve Bank. And, the dividend number also basically should be read from that standpoint. It's a well-calibrated, balanced policy and dividend to the government. So I think absolutely both GOI and RBI, the RBI management and GOI are very much in sync and on board, on this 2.68 lakh crore. Let me just give some added perspective. I suppose the government estimates were around 215 to 220, somewhere around. It's still around 48 to 50,000 crores higher than that. So it's an excellent number. It also, as the guests have pointed out, leaves some little room for future, fiscal requirements, if any. And this would be what? The additionality would be around, more than 0.1% of the GDP. And I'm talking of the FY26 nominal GDP base that the government has calculated at over 257 lakh crores. It will be higher if you calculate on the FY25 revised estimates of GDP. So, more than a 0.1% buffer that's coming in, ideally it should have helped the government to bring down the fiscal deficit. But we have just heard from, top sources in the morning that the FY25 fiscal deficit is remaining unchanged. 4.8% is what they penciled in as RE, and that's where they stand. So all in all, the reactions here are, sanguine, optimistic, positive, and government appears pretty cool and happy with the number.
Well, yes, Sapna, it certainly is larger than what the government had budgeted for. But Madhvi, let me come to you quickly then. To what extent, as Sapna was saying, do you think the government will adjust its fiscal math based on this kind of a windfall? And how much additional fiscal room can this kind of a surplus create for the government?
Hi, Ritu. So as Sapna was mentioning, the government had taken somewhere close to 2.1 trillion for this year budget from RBI as a surplus. And we were expecting almost 3.2 lakh crore from the Reserve Bank to the government. The delta exactly has come in the form of a higher fiscal contingency buffer of 7.5 as against our expectation of 6.5% of the balance sheet, which is basically led to this lower dividend. But despite that, there is going to be roughly around 500 billion plus of additional buffer that the government will get from this higher dividend, which is close to around 0.1% of GDP. Now, as of now, we are not looking at government trying to even think of saving this number. Our sense is that the government fiscal math would not change dramatically owing to this. The incremental gain that they're getting from the higher RBI dividend, which will be largely or actually partly offset by a possibly slower tax revenue growth because they have taken a much higher tax buoyancy this year. And we're likely to be seeing a much slower tax buoyancy given the late cycle growth trajectory that we are in. At the same time, we will also be seeing a lower than expected nominal GDP this year. So any additional saving whatsoever, if any, is there because of this would be largely spent than saved. So as of now, we think the gross fiscal deficit GDP ratio would be still at 4.4% for FY26. And any kind of gains that they make out of dividend would be either offset by the slower tax revenues, or if at all they're still left with any, they would be still spending that than saving it.
Yeah, well, that is the fiscal side. But Radhika, let me come to you on the monetary aspect of this. What are the liquidity management implications of this kind of a transfer? We've already seen RBI pumping in upwards of 8.5 lakh crores into the system since December. Now, with this, how much could core liquidity increase, and therefore the need for durable injections, liquidity injections in future? To what extent could that slow down?
Certainly, I think even if you had assumed about a 2.3, 2.5 lakh crore kind of addition in terms of the dividend, I think you would have seen the liquidity, surplus liquidity be closer to about 5.5 lakh crores. So I don't think that really changes much. Now with the smaller dividend infusion, we do think that the central bank will remain on course in terms of wanting to keep the surplus in place. Indicatively, they have spoken about 1% of NDTL. At this point, we are about, I would say, roughly 20-25% lower than where they would like it to be. So you could see more action coming away. And of course, then you have the seasonal cycle always picking up, right? You have the currency leakage or the advanced tax outflows. And all of that plays out in the rest of the year. But in terms of the liquidity as well as the monetary policy, there are some expectations that if they do a lot on liquidity, they will not cut more. We do see this as two different approaches. In fact, the governor did mention that just because the stance has become dovish does not mean that that's going to be the stance on liquidity as well. To me, monetary policy and liquidity will be seen as two different, levers. And I think that kind of view is going to hold. So while they do keep liquidity in surplus, I think the reaction function in terms of cutting rates is likely to continue. In fact, the next inflation number could be even below 3%. So that's going to give ample headroom for the central bank to remain on course to cut rates. So again, going back to your liquidity question, I think that this still adds to the core liquidity surplus. This still adds to the surplus that they would prefer to have to make sure that whatever cuts are being taken, it really passes through to the real economy.
Abhishek, to continue where Radhika left off, both as far as liquidity is concerned, as Ritu was pointing out, as well as on the rate cut cycle from here on, given also the fact that we are in a very, very uncertain global mix. I mean, we've seen what's happening as far as the US bond markets, for instance, is concerned. But, you know, back home, what do you expect, what do you anticipate on both liquidity as well as rate cuts?
In liquidity, near term, while technically the durable liquidity goes up, this liquidity will only impact the banking system when it is spent by the government. So the pace of spending matters here in terms of when this liquidity really starts bringing down the money market rates more. It is likely that government could make changes to its T-bill borrowing calendar, like has been their preference. In the past, they have preferred, in the recent past, they have preferred to use any fiscal largesse to cut short-term borrowings and to carry lesser cash rather than cut dated borrowing calendar. It is again likely that Q2 borrowing calendar will be adjusted, and that could help bring down government surplus a little more quickly than would have been the case otherwise. For monetary policy, we are thinking there is scope for 2 more rate cuts. For a terminal policy rate of 5.5%. Inflation this year is going to be very low, perhaps around 3.5% only. In that context, 5.5% may look high, but going down further would increase the risk that next year when food inflation picks up, RBI will need to change course and hike again at some point. It is best if growth concerns are manageable, which is the case if a forecast of 6.5% still holds true for RBI, and that is quite reasonable, even if we are slightly lower. A 5.5% terminal policy rate should be suitable, and next rate cut is likely in the upcoming meeting in August itself.
Mr. Madan Sabdavis, just to pick up from that, in terms of action in the next policy, if this pushes the short-term rates towards SDF 5.75%, and if there is some sort of effective easing, how do you expect that to impact RBI's decision? And also, this surplus, if you see it as a form of monetization of deficit, would it really move the needle on inflation, the 2.69 lakh crores?
This particular transfer of surplus from the RBI to the government, if we are assuming it's going to take care of all the contingencies which are there in the budget itself, to my mind, it's not going to have any impact on liquidity. It's only a case of saying that if this additional 60,000 crores is going to be spent and the budget size is going to increase by this amount, only then will the liquidity impact come in. Otherwise, it will be a status quo if we're going to assume that there's going to be a shortfall on account of customs, maybe on income tax because of slower nominal GDP growth rate. I don't think liquidity is going to get affected, which means that the RBI will have to continue to look at liquidity as a different instrument. You keep looking at OMOs and VRR based on the need base, which is what they have been doing since April and May. Now, in terms of policy, I think the RBI has a very strange situation. One thing is to say that inflation has come down. There is a market expectation that interest rates are going to be lowered. But we should keep in mind the fact that we normally see the vegetable prices going up in October, November. This is because of the changing climate pattern, where the crop tends to get affected and food inflation spikes. So we need to see how the monsoon progresses. We need to see pulses, oil seeds. I think these are the 2 pain points which are normally there. We need to see as to what happens on the tariff front. And more importantly, from a banking perspective, I think we've seen that we have already seen a 50 basis points cut in the repo rate, but the transmission to deposits has been slower because I think there's always this fear for banks that funds will move to the mutual funds. The capital market is still doing well. So the absorptive capacity of the bank is also what they have to keep in mind. So therefore, we feel that the rate cut, while definitely is on, and what Abhishek said, we also believe that 50 basis points cut during the course of the year. June could be a status quo. Observe what happens in June and July before you take a decision in August, and probably accelerate in case everything looks good in the subsequent months.
All right. Radhika, quickly, just to sort of also get back to the contingency buffer being raised all the way to 7.5%. Now, given the current macroeconomic conditions, the RBI, of course, said it was prudent to keep a larger buffer with itself. But would it be safe to say this size of a surplus will not become the new normal? The 2.1 trillion we saw last time and 2.6 trillion that we're seeing now. This is more of a one-off and not really going to be sustainable going ahead.
Yeah, certainly. I think, attention really comes back to the basic math in terms of where the income is getting generated from. I think between years, we will see that kind of, up and down, which is this time around, I think the biggest contributor would have been FX sales, foreign exchange sales, and the change or the different gap in, what the dollar was sold at and what the dollar was bought at. So that would have been, I think, when the breakdown comes and the balance sheet is released, annual report is released, we will see that. So I think that would have been the biggest contributor, apart from some of the other non-interest income headings as well. But yes, I don't think one should take this as a given. The year ahead, as we are seeing on a daily basis, is a very different place. The central banks, policy makers have had to be, I'm sure, keeping their eyes on the target. A lot of things have been changing. So I don't think the government in its own math or the central bank is going to consider this as a given. But that said, again, it's a wide range. It's 4.5 to 7.5. So, there could also be years when the risks kind of settle down, and then we have the contingency, the buffer, the ratio is at a 4.5%. So that could also be the case. So it just brings a whole set of possibilities. But I don't think in the math as well, end of the day, this is also kind of not, I would say, an organic revenue source, right? Revenue source, typically, we should go back to the direct, indirect taxes. That's where the tax buoyancy, that's where the growth matters to revenues. So I would think attention should really be on that. So this is, if anything, a supportive or another additional source of revenue. So I don't think complete dependency will be on this source all the while. So it's going to certainly fluctuate between years. Good years, the buffer could come down. Bad years, the buffer could go up, like we are in. I wouldn't say bad, but a rather challenging backdrop as we are in currently.
Well, it's been a significant buffer over the last few years, Radhika, and of course, it's not something that you can depend on, but it's certainly been a significant cushion that the government has enjoyed over the last few years, and it's only been going up significantly. But let me end by asking each one of you, and Abhishek, I'll start by asking you, since we are talking about risk assessment at this point in time, given both global factors as well as domestic risk factors, what are you going to be watching out for? What will be the triggers that are on your radar as possible risks that the RBI will need to factor in?
Shireen, RBI is in a reasonably good place from the perspective of managing the volatile external sector situation. Current account deficit was below 1% of GDP last fiscal. That is what we estimate, and is likely to remain so this year with commodity prices, including crude, having come down. Yes, capital flows is an issue. BOP was in deficit last year, but RBI has done reasonably well in managing the FX market, its FX market interventions. So RBI should be able to frame policy based on domestic growth and inflation considerations. And on that basis, the task is not really that tough right now. Of course, global conditions can worsen more and downside risk to growth could increase. We have to monitor that. But right now, RBI is in a reasonably good place to respond with a clear, stable policy from monetary policy perspective.
Madan?
So in fact, I think given the way in which there is this uncertainty, especially on the global front, I think the major concern for RBI is that if at all we're going to see growth slowing down in the economy, there's definitely going to be some kind of an impact which is going to happen on exports. Exports being largely in the SME sector, I think the possibility of stress building up in the loans given to this particular sector is something which they would be keen to monitor, because I think that seems to be the major risk for the banking system when it comes to this uncertainty which we're seeing across the world.
Radhika?
I think for the central bank, and I think in addition to what the other panelists mentioned as well, I would say the currency has become a lot more, it's allowed to take in the kind of cushion pressure. So if the dollar, for example, weakens, the rupee strengthens, and which was very different from the past 5-6 years when the currency was kind of moving in the same direction or volatility was very low. So that kind of allows the currency to take in some amount of pressure and adjust. So I think that is something that the central bank would keep a very close eye on. And the other one is certainly the growth impulse. I think there has been a large realignment with what the street expected in terms of growth. I think the central bank has also come closer to that. Official forecasts have come closer to that. I think they would watch that very closely because end of the day, not only the external sector, which is trade, but also private sector capex cycles do draw attention from what local demand is doing and what global demand is doing. So there is a fair amount of linkage with how the external environment is. So I think this is where the central bank's attention would be. And having a low inflationary backdrop is certainly a big plus at this point because it gives them a lot more flexibility in terms of what they want to do to support growth.
Oh, that it certainly does. And we have seen that inflation print providing comfort to both the Reserve Bank as well as the government. Madhvi, I'll give you the last word on this.
While I think for me, as of now, the only risk RBI is sort of watching is the fluidity of the global markets, because the way global markets have sort of been very patchy over the past 1.5-2 years. I think wherever we've seen RBI really tilting its monetary reaction function has only been because of the global dynamics and less because of the domestic dynamics. So my sense is that currently we are very comfortable in the global dynamics, domestic dynamics. We are seeing pretty comfortable inflation scenario. We are comfortable with regard to current account deficits and the fiscal deficit as well. The only risk as of now is that of growth, for which RBI has already is in an easing mode. Plus, they are also ensuring that liquidity is adequate. So I think to that extent, they're pretty sorted as far as domestic dynamics are concerned. It's the global bit which is going to worry them. And I think they'll be very, very watchful of that, because global dynamics can get really nasty if uncertainty really drags.
Radhika Rao, Madhvi Arora, Madan Sabnavis and Abhishek Upadhyay. Always a pleasure. Appreciate you joining us on CNBC TV18 to decode the RBI's math as well as the implications of the enhancement of risk buffers. We will take a break here, but there's a lot more coming up. Don't go anywhere. We're back in a moment with more.
India version here, Bharat version.
Hello and a very warm welcome to this special conversation. Now, he led one of Latin America's most valuable tech startups, and now he's running one of the world's biggest tech investors, who also happens to be one of the most active investors when we talk about the Indian startup ecosystem. I'm talking about Fabrizio Bloisi, the CEO of Prosus and Naspers, who is betting billions on the Indian startup ecosystem, on AI, on digital disruption, and he joins us today in this special conversation to reveal his investment playbook. Fabrizio, thanks very much for your time here on CNBC TV18. And, you know, it's been a big year for Prosus this past year, whether it's your acquisition of Just Eat Takeaway back in Amsterdam or the mega IPO of Swiggy here. Tell us how the coming year is shaping up. What are you most excited about?
We are just getting started. So it was a good year, and it's going to be much better ahead. As you know, I'm here as CEO as just 10 months. We made many exciting transformations in Prosus. One of them is to focus much more in the innovation. We are really building the future through AI and putting AI in all our 2 billion customers.
Yeah.
We are focusing in a few ecosystems in a few regions. One of them is Latin America, where we did the acquisition of Decolar. In Europe, where we did the acquisition of Just Eat Takeaway.
Yeah.
And in India, where these are the 3 big focus. In India, we did the IPO of Swiggy, but this is just the start. We are ready to keep investing and committing much more to India.
Okay.
So good year, but the next year, much better. That's the plan.
What will better translate to? Because you've got, from your last disclosed numbers, $8.6 billion invested here across 30 to 35 startups. How much more are you looking to invest?
A few billions at least.
Could you quantify how many billions could come into India, say, in the next 3 to 4 years?
I don't have a precise number for India.
Yeah.
We have in total $18, $19 billion in cash in Prosus.
Yeah.
Our intention is to invest, to grow. And I think India is one of the 3 big priorities. So we will invest, for sure, a few billions here.
A few billions here, but your style of investment, you know, when Prosus first started investing here, it was growth stage. Then in the last few years, we've seen early stage investments come up as well. Are you looking at, you know, perhaps more larger deals, buyouts? Is that something you see an opportunity in the India market?
I think something that Prosus has is flexibility. And our strategy is to empower the local demands and the local entrepreneurs. So I think there is so many very good tech companies in the US, but we don't have the flexibility to invest as the US market have in India, nor in Europe, nor in Latin America. Prosus has a lot of flexibility.
Yeah.
So we are going to keep our early stage and growth stage deals, but for sure we are also going for full acquisitions or even consolidations.
And what sectors would you be most keenly looking at in the India market?
We announced now that what we really believe is running an ecosystem. What means we are not just capital, we are not just investing money and wait to see if the company works. We are trying to share what we know, what we execute well all around the world, how we can share technology, innovation, culture, and management model. So we look for companies that we can help to grow faster, or they can help we grow faster outside India. The most important areas are food delivery and payment. These are the foundations. Here we have Swiggy and PayU and a few other payment business and fintech business.
Yeah.
And also e-commerce and experiences.
Yeah.
So for example, in experience, we have Rapido and Urban Company, but we will have more, probably we'll keep investing around that.
You know, food delivery is a space you're very, very keenly, you know, invested in. You've done that in the past.
I like the segment.
Yeah, you clearly like the segment. But, you know, it's a tough segment, especially in India. Quick commerce hasn't really worked outside. But here we have Swiggy that's gone public, still reporting losses, though, with intense competition. Do you expect to see some consolidation take place in this space?
I don't know if it's going to be a consolidation, but for sure, this kind of new segments, they live in cycles. So we have moments of big investments, very high growth, and companies lose money. And the business mature and become business that grow a little less, and they make money. So if you look to the food delivery business of Swiggy, it's doing quite well. We are growing well. We are growing more than the expectations that people had. So like we are doing well. And the company is profitable and is increasing profitability. Sorry, the food delivery part.
Yeah.
The quick commerce is a younger business.
High cash burn too.
Yes, I know about that. I think India specifically, it's interesting, it's different from the rest of the world. The rest of the world is investing, it's more controlled in the quick commerce investment. India is investing not only Swiggy, but everyone much more.
Yeah.
My point is this is a cycle. There will be a moment after this moment of high excitement that the cash burn are going to reduce. And I think we are prepared to, I think we are executing well. We are prepared to invest when it's time to invest, but there will be time to profit from this new business too.
So for the time being, do you intend to continue holding on to that 20+% stake that you have in Swiggy even after the IPO?
Yes, we are not in a mood of selling. We are in a mood of keeping investing in India.
Okay.
So our intention is to keep investing and invest more, generally in India.
But no plans to, sell some of your stake from Swiggy yet?
No.
No plans. But what do you make of, another one of your portfolio companies, Rapido? Now, there's been reports of them entering the food delivery business, putting them in direct competition with someone like Swiggy. How do you see the optics of that playing out?
I think these are rumors for now, so I'm not commenting the rumors from Rapido. But I think our position is to help our company and create a healthy ecosystem. I think Rapido and Misho, they are very interesting because they are talking about the next 200-300 million customers in India. Yeah. I like very much talking about that because many times the global technology companies, they try to innovate in Silicon Valley and replicate all around the world. We have both in Rapido and Misho a different approach. We are creating for India with a different cost structure, cheaper to serve much more customers. This is amazing. I think this is the kind of innovation we should celebrate and export to the whole world. Hope Process can help with that.
Yeah.
So we are happy to keep supporting Rapido and Misho.
Yeah.
And sometimes they are going to try to keep innovating. Look, you talk about food delivery. I don't know if you know that. I was the CEO of iFood and Movili.
Yes.
So one thing I can tell you, so I'm a CEO of a bigger company now, that is Prosus.
Much bigger.
Much bigger and growing and much bigger in the future. But what I like more in the change we are doing in Prosus is the mindset of a tech company. We are a tech company, we're not like an investor. People said, here you are an investor, we are a tech company.
Yeah.
And we embrace uncertainty, change and innovation. So when I'm running iFood, it's normal to say I'm going to test 10 new verticals and see what works, what not works, and learn through doing new things.
Yeah.
So I think all our companies have to experiment new segments, try new things. So we are confident that they are going to keep experimenting.
Since you brought up Misho and Rapido and all of these companies, could you build on the momentum that you've seen with the Swiggy IPO? Are you expecting a whole lot more companies from your portfolio to go public in the next year or so?
Yeah, I said a few months ago, we expect around 5 companies, it was more or less during the Swiggy IPO, to be public over the next 1 year to 1.5 years.
Would those be Misho, Bluestone, PayU, Urban Company? Which 5 companies are you referring to?
I see you see all the rumors. I should not say the names of the companies, but you see
because
some of them.
These still have to reverse flip before they can even start to file their papers for a public offering.
I heard about that too, but I see you are very well informed. I should not be commenting specifically on the company's IPO. I think these companies you just said, they are maturing, and it's possible. Many people expect them to be public.
Okay.
And we have 35 companies in India. Having 5 IPO, it's not like this is the potential. This is the short-term potential. I think we will have more public companies from Prosus portfolio just after the next 10, 12 months, the next 12, 18 months.
Well,
so my point is we are really confident that we have so many nice companies. We have many IPOs ahead. But I don't see IPOs as the end. Like, we are IPOing so we can sell. No, we are trying to build a $50 billion business here in India. There is so much more to do. We have to invest much more. We have to enable consolidation in terms of ecosystem consolidation, how some of our companies can help the others. That's what I think we bring to the table.
So from 8.6, you want to get to a $50 billion business in India? Is that what you're saying?
We have just started.
Well, let's talk about one of your other companies, PayU, for instance. How do you see them positioned in the fintech space, which is quite competitive in India?
Yes, but PayU, I think, is the biggest one now. They enable e-commerce quite well. So, and they are important player in e-commerce, and e-commerce is not like, this is the size of e-commerce in India. It's going to grow 10 times.
Okay.
It's just starting. So I think PayU has a lot of growth ahead. We are doing well in credit also inside PayU. And just a quick story to inspire you. We invested in China 25 years ago.
Tencent?
Yes.
Yeah.
And for many years, people said, why don't you sell Tencent? They are valuing like 10, 20, $50 billion. People said, I was not there, but people made this question, like Tencent now is public, $10 billion, sell. And we haven't sold, and now Tencent is a $600 billion company. We are in India. India can be as exciting or better than China. We have so much ahead. We are just getting started. We have space to build $10 billion companies here. That's the obvious, but $50 billion, $100 billion here. I'm not in process now trying to say how I monetize that and sell. We're trying to think how we help to create the first $50 to $100 billion business here.
So do you see potential in any of your portfolio companies in India to be the next Tencent for Prosus from this country?
Many of them.
Which ones?
All of the ones that you just described, they are going to be jealous if I say just a few of them. But you listed a few of the biggest ones. I think Swiggy is very important because the frequency, and we are growing, innovating, and going to adjacencies. We have a foundation on payment that is super important. I think Meesho and Rapido, they are disruptive because of the price points, and they have hundreds of millions of customers. The way I see it, it's more than which one. I see it more as an ecosystem. If we can take the most of that, I'll tell you a story about Latin America, and it explains a little how I see the future.
Okay.
iFood has a loyalty program called Club, where we offer not only food delivery, but also pharmacy and pet shop and grocery. And now we are offering online travel agency to the new company and events. So we can create tools as Amazon created Prime that serve much better the customer, that offer them better services, cheaper, so they can consume more. That's what we can offer here. We can try to build a bigger ecosystem, and I think all of that together will be $50 billion or more.
All right, but you know, it's been a bit of a mixed bag for you in India. I mean, you have the stories of Swiggy and Meesho on one hand, but then you also have Byju's, a huge write-off for Prosus, and Farmeezy, you know, in a bit of a financial soup right now. How are you evaluating this risk versus growth strategy when you look at tech investments in India?
If we didn't have these scars, we wouldn't be taking enough risk. So that's part of life. We want to build $50 billion, therefore we will take risks, we will make bets. From those bets, some of them are going to create amazing long-term relationships. And if what we just described, we have like 10 stories of founders that we have great relationship, that we help them a lot, they help us, and we are building big things together. And some of them failed, and it's part of life, no problem. Now, we lost some money, yes, but we made much more money than we lost.
Yeah.
And look, if we're talking about building the future and creating the future, if you're not willing to make mistakes while you do that, you are not positioned well, or you're not prepared to really create the future. But just a correction, Farmeezy got some difficult moments, but it's also doing much, much better now. It's doing well.
Yeah.
And we lost money in Byju a lot. But look, the thesis was education through technology. I love this thesis. The education through technology, the kind of thing that technology can contribute the world to be better and India to be better.
Sure.
I talked a lot about AI here. We do AI a lot in our business. But look the impact AI can have, for example, in education, specifically in India, where we have to enable 1 billion people to have more access to excellent education. Or in healthcare, where AI can have good quality healthcare to billion people at a very low cost.
Sure.
So we have the obligation as a global big tech company to take risks in areas that has a profound impact.
No doubt.
And sometimes we lose money.
But, you know, wouldn't Eruditus be the only company in your portfolio in the edtech space that is profitable at the moment? You're still bullish on the sector?
The only in the portfolio that's profitable, I don't know.
In the edtech space?
15 companies in edtech. I don't know if it's the only, but Eruditus is doing good. So we are happy with Eruditus. If it's the only, I don't know. Maybe we have a few others.
Okay.
If I'm bullish in the sector, the priority sectors is what I told you, food, payments, and around e-commerce.
Yeah.
I like the idea of education, and I think during this transformation with AI, the opportunity is there. But we made a few mistakes. Many people made 2-3 years ago. I think we were during the pandemic, and we said education is going to be disrupted right now.
Okay.
I think the promise of EdTech from 2-3 years ago were not delivered. So, okay, let's keep trying.
There's lots more we want to talk about, but we have to take a very short break. Don't go anywhere. We'll be back in just a moment to continue this conversation with the global CEO of Prosus. Welcome back. We're in conversation with Fabrizio Bloisi, the global CEO of Prosus and Naspers. All right. Since you call yourself a tech company, not just a tech investment company,
yes.
How do you see this AI cycle playing out? Where in the hype cycle are we at the moment? And how are you sort of navigating this space? And what are you telling your portfolio companies to do?
I'm telling my portfolio companies, AI, when people ask if it is overhyped, I say no, it is underhyped. It is bigger, the impact is going to be bigger, the world is going to change completely. I can compare that to Industrial Revolution. After that, everything changed and all companies has to rethink how they operate. It's so profound. Today we use maybe some AI agents or chat 1, 2, 3 times per day. We are going to use 50 times per day. Because we are going to talk to that all the time. Our AI agents are going to synchronize with all the services we buy. Our companies are going to have maybe more AI agents working in the company than people. And look, what we do with AI today was impossible 2, 3, or 4 years ago. And we say, oh, this is amazing. No, this is the first version. Imagine the second version, the third version. Imagine 5 years from now. Imagine when AI can learn by itself, train by itself, and even help us to do R&D, for example.
Yeah.
You saw this week a big AI company, OpenAI, they announced that their first, everyone is doing code by AI, and they're saying 20 to 30% of the code is done by AI today. But now they say, no, maybe it's going to go to 90% now, because we can have a full AI employee working. We haven't saw any impact yet. The impact is going to be 10 times bigger. Some people ask, guys, it's just like a buzzword. It's not. I'll tell you an example. Inside Prosus, we have 800 models that runs many of our companies. Just in iFood, we have 200 models. A model is like a complete training model that take decisions by themselves, defining pricing, where you position people, if it's fraud or not, how do you communicate, what is the preference. There is like customer support. All of that are run by models, not by people. Marketing campaign, marketing strategy, where we announce, how much we announce, what time we announce. The people look to that and they train the model, but they don't take the decision anymore. And this is running today.
Yeah.
Right now, the biggest priority for Prosus is what we call large commerce model. What we are doing. In each region, we are not doing globally yet because of regulation, but in each regions, we are taking all the data of the companies, all the data, 100% of the data, and trying to put that in only one model. Okay. So instead of having, let's give, the focus is iFood, we start in iFood, 200 models, let's make one model, just like the ChatGPT model, OpenAI model, that has all the data of everything, of all users ever. The models, the first versions of these models, are so smart that they can plan the company better than the people can. And that's what we are running today. So imagine in 1 year. So we are very excited about AI. And I talked about, we are here in our Illuminate event. We are asking the companies to take more risks because everything is going to change. Everything is going to be transformed. For sure, we are going to have some winners from Silicon Valley, as we always have. But I think it's time to have winners from India. And Prosus is trying to connect our companies here with what we are seeing outside here, so we can have disruption in AI here in India.
Well, quickly, let me get to your big picture questions as well, because when you took over as CEO in your first 100 days, you said this is a $100 billion company. I want to get it to double the size, another $100 billion.
To start.
Yeah, so, you've already been halfway there now, but what will drive this next $100 billion? What are the sectors, what are the countries, what are the markets that are going to bring this next $100 billion?
Many people like to talk about where you are investing money to do that. My view is a little different. First thing is culture. We have to think as a tech company and to understand that there is so much value to be created over the next 1, 2, 3, 4 years through disruptive innovation, that we have to be ready to be the company disrupting. And we did a profound changing process to say we are the innovator. We are talking about large commerce model. We are talking about investing in AI first companies. We are talking about, we have Tokan, our AI assistant inside the company, that already has all our knowledge inside them and people use that to work. So we made the company as a tech company. As a tech company, we innovate more, we move faster, we take more risks. There is a lot of growth that comes from this different perception about how we face an uncertainty world changing that fast. After that, we are going to keep investing in ecosystems. So Latin America, we're executing very well. We are taking big bets in Europe. I'm very bullish that Europe needs big tech. Europe needs companies that can invest a lot. Europe market size is more or less the same of US in terms of population or GDP. Europe presence in terms of tech companies like 20 times smaller. I think Europe for a few years concentrated in regulating. I think they over-regulated. So Europe is slow due to over-regulation. But now with the world changing the new geopolitics, Europe is more open to create big tech there. And I'm sure Prosus is going to be a very big player in Europe and we have billions of dollars to create there. And the third one is India. And India is the best one. Look, India is amazing.
Okay, Europe and India are your next big bets to create the next $100 billion value. But
and Latin America.
Quickly, when you look ahead, with all that we've seen, with the funding boom during the COVID, then the funding winter that we saw, and now some investment picking up, and you're sitting on $18 billion of dry powder. What are the big themes you expect to play out as an investor that you will watch out for?
I think the big thing is AI. The big thing is to companies that can leverage the disruption in technology to create the next waves. Obviously, we just invested like $6 billion in food delivery and experience. So we are going to keep investing in food delivery, payment, e-commerce, and experience. But every time we invest on that, we are not investing in a company to make a bet and that's it. We are investing in how we can rebuild this sector through profound innovation, through disruptive innovation. When I look to food delivery in 5 years, I'm thinking it's going to be much more automated using AI and disruption. There will be much more space for agents, for messaging applications like ChatGPT or message AI apps that you can talk to them, ask them. And we are going to include AI in travel, in fintech, in everything else. So there is so much change ahead.
Yeah.
We are going to invest in companies that are ready to create the future.
All right, and we'll wait to see more of that in action, especially here in India. Fabrizio, thank you so much for your time here. It was a pleasure speaking with you.
It's a pleasure to be here in India and look forward to keep telling you how we are going to create the future together.
And we'll wait to hear more on that. Thanks so much again for your time. On that note, it's a goodbye, and thanks so much for watching.
Welcome back. You're watching the CNBC TV18 exclusive. We're in conversation with Bill Gates on the big pledge of accelerating the spending being done by the Gates Foundation, $200 billion over the next 20 years. You know, Bill, the last 25 years, the Gates Foundation has worked very closely with Warren Buffett. He's been instrumental in the $100 billion that you've spent in the journey so far. Is there a disappointment that he isn't going to be a co-traveler, fellow traveler over the next 20 years for you at the foundation?
Well, I'll certainly be very sad not to have Warren's regular advice. I mean, Warren is so wise, so generous. You know, he's been a great friend to me. You know, his example as a philanthropist, I think, has influenced many people besides myself. As you say, he's a huge contributor to the foundation. His family is very committed to the causes the Gates Foundation works on, and so they'll continue to be, his children will be great partners of ours in many of these areas. But no, it'll be tragic if Warren's not around. He's 94. I hope he lives this whole 20 years, but you know, he might not.
Well, speaking of milestones, it's 25 for the Gates Foundation, it's 50 for Microsoft, and it will soon be 70 for you in October. As you look back and reflect on the many milestones that you've achieved personally and in your careers, if you had a chance of a do-over, would there be anything that you'd change, anything that you'd do differently?
Well, I'd be very reluctant to go back and change things since I've been so unbelievably lucky. You know, my parents, who I got all my values from, and you know, they made sure I got a great education. You know, I've had amazing friends like Paul Allen, who helped found Microsoft, Steve Ballmer, who allowed Microsoft to be so successful, and now an unbelievable number of great partnerships at the foundation with the incredible team there, and partners all over the world. So. You know, I'm the luckiest person in terms of what I've been able to be involved in So yeah, I've made plenty of things that I've had to learn and do better, but I don't think I'd want to risk going back and making any changes.
Well, speaking of wanting to do better, you're no stranger to criticism, and it's been constant, but perhaps post-COVID even more so. Questions about the influence that organizations like yours build on decisions that have been taken. Many call it the tyranny of the unelected. How do you now respond to that criticism, Bill, and how do you believe the foundation should learn and position itself over the next 20 years to take some of that feedback and criticism on board in some constructive way?
Well, I think the agenda of saving children's lives, and making sure they're well nourished so that their brains and bodies fully develop, fortunately, that's not a super controversial agenda. All the governments we work with, including India, have goals to reduce those deaths. And, so we're able to work together. Vaccines themselves, we test them to make sure they're incredibly safe. And so there is some controversy about those. But, for example, with polio, there's not a single kid in India who's been paralyzed since 2011 when, the final case, which was tragic, was taken care of. And so, we get pretty strong support for the work we're doing. Sometimes seed technologies or contraception, we have to make sure we're communicating well about those things. I wish there were more people involved in, critiquing what we're doing in malaria and TB and HIV. Some of the work we do can actually be pretty lonely because it doesn't get the attention, the resources or the number of people engaged. So, I'd love somebody to criticize our TB drugs or vaccines or diagnostics and, share their ideas because TB is back to being the world's biggest killer, and there's just so few people funding the work there that we wish there were more.
You talked about TB, malaria, and you're hoping that we see breakthroughs on both those fronts. But outside of health, the innovations on energy, the R&D work that's happening on Alzheimer's, I know that there's been a large part of your mind space and as well as your resources that have occupied these areas in the last few years. What are you most optimistic about, both on energy, specifically nuclear energy, and the work that's happening on things like Alzheimer's, the tuberculosis vaccine, etc.?
Well, if I had to pick one, I'd say, getting to the bottom of malnutrition and really solving that might get to the top of the list. It's a tough competition because we've got a HIV vaccine, a TB vaccine that you mentioned, a malaria vaccine, all very important. I also support new energy innovation. I do that through for-profit investments, including, for example, TerraPower, that's working on new lower-cost nuclear reactors. And so climate change, avoiding the worst of that and getting cheaper energy is important. But I'd say the malnutrition would be at the top of the list.
Well, it's clear that you're definitely not retiring anytime soon, Bill. What keeps you going? I know pickleball is definitely not going to be something that's going to occupy a lot of your time outside of the foundation's work. But what keeps Bill Gates going today?
Well, I'm very lucky. I love reading. I love, traveling. I have great sisters and friends, and I love tracking the innovation, meeting people who are out in the field doing the tough work. So it's fascinating, and even though we'll have setbacks overall, the possibility of what we can achieve in these next 20 years keeps me going, makes me want to travel and work hard.
And the possibilities that you alluded to, what we're seeing on the AI front at this point in time. But for AI to really address the world's real challenges, healthcare, finding solutions to the many access deficits that exist, what are we talking about? Are we 5-10 years out before we start to see an inflection point on some of these big, real transformational challenges?
Well, there's no doubt in the next 5 years, it'll be pretty radical, both terms of how we discover new things, where the AI will help, and even healthcare delivery, where the patient will be able to talk with the AI and share everything that's going on with them and how they should interact with the health system. And so, no, that's near term. We have a lot of partners who are doing pilots even this next year.
Well, you've been part of the private sector and, of course, then moved to the development world. If I were to ask you for your message to the private sector in the current volatile environment that we're in, to other philanthropic organizations as well, organizations that you're perhaps partnering with or you're hoping to partner with in the future, what would your message be to them? What would your message be to governments today? You said you want to ensure that your voice is heard. What would you tell governments around the world today as we perhaps face what could loosely be called a leadership recession?
Well, the value of helping other people is pretty strong in all the world's religions. And so, that should extend to the poorest, those most in need. And so the idea that we're having less money to buy vaccines for the world's children is a bit of a surprise. And my advice is, hey, let's reverse that and accelerate the progress we've seen, which we should all be so proud of.
Well, Bill, with that, thanks very much for joining us here on the Global Dialogue today. Thanks very much for giving us a roadmap of where the Gates Foundation is headed. It's going to be an accelerated timeline for you to spend $200 billion over the next 20 years. It's a significant amount of money and, of course, a big change as far as the foundation's charter is concerned. Bill Gates, always a pleasure. Many thanks for joining us here. We will take a break. There's a lot more coming up. Don't go anywhere. We're back in a moment with more. The Gates Foundation, one of the largest charitable foundations in the world, is marking its 25th anniversary. Now, the Silver Jubilee comes with a big commitment. Bill Gates is pledging to give away, in his words, virtually all of his wealth over the next 20 years, which means the foundation plans to spend $200 billion over the next 2 decades. Now, this accelerated timeline has meant a change to the foundation's charter, which had stated that the organization would sunset 20 years after the death of Bill Gates. The last big change to the foundation had come in 2021, when Bill and Melinda Gates announced their divorce. Melinda Gates resigned as co-chair in 2024, which left Bill Gates as the sole chairman of the Gates Foundation. Now, from combating infectious diseases to agriculture research and reproductive health, the Gates Foundation has been at the forefront of solving some of the biggest issues in the world today. And joining me now to discuss the foundation's future and his pledge to give away virtually all of his wealth is the man himself, Bill Gates. Bill, many thanks for joining us on CNBC TV18. And let me start by congratulating you on 25 years at the Gates Foundation. But Bill, why this decision to set yourself a new deadline of 20 years to give away virtually all of your wealth? What has prompted this decision? Why this change from the original position?
Well, looking back on these 25 years, it's amazing what we've been able to accomplish. Together with partners, the one statistic of cutting the number of children who die every year in half has been phenomenal to be part of that. And so as I was thinking about that, I decided that we should essentially double down and spend all the rest of the money I'm lucky enough to have through the foundation on these causes over the next 20 years. And that'll allow us to be very aggressive, make some fantastic progress, and we'll have real clarity. A lot of resources for 20 years, and then others can step in with whatever we haven't been able to finish off.
If I may, Bill, is this decision to accelerate or speed up the giving that you're doing linked to the overall environment that we're currently seeing, where there is a retreat from multilateral institutions, from multilateral arrangements, from development aid? How much of this acceleration perhaps is also linked to the change in the environment as we see it today?
Now, this decision was made before all of these reductions were clear to us. I would say in the short run, it means the work we do is going to be challenged. Although I expect every year we'll have progress in India and some of the countries we work in. In Africa right now, these cuts to the aid budgets, the debt situation, some of the instability means the next 4 or 5 years will be difficult. But over the time period that all my money will be given, I still expect to see pretty incredible progress. So in the short run, I am very disappointed that aid generosity is down. But with the innovations in the pipeline, with, I think, going to people and saying that those aid budgets should come back to some degree, I'm, super excited about what we can achieve in these next 20 years.
Bill, you talked about doubling down on the significant resources that you've already committed. $100 billion was the previous amount that you did over the last 25 years in spending. You're doubling down on that, $200 billion between now and 2045. So help me understand, these are big numbers. Prioritize for me how you intend to use this money and what are you hoping to achieve in terms of impact?
Well, the first 25 years, we got child-to deaths down from 10 million to under 5 million a year. And we also took the 2 other diseases, HIV and tuberculosis, and the deaths were cut substantially for both of those. We also came up with ways to save mothers who are giving birth. And so we're really putting most of the resources into the global health work. We hope to be able to cut the number of children who die more than in half again, and also to make dramatic reductions in all infectious disease. We need to finish our polio eradication. Still a lot of hard work left there, and we also think some other eradications, guinea worm, malaria, a number of diseases could be taken all the way to zero. And so by having, for the next 20 years, over 200 billion in resources, double what we spent in the first 25 years, we'll be able to partner with, scientists, and we have a great partnership with the Indian government to help them achieve their ambitious health goals. And this field, the field of global health, will be able to perform miracles, and our resources will be a meaningful part of that.
Bill, you spoke about the ability to deliver miracles. What have been some of the hardest fought battles over the last 25 years? You talked about some of the important outcomes, especially on the global health front, that you've been able to achieve. What's been the hardest part of making those a reality? Resource is one thing. Execution is another thing altogether. What's been the tough part on the execution front?
Yeah, so for the foundation, we both work on the R&D side, so like creating new vaccines. And so, with Serum, a great Indian partner, a meningitis vaccine was one of the first new ones the foundation did. Later, a rotavirus vaccine that was very low cost, a pneumococcus vaccine, then with other partners like Bharat, a rotavirus vaccine that also brought prices down. So it's the vaccine work, both in the R&D and the delivery, is probably at the top of the list of the impact that we've had. Vaccines, you need to keep them refrigerated, you need to make them cheaper, you need to convince mothers to bring their children in. So, there are plenty of challenges just in that one area.
Bill, you talk about India. Now, you've been spending a fair amount of your time here in India. And of course, the foundation has been working in India for a good part of the last 25 years. Let me ask you about what excites you about what's happening in India today. How important is India going to be for the Gates Foundation over the next 20 years?
Well, certainly India's a very, very important place for us. It's our biggest overseas office, and it plays two big roles. One is that the Indian government has very aggressive goals for improving health, and so we get to partner and try out the latest advances in medicine, and that we've seen great results from that. But the actual creation, the R&D of the new tools, whether it's diagnostics, vaccines, drugs, new seeds to help farmers, or ways of taking AI and helping with health and agriculture as well as education. India is going to be a place where there's so many smart people, so much desire to see these improvements that will pioneer a lot of things first in India, and the brilliant work there will then benefit the entire world. Paradigmatic of that is the work in digital finance, where Aadhaar and the ability to pay digitally, India really did an amazing job on that, and now we work with the Indian government to make that available to all countries.
But Bill, you've been spending more and more time here in India and doing lots of fun, interesting things, not just linked to the foundation, but even outside of the work that the foundation is doing. What about being in India, about making the connections here in India, the people that you're spending your time with inspire you today? I mean, is this a new romance with India that started over the last few years?
No, I've always been fascinated by India, and of course Microsoft has had a fantastic relationship in terms of the huge development offices that we have in India, as well as amazing people like Satya Nadella that have come and made huge contributions to the company. And so as I moved from Microsoft to the foundation, I took that understanding of the great talent that's there with me. And so, I get to India on a regular basis and get to meet with the partners there. The majority of the world's vaccines by volume are made in India. We've had, so many important partnerships with that, and that's really growing. The quality of research in India, its desire to go even beyond vaccines with the tools that are provided. It's very timely, and part of that is Prime Minister Modi's been very generous at sharing with me his goals, and so we can talk about how the foundation helps with that.
Bill, you've referenced vaccines, and I want to ask you this in the context of the last conversation you and I had, which was in September in New York last year. Now, there you had talked about being a salesman for Gavi, the Global Vaccine Alliance, in its quest to raise funds. You've been central to Gavi's ambition and aspiration of providing affordable vaccines to the world. At this juncture, with the very real possibility of funding drying up, specifically from the US, how concerned would you be about Gavi's future?
Well, I'm very, very concerned. It would be tragic if Gavi weren't able to raise as much or more money for this next 5 years as it's had for the last 5 years. And yet, it's pretty clear that we're going to see a reduction. I continue to talk to all the governments about the impact. There's nothing more amazing than making sure all the children of the world have these miraculous vaccines. So we'll see what we're able to raise, but it's looking tough. I'd say the next 5 years, the whole aid picture, whether it's Gavi or Global Fund, are going to mean that we might go backwards a little bit before we resume the progress we've seen since the turn of the century. And that's just a mistake, and I'll be speaking out very loudly, try to get the U.S. back in, try to get others to maintain or even increase in some cases their giving.
But do you feel confident or optimistic about that? You said you're going to try and draw people back to the table. But at this point, with the global retreat that we are seeing, especially from development goals, Bill, how much of a slide back do you believe we should be prepared for? Are we set for?
Well, we have two forces. One is the power of innovation. That is new tools, whether that's new drugs, new vaccines. We have AI to even help with the delivery, to talk to patients and give them advice about care seeking. Things like the ultrasound that'll help figure out about the whether a pregnancy needs special care. So the innovation side is, if anything, going faster than ever. The generosity on resources for the delivery side, the next 5 years are going to be tough. And that might mean some of our statistics that have been improving, we might have a period where they'll get somewhat worse, particularly in Africa. And that's tragic. That shouldn't happen. If you look at the full time frame that all my money will be given over, I'd say we will be much better off by the end of that than we are right now, despite this period where the aid budgets are really going to hurt our work, particularly, as you said, things like Gavi and Global Fund not being fully funded.
Well, we are going to head into a break and continue our conversation with Bill Gates on his big pledge to spend $200 billion as part of the Gates Foundation over the next 20 years. Welcome back. You're watching the CNBC TV18 exclusive. We're in conversation with Bill Gates on the big pledge of accelerating the spending being done by the Gates Foundation, $200 billion over the next 20 years. Bill, the last 25 years, the Gates Foundation has worked very closely with Warren Buffett. He's been instrumental in the $100 billion that you've spent in the journey so far. Is there a disappointment that he isn't going to be a co-traveler, a fellow traveler over the next 20 years for you at the foundation?
Well, I'll certainly be very sad not to have Warren's regular advice. I mean, Warren is so wise, so generous. He's been a great friend to me. His example as a philanthropist, I think, has influenced many people besides myself. As you say, he's a huge contributor to the foundation. His family is very committed to the causes the Gates Foundation works on, and so they'll continue to be, his children will be great partners of ours in many of these areas. But no, it'll be tragic if Warren's not around. He's 94. I hope he lives this whole 20 years, but he might not.
Well, speaking of milestones, it's 25 for the Gates Foundation, it's 50 for Microsoft, and it will soon be 70 for you in October. As you look back and reflect on the many milestones that you've achieved personally and in your careers, if you had a chance of a do-over, would there be anything that you'd change, anything that you'd do differently?
Well, I'd be very reluctant to go back and change things since I've been so unbelievably lucky. My parents, who I got all my values from, and they made sure I got a great education. I've had amazing friends like Paul Allen, who helped found Microsoft, Steve Ballmer, who allowed Microsoft to be so successful, and now an unbelievable number of great partnerships at the foundation with the incredible team there, and partners all over the world. So. I'm the luckiest person in terms of what I've been able to be involved in. So yeah, I've made plenty of things that I've had to learn and do better, but I don't think I'd want to risk going back and making any changes.
Well, speaking of wanting to do better, you're no stranger to criticism, and it's been constant, but perhaps post-COVID even more so. Questions about the influence that organizations like yours build on decisions that have been taken. Many call it the tyranny of the unelected. How do you now respond to that criticism, Bill, and how do you believe the foundation should learn and position itself over the next 20 years to take some of that feedback and criticism on board in some constructive way?
Well, I think the agenda of saving children's lives, and making sure they're well nourished so that their brains and bodies fully develop, fortunately, that's not a super controversial agenda. All the governments we work with, including India, have goals to reduce those deaths. And, so we're able to work together. Vaccines themselves, we test them to make sure they're incredibly safe. And so there is some controversy about those. But, for example, with polio, there's not a single kid in India who's been paralyzed since 2011 when, the final case, which was tragic, was taken care of. And so, we get pretty strong support for the work we're doing. Sometimes seed technologies or contraception, we have to make sure we're communicating well about those things. I wish there were more people involved in, critiquing what we're doing in malaria and TB and HIV. Some of the work we do can actually be pretty lonely because it doesn't get the attention, the resources or the number of people engaged. So, I'd love somebody to criticize our TB drugs or vaccines or diagnostics and, share their ideas because TB is back to being the world's biggest killer, and there's just so few people funding the work there that we wish there were more.
You talked about TB, malaria, and you're hoping that we see breakthroughs on both those fronts. But outside of health, the innovations on energy, the R&D work that's happening on Alzheimer's, I know that there's been a large
Hello and welcome to Global Eye. I'm Parikshit Luthra. The top story we're tracking this evening. 2 staff members of the Israeli embassy were shot and killed by a gunman outside a Jewish museum in Washington, D.C. The victims, Yaron Lishinsky and Sarah Lynn Milgram, were leaving a networking event at the museum organized by the American Jewish Committee when a man opened fire with a handgun at a group of 4 people. The suspect was identified as Elias Rodriguez, a 30-year-old from Chicago. Rodriguez was arrested by the authorities right after the incident and was heard saying "Free Palestine" as he was being led away by the police. He has been charged with first-degree murder as well as murder of foreign officials and related firearm charges. According to the Israeli ambassador to the United States, the 2 victims were a couple about to be engaged. US President Donald Trump called the incident a horrible attack and demanded swift action to combat hate in America. Echoing the same sentiment, Israeli Prime Minister Netanyahu said and also linked the shooting to the 7th October 2023 attack and said he was shocked by the horrific incident. Netanyahu also said that the security will be increased at all Israeli embassies worldwide. This attack comes as Israeli forces continue to deepen their presence in Gaza. Over 50 Palestinians have been killed or are missing after an Israeli airstrike on a residential building in Gaza. Rescue operations have been stopped due to lack of heavy machinery. To take this forward, we are now joined by Kobi Shoshani, Consul General of Israel to Midwest, India. Mr. Shoshani, thank you very much for joining us on the program. Let me begin by asking you, as per the preliminary information available, what do you think were the motivations of this attack on and shooting on 2 Israeli officials, embassy officials in Washington, D.C.?
Definitely, it's a very right and very precise. The poisoning language that this pro-Palestinian organization use, they are fueling terror attacks by agenda. I have to say, they are trying to use words against the state of Israel, which I don't even want to repeat. But they are poisoning the atmosphere. But I want to tell you in a very frank way, Sarah and Yaron was a couple that is supposed to be married, as you mentioned before, very young gentlemen. What they did to go to a museum, Jewish museum in Washington, this is something that, this is the real face of this terrorist. And I'm very, very sorry and send my condolences to the families.
What's been the reaction now in terms of increasing security for Israeli officials and the advice for them all across the world?
Definitely, as the Prime Minister said very, very clearly, we of course are going to tie the security around our missions all over the world. I have to say that in India, we are have a very good collaboration with the Indian authorities, and we are fully trust and fully support what they did to us, to protect us. But definitely this hatred that comes from these Palestinian groups, it's actually grow in the poisoning language that coming up from the Palestinians. I would like to add one more thing with your permission. The pro-Palestinians, I can understand them. They hate us, they like terrorism. That's part of their daily life. But the people who support them, some of them, naive, especially from the left, I have to say, in America, their agenda is a peace and everything. That's the time to say no. No to violence, no to terrorism, not to killing. And I hope that one day they will understand that they're supporting by this poisoning language, killing of innocent people.
I would also like to ask you, sir, about the present offensive in Gaza. Prime Minister Netanyahu has said that Israel will eventually take over all territories in Gaza. Could you give us a status of the operations and what is the strategy ahead?
I think Prime Minister make it very, very clear 2 days ago, or I think even last night, make it very, very clear, and I fully support. I think this is something very crucial. Bring back the hostages, disarm the capability, the military capability of Hamas, and the war going to be ended. He make it very, very clear, and that's right now in the end of the Palestinians.
Right. Now, when it comes to the current situation in the region, US and Iran are talking about a nuclear deal. If this deal is not reached, what could be the action? Because there has been a lot of reporting about how Israel could launch an attack on Iran if this nuclear deal is not arrived at. In fact, Iran has already been sending out warnings.
I think that we are fully support President Trump initiatives to settle down and to get into a deal. What I see from the Iranian side that they don't accept it, which means that the balls again, it's in the hands of the Iranians. But I think that they have to be smart and to accept the deals that the American make for them. I think that it's going to be good for the region, good for the Middle East. I think Iran with the nuclear capability is a risk not to Israel. It's a risk to the world. It's a risk to Europe. It's a risk to Asia. It's a risk to United States. And I think everybody understands it.
Right. But I would like to ask you, what would be the threshold for Israel to carry out an operation on Iran? Because this could lead to a wider war in the region as well. So what is the threshold? What will be the benchmark or the point at which you will say that, yes, we're now going to carry out an operation?
I think, again, our Prime Minister make it very, very clear. You know, the interest, the security interest, the security issue of the state of Israel is about any government and every opposition and coalition in Israel. And I think that the Iran capability, nuclear capability, is a risk to the state of Israel. This is our focus right now. And I think that everybody understands this position.
Right. In terms of the operation against Hamas, what can we expect next from the Israeli government, from the Israeli ground forces?
I think that right now in Gaza, the Israeli military forces, the IDF, is controlling most of part of Gaza. Right now we are controlling a very part ready to continue and deepen the operation until they're going to release the hostages. We still have 59 hostages in Israel, some of them dead, some of them are alive. We want them back, and I think that that's the only solution to end this war. Bring them back and disarm, bring authority to Gaza, but which is not Hamas, without any military capability. Israel will not accept any military capability and risk of its security when such capability there are in Gaza like that.
Right. My final question to you would be about India. Give us a sense about the conversation that you have been having with India. One, about the situation in Gaza and Israel's operation. And number two, India-Israel cooperation over Operation Sindoor and the conflict with Pakistan.
Let me not go into a diplomatic collaboration between Israel and India. Everybody knows that Israel stands by India. I think the operation was successful in my point of view. And I think that right now everything calmed down. I think this is the right way to India as well. India needs stability. India is a superpower that's coming up in the economic field and they need stability. As you probably know, I'm a big fan of India, big friend of India. And I think that India is doing the right thing in my perspective.
Right. All right. Kobi Shoshani, thank you very much for joining us on the program on the death of Israeli embassy officials in Washington, D.C., and also Israel's operations in Gaza, and what next in terms of the country's attack on the Hamas to bring the Hamas terrorists to book and make them accountable. We're taking a short break here on Global Eye, but coming up on the other side, President Donald Trump's crackdown on immigration has gathered steam. The president's tax and spending bill has allocated billions of dollars for mass deportations. A special interview with Christopher Elms, spokesperson at the U.S. Embassy in India, after this break.
away.
Welcome back. You're watching Global Eye. US President Donald Trump has vowed to crack down on illegal immigration in America, leaving the future thousands of immigrants hanging in abeyance. Trump's expansive tax and spending bill, which has been touted as one big beautiful bill, has put the spotlight on this issue. The bill passed by the House of Representatives will allocate over $100 billion for new border enforcement measures. These will include more physical barriers and expansion of detention capacity and the hiring of additional immigration and customs officers. I caught up with Christopher Elms, spokesperson of the U.S. Embassy in India, and began by asking him about Trump's stance on immigration and the steps the U.S. government is taking to crack down on visa frauds.
The Trump administration has made this a priority of the administration. They are cracking down on illegal immigration, and they're sending a clear message to those thinking about heading to the United States illegally that it's not worth the risk. Those that head illegally will face conviction, they'll be apprehended and deported. And so the president and the administration have been pursuing efforts to secure our borders. And part of that includes our visa policy around the world, including here in India. And so on Monday, on May 19th, the administration, through the State Department, announced new visa restrictions on travel agencies that are facilitating illegal immigration. So in practical terms, the restriction is a ban on visas for travel agencies that are owners, executives, senior officials that are facilitating this illegal immigration.
Could you also give us a sense of how the U.S. government, the embassy and the diplomatic security teams are going about this exercise of identifying travel agencies or agents which are indulging in this kind of fraud or, in a way, facilitating people to cross the U.S. border illegally?
Absolutely. So it is an effort here that we're carrying out in our embassy between our visa section and our diplomatic security services. And we're looking to identify these travel agencies that we know are facilitating illegal immigration. These are agencies that are providing fraudulent passports, they're providing fraudulent visas, they're providing different travel documents, they are providing reservations and transportation logistics to people that they know are trying to go to the United States illegally. And so we're looking at that and working closely with Indian law enforcement to prosecute those that are human traffickers and smugglers. And so we do appreciate the cooperation from Indian law enforcement in protecting our borders. Secretary Rubio just said the other day in a hearing before the Senate that the only people that profit off of this trade are illegal human traffickers and smugglers. And so we are working with our counterparts here, and our diplomatic security services are looking into those that are knowingly facilitating illegal immigration.
Right. Would it be possible to give us a sense if there is already a blacklist that has been created? Are there already people and agencies which have been banned? And if yes, how many of them?
Yeah, so I can't give specific numbers due to confidentiality laws, but there are people that have already faced this restriction. So the restriction is under our Immigration and Nationality Act. It's called Section 212A3C, which we abbreviate 3C. And these 3C restrictions have already been applied to travel agencies, to executives, to owners, to senior employees, and we're going to continue to look for them. And so as we identify those that are knowingly providing fraudulent documents, we will be applying this 3C visa ban on them.
Right. What is the red flag for people? How should they identify an agency which could be trying to send them to US via illegal means? What are the kind of advertisements, videos on social media, or the kind of travel agencies one has to be wary of?
Yeah. So if you see any advertisements on social media or elsewhere of people that are explicitly advertising routes to the United States illegally, you know that they are involved in human trafficking and smuggling. If you're at a travel agency and they are offering a fraudulent passport, a fraudulent visa, they know that they are trying to facilitate an illegal movement. And so if you see that, please share that information with the U.S. Embassy or local law enforcement. These are people that are trying to prey on individuals here in India. These are agencies that are looking to take your money, and they know, as we all do right now, under the Trump administration, the United States is going to apprehend and deport folks that cross the border illegally. And so we're looking to stop these agencies from profiting off of Indians here in India.
One of the warnings that I saw on the embassy X handle was about overstaying your visa in the United States. What could be the consequences and what has changed over the last few months?
So what has changed over the last few months is a stronger enforcement effort by the United States. This is a whole of government effort. The Department of State, who issues visas, the Department of Homeland Security in the United States that controls our border. We're working hand in hand to stop illegal immigration. What's the same is that we're looking to stop fraud everywhere. Folks cannot lie on their visa applications. If in the United States, they're overstaying their visas, if they're committing criminal acts in the United States, this is not new. These are laws that have been on the books for a long time under our Immigration and Nationality Act. Those folks are subject to deportation if they violate our laws or present fraudulent documents or have been fraudulent in what they said they'll be doing in the United States.
Right. So overstaying your visa could also mean a permanent ban from entering in future?
It can, yes. The permission on the visa, when presented to an official at a port of entry, grants a certain amount of time in the United States based on that visa. And so those that overstay it are violating the visa laws, and they could be subject to a permanent ban in the future.
Right. I'd also like to ask you, we have been reading U.S. Embassy advisories, and they have gone on to say that please be very careful, do not submit fraudulent documents for your visa applications. They can be easily detected, and visa fraud is a punishable offense under U.S. criminal law. Could you give us a sense of what are some of the most common examples of visa fraud or fraudulent documents which can be easily detected by the U.S. Embassy?
We're interviewing thousands of people every day across the country. We have a consular section in New Delhi. We also have them in our consulates in Mumbai, Chennai, Kolkata, and Hyderabad. And so these are folks that are reviewing hundreds of applications on a daily basis. They're working in these jobs for months or years. And so fraudulent documents are easy to pick up on for our consular officers. And so when you're presenting your case at the interview, just tell the truth. It's pretty simple. Those that are going for legitimate means just need to tell the truth at the window. If you're bringing fraudulent documents, it's only hurting your cause and could result in a permanent ban.
Right. We've been seeing how the U.S. Embassy has also been cancelling certain visa appointments. Recently, there was a message about 2,000 appointments being cancelled. Is this now a regular exercise to check if there are appointments being generated fraudulently or via bots for that matter?
You're right. We did cancel 2,000 appointments recently in March, and we've been on the lookout for bots and other programs that are trying to take away appointments for legitimate visa applicants. And I know that people are looking to get their visa appointments in a fair way, and we're looking to make sure that our system allows for that. So we are looking out for cases where we identify irregularities in the appointment system, and where we do, we are canceling those appointments and putting bans on those that have applied for those appointments.
Right. My final two questions, Chris. One would be on the larger issue of immigration and deportation. The U.S. has deported over 680 Indians back to India over the last few months. This is an ongoing conversation. Could you give us a sense of what is the objective and what are the two countries trying to achieve right now on that front?
Yeah, the objective is simple, that those that came to the United States illegally are heading back to their countries. Those that we have apprehended, we are now deporting, and we're working with countries around the world, including India, to take back the citizens that went illegally. And so as we talk with the government of India, we appreciate the stance that we're looking to secure our borders in both countries. And the government of India understands that. And we will continue to work with the government of India and in the United States in apprehending those that have come illegally. When they're identified as Indian citizens, we'll work to send them back to India.
My final question would be now about legal migration and legal travel to the US, either for work or for student visas or for business for that matter. Both countries have said that while we'll crack down together on illegal immigration, we will also support avenues for legal migration into the United States. In the last 3 months, have things changed in terms of how visas are processed for students, for business owners, for individuals, for tourists, or for those going on H-1B or work visas to the US? Are there other issues or background checks that are now conducted? Are there things that people should keep in mind, Chris?
So we continue to welcome legitimate travelers to the United States. We're excited that next year, the United States, together with Canada and Mexico, is going to host the World Cup. We expect plenty of international visitors coming for that. And so what we're really focused on is illegal immigration to the United States. And so over the past few months, there has been an increased emphasis under this administration of those that came illegally or are trying to go illegally. And so the actions that we're taking in India largely reflect those that are trying to go illegally. And if they are receiving support from a travel agent, if they are presenting fraudulent documents, they're presenting fraudulent visas, passports, other things like that, that's what we're trying to stop. And so as we continue to welcome legitimate travelers, the last 3 months, there has been an increased focus on cracking down on those going illegally.
All right. Thanks very much, Chris, for joining us. Let's take a look at some other headlines. Commerce Minister Piyush Goyal has said that he had a constructive meeting with US Commerce Secretary Howard Lutnick for a mutually beneficial trade agreement. In a post on X, Goyal said that both countries are committed to enhancing opportunities for their businesses and people. This was their second meeting within a week to discuss a proposed bilateral trade agreement between the two nations. Both sides are looking at finalizing an interim trade pact by the 9th of July. The Trump administration has revoked Harvard University's certificate to enroll international students. The university has just 72 hours to comply with 6 federal demands to regain its eligibility. The demands include giving the Trump administration access to all records of illegal activity by non-immigrant students in the past 5 years. If the university fails to comply, it means that thousands of current students must transfer to other schools or leave the country. This action comes after the government terminated the $2.7 million in grants for Harvard last month. With that, it's a wrap on this edition of Global Eye. Thank you for watching. Stay tuned to CNBC TV18 for more news and updates.
Good evening. Thanks for joining us on India Business Hour. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The RBI clears a record surplus transfer to the government of 2.69 lakh crore rupees. This is 27% higher than the dividend transferred last year. The RBI also raises the contingent risk buffer to 7.5% from the current upper limit of 6.5%. President Trump threatens 25% tariffs on iPhones made outside the US. Trump also threatens 50% tariff on European Union from the 1st of June, saying the EU has been very difficult to deal with. Wall Street wobbles after fresh tariff threats. In European markets plunged more than 2%, with auto stocks leading the decline, fearing higher tariffs. India and the US may arrive at an in-principle agreement on the first tranche of the trade deal in the next 7 to 10 days. Sources say the US is likely to impose 10% tariffs on Indian goods, but some product lines could get zero duty. The Sensex and the Nifty end the week down nearly 1% despite a rally on Friday. 35 out of the 50 Nifty stocks post losses this week. Real estate and defense stocks buck the trend, gain over 2%. Harvard University sues the Trump administration over its move to ban enrollment of international students. Harvard argues the U.S. government's decision is a blatant violation of the First Amendment. More than 25% of students at Harvard are non-U.S. citizens. The U.S. House of Representatives approves Trump's tax cut bill. This includes a 3.5% tax on remittances sent by non-U.S. citizens to their countries of origin. Nearly 3 million Indians work in the U.S. under various visa programs. The U.S. contributed nearly 28% of remittances for India in FY24. The CEO of processor Naspers is betting big on food, fintech and e-commerce in India. Fabrizio Bloisi promises to invest billions and eyes at least 5 IPOs in the next 18 months despite setbacks in Byju's and Farmeasy. Also rules out any stake sale in Swiggy. That's an exclusive. Pakistan denied permission to Indigo's Srinagar-bound flight for using its airspace to escape bad weather, says India's aviation regulator. The flight from Delhi suffered damage to the nose cone, leading to its grounding for further inspection. Passengers and crew escaped without injuries. Israel's Prime Minister Netanyahu accuses leaders of UK, France and Canada of emboldening Hamas after they called for an end to the military offensive in Gaza. At least 29 people, including children, have died due to starvation in the last few days, according to health officials in Gaza. Well, let's head straight to the market action. The markets witnessed major buying in trade today. That's Friday, with the benchmark indices rising nearly 1%. 48 out of the 50 Nifty stocks closing in the green. FMCG and IT were among the top gainers. But for the week, the market ended in the red. That's the story on Friday. But for the week, they closed lower by about 1% each, that is. Now, 35 Nifty stocks posted losses this week. So that's the snapshot of the market this week for you. But the top story that we're tracking this evening, the Reserve Bank has decided to transfer a record 2.69 lakh crore rupees to the Indian government as dividend for the last fiscal. Now, this amount is 27% higher than what the Reserve Bank transferred to the government in FY24. So look at that jump there. It's still lower than what the street was expecting. The RBI has also revised its economic capital framework and raised the upper limit of the contingent risk buffer range to 7.5%. Now, this is the buffer maintained by the central bank to cover unexpected and unforeseen financial risks. It is a key component of the economic capital framework, which determines the appropriate level of capital that the Reserve Bank should hold on to. So that has been hiked now to between 4.5% to 7.5%. Let's go across to Ritu. She joins us now to explain what the Reserve Bank has decided to do as far as its dividend is concerned and what the contingent risk buffers mean. Ritu.
Well, record high surplus transfer from the Reserve Bank of India to the central government, coming in at 2.69 lakh crores, which is an increase of more than 27% from last year's dividend transfer of 2.1 lakh crores. Now, this number, although large, is tad below what the market was expecting at 3 lakh crores plus, and that is because the RBI board has also adopted a revised economic capital framework
under which the contingency risk buffer was hiked to 7.5% at the upper end. Now, without this large buffer, the surplus transfer could have been even higher and perhaps closer to market expectations. Now, the contingency risk buffer is nothing but the buffer that is maintained by RBI to cover any unexpected and unforeseen financial risks. And previously, it was at 5.5% to 6.5% of RBI's balance sheet, and that has now been widened to 4.5% to 7.5% under the revised framework. Now, RBI says this revised framework provides some flexibility to be able to maintain risk buffers, keeping in mind the prevailing macroeconomic and other factors, while also ensuring the needed intertemporal smoothing of transfer, which means avoiding any large fluctuations year on year. Now, while we'll get to know the fine print of what really contributed to this large surplus when we get the RBI annual report in the coming weeks, but safe to say the big contributor has been the gains from RBI's sale of dollars, which is probably the highest since the global financial crisis, at $400 billion nearly for FY25 compared to just $153 billion in the year before, and RBI has made a profit on every dollar that it sold. Other key factors like interest income on rupee and foreign securities would have also lent some support. Now, a higher dividend payout is good news. It is going to augment the government's non-tax revenues, and it is also likely to improve liquidity conditions in the system as well as potentially ease the short-term interest rates.
Ritu, many thanks. Now, the Reserve Bank dividend is much higher than what the government was expecting in the union budget. Sapna is standing by to explain how this provides a much-needed fiscal cushion for the government. Sapna, how will this help the fiscal math? Are we likely to see an improvement on the fiscal deficit number?
Just answering that question right away, of course, in terms of FY25, nothing much can be done because those numbers are more or less frozen. And we have been given an indication in the morning itself that, top government sources have indicated that 4.8 is what it is going to be for FY25. However, going forward, if you recall, in the current year, the FD numbers are slightly more, not challenging, but they are slightly that's a goalpost that the government has to meet. So, a bit of challenge could come on that front. But having said that, if you just look at the numbers, the kind of dividend that has come in, of course, it's a record number once again. And, the estimates are that probably around 2.20 lakh odd crore to 2.25 lakh odd crore was the number that the government had estimated in terms of the RBI dividends for the current financial year. Of course, the rest, is done by the PSB dividends and financial institutions. So having said that, against that, 2.68 is not a bad number at all, number one. Number two, it's like around 43,000 to 48,000 crores higher. And in terms of the GDP, of course, this would translate into a boost of more than 0.1% of the nominal GDP. Now, so there are two data sets here. One, of course, the GDP for the previous financial year, which is lower, and the higher estimate is there in the budget documents, 357 odd lakh crore is what the number is. So both net around 0.1 plus 0.1 plus is the kind of boost that is going to come to the exchequer. We'll have to, of course, wait and watch and see in the next couple of months how the government plans to use these funds. But at least 220 to 225 has already been factored in. So it's the additionality, the 43 to 48 odd thousand crores. That's the additionality that we have to wait and watch and see how that is actually used up. And government sources earlier indicated very clearly to CNBC TV18 that this is a well-calibrated, well-balanced economic capital framework policy, as well as the dividend that has come in. Should we see it in that light? And of course, the fact that the risk buffers have been increased by RBI, keeping the current macroeconomic environment in mind. So going forward, there could be some easing out in terms of the future RBI dividends that will come through. Of course, they will be on the higher side, but maybe the growth rate will be paced out.
Yes, that certainly seems to be indicated by both the Reserve Bank as well as the government. Sapna and Ritu, thanks very much for joining us. And to all our viewers, you can catch our broadcast on the record RBI dividend as we analyze the numbers with top economists. That's coming up for you. But shares on Wall Street down sharply at opening bell, and markets across Europe have also seen a sharp sell-off. This after US President Donald Trump's latest tariff salvo. In his first post on his social media, President Trump said that Apple would have to pay tariffs of 25% or more for iPhones that are made outside of the US. He said, and I quote, "I have long informed Tim Cook of Apple that I expect their iPhones that will be sold in the US of America to be manufactured and built in the US not India or any place else, end of quote. Now, only 30 minutes after this post, President Trump also said he was recommending a straight 50% tariff on the EU after complaining about stalled trade negotiations. The new import duties would start on the 1st of June. In his post, he said, and I quote, EU has been very difficult to deal with. Our discussions with them are going nowhere, end of quote. So the tariff threats are back. Now, India and the US may arrive at an in-principle agreement on the first tranche of the trade deal in the next 7 to 10 days. Sources tell CNBC TV18 that the US is likely to impose 10% tariffs on Indian goods, but some product lines could get zero duty. Parikshit is standing by with the details. So, Parikshit, tranche 1 in-principle agreement perhaps in the next week or 10 days?
Well, yes. We believe that the talks between Commerce Minister Piyush Goyal and U.S. Secretary of Commerce Howard Lutnick, and also the meeting between Commerce Minister Piyush Goyal and USTR Jamieson Greer have been very positive, and both sides could reach an in-principle agreement as early as next week. Also, there has to be certain political agreement at the topmost levels. So it's possible that that Donald Trump would have to finally approve what has to happen, but we're told that an in-principle agreement is very close, and US is not going to exempt India completely from reciprocal tariffs. It will be 10% that US would want to impose on India even after there is a reprieve from the 26% reciprocal tariffs. There will be zero tariffs, possibly on some goods, and we hear from sources that some of the labor-intensive sectors in India, some of the SME manufactured goods, those are the areas which could enjoy zero duty benefits. But the nitty-gritties, we're still yet to hear on that. We're also told that there will definitely be an agreement well before the 9th of July when those reciprocal tariffs kick in. We have been speaking to our sources about this comment by Donald Trump about imposing a 25% tariff on Apple in case they don't manufacture in the United States. Sources telling us this is unlikely to have any material impact on manufacturing in India. This is mainly because Apple cannot shift manufacturing to USA over the next 2 to 3 years. It is going to take time, and even if they do manufacture in US, it is going to be expensive for the American consumer. So there is a feeling that there is going to be a way out, and Apple will be able to convince the US administration. And number 3, Apple would be using India to cater to other global markets in the years to come.
All right, Parikshit, many thanks for joining us. Meanwhile, the U.S. Treasury Secretary Scott Bessent told Fox News that the Trump administration is far along with India in trade talks. That's not all. He also said that with the exception of the EU, most nations were negotiating with the U.S. in good faith, and that's why we've seen that threat coming in from President Trump of imposing a 50% tariff on the EU. The big newsmaker this evening, the global CEO of Processor Naspers, is betting big on food, fintech and e-commerce in India. Fabrizio Bloisi is the head of one of the largest tech investors in the world. It's planning to invest billions and promise at least 5 IPOs by companies backed by Process in India over the next 12 to 18 months. The portfolio of Process spans across sectors including companies like Swiggy, Rapido, Meesho, Urban Company, among others. Process, though, says it's not keen on selling any stake in Swiggy at the moment.
Yeah. We have in total $18–19 billion in cash in Prosus. Yeah. Our intention is to invest to grow, and I think India is one of the 3 big priorities. So we will invest for sure a few billions here.
A few billions here, but your style of investing, when Prosus first started investing here, it was growth stage. Then in the last few years, we've seen early stage investments come up as well. Are you looking at, perhaps more larger deals, buyouts? Is that something you see an opportunity in the India market?
I think something that Prosus has is flexibility, and our strategy is to empower the local demands and the local entrepreneurs. We have 35 companies in India. Yeah. Having 5 IPO, it's not like this is the potential. This is the short-term potential. I think we will have more public companies from Prosus portfolio just after the next 10–12 months, the next 12–18 months. Well, so my point is, we are really confident that we have so many nice companies. We have many IPOs ahead. But I don't see IPOs as the end, like, we are IPOing so we can sell. No, we are trying to build a $50 billion business here in India. There is so much more to do. We have to invest much more. We have to enable consolidation in terms of ecosystem consolidation, how some of our companies can help the others. That's what I think we bring to the table.
for the time being, do you intend to continue holding on to that 20+% stake that you have in Swiggy even after the IPO?
Yes, we are not in a mood of selling. We are in a mood of keeping investing in India.
Okay.
So our intention is to keep investing and invest more, generally in India.
But no plans to, sell some of your stake from Swiggy yet?
No. PayU has a lot of growth ahead. We are doing well in credit also inside PayU. And just a quick story to inspire you. We invested in China 25 years ago.
Tencent?
Yes.
Yeah.
And for many years, people said, why don't you sell Tencent? They are valuing like 10, 20, $50 billion. People said, I was not there, but people made this question, like Tencent now is public, $10 billion, sell. And we haven't sold it. Now Tencent is a $600 billion company. We are in India. India can be as exciting or better than China. We have so much ahead. We are just getting started. We have space to build $10 billion companies here. That's the obvious, but $50 billion, $100 billion here.
Well, that's process betting big on India. The big earnings of the day are Ashok Leyland posting a healthy performance in the Q4 on expected lines. Net profit up 38%, primarily driven by a tax credit of 170 crore rupees. Revenue saw a spike of close to 6% as recent price hikes have boosted realization. The board approved a bonus issue of 1 share for every share held. It also approved a dividend of over 4 rupees per share. Moving on to metal giant JSW Steel, strong Q4, net profit up by over 13% year on year. Meeting street expectations, revenue declined by 3%, but in line with what the street was forecasting. JSW Steel has also sent a demand notice to banks requesting a refund of the 19,300 crore rupees paid under its resolution plan for Bhushan Power and Steel. Now, the company has also sought a 60-day delay in the liquidation proceedings. Banks have said they will decide on the refund during this period and don't have to immediately refund the money to the company. This was part of the terms and agreement between the company and the lenders when the deal was signed. Remember, there is a Supreme Court order that basically has said that the Bhushan Power deal between JSW under the IBC will no longer hold and the company will have to move towards liquidation. Up next on India Business Hour, 2 days after a Srinagar-bound Indigo flight suffered damages to its nose cone due to a hailstorm, India's aviation regulator says Pakistan denied permission to the pilots to use its airspace. Remember, there is a NOTAM in place. Details on that coming up. You can catch all of CNBC TV18's news and updates on YouTube, Facebook, Instagram, X and Jio Hotstar. You're watching India Business Hour. The big global stories that we're tracking this evening. Over 50 Palestinians have been killed or are missing after an Israeli airstrike on a residential building in Gaza. Rescue operations have been stopped due to a lack of heavy machinery. Health officials in Gaza have said that at least 29 people, including children, have died due to starvation in the last few days. Officials have warned that thousands more are at risk of dying as limited aid begins trickling into the enclave. Israel's Prime Minister Netanyahu has accused leaders of Britain, Canada and France of emboldening Hamas. This comes after the leaders threatened coordinated action if Israel did not stop its military offensive in Gaza. The Israeli Prime Minister also said that President Macron, Prime Minister Khani and Prime Minister Starmer were on the wrong side of justice. The suspect in the fatal shooting of 2 Israeli embassy employees in Washington has been charged in federal court with 2 counts of first-degree murder. The suspect, Elias Rodriguez, has also been charged with murder of foreign officials and causing death with a firearm. Officials have said that more charges, including terrorism, could be added. From one war-torn region to another, U.S. President Trump has announced that there was a major prisoner swap between Russia and Ukraine. Trump congratulated both sides in the negotiations. Meanwhile, G7 nations have vowed to impose more sanctions on Russia if it fails to make progress towards peace with Ukraine. 2 days after a Srinagar-bound Indigo flight suffered damages to its nose cone due to a hailstorm, India's aviation regulator has said that Pakistan denied permission to the pilots to use its airspace. The pilots were attempting to escape bad weather, but their request was rejected by Pakistani authorities. Remember, the Pakistan airspace has been closed to Indian Airlines after Operation Sindoor. In fact, that closure is now extended to the 23rd of June on both sides. The passengers and pilots managed to escape without injuries, fortunately. Madiha joins us now to give us a timeline of what transpired on that Indigo flight that evening. Madiha.
It was an extremely harrowing experience for these passengers on board Indigo's Delhi-Srinagar flight 6E2142. And why not? If the aircraft is being hit by ice balls from all over and is descending at 8,500 feet per minute, we can only imagine the state of the crew as well as the passengers during those moments. The incident occurred on Wednesday, 21st May. It was all normal when the flight took off from Delhi at around 5 p.m. Problem started after a few minutes into the journey when the aircraft, cruising at 36,000 feet, entered hailstorm and severe turbulence near Pathankot. Now, according to what the pilots have told the Directorate General of Civil Aviation, they requested the Indian Air Force for permission to deviate towards the left, which is the international border, but IAF did not allow the flight to do that. Remember, Pakistan has closed its airspace for Indian carriers, and IAF's denial could be based on the airspace restrictions to avoid any potential adverse action by Pakistan. Then the pilots directly contacted Lahore ATC to enter into their airspace to avoid the weather, but they were not allowed to enter by the ATC authorities in Lahore as well. The statement further states that the crew initially attempted to return to Delhi, but as they were close to the thunderstorm cloud, they decided to penetrate the weather, and subsequently the aircraft was in the middle of hailstorm and severe turbulence. With limited options to navigate in the mountain region, the crew chose to continue to fly through the weather by the shortest route towards Srinagar. The weather was extreme and the aircraft triggered several warnings: angle of attack fault, alternate yaw protection lost, backup speed scale unreliable. These were the warnings triggered by the aircraft system. Due to the upward and downward movement of the wind, the aircraft lost the autopilot control as the wind speed had steep variations. During this period, the aircraft descended at 8,500 feet per minute, much higher than the typical descending rate